Hello, my dear CA Inter students. Hope all of you are doing very well. Let's start CA Inter Advanced Accounting Revision Marathon for September 2025 attempt. Those who are planning to write January 2026 attempt also, they can use this revision marathon, sir. See, I have planned this revision marathon in two parts, sir. Now I am releasing part number 1. This part number 1 covers approximately 70 to 75 marks from examination, sir. In this part number 1, sir, I have covered the following chapters: Financial Statements of Company Schedule 3, Cashflow Statement Accounting Standard 3, Buyback of Securities, Amalgamation of Companies AS 14, Internal Reconstruction, Consolidation AS 21, 23 in Consolidation. See, all these chapters together will give you 70 to 75 marks, which is the major part. So this part number 1 is very, very important from examination point of view. Now, in this revision marathon, sir, I have given both the conceptual explanation, the theory explanation for every concept, as well as I have solved few important questions, sir, to give you the confidence, to give you the practical insights relating to every important concept. And also, sir, I have covered all the key adjustments, journal entries, the formats, wherever they are. And I have covered each chapter in a reasonable period of time, but very comprehensive, concise, which allows you to do multiple revisions in a shortest possible time, so that you can concentrate your time on solving, practicing the other questions and difficult subjects. And all the material, whatever I have used in this marathon, the concept book, question bank, supplementary material, everything is freely available from Strata website, free resources. You can go there, you can see free resources. There you will find all the resources, whatever the notes I have given in the classroom, whatever the materials I'm using, everything is available. You can download and you can use them. And of course, description link will be given below the video. So don't worry. So you can click on this description link, you will get there and you can download. And it is a sincere effort from my side to help you all to succeed in your examinations. Hope you all like it. All the very best. Let's begin the revision marathon for September 2025. Hello, my dear students. Hope all of you are good, doing fine. The chapter for our discussion is Preparation of Financial Statements of Companies. The format for preparation of balance sheet and P&L account of a company as per Schedule 3 is the main part of this chapter, sir. Every student should have the basic idea about the format, how the balance sheet format will be, how the P&L account format will be according to Schedule 3 in case of a company. So that is the main concentration in this chapter, sir. You have to revise these formats number of times so that it will fit into your mind. And in examination, sir, they may ask a direct 14 marks question from this chapter, sir. They will give you the trial balance and some adjustment relating to a company, and they will ask you to prepare balance sheet and P&L account. Or else, sir, in chapters like Amalgamation, Internal Reconstruction, Buyback, so they will ask you to prepare the balance sheet after buyback, after amalgamation, after internal reconstruction. So there also you need to apply this Schedule 3 balance sheet P&L account format for preparation of financial statements. So the knowledge of this chapter will help you in so many other chapters also. So that's why this is very important chapters. You have to revise these formats number of times. That's the main thing here. Now let us start discussing this chapter, sir. So first we are going to start with the maintenance of books of accounts. See, there is one section in Companies Act, section 128, which says every company without any exception, for every financial year, they need to maintain books of accounts, other relevant papers and documents, and financial statements for every financial year at their registered office. So it is the responsibility of the company. Every year, they need to maintain proper books of accounts. They need to maintain the documents, papers, and also they need to prepare financial statements for every financial year. And when they are maintaining these books of accounts, they need to follow accrual basis double entry system of accounting. And these books, everything will be preserved at least for 8 financial years, and they will be kept at registered office. So the bottom line is what? The responsibility is on the company board of directors to make sure that they maintain proper books and prepare financial statements for every financial year. And it is the responsibility of the board of directors, sir. They need to lay down these prepared financial statements in the annual general meeting before the shareholders. And sir, basically, what is these financial statements? Companies Act defines financial statements as balance sheet at the year end, P&L account if you are a commercial organization. If you are a non-profit oriented organization, in place of P&L, we are going to prepare income and expenditure account, and also cash flow statement for the year, and also statement showing changes in equity if applicable. Generally for a listed company, they need to prepare statement showing changes in equity, and any explanatory note incorporated in any document. That means the notes to accounts forming part of the above. So therefore, balance sheet, P&L account, cash flow statement, statement showing changes in equity, and explanatory note. And if you are a small company, dormant company, private startup companies, for you cash flow statement is not required. This point will come in cash flow statement chapter also. And see, okay, sir, I'm a company in India. I want to prepare my financial statements. So first you have to see whether you are an insurance company, banking company, electricity company. Because if you are an insurance, banking, electricity company, you have separate acts. Now in those acts, if there is a separate format for preparation of financial statements, I need to prepare the financial statements by using those formats. Suppose if I am not a insurance company, banking company, electricity company, or even if I am any one of these companies, but in the respect to act there is no format, then I have to follow schedule 3 only. So schedule 3 for rest of the companies. And if you look at the schedule 3 of the Companies Act, we have divisions: division 1, division 2, division 3. Division 1 is for companies who is following normal accounting standards. Division 2 is companies who need to follow Indian accounting standards. And division 3, NBFCs who is required to apply Indian accounting standards. Of course, you know, in CA Inter, we have only normal accounting standards. We don't have Ind AS. Therefore, division 1 is only applicable for us. And one important point, sir, when you are preparing the financial statements of company, you should keep in certain things. 4 things, sir. First, you need to keep in mind the requirements of schedule 3. Schedule 3 is the main thing, sir. Schedule 3 has provided the format, how different items will be presented, what kind of information we need to present in respect of each item. That you need to keep in mind. And also other statute requirements. See, along with the Companies Act Schedule 3, any other provisions from the respective act or from different act, that you need to follow. And also you need to follow the accounting standards, which is prescribed by MCA and notified by MCA, and then statements and guidance note given by ICA. If you observe, sir, in your syllabus we have accounting standards as well as schedule 3 completely. Of course, other statute requirements and the guidance note given by ICA is not there, but we have all the standards in our syllabus. So therefore, ultimately you need to understand that the knowledge of the standards, the principles, the disclosure requirements, whatever provided in the accounting standards is ultimately will help you to prepare the financial statements better, right? So these are the things you should keep in mind when you are preparing the financial statements of a company. Now, the most important thing is the format. So as I told you, according to schedule 3, there is a format they have given for balance sheet, part 1, balance sheet format, then part 2, P&L account format. Now concentrate on the format alone, how different items will be presented. You have to revise, mug up these formats. First, name of the company, then balance sheet as it. You know, particulars, note number, current year figures, previous year figures. When you are preparing the solution, generally last year figures is not available, sir, so you can ignore this. So particulars, note number, current year figures. Now you see, balance sheet is divided into 2 parts. First part is equity and liabilities. First part is equity and liabilities. Second part is assets parts. Assets. In equity and liabilities, we have 4 heads. In assets, we have 2 heads. So what are the 4 heads in equity and liabilities? Shareholders funds, share application money pending allotment, and then liabilities. When it comes to liabilities, non-current, current liabilities. So 4 major heads in equity and liability side: shareholders funds, share application money pending allotment, non-current liabilities, current liabilities. When it comes to assets, only 2: non-current assets, current assets. So according to schedule 3, sir, according to schedule 3, the liabilities are classified into 2 categories, the assets are classified into 2 categories: current, non-current. Now come to the equity and liability side. In shareholders funds, we have 3 items: share capital, reserves and surplus, money received against share warrant. Share capital, reserves and surplus, money received against share warrant. And share application money pending allotment, there is no breakup. Next, non-current liabilities. In non-current liabilities, long-term borrowings, deferred tax liabilities net, other long-term liabilities, long-term provisions. 4 items will come. And when it comes to short-term borrowing, current liabilities, we have short-term borrowings, trade payables, other current liabilities, short-term provisions. Okay. See, these things will come only when you revise number of times. Don't expect that first time it's alone you try to remember. No, you have to repeat. So therefore, equity and liabilities. In equity and liabilities, first one, shareholders funds. In that, A, share capital, B, reserves and surplus, C, money received against share warrant. Second, share application money pending allotment. Third, non-current liabilities. In non-current liabilities, long-term borrowings, deferred tax liabilities net, other long-term liabilities, long-term provisions. Now come to current liabilities. In current liabilities, short-term borrowings, and then we have trade payables, other current liabilities, short-term provision. Now coming to asset side, sir, we have non-current assets and current assets. So two things, non-current assets as well as current assets. Now see, within these items, we need to present some information, sir. Suppose, for example, relating to share capital, we need to present some information. Reserves and surplus, some information. What information we need to present in respect of the each item, that is also provided in schedule 3, that we are going to discuss. Now coming to asset side, sir, as I told you, non-current assets, current assets. In non-current assets, we have 5 items. 5. What are the 5 items? First, A, in that 4, PPE, intangible assets, capital work in progress, intangible assets under development. That means fixed assets, tangible fixed assets, PP, intangible assets, work in progress, capital work in progress, intangible assets under development. Second, non-current investments, investments of the company is basically an asset, long-term investments, which is called non-current investments, will be shown in non-current assets. And then deferred tax liabilities, then long-term loans and advances, and last one, other non-current assets. Right? Coming to current assets, we have 6 items. Current assets, we have 6. What are those? Simple. In current assets, we have current investments, we have inventories, trade receivables, cash and cash equivalents, short-term loans and advances, other current assets, and then total. So these are the items. These are the items. So first, recollect the entire format. So equity and liabilities. In equity and liabilities, shareholders funds. In shareholders funds, share capital. B, reserves and surplus. C, share application money pending. Money received against share warrant. Second, share application money pending allotment. Third, non-current liabilities. In non-current liabilities, long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. Now current liabilities. In current liabilities, we have short-term borrowings, trade payables, other current liabilities, short-term provisions. Now coming to assets, non-current assets. In that, A, in that 1, PP, 2, intangible assets. Third, capital work in progress. Fourth, intangible assets under development. Next, B. B is what? Non-current investments. Next, deferred tax assets. Next, long-term loans and advances. Next, other non-current assets. Now come to current assets. Current assets, we have 6. First, current investments. Second, inventories. B, inventories. C, trade receivables. Fourth, cash and cash equivalents. D. Next, short-term loans and advances. And last one, other current assets. Now, sir, we have classified the assets and liabilities into 2 categories, current, non-current. Sir, what is the basis for this classification, sir? On what basis you have classified this? Okay. Now, let us see first liabilities. Liabilities are basically classified into 2 categories, right? Current liabilities, non-current liabilities. When we say a liability is a current liability, see, in schedule 3, we have 4 criteria, sir. If any one of these criteria is met, that liability is called current liability. Otherwise, it is a non-current liability. So a liability is said to be current if it satisfies any one of the following. What are those? First, which is expected to be settled within the normal operating cycle and which is held primarily for the purpose of trading, and any liability due to be settled within 12 months after the reporting date. And the last one, there is no unconditional right to defer the settlement of liability for at least 12 months after the reporting date. So these are the 4 criteria. So first criteria to become current liability is what? That liability is expected to be settled in the company's normal operating cycle. Sir, what is this company's normal operating cycle? See, normal operating cycle means how much time it has taken to convert the raw material into cash or cash equivalents. So the time between the acquisition of assets for processing, and their realization in cash or cash equivalents is called what? Operating cycle. So generally, if you can able to determine, you can. If you are unable to determine, assume it as 12 months. 12 months. So for example, you see, so there is a company. Suppose, look at this cycle, sir. Raw material, it will become work in progress. Once you put into the production, it will become finished goods, debtors, and then cash. How much time it has taken to complete this circle? That is called operating cycle, normal operating cycle. Any liability which you are expecting to settle within this cycle will become current liability. For example, there is a bakery, A to B bakeries. So, you know, in bakery, they will prepare cakes, pastries, different kinds of bread items, right? First, they will purchase all the food ingredients, food grains, raw material, and they start producing the items. So they will convert this raw material into finished goods, different kind of food items. So it will take 2 days for them. Now, once the items are ready, cakes, pastries, everything is ready. Suppose to sell all of them, it takes 2 days time. So 2 days. So therefore, to convert the raw material into cash, how many days it has taken? 4 days. So any liability which they are expecting to settle within this 4 days generally will become a current liability. So this is the first case. Okay. So next, held primarily for trading. Sir, any liability held primarily for the purpose of trading. So trading means what, sir? Like derivative contracts, options, so futures, any financial assets which is held by the organization. And in respect of these financial assets, these contracts, optional contracts, derivative contracts, future contracts, any liability arises, that is also a current liability. Okay. Understand, here these things are entered by the company primarily for the purpose of trading. And the last, third one is what? Any liability due to be settled within 12 months after the reporting date. For example, the company, they have taken a loan, sir. In respect of that loan, so they need to pay this loan. 10 lakhs loan they have taken. Out of this 10 lakh, 1 lakh they need to pay in the next 12 months as an installment. So that will obviously become what? Current liability, which is due to be settled within 12 months after the reporting date. And the last one, the most important one, is no unconditional right to defer the settlement of liability for at least 12 months after the reporting date. Sir, what is this? No unconditional right to defer the settlement of liability. Defer the settlement. Defer means postponement of settlement of a liability for at least 12 months. No unconditional right. What is unconditional right? See, if without consulting anybody, if I can able to take any decision on my own, that is called unconditional right. But here company does not have this unconditional right. That's why the sentence starts with what? No unconditional right. For what? To defer the settlement of liability for at least 12 months after the reporting date. That means if as a company, I don't have the right on my own to defer the settlement of any liability for at least 12 months after the reporting date, obviously that liability has to be classified as current liability. Because if I don't have the unconditional right to defer it for at least 12 months, means I have to settle within 12 months. And one more point they're saying is that even if the terms of liability provides an option to the holder that the settlement can be done by equity, that doesn't affect the classification. That means sometimes instead of cash, we already entered an agreement with other party that we will going to issue the shares. Whether you are going to pay the cash or shares doesn't make any difference. Still, it will be classified as current liability only. I will give you best example, sir. For example, convertible bonds. See, I think way back they have asked one question relating to it. Suppose a company issued a convertible bonds, sir, and these bonds are going to be settled in the next 12 months. Now tell me, without consulting the bondholders, can company on its own defer the settlement of these bonds for at least 12 months? No. That means they have to settle these bonds within the next 12 months as per the agreement between the parties. And suppose these are convertible bonds. That means some of the holders, bondholders, may exercise the option of cash. Some of the holders may exercise the option of shares. So even if the terms of the liability provide an option to the bondholder that if you want, you can take a shares, it doesn't make any difference in the classification of liability. So the terms of the liability provide an option to the holder to take shares for settlement of liability could not affect the classification of liability. So when we say liability is a current liability, first thing is it is expected to be, not due to be settled, which is expected to be settled within the company's normal operating cycle, and which is held for the purpose of trading, and which is due to be settled within 12 months after the reporting date, and no unconditional right to defer the settlement of liability for at least 12 months after the reporting date. And even if the terms of the liability provide an option to the bondholder or holder that he can take shares, doesn't make any difference. Any loans repayable on demand is also best example for what current this last point. Loans repayable on demand means whenever the other party demanded, we have to pay it, right? So therefore, you don't have the unconditional right to defer the settlement of liability for at least 12 months. So on your own, can you take a decision? I will postpone this liability settlement after 12 months. No, you can't. Therefore, it's a current liability. All other liabilities will be non-current liabilities. Now, similarly, come to assets, sir. Sir, when we say an asset is a current asset, same. Like liabilities, sir, for assets also, they have given 4 criteria. If any one of the criteria satisfies, that is current asset. First, any asset expected to be realized or consumed in the company's normal operating cycle. What is normal operating cycle? We have discussed. So anything we are consuming, anything we are expecting to realize within this normal operating cycle. Suppose we calculated a normal operating cycle of a company. It came to 6 months. So within that 6 months, if any asset anything we are going to expect it to realize or consume in the company's normal operating cycle, that is definitely will be classified as what? Current assets. Held for primarily for trading. Any financial assets, any investments made in options or derivatives or futures, so that will be classified as what? Current assets. But understand, it is held primarily for the purpose of trading. And also anything which is expected to be realized within 12 months after the reporting date. So from this balance sheet date to the next balance sheet date, this much amount I am going to receive from the other party. Obviously it will become a current assets. And cash and cash equivalents. Generally cash and cash equivalents is always what? Current assets. Unless there is a restriction being used for at least 12 months after the reporting date. Suppose if there are any restrictions relating to cash and cash equivalents that it cannot be used for the next 12 months, then it cannot be classified as current assets, because the primary nature of the cash and cash equivalents is it must be usable. So if it is not usable, if there are any restrictions, then it cannot be classified as current asset. Okay, so this is the classification criteria, sir. Now try to understand, sir. We have discussed the format, right? In format we have different items. First you take equity and liabilities, in that shareholders funds, in that share capital. So relating to share capital, what items I need to present? As I told you, in respect of each items, we need to prepare notes to accounts. In the notes to accounts, we need to present the information. Which information? The information which is required as per schedule 3. When it comes to share capital, what is the important information you need to present, sir? Always try to present the authorized capital, issued, subscribed, paid up capital. Sometimes subscribed but not fully paid, you have to present it separately. And what is the nominal value of share? Present it. And also try to prepare a summary of shares outstanding at the beginning and at the end. And also, who are the shareholders owning more than 5% shares? With the shareholding numbers and names you present. And also the most important point is this. If company has issued any shares without payment being received in cash, and if shares are issued by way of fully paid bonus shares, and the last one is buyback. See, if any one of these 3 things happen in the company, we need to present the aggregate number class of shares, aggregate number class of shares, aggregate number class of shares. Remember, they may ask a question. So if company issued shares for consideration other than cash, if company issued fully paid bonus shares, if company bought back any shares, then we need to mention in the notes to accounts how many number of shares, what is the class of shares for a period of 5 years. We need to mention this. And if you have any forfeited shares, in respect of the forfeited shares, what is the amount we paid? That is also we need to discuss. Okay, remaining and all theory points, but the important points, these are all. Next, in shareholders funds, share capital over. Next one, reserves and surplus. Important, sir. Sir, here when you are presenting share capital, sir, understand, sir. In the balance sheet total purpose, we will show paid up share capital. Okay, paid up share capital is the important thing for us. That is what we are going to present actually. So sometimes they won't give you paid up share capital. So first you take called up share capital, and from that calls in arrears you reduce. Calls in arrears. Then you will get the paid up share capital. Okay. Now important. But authorized capital, issued, subscribed, all these are what? Presentation purpose. If they have given in the question, you have to present it. That is what schedule 3 says. The schedule 3 is all about disclosing the information, needed information. And then come to reserves and surplus, sir. In reserves and surplus, all kinds of reserves we have to present, sir. All kinds of reserves. Including this reserve called share option outstanding account, which will come in ESOP chapter. Employee stock option, which is not there in your syllabus. But understand, majority of the students, what they're thinking is when they look at the share options outstanding account, the moment they see outstanding, it is a liability, they think. No. Here share option outstanding account, that means in respect of ESOP plan, whatever the share option outstanding arises, it is also part of reserves and surplus. Debenture redemption reserve, securities premium, CRR, capital reserves, all these things we need to present. Revaluation reserve, any kind of reserve, including P&L account, sir, including P&L account. Suppose P&L account, we have a debit balance where we need to present reserves and surplus only with a negative symbol. So you cannot present it on the asset side. Even if P&L account is having a debit balance, it will be shown as a negative figure under the head surplus. I mean, surplus means P&L account balance, nothing but. Because of the P&L account negative balance, the entire reserves and surplus may become negative, no problem. Okay, the total reserves and surplus after adjusting any negative surplus may show a negative balance also, not a problem, sir. Actually, we have one practical question also. I will show you. In the financial statements of company chapter, yeah, see this schedule 3. There is a company Futura Limited, sir. This company reserves and surplus head given, securities premium, capital reserve, general reserve they have given, sir. And this company had an accumulated loss of 250 lakhs on the same date. That means P&L account debit balance, which it has disclosed under that statement of P&L as asset in its balance sheet. See this. So instead of showing it on the liability side reserve, sir, where they have shown this P&L account debit balance asset side, comment on the accuracy of this treatment. This treatment is wrong, sir. Schedule 3 says P&L account debit balance will be shown under the head reserves and surplus with a negative figure. Even though the total reserves may become negative, still it has to be presented on the liability side reserves, equity and liability side reserves. So therefore, whatever the company has done, this is not correct. Presentation by the company is incorrect. And also one more important point, sir. See, just now we have seen, suppose there is a company, sir, Alpha Limited. In the year 11-12, this company has given 24,000 equity shares of 10 each as fully paid bonus shares. Bonus shares they have given 24,000 bonus shares. And in the notes to accounts, the source they have not mentioned. Is non-disclosure of the source is a violation of Schedule 3? Now, just now we have seen, sir, in Schedule 3, relating to share capital, is there any way they have mentioned that we need to mention the source in case of bonus issue? No. But they told if any company issued a fully paid bonus shares, they need to mention what? Aggregate number class of shares. We are not required to present source. If you present, that's fine. But it is not a violation of Schedule 3. Because as per Schedule 3, it is not mandatory. So therefore, in this case, okay, majority of the students, they don't know what is there in Schedule 3. They don't read notes to accounts. So what they will feel is, whenever they will ask a question, company issued bonus shares, they have not mentioned the source, they feel, oh, this is not correct, they have to mention the source. Like that, they will write the answers by their emotions rather than understanding the concept. So here there is no violation. Schedule 3 does not require the company to disclose the source from which shares have been issued. Therefore, non-disclosure of the source from which bonus shares have been issued is not violation of Schedule 3. So these are the points. Now next, relating to other items, sir. So we have completed share capital as well as reserves and surplus. Next to long-term borrowings. Where long-term borrowings will come? Long-term borrowings will come in non-current liabilities. Generally, long-term borrowings means what? Bonds or debentures issued by the company, term loans from banks, from other parties. Generally, term loan means for a period of more than 1 year, 4 years, 5 years, 7 years, like that. Any deferred payment liabilities. What is deferred payment liability? Any liability which is to be settled over a period of time. Okay, it's called deferred payment liability. Any deposits accepted by the company for the long period, any loans and advances from related parties, any long-term maturities of finance lease obligation. See, when a company entered a finance lease, as per accounting standard 19, leases are basically two types, operating, finance lease. When a company entered a finance lease, in respect of this lease, what are the liabilities the company is going to pay? What is the liability of the company? That will also comes under the long-term borrowings. Remember all these things, important thing. So long-term borrowings comes under what items generally will come? Bonds or debentures, term loans from banks and other parties. When you see term loan, you have to classify under long-term borrowings. Deferred payment liability, deposits, loans and advances from related parties, long-term maturities of finance lease obligation, other loans and advances. See, I will give you one example for deferred payment liabilities. Deferred payment liability, I will give you. Yeah, suppose for example, Ours is an XYZ company, sir. GST department is there. Suppose we are not paying GST, and one fine day we have received a notice from the department saying that your GST liability is 50 crores. You have not paid till so far. So we went to the higher authorities, but we lost the case. Now we need to pay 50 crores along with the interest and everything. Now GST department said, you do one thing, paying these 50 crores is very difficult for you at a time. So we are giving you time of next 10 years. Hypothetically, we are giving you the time of next 10 years. So what you do is this 50 crores you pay over a period of 10 years. Now, can you tell me this GST liability is what? They are going to settle within a period of 10 years. So can I say this is called deferred payment liability? Yes, these kind of liabilities which is going to be settled over a period of time can be classified as deferred payment liabilities. Next, as per schedule 3, when you are presenting the borrowings, sir, liabilities, classify them as secured, unsecured. So if any asset is given as security for that particular liability, secured, otherwise it is unsecured. So borrowing shall be classified as secured, unsecured. And remember guys, if they are secured, you need to present the nature of the security. I think in study material we have one of the questions, sir. In that question, that company has taken a loan, and I think loan from State Financial Corporation they have taken, and they have given plant and machinery, hypothecation. So that means they are secured, and in that case, as per schedule 3, you need to present the nature of security. So therefore, in the notes to accounts below the loan, you have to clearly write that it is secured by plant and machinery, it is secured by buildings, like that. Okay. So these are the details. So mostly understand the borrowings are classified as secured and unsecured, and in case of secured, you need to mention the nature of security. If any loans and guaranteed by directors and others, we need to clearly mention how much amount they have given a guarantee, and all other details relating to loans also we need to mention, like what is the interest rate, redemption, conversion details, list of latest date first, if paid in installment, use the first payment date as a maturity date. So any other terms relating to term loans we need to mention, and if there is a default in respect of the loan, what is the, for how much period there is a default, how much amount is in default, all these things we need to present. And next, other long-term liabilities. These other long-term liabilities also comes in long-term borrowings, right? So generally what items will come in other long-term liabilities? Trade payables, others. Generally trade payables, sir, will come in current liabilities. But if any trade payables is not fit into other current liabilities, then they have to fit into the long-term non-current liabilities. In non-current liabilities, other long-term liabilities. And then long-term provisions. So provisions, so see, generally important thing in respect of provisions, sir, when you are presenting information relating to provisions, understand. Basically, AS 29 talks about provisions. See, basically what is provision? Provision is a liability which can be measured by substantial degree of estimation. So when you are preparing the balance sheet of a company, sir, in the liability side, you see, in non-current liabilities, you are seeing long-term provisions. In current liabilities, you are seeing short-term provisions. Those provisions are relating to liabilities, sir. Those provisions are relating to liabilities. Any provision created against asset, they will not be shown on the liability side, sir. They will be shown as a reduction from the particular asset. Like for example, provision for doubtful debts, provision for depreciation. These are provisions relating to assets. So they will be shown by way of deducting from that particular assets. Okay. See this, provision for doubtful debts, provision for depreciation, provision for diminution in the value of investments. These are provision created against assets. So they will be shown by way of reduction from the particular assets on the liability, not on the liability side. Please understand. Most of the students thinking the moment they see provision, so why can't I show is on the liability side as a long-term provision, short-term provisions? No, the long-term provision, the short-term provisions which you are appearing in the liability side is they are talking about liabilities provisions as per AS 29. Basically, provision means a liability like provision for warranty, provision for tax, provision for gratuity, provision for employee benefits, all these things. So that's why you see provision for employee benefits, any other provisions come here. If the provision is for to settle a liability of long-term nature, then they will be classified here. Next, coming to current liabilities, we have short-term borrowings, right? Short-term borrowings, what items will come? Any loans repayable on demand. When other party demanded, I have to pay it from banks, from other parties. Any loans and advances from related parties, deposits, other loans and deposits, they will come. Similar to long-term borrowings, even short-term borrowings also classified as secured, unsecured. If they are secured, nature of security must be mentioned. And if they are guaranteed by directors, how much amount they have given a guarantee. If there is any default in the loan payment, what period, how much amount, along with the interest we need to mention. And the most important thing is current maturities of long-term borrowings has to be shown under the heading short-term borrowings. Current maturities of long-term borrowings. Sir, what is this current maturities of long-term borrowings? I will tell you. Current maturities of long-term borrowings. Okay. For example, sir, current maturities of long-term borrowings. Suppose there is a long-term borrowings. In respect of those long-term borrowings, any amount due to be settled in the next 12 months will become current maturities of long-term borrowings, which will be shown under the short-term borrowings. For example, we have taken a bank loan. Now, bank loan is basically taken for 5 years. So, which is basically what? Long-term borrowings, right? Under non-current liabilities. Now, in respect of this bank loan, suppose the next 12 months, 2 installments become due. Suppose we are paying installments every 6 months. So, 2 installments become due. So, the amount which going to be due in the next 12 months, that is 2 installments, will be shown as current maturities of long-term borrowings under short-term borrowings. See this. So, see this. So, basically bonds and debentures, long-term borrowings are? Yes. If they become due for payment in the next 12 months, then they will be classified as short-term borrowings, that is current maturities of long-term borrowing. Suppose, for example, we have issued 12% debentures, 100 lakhs, sir. For 5 years, suppose, let us say we have issued for 5 years these bonds. Now, on 1/4/2024, they will be classified as non-current liability, 100 lakhs. Second year also, third year also, fourth year also. Coming to fourth year end, we know these debentures are going to be settled in the next 12 months. So, automatically short-term borrowings, current maturities of long-term borrowings, they will be classified. So, basically any liability of long-term nature, if it is going to be settled in the next 12 months, that is called current maturities of long-term borrowings, that will be shown as short-term borrowings. Next, other current liabilities, residual items. Basically, it is a current liability in that others, like current maturities of finance lease obligation. Important, sir. Sir, long-term maturities of finance lease obligation, long-term borrowings. Current maturities of finance lease obligation, other current liabilities. Interest accrued but not due. Interest accrued and due. Any income received in advance. Unpaid dividends. Any application money received for allotment of securities and due for refund. Generally, suppose a company issued a shares, we have received application money, but at the end of the year, allotment not done. When allotment not done, we need to refund the amount. So, if any amount is refundable to the shareholders, so in respect of that amount, it will be shown as other current liability, including interest. Any unpaid mature deposits and interest accrued thereon. Any unpaid mature debentures and interest accrued thereon. See, unpaid mature deposits. Already deposits was matured, maturity date came, but we have not paid the amount, including interest. Similarly for debentures and any other payables. Okay. So understand other current liabilities, what items will come. Then short-term provisions, provision for employee benefits, others. Now coming to assets, sir, property, plant, equipment. Generally all tangible assets like land, buildings, property, plant, equipment, furniture and fixtures, vehicles, office equipment, others we have to show. Sometimes we will take the assets on lease basis. So those leased assets we need to show separately. And in the notes to accounts, we need to prepare generally a reconciliation statement. Like for example, we will show what a gross and net carrying amounts of each assets at the beginning and at the end, including the details of what are the additions happened, disposals happened, business combination acquisition like amalgamation, how much assets came, revaluation changes if they are 10% or more of the net carrying value, other adjustments, and also related depreciation and impairment losses reversals we need to show. When it comes to intangible assets, goodwill, trademarks, computer software, mastheads, publishing titles, mining rights, all these things we have to show. Similar to PPE, we need to prepare a reconciliation statement also. Next, non-current investments. See, basically investments are two types, current and non-current. Current means short term, within 12 months. If you want to sell it in the next 12 months, that is current investments. Long term means more than 12 months, right? So Schedule 3 uses the word non-current, not long term. If you see Accounting Standard 13, they have classified current to long term. But here they are using the word non-current investments, kind of a long-term investments. So generally in non-current investments, we have to show all the investments like investment in investment property, any investment in land and building, okay, for the purpose of earning income, any investment in equity shares, preference shares, government securities, bonds, mutual funds, partnership, all these things we need to mention. And also whenever we invest in any corporate body like companies, we need to mention what is the name, relationship type, is it our subsidiary, associate, joint venture, what is the nature of amount, separate details for if it is partly paid, all these details we need to mention. And also if you invest in a partnership firm's name names of all partners, total capital, each partner, all these details we have to mention. And also what is the aggregate number of quoted investments, market value, unquoted investments, what is the diminution in the value of investments. And then similarly, long-term loans and advances. Long-term loans and advances means asset, it is also any loans and advances given by the company. These are generally classified as capital advances, loans and advances to related parties, others. So what is this capital advances? Any advance which is given for acquisition of any fixed asset, tangible fixed asset, basically is called capital advances. And these loans and advances, which is long-term loans and advances, which is given by the company, are basically classified into three categories, sir. Secured good, unsecured good, doubtful. Okay, secured considered good, unsecured considered good, doubtful. We have to classify like this. So secured means any asset we have taken as a security and recovery is possible. Unsecured means no asset is taken, but customer will make the payment, no doubt. Okay. Doubtful means we have a doubt whether amount will be collected or not. And also any loans and advances owed by directors and officers, try to present them separately. Other non-current assets, what items will come? Long-term trade receivables. Basically trade receivables comes under current assets, but long-term trade receivables, if any trade receivables, if it is not fit in current assets, they will come in other non-current assets. Any kind of security deposits made by the company. And similar to long-term loans and advances, even other non-current assets, company have to classify as secured considered good, unsecured considered good, doubtful. And current investments, classify them. What are the investments you made in the current investments category? And you try to mention the name of the companies. If they are partly paid up, separately mention what is the basis of valuation, quoted investments, how much, unquoted, how much, any provision for reduction in the value of investments. If you make investment in partnership firm, the details of the partnership firm, partners, all these details. And next one is inventories. So raw materials, work in progress, finished goods, any goods which is acquired for trading, like stock in trade, stores, spares, loose tools, all these things. If any goods in transits, present separately. And you also mention what is the mode of valuation of inventories as per as to cost or market value, whichever is lower. And then relating to trade receivables debtors, try to prepare a aging schedule. So aging schedule, when you are preparing an aging schedule, so the time limits is less than 6 months outstanding, 6 months to 1 year, 1 to 2, 2 to 3, more than 3 years. And also when you are preparing aging schedule, the debtors have to be classified like this: undisputed trade receivable but considered good, undisputed but doubtful, disputed but considered good, disputed, doubtful. So like this you have to classify, sir. And coming to cash and cash equivalents, sir, what is the cash balance with banks, checks, drafts, cash on hand, others. Earmarked balances with banks. So in the bank account, if for any specific purpose, if the amount is saved, so that is called earmarked balance, that you have to mention. And also if any amount held as a margin money as a security in the bank, suppose when you take any borrowings, guarantees from the bank, you deposit some amount, you secure, that amount is called margin money or security money, that amount. And also repatriation restrictions. See, if you have any bank balance in the foreign countries, now relating to the repatriation, bringing that amount to India, if there are any exchange regulations, restrictions are there, those restrictions you mention. Okay. And if bank deposits is maturity is greater than 12 months, if any bank deposits is there with a maturity period of more than 12 months, you try to mention them separately. And finally, short-term loans and advances, like loans and advances to related parties, others, like long-term loans and advances, other non-current assets. For this short-term loans and advances also, you make a classification: secured considered good, unsecured considered good, doubtful. Okay. And finally, other current assets, the residual category. So that's it. Next, contingent liabilities and commitments. Sir, basically what is this contingent liability? Contingent liability can be defined in two ways, sir. One is a liability which may come in future. Whether it will come or not depends upon the future events, which is not in our control. A liability may come or may not come, we don't know. Those are called contingent liability. So contingent liability, we are going to discuss in accounting standard 29, actually, contingent liability. So basically, to become a liability, what are the qualities it should have? There must be a present obligation from the past event, and to settle this obligation, there must be an outflow of resources. So if any one of these things are missing, that is basically contingent liability. Suppose there is no present obligation, that is not a liability. So that's a contingent liability. There is a present obligation, but there is no probable outflow of resources as of now. That is also contingent liability. So if you have any contingent liabilities, generally, contingent liabilities we don't present in the balance sheet. We will show in the notes to accounts, right? Like for example, any claims against the company not acknowledged as debt, any guarantees given by the company. So other money for which the company is contingent liability. For example, guarantee. Suppose you are a parent company, you have given a guarantee on behalf of subsidiary to the bank. Your subsidiary company has taken a bank loan. On behalf of subsidiary, you have given a guarantee. Now, if the subsidiary could not pay, you have to make the payment of that amount. So whether the liability will come or not, that depends upon future events. If the subsidiary paying the amount, I am not liable. If the subsidiary doesn't pay, I need to pay the amount. So that is called contingent liability. If any contingent liabilities are there, please present them in the notes to accounts. And also commitment. See, what is this commitment, sir? Sir, company committed something for future. Suppose company wants to invest in any asset. Company wants to make any investment in future. Company wants to spend some amount for capital expansion. These are called commitments. See, these are not yet done. They are going to be done in future. They are going to be executed in future. So those are called commitments. So basically these commitments will not become our assets as of now. When actual investment is made, when actual amount is spent, they may become investments. So now they are only part of notes to accounts. They are not part of the balance sheet because they have not become any assets. Like for example, estimated amount of contracts on capital account remaining to be executed and not provided. Suppose a company wants to start a plant and machinery. The estimated amount to be spent is 50 crores. So till now, out of these 50 crores, suppose only 20 crores spent, remaining 30 crores, this is not yet spent now. So that is called estimated amount of contracts on capital account remaining to be executed. So that is commitment, not at investment or asset for us. So if these kind of commitments if at all there for the company, you present it. And also any uncalled liability on partly paid shares for shares and other investments partly paid. See, this is one of the most doubting area for the students, sir. Please understand, sir. The moment students seeing this uncalled liability on partly paid shares for shares and other investments partly paid, they are saying this calls in arrears. No, sir. Please read carefully, sir. What is this? Uncalled liability on partly paid shares for shares and other investments. So as a company, I am making investment in other entities. In respect of those investments, I paid only part of the amount because the company where I invested, if they call the remaining amount, I will pay. As of now, they are partly paid. Suppose, for example, we purchased debentures of other company and the value of debentures we purchased is 10 crores. Now, till now, that company has called only 6 crores. We paid 6 crores. Remaining 4 crores is what? When they call, we will pay. So, as of now, they are partly paid. So, in future, if they call, I need to pay 4 crores now. Then it will become an asset. So, as of now, this 4 crores is a commitment because I have made an investment. I promised to the other company, I agreed to the other company that I will make the total investment. Similarly, if my company purchased shares of other company, now when I make an investment in the shares, whenever they call, I need to make the payment now. Suppose as of now, these shares are partly paid. The remaining amount when they call, I need to pay. So that is called uncalled liability on partly paid up shares and other investments. See carefully, they may ask a question, 4 marks question. They will give you small items and asks you where you need to present all these things. So any uncalled liability on shares, on partly paid up shares or other investments, generally they have to be shown as commitments. Okay. So this is the entire balance sheet and different items, sir. Now coming to P&L account, sir. Very simple. You know, P&L account is prepared for the year. Right? Name of the company, P&L account for the year. So like balance sheet, particulars, note number, current year figures, last year figures. And when it comes to P&L account, you know, incomes and expenses. First take incomes, revenue from operations, other income, then total income. Coming to expenses, first 3 items relating to stock. Cost of materials consumed, purchase of stock in trade, change in inventories of finished goods, work in progress, stock in trade. So relating to stock, 3 items. Cost of materials consumed, purchase of stock in trade, change in inventories of finished goods, work in progress, stock in trade. Employee benefit expenses, finance cost, depreciation and amortization, other expenses, total expenses. Then profit before exceptional extraordinary items, extraordinary items, if they are there, present it. Then you will get profit before tax. Then tax expenses as per age 22, current tax, deferred tax. Then P&L account for the period. And finally EPS, basic and diluted EPS you present. So what is the format for P&L account, sir? First revenue from operations, then other income, then total. Expenses side, cost of materials consumed, purchase of stock in trade, change in inventories of finished goods, work in progress, stock in trade, employee benefit expenses, finance cost, depreciation and amortization, other expenses, total expenses. Now, Sir, relating to the inventory, how I am going to present, I will show you, sir. Inventory. See this. Suppose if I am a manufacturer, sir. Take I am a manufacturer. Okay. So as a manufacturer, I will have raw materials. I have work in progress, finished goods. Now, first take raw material. Opening balance I will have. During there I will purchase raw material and then closing balance. So relating to raw materials, sir, we need to show in P&L account the consumption. So here you are seeing in the P&L account expenses, the first item, cost of materials consumed. This is nothing but raw material consumption. So opening stock plus purchases minus closing. Then you will get the consumption of raw materials consumed during the year. So that you need to show in the P&L account first. Relating to raw material, you need to show what? Consumption. Now coming to work in progress. Work in progress basically means semi-finished goods. Beginning, ending. The difference I need to show. That is called change in inventories of work in progress. Similarly, for finished goods, what is the opening, what is the closing? I need to show the difference. So, see here, change in inventories of finished goods as well as work in progress. So therefore, understand if you are a manufacturer, relating to, you have raw material, work in progress, finished goods. Relating to raw material, you show consumption. Relating to work in progress, finished goods, you show the change, the difference between opening and closing. Suppose the opening stock is 10, closing is 20. So the difference is minus 10. So minus 10 you have to show in the P&L account, change in inventories, because revenues minus expenses. So minus minus plus, this 10 lakhs will be added. Generally, when you prepare the P&L account in T shape, sir, closing stock will be created, opening stock will be debited. The difference is nothing but will be added to our profits if the closing stock is more than opening stock. Similarly here, the difference between opening and closing, since we are not preparing T-shape format, generally directly we will write. So that's why the difference between opening and closing, opening how much, closing how much, the difference can be minus also. So put it as a minus symbol, nothing wrong. So that's what I see. For example, if I show in T-shape trading account, closing balance 20, opening 10. So what's the difference? 10. So but here I'm not preparing a T-shape format. So that's why I will take the change directly. And one more thing is stock in trade, purchase of stock in trade and change in inventories of stock in trade. Sir, what is this stock in trade? See, if I'm a trader, trader means I will purchase and sell. So if I'm a trader, I have what? I have my opening balance of inventory. I have my purchases during the year. I have my closing balance separate. So for example, I'm trading calculators. So what is my opening balance of calculators? How much calculators I purchased during there? What is my closing balance of calculators? So see this. Relating to stock in trade, sir, purchases you show separately. During there, whatever the purchases done by the trader, purchase of stock in trade you show separately. The difference between the opening and closing stock in trade you show separately. So therefore, if you follow me carefully, I think you will understand these points. Think from manufacturer, trader. Manufacturer, raw material, consumption, work in progress, finished goods, change. If I'm a trader, purchase of stock in trade during there separately in the P&L account, change in stock in trade separately. That's it. Okay. So these are P&L account items, sir. Of course, relating to the items like revenue from operations, we need to show separately. If you are a non-finance company, sale of products, sale of services, any grants or donations. If you are a Section 8 company, what are your other operating revenues less excise duty? Excise duty means any duty paid on manufactured items. If you are a finance company, predominantly interest and other finance services is your income. Finance cost means interest, borrowing cost you show. Any gain, net gain or loss on foreign currency transactions. Show other incomes, interest income. If you are a company other than finance company, suppose if you are a finance company, interest will be revenue from operations, not other income. So therefore, depending upon the nature of the company, the revenue classification will be done. Dividend income, any net gain or loss on sale of investments. And see, in the additional information, sir, one important point, this one, sir. So schedule 3 says, sir, any item exceeding 1% of revenue or 1 lakh, any item 1% of revenue or 1 lakh exceeding that limit, disclose it separately, sir. So this is schedule 3 requirement. Okay. Now practical questions, sir. This question, sir. Suppose there is a company Loyal Limited, sir. They are making valuation of work in progress. Their opinion is they want to value the opening and closing work in progress could be more or less the same. So accordingly, the management had not separately disclosed work in progress in its financial statements. Comment in line with Schedule 3. Sir, tell me, work in progress is one of our inventory. According to Schedule 3, how you are going to present this? Tell me. Just now we have finished P&L account. In P&L account, we need to show the change in work in progress. Change means the difference between opening and closing, right? So is it required to show opening work in progress, closing work in progress separately? No. So the opinion of the management is, what they have done is they have not separately disclosed work in progress in its financial statements. Opening how much, closing how much, they have not separately disclosed. And they are also saying that the opening and closing work in progress is more or less the same. That means there is no difference. So therefore, here, is it separately required to present opening and closing? No, because according to Schedule 3, only difference is enough. Second thing, the difference is not material. Therefore, no need to make a disclosure. So therefore, the management contention is absolutely right, sir. See this, Schedule 3 of the Companies Act does not require that company's amount of work in progress at the beginning and at the end of the accounting period to be disclosed in the statement of P&L. Only changes in work in progress need to be disclosed. Non-disclosure of such change in the statement of P&L by the company may not amount to violation. Schedule 3, if the difference between opening and closing work in progress are not material. Okay, that's it, sir. And also one more question, sir. Sumedha Limited, this company has taken 10 lakhs loan, sir, payable in 5 years. 10 equal half yearly installments, sir. That means every 6 months one installment, sir. That means in the next 12 months 2 installments will become due. 2 installments means 10 divided by 10, 2 lakhs. Each installment 1 lakh rupees, sir. First installment is due on 30th 9. Determine how the loan will be classified in the preparation of financial statements as on 31st March 2011. See, suppose on 31st March 2011, this company is preparing financial statements, sir. Simple. From this 31st March 2011 to next 30th September 2012, next 31st March 2013. So in the next 12 months, how many installments become due? 2 installments. 2 into 1 lakh. How much? 2 lakhs. So therefore, 2 lakhs will be what? Current maturities of long-term borrowings. So it will be shown as short-term borrowings. Remaining 8 lakhs long-term borrowings. They have to classify. So therefore, you see, in the balance sheet, as on 31st March 2011, 8 lakhs, 8 installments will be shown under the heading long-term borrowings. And 2 lakhs will be shown under the head short-term borrowings. Okay, that's it. And so we completed the balance sheet and P&L account and some practical questions also. Now there is one more concept, sir, dividend concept in this chapter. See, in this dividend concept, sir, very simple concept, sir. They are going to ask one question, sir. Whenever a company wants to declare a dividend, suppose in the current year they don't have profits. Even if they have profits, they are not sufficient. Then they are depending upon the past profits to give a dividend. Whenever a company wants to give a dividend from the past profits, they have to follow certain conditions. So those things you need to understand. So based on this only they will ask a question. So what are the conditions they need to follow, sir? Whenever a company wants to give dividend from the past profits, so what are the conditions generally they need to follow? Simple. First, the rate of dividend cannot exceed last 3 years average. Second, the amount to be withdrawn cannot exceed 1/10 of the paid up capital plus free reserves. Third, the balance of reserves after such withdrawal shall not fall below 15% of the paid up capital. So these are the major conditions, sir. First condition, sir, whenever a company wants to declare a dividend from the past profits, because current year profits are not there or current year profits are not sufficient, then they can declare a dividend by using the past reserves. But what are the conditions they need to follow? The dividend you are declaring cannot exceed last 3 years average. Second, what is the maximum amount you can withdraw? It shall not exceed 1/10 of the paid up capital plus free reserves. And the balance in reserves after such withdrawal shall not fall below 15% of the paid up capital. Okay. And so suppose if you have a current year loss, whatever the amount you are withdrawing from the past profits, first you need to adjust that loss. Okay. These are the conditions you need to follow, sir, whenever a company is declaring a dividend. Now relating to this, there are some questions. We will try to solve those questions. So this is the entire concept of financial statements of company. So you need to focus on the format entirely. You read that to main format, you read 2 or 3 times and try to solve the questions. That's more than sufficient. Now let us try to solve the questions. Now we are going to cover some important questions from preparation of financial statements chapter. The first question I am going to cover is examination question from this chapter, sir. September 2024 attempt, 14 marks question. So there is a company Shivam Limited, its trial balance on 31st March 2024 given. So credit balances, debit balances, credit balances given rupees in thousands. See, the best way to approach this financial statements question is whenever you are reading the trial balance, you mark down the head under which these item will come. These item will come. So when you are solving, sir, your time will be saved. Now see the debit items. First thing, land at cost, non-current assets, property, plant, equipment, plant and machinery at cost. Again, property, plant, equipment, non-current assets, debtors, current assets, trade receivables, closing stock, current assets, inventories, bank balance, current assets, cash and cash equivalents, adjusted purchases, P&L account, purchases, P&L account. Generally, what is adjusted purchases? Purchases after adjusting purchase returns and any related expenses. Factory expenses, P&L account, other expenses, because we don't have specific head for factory expenses. This is also administration expenses, other expenses, selling expenses, other expenses, debenture interest, P&L account, finance cost. Now come to the credit side balances, sir. Equity share capital, shareholders fund share capital, debentures, long-term borrowings in non-current liabilities, general reserve, reserves and surplus, P&L account, reserves and surplus, shareholders fund, securities premium, reserves and surplus, sales, P&L account, revenue from operations, creditors, current liabilities, trade payables, provision for depreciation. Provision for depreciation generally will be deducted from the concerned asset. In this case, there are two land, plant and machinery. Land is non-depreciable. So therefore, this provision for depreciation is relating to plant and machinery. Suspense account. So they have given a suspense account of 3,000 rupees in thousands. So let's see any information given relating to it. Now see the additional information what they have given in the question. On 31st March, the company issued bonus shares to the shareholders on 1:2 basis. That is, one equity share issued as bonus for every 2 shares held. No entry relating to this has been made. Actually, in the question, you see total equity share capital is 2 lakhs. Face value 10 rupees. That means total 20,000 shares are there. Now, the bonus has been issued. One equity share issued for every 2 equity shares held. So 20,000 divided by 2 into 1. So 10,000 bonus shares were given of rupees 10 each. So total 1 lakh is the bonus share equity share capital given in the form of bonus. So we need to write this. Where we need to write in notes to accounts, share capital, existing shares, bonus shares we will add. And as per schedule 3, whenever a company has issued fully paid bonus shares, we need to mention the aggregate number class of shares. This point we have covered. Next, the authorized share capital of the company is 35,000 equity shares of 10 each. See, authorized capital is only for presentation purpose. We need to present. I told you as per schedule 3, first you need to present authorized capital which is given in the question. When you are presenting the authorized capital, you need to mention the number of shares and the face value. Next, the company on the advice of the independent valuer revalued the land at 2,45,000. So there is a revaluation of land happened, sir. Land original cost 148. So the 1,48,000, sir. They revalued it to 2,45,000. So therefore, 97,000 increase in the land value. What is this? This is revaluation surplus, which is transferred to reserves and surplus. Okay. So this is 97,000 revaluation surplus. Or we can call this as revaluation reserve. Both are same only. Next what happened? The directors declared a dividend of 10% on 5th April 2024. Sir, dividend declared after 31st March. So any dividend declared after 31st March is a non-adjusting item. We will not consider this as a liability on 31st March. So this we will not consider in the financial statements. And also transferred a profit at a 10% to general reserve. See, from the current year profits, 10% will be transferred to general reserve. That means current year appropriation. So you prepare P&L account, you will get the current year profit. From that current year profit, transfer 10% to general reserve. So general reserve, in the reserves and surplus, opening balance, add current year profit we will do. Okay. So this will be form part of reserves and surplus, sir. Next. Now next point they are talking about suspense account. Suspense account of 3,000 represents cash received for sale of some machinery on the first day of the financial year 23-24. Cost of this machinery was 10,000, accumulated depreciation thereon being 8,000. Sir, in the trial balance, you see there is a suspense account of 3,000. And this 3,000 is nothing but this company has made a sale of some of the machinery, sir, on the first date of the year 23-24. In the first date of the year itself, they made a sale. 3,000 is the sale value. and the cost of this machinery was 10,000, accumulated depreciation 8,000. That means cost 10,000, cost of the machinery they sold, accumulated depreciation on that machinery is 8,000. Therefore, what will be the carrying amount of the asset sold? Machinery sold 2,000. And what will be the sale value? 3,000. So we sold it for profit. So what is the profit here? 1,000. This is what profit on sale of machinery. Where it will come? P&L account, other income. We need to show this 1,000. This is one important item, sir. Another thing, sir, your plant and machinery in the beginning is how much, sir? The cost, original cost is 520, correct? 520. Out of this 520, how much we sold in the beginning itself? 10,000. That means 10. So what will be the balance? 510. 510 is the balance after sale. Okay. Now from this, I need to reduce the accumulated depreciation. What will be my accumulated depreciation, which is given 116? Now what adjustments will happen to this accumulated depreciation, sir? 116. And when you sold a machinery, relating to that machinery, accumulated depreciation is 8,000. So that will also be cancelled. So minus 8. And in the question, they clearly said that depreciation is to be provided on plant and machinery, 10% on the cost. So 510 into 10%, sir. Cost of the machinery 510. You should not provide depreciation on 520 because in the beginning itself, the 10,000 worth of machinery was sold. So therefore, technically speaking, you need to provide depreciation on 510. So if I provide 10% depreciation on the remaining cost, it will be 51. So current year depreciation, I need to transfer to accumulated depreciation. So generally see, depreciation, we are maintaining a separate account. Whenever you maintain a separate account for provision for depreciation, what entry we will write? Depreciation account data to provision for depreciation. So current year depreciation 51. So 51 depreciation account debit, which is transferred to P&L account to provision for depreciation 51. So provision for depreciation will be added with 51. And whenever there is a sale of machinery, what entry we will write here, sir? So tell me, sir. For this sale, what entry will write? Simple. Bank account debit. What is the sale value? 3,000. And what is the cost of plant and machinery, which is going out? 10,000. And what is the accumulated depreciation we are going to cancel? Because see, whenever an asset is sold, related depreciation will also be cancelled. How much? 8,000. So what will be the profit? 1,000, which is credited to P&L account. So bank account debit 3,000, accumulated depreciation 8,000, plant and machinery account 10,000 will be created, P&L account 1,000. So therefore, the accumulated depreciation, the closing balance is 116 minus 8 plus 51. So it will be 159. So 510 minus 159. So 351 is the plant and machinery closing balance, which will come in the balance sheet. I will show you. See, plant and machinery closing balance. In the notes to accounts, you see here. Plant and machinery closing balance 351. How we got this? Most of the students confusing area on this one only. Opening balance 520, correct? How much you sold? 10. Cost. So what is the balance? 510. Minus accumulated depreciation. This is accumulated depreciation, not current year depreciation. So what will be the accumulated depreciation? In the trial balance, they have given this. And this minus 8,000 is what? The accumulated depreciation in respect of the asset sold. And this is current year depreciation. Current year depreciation will be added to your provision for depreciation. So therefore, the closing balance of the accumulated depreciation is how much? 159. So 510 minus 159, 351 is the closing balance we need to consider. Okay. So this is one of the important adjustments here. And as I told you, when you are preparing P&L account, other income, you see what item is there? Profit on sale of machinery. Profit on sale of machinery, you see. Sale value 3, book value 2. So 1,000 is the profit on sale of machinery. So this will come in P&L account, other income. So these are the adjustments relating to assets sold. Provision for income tax is required at 30%. So provision we need to create it for income tax, which will come in balance sheet, current liabilities, short-term provisions. So short-term provisions we need to show. Generally, provision for tax is a short-term provision, sir, because every year we need to pay taxes to the government, so which is to be settled within a year. So what they're asking, you are required to prepare Shivam's Limited P&L account and balance sheet as per the provisions of the Companies Act after considering the above information. So we need to prepare the P&L account as well as balance sheet, sir. Sir, how to approach this type of question, sir? Very simple, sir. First, write down the format, not the entire format, sir. Only the items which will come. Don't waste your time. The entire format you don't write. For example, here now you see. First, I will start like this. The balance sheet of Shivam Limited as on 31st March 2024. Equity and liabilities. First one, shareholders funds, share capital, note number 1. Reserves and surplus, note number 2. Money received against share warrant, not there. Don't write. Share application money pending allotment, not there. Next, non-current liabilities. Yes, in non-current liabilities we have long-term borrowings, that is debentures. Yes, note number 3. Next, any deferred tax liabilities? No. Any other long-term liabilities? No. Long-term provisions? No. Next, come to current liabilities. Current liabilities, first short-term borrowings? No. Next, trade payables? Yes. Creditors are there, so write it down. Next, any other current liabilities? No. Then short-term provisions? Yes. Provision for tax. That's it. So equity and liability side is over. Now come to asset side. Non-current assets. In non-current assets, first A. In that one, PP. Land at cost is there. Plant and machinery at cost is there. Okay. Next, any non-current investments? No. Any deferred tax assets? No. Any long-term loans and advances given by the company? No. Any other non-current assets? No. See, every time when you are solving a question relating to financial statements, you revise the format. So, as I told you, repetition. When you revise number of times, it will fit into your mind. So, every time you check yourself. So, now I am on current assets. Current assets, what is the first one? Current investments, there are no. Next, inventories, there are. Yes, closing stock is there. Next, trade receivables, debtors is there. Then cash and cash equivalent, bank balance is there. Next, short-term loans and advances, not there. Next, any other current assets, not there. That like that, in the balance sheet, in the P&L account, each and every item you check. Okay. So if you see whether all the items which I have told you came or not, you check it yourself. See this. First, you write down the format. Equity and liabilities, shareholders funds, I told you. Share capital, note 1. Reserves and surplus, note 2. Long-term borrowings, debentures is there, note 3. Current liabilities, we have trade payables, short-term provisions, provision for tax, total. Asset side, you see, we have property, plant, equipment. We have intangible assets, no intangible assets, only property, plant, equipment. And for this, give note number 4. Current assets, inventories is there, trade receivables is there, cash and cash equivalents is there. See, some students, usually they ask me a doubt, sir, when to prepare a note, when not to prepare a note. Simple, sir. Note is for providing some extra information, additional information, or whenever any particular piece of information you need to provide relating to that particular item as per schedule 3, you provide the note. Otherwise, ignore it. Suppose, for example, trade payables is there, directly available now, so no need to prepare a note. For example, long-term borrowings you write. Prepare a note because long-term borrowings, the breakup is nothing but debentures. Right, like that. Suppose even trade payable, suppose you have bills payable, creditors, multiple is there, 2 or 3 items is there, you prepare a note. So you take a decision whether to prepare a note or not, whether item is directly available or shall I need to give the breakup. If you want to give the breakup, you prepare it. Okay, so total. Now, once you write the format of the balance sheet, next format of the P&L account. The P&L account format, sir, very simple, sir. First, it starts with revenue from operations. Sales is there. Next, other income. Profit on sale of machinery is there. Total. Then coming to expenses. First expenses is what, sir? Cost of material consumed. In this case, not there. Next, purchase of stock in trade. Purchases is there. Adjusted purchases. Take it. Change in inventories of the finished goods work in progress. Not there. We have only closing stock. No opening stock is available. Next. Employee benefit expenses. Not there. Finance cost. Yes. Debenture interest is there. Next, depreciation and amortization, current year depreciation we can calculate. Next, other expenses, factory expenses, administration expenses, selling expenses. That's it. So write down the format. Revenue from operations is there, other income, total income. Expenses side, purchases, finance cost, depreciation and amortization, other expenses, total expenses. Once you got the total expenses, revenue minus expenses, you will get profit before tax from the tax expenses, current year provision for tax. Then you will get profit after tax. So for which items we have prepared a note here? Other incomes, they have prepared 1 note. Other expenses, they have prepared 1 note. Total 6 notes. So if you want to provide any information extra, you can prepare a note. Nothing wrong. Now once you write the format, then start preparing notes documents. Try to fill each amount. For example, first take share capital. So how they are presenting share capital, look at this. Share capital, equity share capital, first authorized. Given in the question, you present it 35,000 shares of 10 each. So this is only for presentation purpose, not for total purpose. Next, issued, subscribed and paid up capital. Original 20,000 shares of 10 each fully paid. Look at how they have written. In exams, you need to write like this. Some students what they are doing now, 20,000 into 10. No, 20,000 equity shares of 10 each fully paid up. Then add 10,000 bonus shares issued during the year. Or else you can present like this. 30,000 shares issued, subscribed, paid up. 30,000 shares of 10 each fully paid up. In that you give a note that out of the above, 10,000 shares are issued for as fully paid bonus shares. That is also correct. Okay, total 300. Now coming to reserves and surplus. So this one is over. This one is done. Next, reserves and surplus, sir. Sir, reserves and surplus, what items will come? Tell me. We have general reserve 90. But from this general reserve to this general reserve, current year appropriation will be added. Because in the additional information, they said 10% of the current year profits will be transferred to general reserve. What will be the current year profit, sir? The current year profit is, see this, current year profit is 70.70. From that 10% I need to transfer. So see this. What is my general reserve balance? 90. And add transfer from P&L account 10%. How we got this? 70.7. My profit. 70.7 into 10%. So 7.7 I have added. And I forgot to mention one thing, sir. Bonus issue. Sir, in this question, company went to a bonus issue, right? So how much they have utilized for bonus issue, sir? So bonus issue, if you see carefully, sir, 1 lakh worth of bonus shares they have given. 1 lakh, right? And whenever we have given a bonus shares, from which source this bonus is given? Either from free reserves. So if you see, general reserve is the first free reserve. So out of this, they have utilized 73. Total 100 I want for bonus issue. What they have done is, first securities premium they have taken from the question 27. Entire securities premium they have utilized for bonus issue. Balance 73 they have utilized from general reserve. Okay. So the closing balance is 24.07, sir. Simple, sir. General reserve original balance 90. How much current year profits it is added? 7.07. How much we used for bonus issue? 73. So 90 plus 7.07 minus 73. So it will be 24.07. Or else what you can do is, sir, you can use entire general reserve also, nothing wrong. But here the combination what they have selected is, first they have utilized securities premium, then general reserve, then P&L account balance. How to prepare P&L account balance, sir? You see, original P&L account balance from the question is how much, sir? 48. Okay. 48. First you take 48. And for that add current year profits. Current year profit is 70.70. From that 10% you transfer to general reserve, minus it. So you will got this. So in this question, what we can do is, this bonus issue I can use from general reserve as well as P&L account also, or entirely from P&L account also I can use, nothing wrong. But here what they have selected is securities premium, general reserve. Kindly make note of it. Here multiple combinations are possible. So you got total reserves and surplus. Long term, so reserves and surplus is done, sir. Here reserves and surplus is done. Next to long term borrowings, we need to show debentures, 10% debentures, 135. So debentures. Then property, plant, equipment. Then once you present this, trade payables 35 directly we can take. Creditors. And then short term provisions means provision for tax. So provision for tax 30.30. We have already calculated. See this. Provision for tax. Once you got the current year profit, this one 101.10, 101, 30% tax. So 30.30. This is balance sheet short term provisions 30.30. So total 733. Now come to asset side set. Property, plant, equipment. Land was revalued to 2,45,000. So see this, original plus revaluation surplus 245. And this revaluation surplus of 97 will appear in the reserves and surplus. You see 97. See this revaluation surplus. Okay. Next, plant and machinery I already explained. Opening 510, we sold 510, so it will be 510 minus accumulated depreciation. Accumulated depreciation, you have to be very careful. What will be the accumulated depreciation? Opening balance minus current year sale relating to that accumulated depreciation plus current year depreciation, it will be 159. So you got 351. So total 596. That's it. So 596 I will show here. And then inventories 58. Trade receivables 65. Directly cash and cash equivalents 14. Okay. So revenue from operations, sales directly given 473. Expenses, purchases directly given 226. Finance cost, debenture interest. Depreciation and amortization 51. 510 into 10%. Other expenses you add everything. This one. Factory expenses, selling expenses, admin expenses, you add everything. You will get it. That's it, sir. So total expenses, this is profit, this is provision for tax. So this is how the things will be presented, sir. See, with one question, you can solve multiple questions, sir. You see the study material, question number 2, illustration number 2, Omega Limited question, exactly same, sir. Exactly same. Only numbers will change. If you see the question, they will give you trial balance again, debit balances, credit balance. You will find suspense account. You will find adjusted purchases. And you will find same land at cost, planted machinery at cost, and you will see additional information, authorized capital, land was revalued, declared dividend after 31st March, suspense account, sale of machinery, depreciation is to be provided. Same question, sir. So with this one question, you can solve this question very simply. And these kind of questions will be repeated in the examination, sir. Okay. So this is one question you see it, sir. You solve it. Okay. So I have explained everything in this question. You just practice it once. Okay. Next, one more question from preparation of financial statements is illustration number 4, sir. From the study material, illustration number 4. This question is also one of the important questions, sir. See this question, how nature of business is going to impact the presentation of financial statements. This question is the classic example, sir. See, in this question, they have given a trial balance of a hotel industry, International Hotels Limited. So that is very important. That plays a crucial role here. The nature of business is hotel. Now they are asking us to prepare the statement of P&L and balance sheet. So items, trial balance items, debit items, credit items, they have given different items. They have given, sir. And once the total trial balance is over, they have given additional information also. Wages and salaries outstanding, closing inventory balance. Depreciation also given, sir. The equity capital on 1st April 2011 stood at 7,20,000. That is 6,000 shares fully paid, 2,000 shares 60 paid. They're talking about at the beginning of the year, the total paid up capital is 6,000 shares fully paid, 2,000 shares only 60 paid, 40 rupees unpaid. Now these 40 rupees, directors made a call on 1st October. A shareholder could not pay the call on 100 shares, and these shares were then forfeited and reissued at 90 per share as fully paid. One shareholder who is having 100 shares, sir, he has not paid the called up that 40 rupees, sir. So his shares were forfeited and then reissued. Okay. So this adjustment is one of the important adjustments here, sir. Sir, tell me, when shares are forfeited and reissued, in respect of forfeited shares, sir, what is the unpaid amount? Tell me. Unpaid balance is 40, correct? What is the reissue price? Reissue price is 90. That means how much excess you are collecting? 50 into 100 shares. That means how much? 5,000. Whether this 5,000 will be part of share capital? Answer is no. This will be transferred to capital reserve account. Capital reserve account. So whenever shares were forfeited and reissued, if the reissued price exceeding the unpaid balance, that will be transferred to capital reserve account, because it makes sense, sir. See, 6,000 shares fully paid, 2,000 shares 60 paid. If 40 rupees paid, now it will become fully paid. So therefore, ultimately, these 2,000 shares are also, if issued and fully paid, it will be total 8,000 shares. 8,000 shares into 100 rupees is the face value. It is given in the question. See this, 100 rupees is the face value. So therefore, 8,000 shares into 100, it will be 8 lakhs only, na? The total paid up share capital should be 8 lakhs because we will credit to share capital only the face value, 8 lakhs. So therefore this 5,000 we should not include as a part of paid up share capital. That is the excess of unpaid amount in respect of these 100 shares. But what they have done in the question is, you see, they have given an equity share capital of 8,05,000. That means that excess amount in respect of the forfeited shares, reissued forfeited shares also they have included here. So therefore what we need to do, out of this 8,05,000, 8 lakhs only we need to show as a part of paid up share capital, 5,000 we need to show as a part of capital reserve, which is part of reserves and surplus. This is the first important thing of this problem. Okay. And also you see here in the additional information, the directors declared a dividend of 8% on equity shares on 2nd April. 2nd April means after 31st March, which is a non-adjusting item. So again, it will not be considered. So therefore, it is not part of balance sheet. Okay. So now, see the normal items in the question. First, they have presented authorized capital. They have given authorized capital. Authorized capital is only for what? Presentation purpose. We have to present it. And then subscribed capital they have given, preference share capital given, equity share capital given. Relating to equity share capital, I have explained it. Now, the most important parts are inventory. Now, see this. In the question, what is the inventory they have given? Purchases, wines, cigarettes, cigars they have given, food stuff they have given. Now, imagine your hotel. Okay. For a hotel, wines, cigarettes, cigars is what? Is it raw material? Is it finished goods? I mean, stock in trade. This is stock in trade for them because they are not manufacturing these wines, cigarettes, cigars, right? They are purchasing and selling in the hotel, right? So therefore, stock in trade. Now tell me, according to Schedule 3 in the P&L account relating to stock in trade, what you going to present? I told you if you are a trader, opening stock in trade, purchases, closing. So relating to stock in trade, what we need to present? Recollect P&L account expense side. First, cost of materials consumed. Second, purchase of stock in trade. So therefore, these purchases we need to show separately in the P&L account. Second item, purchase of stock in trade, 45,800. Because for a hotel, wines, cigarettes, cigars are what? Stock in trade. He is purchasing and selling them to the customers. What about food stuff in the hotel? Food stuff means the ingredients which they use in the preparation of food, right? This food stuff is like what? Raw material for the hotel. The pulses, the cashews, different kinds of ingredients, foodstuffs they will use for preparation of food. So it is kind of a raw material for them, right? Now in respect of raw material inventory, what we need to show? I told you in respect of raw material, we need to show consumption. Raw material consumed, consumption, cost of materials consumed. So therefore, in the P&L account, you know, the first item in the expenses side is cost of materials consumed. How to find out cost of material consumed? Opening plus purchases minus closing. So this is purchases. So they might have given opening. Say this opening. Yes. Opening of foodstuffs 5,260. 5,260 plus purchases during the year 36,200 minus closing. They have given, see this closing inventory of foodstuffs 16,400. So you will get what? Consumption, which is 25,060. So if you see the answer, sir, for this question, I will show you the answer. See, if you see the P&L account, see this P&L account, cost of material consumed, look at this 25,060. How they got this? Here cost of material consumed is nothing but what? Food stuff. How they got it? Opening plus purchases minus closing. Because food stuff means ingredients they use for preparation of food, which is the raw material. In respect of raw material, we need to prepare what? Consumption. So look at note number 11. See this. Opening plus purchases minus closing. 25,060. And in the P&L account, sir, if you see purchase of stock in trade, I told you now. For a hotel, wines, cigarettes and cigars is what? Stock in trade. Relating to stock in trade, what we need to show? Purchases. So what is the purchases in the question? You see, purchases in the question, they have given 45,800. So 45,800, see this. 45,800. Look at the presentation. So for this, they have prepared note number 12 actually. So note number 12 is what? See, Purchase of wine, cigarette, cigars. Okay. Now, sir, relating to inventory, foodstuff is raw material consumption we have shown. Stock in trade purchases we need to show separately. Change in inventories of stock in trade we need to show separately. So relating to these wines, cigarettes, cigars, sir, what is the opening balance? 12,800 minus what is the closing balance? 22,500. So what is the difference? 9,700. This 9,700, that is change in inventories of wines, cigarettes, cigars. See this, note number 13. 9,700 minus opening minus closing. They have shown separately. See this, change in inventories of this one. This change in inventories is relating to what? Wines, cigarettes, cigars, because it is stock in trade. Therefore, understand how presentation will be done. In respect of stock in trade, we need to show purchases separately. The difference between opening and closing, that is changed separately. In respect of raw material, we need to show consumption. So 9,700 minus 9,700, because opening minus closing, we got minus 9,700. I think the rest of the problem is quite easy, sir. Once you understand these things, rest of the problem is very simple. One more important point, as I told you, in the solution, if you see asset side, share capital, you see total 13 lakhs, right? Especially when it comes to equity capital, first authorized you need to present, then issued and subscribed, you see. So issued and subscribed, they have taken only 8 lakhs. That means 8,000 equity shares of rupees 10 each, fully paid. And but in the trial balance, they have given 8,05,000. Na? That 5,000 is what? Capital reserve, which they have shown it as a part of reserves and surplus. 5,000. Understand this, reserves and surplus. So this capital reserve is what, sir? Forfeited shares. So forfeited and reissued shares. Forfeited and reissued shares, in respect of that, this 5,000, so they have transferred, sir. So this is the important point, sir. I think rest of the problem is very easy, sir. Okay, you can easily different items where they can be part. And one more important adjustment in this question is wages and salaries outstanding. Where will you show? Any outstanding means they are already incurred but not yet paid. Therefore, they will be added to the corresponding expenses in the P&L account, and they will be shown in the balance sheet as a part of other current liability. So therefore, this wages and salaries 1280 will be added to the wages and salary, original wages and salary. See, in the solution, in the P&L account, you see we have employee benefit expenses. In this employee benefit, note number 14 they have prepared. So employee benefits, you see wages and salaries given 28,300, sir, in the question. Originally 28,300 wages and salaries. Where they have given 28,300 wages and salary. Yes, 28,300 plus outstanding. What is the outstanding amount? 1,280. Add these two. 29,580. Okay. And then one more important point, sir, in this question, sir, relating to P&L account, sir. If you see P&L account, revenue from operations for a hotel, sale of products. So sales they have given, sir. See this: wines, cigarettes, cigars, ticket 400, food that 57,600. These two, and also sale of services. You see, sir, sale of services like rent of rooms, billiard games. They are also. And then come to other income, sir. Other income remaining, sir, like miscellaneous receipts, discount received, transfer fees. So these are all other income. So even the billiards games which they organized in the hotel, which is part of services, sir, so which you need to consider as a revenue from operations. Okay, so inventory adjustment to capital reserve adjustment, I told you. I think these are the important points. Rest of them are very common, very simple points, sir. So reserves and surplus, you see reserves and surplus, In this question, capital reserve, general reserve is also there. No adjustments. P&L account current year plus last year. See, in the P&L account balance they have given, sir. Actually, in the question, we have available with P&L account balance. See this 41,500. This 41,500 plus current year profit 22,245. So current year profit. Then you will get the total P&L account balance. So other current liabilities, we had wages and salaries outstanding, interest on debentures. Sir, here in this question, sir, they have given debentures, sir, 6% interest. But in the question, they have not mentioned any interest on debentures. Interest on debentures, they have given, not given, sir. So on these debentures, if interest accrued, sir, 2 lakhs into 6%, what will be, tell me, 2 lakhs into 6%, it will be 12,000. So they have considered this 12,000, sir. So this 12,000 interest accrued but not yet paid. So therefore it is part of P&L account as finance cost. They have considered it. And also interest accrued but not paid in the balance sheet, current liabilities, other current liabilities, they have shown this 12,000. So here interest accrued on debentures, even though it is not given, they assumed it. Okay, which is fair enough. And preliminary and formation expenses, P&L account, other expenses we will show. Okay, that's it. So this coal and firewood, carriage and coolage, sundry expenses, advertisement, repairs, these are all P&L account expenses, other expenses we will show. That's it. I think this question is quite simple now. The important adjustments we have discussed it, sir. So this is one question, sir. International Hotels Limited question. The important adjustments in this question is inventory adjustment as well as capital reserve adjustment. That means forfeited and reissue of shares in respect of the amount, excess amount collected. Na, sir, be careful. That should not be part of share capital. Rather, it should be transferred to capital reserve. Okay, that is one adjustment. Next, one more question from financial statements of company chapter. Scenario based question number 8 from the study material, sir. Alpha Limited question. This question is also very important question, sir. See, there is a company Alpha Limited, sir. They are asking us to prepare the balance sheet of this company by following schedule 3. Only balance sheet. They have given the following details: debit balances, credit balances. First, the equity share capital given 50 lakhs. So 50 lakhs equity share capital given. And then calls in arrears given, sir, in the question. See, whenever calls in arrears given, sir, what you need to do is, when you are presenting notes to accounts, first you are going to present what's the share capital. First, share capital. So in share capital, first if you have authorized, you will write authorized, then issued, subscribed, called up capital you write. Issued, subscribed and called up capital. Called up share capital. Oh, 50 lakhs is the called up share capital, right? Now from this, reduce calls in arrears. Whatever the amount which is not paid by the shareholders, 5,000, reduce it. So you will get 49 lakhs 95,000. This is how you need to present, sir. So calls in arrears generally will be deducted from the called up capital to get paid up share capital. Next in the question, remaining items, land and buildings, PP, plant and machinery, PP, furniture, PP, general reserve, reserves and surplus, loan from state financial corporation. Generally loan from state financial corporation means long-term borrowings, and then inventories, current assets, raw materials, finished goods, provision for tax, current liabilities, short-term provisions, correct? Short-term provisions. Next, trade receivables, current assets, short-term advances, debit balances. Advances, debit balance means asset. So where will you show current assets? Short-term, na? Current assets, short-term loans and advances. In current assets, we have an item called short-term loans and advances. There we will show. P&L account, reserves and surplus, cash in hand, current assets, cash at bank, current assets, unsecured loan, 6 lakhs 5,000. Basically long-term borrowings. Next, trade payables, current liabilities, loans and advances from related parties, any loans and advances taken from related parties. So credit balances, so it is also liability. So either long-term borrowings or short-term borrowings. So I am assuming it as short-term borrowings. If you want, you can assume as a long-term borrowings also. Now look at the additional information which is very important, sir. 10,000 equity shares are issued for consideration other than cash. Can you tell me what is the impact of this point? See, monetarily, amount wise, it does not make any impact. But as per schedule 3, if you know, I told you in 3 situations relating to share capital. One of the situation is if company has made any issue of shares for consideration other than cash, you need to mention aggregate number and class of shares in the notes to accounts. So this one. So this is for disclosure purpose in the notes to accounts. This will be helpful. Okay. Disclosure. Next, trade receivables of 2,60,000 is due for more than 6 months. See this. You know, when I'm discussing the notes to accounts, sir, I told you one point. In respect of debtors, we need to prepare aging schedule. Debtor outstanding for more than 6 months, we need to show separately. So therefore, this is also will impact the disclosure. So when you are disclosing the notes to accounts relating to debtors, more outstanding for more than 6 months, you show separately. Remaining debtors, you need to show separately. And they have given the cost of the assets, building, plant and machinery, furniture. See, they have given cost, sir. In the trial balance, if you look at, sir, they have given you the land and building, plant and machinery, furniture. Suppose land and buildings here 27,50,000 is there, but the original cost is land and buildings 30. So what is the difference? Nothing but current year depreciation. So 30 lakhs is the cost of the building, but in the trial balance they have given 27,50,000. So 30 lakhs minus 27,50,000. So what is that? 2,50,000 is the current year depreciation. Like similarly for plant and machinery and furniture. Next, the balance of 7,50,000 in the loan account with State Financial Corporation is inclusive of 37,500 for interest accrued but not due. The loan is secured by hypothecation of plant and machinery. See, important, sir. Sir, loan from State Financial Corporation 7,50,000, sir, which is long-term borrowings. But in this 7,50,000, sir, they are saying 37,500 is interest accrued but not due. If you remember Schedule 3, sir, any interest accrued but not due is part of other current liabilities. So therefore, out of 7,50,000, 37,500 we need to classify it as other current liability. So therefore, 7,50,000 in that 37,500 go to other current liabilities. What is the remaining balance? 7,12,500, which will be kept in long-term borrowings. And the most important point, sir, the loan is secured by hypothecation of plant and machinery. If you remember Schedule 3 discussion, sir, I told you in the borrowings, if you want, you can check borrowings. Borrowings are basically divided into short-term, long-term. Secured, unsecured. If they are secured, we need to mention the nature of security. I have referred there this point also. In one of the question, they will give you the loan and loan from State Financial Corporation, and they will tell you the loan is secured by hypothecation of plant and machinery. So what is the impact of this point when you are preparing the notes to accounts relating to the borrowings? So loan from State Financial Corporation, below that you need to provide in the note clearly that this was secured by hypothecation of plant and machinery, which is because it is a disclosure requirement as per Schedule 3. Okay, this point also we have done. Next, balance at bank includes 10,000 with Omega Bank, which is not a scheduled bank. So when you are presenting the bank balancer, you deposit 10,000 with Omega Limited, which is not a scheduled bank. So out of total bank balance, 10,000 with not a scheduled bank, remaining is there with the scheduled bank. Like that you need to make a disclosure. And transfer 20,000 to general reserve is proposed by the board of directors. So transfer 20,000, which is proposed by board of directors. That means you should add to the general reserve from the reserves and surplus in the reserves and surplus. And board of directors declared a dividend of 5% on the paid up capital on 2nd April. See this. So board of directors declared dividend after 31st March, which is a non-adjusting item, so we will not consider it. So therefore, how you are going to approach this question? Very simple. First, you need to write down the format. How? First, equity and liabilities, shareholders funds, share capital note 1, reserves and surplus note 2. Next, non-current liabilities, because we don't have any money received against share warrant, share application money pending allotment, not there. Non-current liabilities, long-term borrowings. We have long-term borrowings. What is that? Loan from State Financial Corporation is there, and then unsecured loan is there. Next, any deferred tax liabilities? No. Any other long-term liabilities? No. Any long-term provisions? No. Now coming to current liabilities, any short-term borrowings? Yes. Loans and advances from related parties, I assume that as short-term borrowings. Next, trade payables is there? Huh? Yes. Trade payables obviously will be there. Like creditors, trade payables. Yes, there. And then other current liabilities also there in the question. What are the other current liabilities in this question, sir? Other current liabilities, interest accrued but not due. That is the other current liability we had. And next, any short-term provisions given in the question? Yes, provision for tax. And then coming to asset side, sir, what items will come in asset side? Property, plant equipment, nothing but land and building, plant and machinery, furniture. Any non-current investments, nothing. Any deferred tax assets, nothing. I think investments are there in the question. Nothing. So non-current investments are not there. Deferred tax assets are not there. Long-term loans and advances are not there. But short-term loans and advances are there. Short-term advances are there. Long-term is not there. Now other non-current assets are not there. Coming to current assets, first one, current investments, not there. Second, inventories, there. Trade receivables, there. Cash and cash equivalents, there. And then short-term loans and advances, there. Other current assets, not there. That's it. This is the total presentation. So look at the presentation, sir. I will show you. See this. So how, first to write down the shareholders fund, share capital is there, reserves and surplus. Note 1, 2. Next to non-current liabilities, we have long-term borrowings. Loan from State Financial Corporation, unsecured loans. Note 3. Current liabilities, we have trade payables. Short-term provisions is there, provision for tax. Short-term borrowings also there, loan from state financial, related parties. Other current liabilities also there, interest accrued but not due. Total. Now coming to asset side, we have non-current assets, PPE. Current assets, we have inventories, trade receivables, cash and bank balance, short-term loans and advances. So everything note is given. Now first to come to share capital, sir. So share capital, if you see the question carefully, sir, relating to share capital, 50 lakhs is there, but calls in errors 5,000 is there. So look at how they have presented this. Equity share capital issued, subscribed and called up 50,000 shares of 100 each. See, whenever any share, less calls in errors, see this, 49,50,000. And the important point is, I told you in the notes to account set, 10,000 shares are issued for consideration other than cash. So this point is there. So whenever shares are issued for consideration other than cash, we need to mention a note. See this. Out of this 50,000, 10,000 shares are issued for consideration other than cash. So this is very, very important, sir. This is because of Schedule 3. And then coming to reserves and surplus, sir. Reserves and surplus, if you see carefully in the question, we have general reserve 10,50,000, sir. This is reserves and surplus 10,50,000. And also in the additional information they said 20,000 is transferred to general reserve. So for this 10,50,000 we need to add this 20,000. See this 10,50,000 plus 20, it will be 10,70,000. Now coming to P&L account, sir. In the question they have given P&L account balance 4,33,500. Right? So from this 4,33,500, we transfer 20,000 to general reserve. Generally from P&L account, current year profits from P&L account only, it will be transferred to general reserve. So 20,000. So it will be 4,13,500. Total 14,83,500. So share capital, reserves and surplus done. Next, non-current liabilities, we have long-term borrowings. Long-term borrowings is how much? Loan from State Financial Corporation. Look at how presentation, 7,50,000 minus interest accrued but not due. We need to separate it. See this. Secured loan from State Financial Corporation, 7,50,000 minus 37,500, 7,12,500. And look at this point, secured by hypothecation of plant and machinery. This is as per Schedule 3. And also unsecured loan. So I told you whenever borrowings are secured, we need to mention the nature of security. In the question itself clearly given, it was secured by hypothecation of plant and machinery. Okay. So this is long-term borrowings presented. Next, trade payables directly given in the question. You see trade payables 8 lakhs. So directly write 8 lakhs. Next, short-term provisions, provision for tax. They have given, I think, 6,40,000. See this, 6,40,000. Provision for tax, note number 5. Provision for tax. Okay. Next, other current short-term borrowings also there. This 2 lakhs. What is this short-term borrowings? This one, loans and advances from related parties. 2 lakhs. See this. Short-term borrowings, loans and advances from related parties. Sir, here the assumption, sir. Loans and advances from related parties is a short-term borrowings. We assumed. We consider it. Okay. Next. So this is also done. Other current liabilities, interest accrued but not due, 37,500. So total 94,73,500. Now coming to asset side, PP, note number 6. We know directly we can take, but presentation how you are going to do in exams is cost 30,000, WDV 27,500. So 27,500 will be considered for total purpose, but presentation wise cost 30 lakhs, cost minus depreciation. Like that you need to present. See this, how they have presented. Understand this. See this. Land and building cost 30. So here 2,50,000, I mean 27,50,000 is the WDV. That means what is the difference between these 2,50,000 is the depreciation. Similarly, plant and machinery. Similarly, furniture and fittings. You know the cost, you know the WDV given in the question itself. So see this, 25,000 this is. And this one, so 2,50,000. So the balance figure is nothing but depreciation for the current year. Okay, so you will get PP 56,25,000. Now coming to current assets, sir, inventories. You see, inventories, raw material, finished goods, 2,50,000, 10 lakhs. So total 12,50,000. Note number 7. Next, trade receivables. This is important, sir, because you see in the question, the trade receivables is 10 lakhs. But here, look at the notes to account, sir. They are saying that trade receivable 2,60,000 is due for more than 6 months. That means out of this 10 lakhs, sir, 2,60,000 we need to present separately. Remaining balance we need to present separately. Like for example, note number 8, you see, trade receivables outstanding for a period exceeding 6 months separately, remaining separately, because as per schedule 3. Okay, so this one is also done. Next, cash and bank balances. Cash and bank balance also very important, sir, because relating to cash and bank balance, cash in hand 1,50,000, cash at bank 12,35,000, sir. But in this 12,35,000, sir, they have given 10,000 is there with Omega, which is not a scheduled bank. That means out of 12,35,000, sir, 12,25,000 is there with scheduled bank, 10,000 is there with non-scheduled bank. Like that you need to present. See this. Cash at bank with the scheduled bank 12,50,000, with others Omega Bank Limited 10,000, which is given in the question. So you need to present like this. So that's why reading additional information and applying them in presentation is very, very important, sir. Okay, so we got this also. Now last one, short-term loans and advances, sir. In the question they have given short-term loans and advances. The most 2,13,500. Most of the students, what they are doing now, the moment they see short-term loans and advances, they are thinking liabilities. No, sir. See the balance carefully. This is a debit balance. It represents assets. Advances we have given. So therefore it is part of short-term loans and advances. That's it. So this is one type of question they are asking. Why this question they are asking in the examination, sir? Even this question is a repetition. Why? Because look at the additional information. Shares are issued for consideration other than cash. That point you need to write a note. Debtors outstanding for more than 6 points. That separate presentation you need to do. For that separate marks will be there. Cost is given in the balance sheet. Trial balance WDV is given. The difference is depreciation. That point you need to present. And a loan from State Financial Corporation, interest accrued but not due. You need to separate it to other current liabilities. And this loan is secured by hypothecation of plant and machinery. For that note will be mentioned. Look at how many good points are there in this question. And also balance with the bank, with the non-scheduled bank, that has to be separated and transferred to general reserve. This is common points. And dividend after 31st March. So this is also one of the unique questions from financial statements of companies. Please practice these kind of questions. Okay. Hello, my dear students. The next chapter we are going to focus is cash flow statements, accounting standard 3. Examination point of view, sir, usually 8 marks question. Every attempt they are going to ask from this topic, sir. Sometimes what they are doing is they are framing one case scenario based question exclusively covering this cash flow statement topic. So like in Jan 2025 attempt, if you see, there is a one case scenario based question exclusively covering cash flow statement they have asked it, sir. So needless to say, examination point of view, definitely important and also very easy in scoring. So you cannot miss this chapter, sir. Now let us start discussing this cash flow statement chapter. See, in this chapter, the main focus is on how to prepare a cash flow statement, what are the different heads of cash flow statement, and how the cash items are classified under these heads. That is the main discussion in this cash flow statement. Okay. So first, what is cash flow statement? Basically, see, cash flow statement is a statement which shows the cash inflows and outflows. Sir, already every company will prepare a cash book, right? Relating to cash, we will have cash book, right? In this cash book, all the receipts and payments are available. Then again, why we need to prepare cash flow statement? See, cash is important item of the organization. You know, proper analysis of the cash is required for the management to take proper decisions. But is cash book is enough for making analysis? I mean, draw some conclusions and based on that to take some decisions. Is it helpful for the management? The answer is no. Because cash book is basically the receipts and payments. That's it. Then what is cash flow statement? Cash flow statement is also the inflows and outflows of cash. Inflows and outflows, basically. But the inflows and outflows of the cash are grouped into three categories here. Here grouping will be done as operating, investing, financing. Like this, the grouping will be done. See, this grouping will help the management to make some reasonable conclusions and to make proper analysis of the cash and cash equivalents and to take decisions of the organizations. So the bottom line is, what is cash flow statement? Cash flow statement is basically a statement which shows the cash inflows and outflows of the organization for a particular accounting period by grouping them into operating, investing, financing activities. Okay. So it shows the resources, inflows and outflows by grouping them into operating, investing, financing activities. Now, sir, how this cash flow statement looks like, sir, I will show you. Basically, when you want to prepare a cash flow statement, you know how the basic presentation will be: cash flow from operating, investing, financing. So first you need to take cash flow from operating activities. You identify the inflows and outflows relating to operating activities and you will get one total result. And investing activities, total. Financing activities, total. The total can be positive or negative. If the outflows are more than inflows, it will be negative. And then find out the net increase or decrease in cash and cash equivalents. For that, add opening cash and cash equivalents. You will get closing cash and cash equivalents balance. Opening cash and cash equivalents, during the net increase or decrease, you will automatically get closing cash and cash equivalents balance. This is the basic presentation of cash flow statements. Now, sir, is this cash flow statement is necessary for everybody? See, this cash flow statement is only for big companies, sir. Relating to companies, it is applicable only for non-SMCs. Relating to non-corporate, it is applicable only for level 1. Okay. So for level 2, level 3, level 4 or small and medium sized companies, this accounting standard is, cash flow statement is not mandatory. And also one more thing, sir. If you are a OPC, one person company, small company, dormant company, private startup companies, for you also cash flow statement is not required. So cash flow statement is not mandatory for every kind of organizations. Only big companies are required to prepare cash flow statement. Now, when you are preparing a cash flow statement, sir, there are certain terms which is very, very important, sir. Two terms here plays an important role. One is cash, another one is cash equivalents. Let us try to understand what is cash. Basically, cash is what? Nothing but cash in hand, cash at bank. But here the definition says cash includes cash in hand and demand deposits. Cash includes cash in hand, demand deposits. Demand deposits with bank or any other financial institution. Sir, what is this demand deposits? Demand deposits means whatever the savings, whatever the deposits which is there in the bank or financial institution, which we can withdraw any point of time without any prior notice, without payment of any penalties. If you have the right to withdraw any point of time without any prior notice, those are called demand deposits. So these demand deposits are also considered as a part of cash, nothing but cash at bank. Next, cash equivalents. This is very, very important definition. See, in cash flow statements, sir, wherever you use the word cash, along with that you need to use the word cash equivalent. What is basically cash equivalent? The standard says cash equivalents are short-term, highly liquid investments that are readily convertible into known amounts of cash and which are subject to insignificant risk of change in value. So here the wordings are important. So what is cash equivalent, sir? They are short-term. Short-term here means 3 months or less. Highly liquid. Liquid means anytime if I want, I can sell them. I can convert them into cash. Readily convertible into known amounts of cash. And the most important thing is they are subject to insignificant risk of change in value. The principal should not be in danger. If there is a high risk in the value of the investment, then that will not become cash equivalent. For example, we invested in equity shares of a company for 3 months. So we invested in equity shares, of course, for 3 months. Now tell me, equity shares invested for 3 months. Short term, yes. Highly liquid, yes. Anytime if I want, I can sell the equity shares and I can convert them into cash. But the most important thing, is it subject to insignificant risk of change in value? No. Equity shares are subject to significant risk of change in value. So there is so much risk for investment in equity shares. Anytime the principal value may change. So therefore, investment in equity shares cannot consider as cash equivalents because the principal is in danger. So basically, cash equivalent should be a short-term, highly liquid investments which can be converted into cash any point of time, but the principal should not be in danger. That means there should not be any significant risk of change in value, like investment in treasury bills, investments in government bonds, or maybe money market instruments. They may be considered as what? Cash equivalents. So understand. Because once an investment is classified as cash equivalent, next when you are making a classification, there is investing activity there, that investment cannot be classified. So here understand, short term means the maturity with a 3 months. From the date of acquisition till the date of maturity, 3 months gap should be there. That is called short term. If it is much beyond that, that is not considered as short term. Okay. So we understood what is cash and also cash equivalent. Now the most important part of this cash flow statement is, as I told you, when you are preparing a cash flow statement, you need to group the cash activities or cash items into 3 categories: operating, investing, financing. Okay. Sir, what is operating? What is investing? What is financing? Sir, cash inflows and outflows. Inflow means cash is coming into the organization. Outflow means cash is going from the organization. If the cash activity is relating to the principal revenue generating activities of the enterprise, that is called operating activity. So basically, what is operating activities, sir? These are the principal revenue generating activities of the enterprise. What is principal revenue generating activities? For which purpose the organization has been formed? What is our main activity? Like for example, if I am a cement manufacturer, manufacturing the cement and selling the cement. For example, cash sales, collection from debtors, trade commission received, royalty received, and salaries paid, wages paid, rent paid, advertisement fees paid, administration expenses paid, like that, staff welfare expenses paid. These are all principal revenue generating activity. What is your primary activity? Corresponding to the primary activity, what will be the inflows and outflows? They will be classified as operating activity. One more important thing, sir. Any cash inflow or outflow, if you are unable to classify under investing and financing, that will also be classified under operating activity, a kind of a residual category. So the question of I am unable to classify this cash activity will not arise in cash flow statement. If you are unable to classify any cash item, whether inflow or outflow, under investing and financing, obviously you have to classify under operating activity. So that's why they said here, other activities that are not investing and financing will also comes under residual activity. Okay, operating activities done. Now next, investing activity. Sir, what is investing activity? Investing activities are basically nothing but our organization resources are going out. For which purpose? Because we are investing in assets, we are purchasing assets, and also we are making investments. So purchasing fixed assets, making investments, purchasing investments is part of investing activity. When the primary activity is investing, the corresponding activity, like for example, when I purchase an asset, I may sell the asset, that is also investing activity. And when I made investments, I may sell those investments, that is also investing activity. If the primary activity is one particular activity, the corresponding, the opposite is also that activity only. So therefore, what is investing activity? Investing activity is nothing but acquisition and disposal of long-term fixed assets and other investments that are not classified as cash equivalents. Important, sir. As I told you, any investment, if you are already classified as cash equivalent, don't consider under investing activity. Like for example, a company invested in treasury bills for 3 months or money market instruments for 3 months or less. So it is satisfying the definition of cash equivalent. Again, it should not be classified under investing activity. So therefore, what is investing activities here? Investing activities are nothing but acquisition and disposal of long-term assets like fixed assets and other investments that do not consider as cash equivalent. Any investment already classified, already satisfying the definition of cash equivalent, again you should not consider under investing activity. Okay, so here purchase of fixed assets, sale of fixed assets, and income received from assets, and also purchase of investments, sale of investments, interest received from investments, dividend received from investments, all these things will come in investing activity. So understand the bottom line. In investing activity, our resources are going out. Our resources are basically going out. That is the primary activity. and opposite activities, the corresponding activities, everything will be classified under investing activity. Next one, financing activity. So what is this financing activity? Basically, any cash inflow outflow relating to the shareholders funds and borrowings will be classified under financing activity. So financing activity means any activity which will change the nature, size and composition, which will change the size and composition of owner's capital. Owner's capital means equity share capital, including preference share capital and borrowings of the enterprise. Suppose, sir, company issued shares, financing activity. Company bought back shares, financing activity. Company issued preference shares, financing activity. Company redeemed preference shares, financing activity. Company taken a bank loan, borrowings, financing activity. Company repaid the loan, financing activity. Company paid interest on loan, financing activity. So as I told you, if the main activity is financing, the opposite, the corresponding will also comes under financing activity. So therefore, what is financing activity? Any activity that will change the size and composition of owner's capital, including preference share capital and borrowings of the enterprise. So now I am going to ask one question. You have to tell me, issue of debentures, which activity? So you understand first, issue of debentures. So company issue debentures. That means funds are coming from outside. See, when company is taking resources from outside, it is basically financing activity. So issue of debentures is a borrowing. It's a financing activity. Company received bank loan. So we have taken a loan from bank. That means resources are coming from outside. Financing activity. Like that you need to understand. Okay. So this is the three kind of activities, sir. So whenever a cash flow statement question is given, sir, first you try to segregate the items. They will come under which activities, you try to segregate. I will show you some questions, sir, here. Now see illustration number 3, sir. Very basic questions, how they are asking. See, these type of questions they are asking in the examination, sir. So they are asking cash flow from operating activities. Okay. So tell me, they have given a cash book, cash account, and they're asking us cash flow from operating activities. So tell me which are operating activities here. Cash sales, yes, operating activity. Trade receivables, this is cash book, sir. That means every item is cash involved. Collection from trade receivables, operating. Trade commission, operating. Sale of investment, purchase and sale of investment is investing activity, so it is not operating. Loan from bank, any loan taken from bank, financing activity, so which is not operating. Interest and dividend received, is investing activity. Generally we receive interest and dividend from investments. Next, cash purchases, operating. Trade payables, amount paid to. Sir, this is cash book, sir. Outflows, these are all. Office and selling expenses paid, operating. Income tax, operating generally. Investments sold, this is sale of investment. Sale of investment is investing activity. Repayment of loan, financing activity. Interest on loan, financing activity. So these are all not operating activities. So only these things, I think 7 items are comes under operating activities. See this. So like this you need to identify, sir, from the question, which comes under operating, which comes under financing, which comes under investing activity. Okay. Now next. So once you identify the items, they will comes under which category. Next, you need to understand the special items. There are some special items when you are solving the question relating to cash flow statement. Some special items will come. See the one by one. First, loans and advances given and interest earned. Important, sir. Listen to me carefully. Sir, loans and advances given, interest earned. See, whenever you are solving a question relating to cash flow statement, sir, you need to see what is the nature of your company. Is your company a financing entity, non-financing entity? Depending upon the nature, the classification will change, sir. Suppose if you are a financing entity, sir, you are giving loans and advances and earning interest on them in the ordinary course of the business, which is operating activity for you because it is your principal revenue generating activity, right? Suppose if you are a non-financing entity, your main activity is not giving loans and advances. Suppose if you give any loans and advances and earned interest on them, for you it will become investing activity. Okay. So loans and advances given and interest earned by the non-financing entity is basically investing cash flows. Next, any loans and advances given to subsidiaries. Suppose, sir, you are a company, you are a finance company, like for example, SBI. SBI is a financing company. They have given loan to their subsidiaries. So finance company giving loan to subsidiary company is investing activity. Similarly, non-financing company giving loans to subsidiary company is also investing activity. So there is no difference. When you give loans and advances to subsidiary company, whether you are a finance company, non-financing company, basically it is an investing activity. And also any loans and advances given to employees and interest earned on them. Tell me, loans and advances given to employees. So basically employees are part of the principal revenue generating activity. They are also internal people. So therefore which belongs to operating activity. So giving loans to employees by any enterprise, whether it is financing, non-financing, it's a operating cash flows. And also any advance payment to suppliers. Suppose we have given advance to suppliers for supply of goods and we earned interest on them. So tell me, giving advance to suppliers. Suppliers are part of operations, main principal revenue generating activity. So it's an operating activity, including interest earned on those advances. Similarly, interest earned from customers for late payments. So suppose for example, one of the customer has exceeded the due date, sir. So we charged interest. So whatever the interest we received from the customers for the late payment, so where it will come? Operating. Very simple, because collection from debtors operating, the corresponding item, the interest received from customers late payment is also operating. Next, to loans and advances taken and interest paid, sir. Suppose if you take loans and advances, suppose you are a financing entity, taking loans and advances in the ordinary course of the business is a operating activity for you. But if I am a non-financing entity, if I take loans and advances and interest paid on them, that is not my ordinary activity. So it will be my financing activity. It is kind of a borrowings for me. And also any loans and advances taken from subsidiaries and paying interest on those loans, whether you are a financing entity, non-financing entity, taking loans and advances from subsidiary company will be financing activity. And also any advance taken from customers and interest paid on those advances. Sometimes from the customers we have received advance for supply of goods. Now whatever the advance you received, where will you classify, sir? Operating, because it is relating to customers, debtors. But the question of receiving advance from the customers will not arise in case of financing activity. That way it is not considered here. Next, interest paid to suppliers for late payment. So we made a late payment to the suppliers. So supplier charged some interest. So payments to suppliers is operating activity. Similarly, any interest paid on late payment is also operating activity. And the last one, interest taken as a part of inventory cost in accordance with AS16. This is important, sir. Sir, you know, we have one accounting standard AS16, borrowing cost. There I told you, if the borrowing cost, interest nothing but, if it is capitalized to the inventory, being inventory is a qualifying asset. A16 says if the inventory is a qualifying asset, then interest cost can be capitalized to the inventory cost. Generally, interest cost will not be capitalized to the inventory cost. But if the inventory is a qualifying asset, A16 says we can capitalize. Now that interest, whatever you are capitalizing on borrowings, whatever the interest generated on borrowings, if it is relating to qualifying asset, then if you capitalize, then where will you take that interest, which is capitalized to the inventory? Inventory is basically what? Principal revenue generating activity, operations. So therefore, whatever the interest you are including as a part of inventory cost as per A16, that is also operating activity. Very simple. So once you able to identify the primary activity where it will belong, the opposite, the corresponding will also comes under that category only. So that's the major thing you need to remember. And also next third special item, investments made and dividends earned. Interesting, sir. Sir, investment made. Tell me, sir, if I am a financing company or investment entity making investment in the ordinary course of the business, in the ordinary course of the business I will make investment in shares, debentures, other companies. That is my operating activity. Suppose if I am a non-financing entity and if I make any investments in company shares or debentures and earned some interest, some income, so that is my investment activity. So if I'm a financing entity, sir, it is my operations. If it is non-financing, it is my investing. Similarly, sir, any investment in subsidiary companies and earned a dividend on them. So whether I am financing entity, non-financing entity, doesn't make any difference. It's a investing activity. So therefore, here you need to understand, sir, if you are a financing entity, financing entity. So loans and advances given in the ordinary course of the business, being a financing entity. Loans and advances taken in the ordinary course of the business. Okay. And also making investments in the ordinary course of the business. These are all your operating activity. But if you are a non-financing entity, loans and advances given, if you give, investing activity. Loans and advances taken, financing activity. Investments made, investment activity. So that's the difference. And now if you see loans and advances given to subsidiary company, loans and advances taken from subsidiary company, and investment in subsidiary company. See, when it comes to subsidiary company, sir, whether you are a financing entity, financing entity or non-financing entity, so if loans and advances given to subsidiary company, they are investing activity, irrespective of the type of the organization. Loans and advances taken from subsidiary, it's a financing activity. Investment made in subsidiary companies is a investing activity. So that's the bottom line. And very interesting point, I am going to explain it now. Dividend received. Sir, when you make investment, you receive dividend, sir. So basically dividend received is which activity, sir? Dividend received. Dividend received is nothing but investment activity. Dividend received is nothing but investment activity. Okay. So next, sir, dividend paid, sir. Important, sir, because most of the students are asking me one doubt, sir. See, just now I told you, if you are a financing entity, giving loans and advances, interest earned, operating activity. Loans and advances taken and interest paid, operating activity. Investment made, from that investment any income, dividend or whatever received, operating. What about dividend paid? Dividend paid, sir. See, dividend paid. Always remember, sir, dividend paid, whether you are a financing entity or non-financing entity, sir, doesn't make any difference, because dividend paid, if you are a finance entity or non-financing entity, you pay dividend to whom? Your shareholders. So any activity relating to shareholders is which activity? Financing activity. So therefore, when a financing entity receive dividend from their investments or from the loans and advances given, that is their operating activity. But when the financing entity pays dividend, it is paying dividend to its shareholders. That is not operating, that is financing activity. And if you are a non-financing enterprise, dividend received is investing activity. Dividend paid, again, it is financing activity for you. So therefore, understand, whatever be the organization, dividend paid are considered financing activities for all enterprises. Because the bottom line is, to whom you are paying the dividend, whether you are financing, non-financing, you are paying dividend to your shareholders. So any activity relating to shareholders will comes under the financing activity. Now income tax, one more special items when you are preparing cash flow statement is income tax. Okay, sir, income tax belongs to which category? Operating, investing, or financing? See, if you can able to segregate the income tax to particular activity, classify. Unable to classify, operating. Segregation of income tax is possible, classify. Segregation not possible, sir, operating. Simple. Suppose if the income tax belongs to, suppose a company sold the asset. In respect of the sale, they paid capital gains tax. That means sale of asset is investing. So tax relating to is also investing. Suppose a company paid interest on borrowings. Now when you are paying, you have deducted the tax and paid to the government. So tax deducted on interest payment. Generally interest payment on borrowings is financing activity. So interest relating to that is also financing activity. And suppose, for example, if you are a non-financing enterprise, you made investments. From that investment, you received some interest. Now the person who is paying has deducted some tax. So tax, interest received on investment is a investing activity. So tax paid in respect of that interest is also investing activity. That's it. So when you can able to classify the tax under the particular activity, classified, otherwise operating activity, you take it under operating activity. And also, sir, insurance claims received, sir. Sir, when you receive any insurance claim in respect of loss of stock or loss of profits, operating. So stock is part of operation, so consider it under operating activity. Suppose when you receive any insurance claim against loss of fixed assets, Generally, sale and purchase of fixed assets is which activity? Investing activity. So insurance claims is also, investing activity. Insurance claim received against the fixed assets loss is also investing activity. And the last one, extraordinary items. We have one standard called accounting standard 5, sir. In that standard, okay, so they talk about extraordinary items. Basically, the nature of the extraordinary item is they has to be disclosed separately. So similarly, when you're preparing a cash flow statement, if you have any extraordinary items, either inflow or outflow, try to disclose it separately. The impact has to be disclosed separately. Like for example, we receive an insurance claim against the loss of fixed asset. So it's a extraordinary investing activity. So disclose it separately. So AS3 requires separate disclosure of extraordinary cash flows, classifying them as either if it is operating, investing or financing activities as appropriate. So we have completed what is cash flow statement. I told you the important definition, the cash and cash equivalent, and I also told you the cash activities, how AS3 has classified the cash activities into operating, investing, financing, and also some special items we have seen, sir. Special items we have seen. Now, how the cash flow statement will be prepared? Presentation of cash flow statement. This is also I explained. Basically, the presentation includes what? So when you are preparing a cash flow statement, so first you need to take cash flows from which activity? Operating activity. You write everything. Then cash flows from investing activity. All the inflows and outflows relating to investing activities you write. Next, cash flow from financing activity. You write all the inflows and outflows. For every category, you will get total, right? One amount. And then you find out the net increase or decrease. Okay. Now for that, you add opening cash and cash equivalents. Cash and cash equivalents. Obviously, you will get what? Closing cash and cash equivalent. That's it. So when you're solving a cash flow statement, complete cash flow statement question, sir, it is very easy to check whether the answer is correct or not. Because whatever the net increase or decrease arrived, opening balance they will give in the question. Add it. Automatically closing balance will come. Closing balance will also mention in the question. Suppose my closing balance is 10. My opening balance is 5 lakhs. Obviously the net increase or decrease during there should be 5 lakhs. If it is other than 5 lakhs, your answer is wrong, sir. Somewhere you have done the answer wrongly. So easily you can cross check. But now, see, when you are presenting the cash flow statement, sir, especially cash flow from operating activities, there are two ways to present it. There are two ways we can present these cash flows from operating activities. One is direct method. Another one is indirect method. So direct method, indirect method. Why they are calling this as direct, indirect? Because in direct method, sir, we'll try to identify the inflows and outflows relating to operating activities. But in indirect method, each inflow and outflow we don't identify relating to operating activity. Rather, we will take the P&L account. From the P&L account, we pick out the net profit. Now, we'll make some adjustments to this net profit to arrive cash flow from operating activities. So that means we are trying to ascertain the cash flow from operating activities indirectly. That's why this method is called indirect method. Okay, sir, out of these two methods, which method is preferable, sir? Basically, indirect method is more preferable. But in examination, sir, they are not testing indirect method, but we don't know. So anytime it can change. So indirect method, direct method, both are important only. Okay. Now first, let us see the direct method, sir. So as I told you, there are two methods, direct and indirect method. How direct method will work? See, I have solved one question, right? See this. This is how operating activities, all the inflows and outflows relating to operating activities, like cash received from sale of goods, cash received from debtors, so cash received from sale of services, minus outflows like payment for cash purchases, payment to trade payables, payment to operating expenses, payment for wages and salaries, payment for income tax, all these things. If any extraordinary items are there, try to present it separately, then you will get net cash flow from operating activities. Sir, remember, sir, the direct method, indirect method of presentation is applicable only for cash flow from operating activities. For investing and financing activities, it is direct identification of inflows and outflows. This direct method and indirect method is applicable only for cash flow from operating activities. Now see some questions, sir, so that you will understand it better. How direct method will work. I will show you. Suppose, sir, now see this question, sir. This question I have taken from RTP May 2025. So see this question. From the following data of Vishnu Limited, prepare a cash flow statement from operating activities using direct method. See this. They're asking cash flow from operating activities using which method? Direct method. So look at the information they have given, sir. Opening balance, closing balance. Some items opening, closing balances they have given, sir. And also summary of P&L account given, sir. So generally, sir, P&L account data and some assets and liabilities balances they will give. So they're asking us to prepare cash flow from operating activities using direct method. Additional information you see, trade receivables, trade payables includes amount relating to credit sales and credit purchases only. So trade receivables and trade payables includes only credit sale and credit purchases. No cash sale, cash purchases. Foreign exchange loss represents increment in liability of long-term borrowings due to exchange rate fluctuation between the acquisition date and foreign balance sheet date. Because of the foreign exchange fluctuations, the liability, the loan which is taken from foreign currency has been increased, which is not a cash activity because no cash involved here. Just because of the fluctuations in the exchange rates, there is an increase in liability. This you can easily ignore. Now I want cash flow from operating activities, sir. So tell me, sir, how to find out cash flow from operating activities here? You know, first to look at the P&L account, sir. What information they have given and recollect what is operating activity. These are principal revenue generating activities and any activity which is not classified under investing and financing activity. So let us try to identify the operating activities like cash sales, amount collected from debtors, amount paid to creditors, cash purchases, okay, salaries paid, wages paid, taxes paid. These are all operating activities, right? So let us try to identify. First to go to P&L account and check. Sales they have given, sir, 85,50,000. Okay. Cost of sales also given. Okay. Other incomes, interest income given, fire insurance claim received. And expenses you see, depreciation, admin and selling expenses, interest expenses, foreign exchange loss, net profit before tax and extraordinary income, income tax, net profit. So these are the details they have given, sir. Now they are asking us to prepare the cash flow from operating activities. How you are going to ascertain the cash flow from operating activities here? So in this question, how I am going to approach is, first they have mentioned in the question set that trade receivables and trade payables includes amounts relating to credit sale and credit purchases only. So no question of cash sales and cash purchases. Now first coming to sales, sir, I know the sales. These are all credit sales. And I know the debtors, opening balance, 1,88,000 closing balance. So from this information, is it possible to ascertain anything relating to debtors? Collection from debtors, can I ascertain? Opening 1,88,000. During the year, purchases, sales 85,50,000 minus closing 2,05,000. So 85,33,000 is a collection from debtors. Because when you prepare a debtors account, sir, easily you can get what? Collection from debtors. See this. Working note, calculation of cash received from customers. I know the opening balance given in the question. I know the closing balance given in the question. I know the sales during there, all sales, 85,50,000, which is available from P&L account, all credit sales. So the balance figure is nothing but what? Amount collected from customers. So this is one of the operating activity, 85,33,000. So cash received from debtors, see this, 85,33,000. So direct method, you try to identify each inflow and outflow. And then next, coming to creditors, sir. See, I don't know the purchases, but I know the cost of sales. Okay, I know the opening inventory, I know the closing inventory. And also trade payables, opening balance, closing balance, I know. Is there any way I can ascertain the amount paid to creditors? Because amount paid to creditors is also operating activities, yes. But here I don't know the purchases. First try to find out the purchases. How to find out the purchases, sir? Here cost of goods sold we know. Cost of goods sold we know. Cost of goods sold is equal to opening stock plus purchases minus closing stock. This is what? Cost of goods sold. What is your opening stock? Add purchases minus closing stock. You know, COGS you will get. So ascertain this purchases as balance figure because you know COGS, you know opening stock, you know closing stock. So once you know the purchases, all purchases are credit purchases. So opening creditors plus purchases minus closing creditors. You know the amount paid to creditors. So in this question, the twist is that like debtors, you cannot able to find out directly what is the amount paid to suppliers because we don't know the purchases. First, you need to find out the purchases. Calculation of total purchases you need to find out. First purchases you try to find out, sir. Okay, how to find out purchases? See this: opening stock plus purchase minus closing stock. COGS is equal to cost of goods sold. This formula we know. So opening stock, purchases, closing stock. Ascertain this as a balancing figure: 55 lakh 55,000. Now once I know the purchases, I can easily ascertain the amount paid to suppliers. See this: opening balance of creditors 2 lakh 15, closing balance I know. During the year purchases I know. So the balance figure is nothing but amount paid to suppliers, 55 lakh 75,000, which you take it. See this. So two things: amount collected from debtors, cash paid to suppliers. So two operating activities. Next, any other items? Like for example, interest income. Sir, generally interest income is what? Investing activity. So which is not part of operating. Fire insurance claim received. Yes. I told you any fire insurance claim received. Suppose if generally if nothing mentioned, that means fire insurance claim received in respect of what? Inventory. So it's an operating activity. But since fire insurance claim is an extraordinary item, it has to be presented separately. So we will present this inflow 1,10,000 separately. So if you see this, they have presented it. See separately. Adjustment for extraordinary items 1,10,000. Once they have arrived all other items and got the total, next see these extraordinary items they have presented separately 1,10,000. Okay, so this one. Next, depreciation, which does not involve cash, so it is not part of cash flow statement. Admin and selling expenses, sir, generally 15,40,000. So admin and selling expenses generally it is part of operating activities. So if we assume it is paid, so 15,40,000, it is paid only because opening, closing, no outstanding. No outstanding means it is paid during the year. So 15,40,000 admin and selling expenses, which is part of operating activities. See this: payment for admin and selling expenses 15,40,000. That's it. So this is also operating activity, we consider it. Interest expenses, basically interest expenses means interest we are going to pay. So financing activity. Foreign exchange list does not involve cash, so it will not be considered. Income tax, important, sir. Income tax adjustment is one of the important adjustments. Most of the students are confusing, sir. So I'm going to throw some little bit light here. Income tax, 95,000 is appearing, sir, in the P&L account. Sir, the income tax, whatever is appearing in the P&L account, that means this is provision for a tax, sir. This is provision for a tax we created on the current year profits. This is current year provision for tax, 95. And if you see the additional information, our opening provision is 65, closing 48. So opening provision plus current year provision minus closing provision, you will get income tax paid during the year. So if you prepare provision for tax account, so by balance brought down opening, by P&L account current year provision, to balance carried down closing provision. The difference is nothing but tax paid during the year. So if your opening provision is 65 and current year there is a provision of 95, 65 plus 95 minus 48,000. So 1,12,000 is the tax paid during the year, which is also comes under operating activity. Say this. So tax paid. Provision for tax account they prepared, sir. First opening balance they have given 65. Closing balance also they have given. Current year provision. See this. This is taken from P&L account. So opening plus provision minus closing. You will get the tax paid during the year as a balancing figure. So why I have selected this question is, look at how the items they have arrived, sir. So amount collected from customers they have arrived as a balance figure by preparing debtors account. Amount paid to suppliers they have arrived it by first purchasing purchases. How to find out purchases? Cost of goods sold is equal to opening plus purchases minus closing stock. And then tax paid during that they have prepared a provision for tax account. So this is one question, sir. This is RTP May 2025 question relating to direct method, sir. How questions will be come. Okay. And one more. Yeah. One more question, sir. From the study mat, you see there is scenario based question number 24, sir. See, this question, they are asking us to calculate cash and cash equivalent. Possible, sir. A 4 marks question is possible. So they are asking us cash and cash equivalents. We have seen in the definitions how to find out the cash and cash equivalents. See this. Balance as per bank statement 25,000 is given. So is it part of cash and cash equivalents? Yes, cash in hand. Cash at bank, it is part. Checks issued but not presented in the bank. So we issued checks but the other party has not presented in the bank. So that means once you have issued, to that extent your cash balance must decrease, no, sir. So this 15,000 has to be reduced from the available 25. Next, short-term investment in liquid equity shares of ABC Limited. Tell me, sir, whether short-term investment in liquid equity shares will become cash equivalent? No, because I told you, to become cash equivalent, there must be insignificant risk of change in value. But here we are investing in equity. Equity is having a significant risk of change in value, so it should not be considered. And also, you see, fixed deposited created on 1/11/2011, maturing on 15th April 2012. So we made a fixed deposit in the month of November. So November, December, January, February, March, more than 3 months. So in order to become cash equivalent, it must have a maturity period of 3 months. So it is not. Next, short-term investment in highly liquid sovereign debt, mutual fund on 1/3/2011, 12, having maturity period of less than 3 months. Yes, I think this will be considered as cash equivalent. Next, last one, bank balance in foreign currency account in India. See, we have a foreign currency account, in that we have a bank balance. So $1,000 is there. On the date of deposit, $1.69, sir. At the end, $1 is equal to 70. So therefore, we need to consider, I think 70. $1,000 into 70 rupees. So it will be 70,000. So therefore, what will be the cash equivalent, sir? 25 minus 15. I think 10,000. This 10,000. And investment in highly liquid sovereign debt, the maturity period is 3 months less. So it will be considered as cash equivalent. And also bank balance in foreign currency account, we need to convert by using the exchange rate at the end of the year. So 70,000. So total 1,80,000. So this is how the cash equivalents will be ascertained. So this is one question, sir, relating to cash and cash equivalents. Okay. One more question, sir. Illustration number 10. This question is also relating to direct method. Very good question. In this question also, like RTP May 2025 question we have solved, sir. Similar to that, they have given the extract of the balance sheet and P&L account of ABC along with the following information, sir. Balance sheet extract given and also P&L account extract given, sir. Okay. Balance sheet, P&L account extract, notes to accounts also given. What they are asking is cash flow from operating activities using direct and indirect method. So we are going to solve this by direct method. Sir, how you are going to approach? First, see the P&L account, sir. In the P&L account, look at the sales first. Because relating to operating activities, cash collection from debtors, cash paid to suppliers, these are the basic items will come. Then expenses paid, these are the basic items. So first, to revenue from operations, 4150. Obviously, this is what sales. Sales. Okay. And we know debtors, opening balance, closing balance, which is given in the balance sheet. You see, balance sheet. Trade receivables 400, 250. So therefore, opening plus sales, opening debtors plus sales minus closing, you will get cash collected from debtors during the year. Right? So see this. And here the assumption is that there are cash sales which is included there only. So cash sales and collection from debtors, everything is part of operating activities only. We cannot able to segregate here because information is not available. So from the P&L account, you see the sales. And what is the opening trade receivables, closing trade receivables. So opening debtors plus sales minus closing, you will get this one. And come to cash payments, sir. Same. Take the purchases, sir. Purchase of stock in trade, 2,400. And take the trade payables, opening, closing. So opening 230, opening 230 plus purchases 2,400 minus closing 250. So you will get amount paid to suppliers. See this, amount paid to suppliers. Purchases plus opening trade payables minus closing. And next, once you got these two items, next see the other items. Other income, you see, what is the other income? Note number 4. Other income, they have interest and dividend. Generally, interest and dividend is investing, so it is not part of operating. We are ascertaining operating activities. So therefore, it will not be considered here. Expenses, purchases already considered as a form of cash paid to the suppliers. Next, change in inventories of finished goods. This will also not come. Employee benefit expenses, that means salaries and wages paid. Yes, this is operating activity. We need to consider. Depreciation, non-cash, we will not consider. Finance cost means interest. Generally, it will not comes in operating, it will comes in financing activity. Then other expenses, so also assumed that it is paid. So wages and salaries paid 800, we need to consider. See this, wages and salaries paid. Wages and salaries paid, but wages and salaries, sir, in the P&L account one item given, and if we look at the additional information, they have given opening, closing. So therefore opening wages and salaries, current year expenses minus closing, you will get wages and salaries paid during the year. Opening outstanding plus incurred during the year minus closing. So 40 plus current year 800 minus closing 50. You will get wages and salaries paid. Similarly, expenses. Opening expenses 10, closing 20. And during the year the expenses incurred 200. So opening plus current year minus closing. So you will get all the two items. See this, wages and salaries paid, cash expenses paid. Take it. Next, coming to the tax expenses, one of the most important, sir. Sir, in this question, sir, you see opening provision 180, closing 200. In the P&L account, you see 200. This is what? This is current year provision. So if I prepare provision for tax account, like previous question we solved, provision for tax, I told you what is the opening provision. The opening provision for tax is 180. Current year provision for tax 200 from P&L. Total 380. And what will be the closing provision given in the question? See this, 200. 200. That means 180 is paid during the year. Correct? If nothing, no advance tax is given in the question. This is how we need to find out tax paid during the year. Prepare a provision for tax account, opening, current year provision minus closing, you will get tax paid during the year. That you need to take it in the cash flow statement. But in this question, sir, they have given advance tax. See this, advance tax they have given. So whenever advance tax given, sir, what is advance tax, sir? Tax paid during there is advance tax. Last year advance tax is 180, current year 195. That means during there how much is the tax they paid? 195. So therefore we need to consider income tax paid 195, advance tax paid 195. So most of the students are not understanding this, because see, cash flow statement is prepared on cash basis. P&L account is prepared on accrual basis. So the fundamental difference is this. And when you see advance tax, sir, opening 180, closing 195. You need to understand that 180 opening is last year advance tax paid, but we are preparing cash flow statement of the current year. So at the end of the current year, what is the advance tax? 195. That means it is paid during there. So I want tax paid during there 195. So therefore, whenever in the question relating to tax is given as sir, opening provision, closing provision, current year provision, you know, no other information is given. Just to prepare provision for tax account, opening, current year minus closing, you will get tax paid during there. But in the question, if advance tax is given as sir, current year and whatever the advance tax is there, assume that is paid during there, because that was paid during there. So advance tax paid, you take it. So you will get cash flow from operating activities 445. Okay. So because collection from debtors 4,000, sir, inflow, paid 2,380 minus, this is the amount we paid. Wages and salaries paid 790, cash expenses paid 190, taxes paid 195. So therefore 4,000 minus 2,380 minus 790 minus 190 minus 195. It will be 445 is the answer. Okay. So this is how we need to find out cash flow from operating activities under direct method. So direct method, you try to identify each cash inflow and outflow relating to operating activity. Okay. Sometimes they will give you directly. One question we solved, basic question. They will give you cash book. They will inflows and outflows. They will give you. You need to just pick out. Sometimes they will not give directly. Like two questions we solved. RTP May 2025 and illustration. Just now we solved one illustration. This illustration number 10 from the study material. So in this case, what you need to do is they will give you balance sheet as well as P&L account information. So by using this information, you need to identify the operating activities like collection from debtors, amount paid to creditors, so all this by finding out the missing figures. Okay. So these are the two types of questions they are going to ask, and one question relating to cash equivalents I have solved. Now I am going to discuss about the indirect method, sir. So we are going to discuss about indirect method of cash flow statement. Cash flows from operating activities under indirect method. How to ascertain them? Let's see. Every company will prepare P&L account. Every business organization will prepare P&L account, sir. I am taking this form of P&L account for your understanding. In P&L account, we have incomes on the credit side, expenses on the debit side, and we will get net profit. Now I want to prepare cash flows from operating activities. I will take net profit before tax and extraordinary items from P&L account as a starting point. One important point, sir, P&L account is prepared on accrual basis, sir. Whereas cash flow from operating activities is prepared on cash basis. This is the fundamental difference between these two. Now I am taking this net profit from P&L account, which is prepared on accrual basis, as a starting point to ascertain cash flow from operating activities. My target is to reach net cash generated from operating activities. This is my target. What adjustments if I do to this net profit before tax and extraordinary item, which is taken from P&L account, I will reach net cash generated from operating activities. And one important point, sir, this net profit before tax and extraordinary items, most of the cases they will give, sir. Whenever they want to test you indirect method, they will give you net profit before tax and extraordinary items. Suppose sometimes net profit before tax and extraordinary items is not available from the question. Then what you need to do? There is an adjustment. There is a way to find out it. I'm going to explain that adjustment also. First we see, we'll start with net profit before tax and extraordinary items, because extraordinary items we want to present them separately, and I want to reach net cash generated from operating activities. Three broad category of adjustments we need to do to the net profit, sir, in order to arrive the net cash generated from operating activities. First adjustment is non-cash items. Non-cash items. Non-cash items basically does not involve cash. Therefore, they are not part of cash flow statement. But when you are arriving net profit from P&L account, you might have already debited or credited these non-cash items. So now eliminate the effect. Best example is depreciation. Suppose I debited 10 lakhs depreciation to P&L account. Because of that, my net profit was decreased by 10 lakhs. But actually, because of this 10 lakhs, is there any cash outflow? No. So this 10 lakhs of depreciation, it is decreasing my net profit, but it does not have any impact on cash flow statement. Since I am considering this net profit before tax and extraordinary items is the starting point, already this net profit was deducted by 10 lakhs because of the depreciation. I need to add back. Similarly, any non-cash items might be created to P&L account. Because of that, my net profit was increased. Now I need to deduct non-cash items because they are not relevant for cash flow statement, but they might be considered in P&L account. Next, non-operating items, other than operating items. Sir, we want cash flow from operating activities. Other than operating, we have investing, financing activities, financing items. Those items are also debited or credited to P&L account. Therefore, when this net profit, whatever you are considering, it is already adjusted with non-operating items also. But I want cash flows from operating activities only. So therefore, what I need to do? I need to eliminate the non-operating items, which is already adjusted my net profit. For example, interest income, interest credited to P&L account, 10 lakhs interest credited. Definitely it has increased my net profit by 10 lakhs. But is this 10 lakhs is part of operating activity? No, interest income is basically investment activity. Therefore, it is already included in net profit, deduct it. Similarly, I have debited interest expenses. Because of that, 7 lakhs. My net profit decreased by 7 lakhs. But is this 7 lakhs interest expenses is part of operating activities? No. Interest expenses generally we pay on borrowings, right? So it is a financing activity. But it is already decreased my net profit 7 lakhs. Now add back. So I need to eliminate the effect of non-operating items, non-cash items. Non-cash items is basically not relevant for cash flow statement. Non-operating items not relevant for getting operating activities cash flows. So these two adjustments I need to do. After that I will get one amount, that is operating profit before working capital changes. Now third and the most important adjustment is working capital changes adjustment. I need to do. Sir, what is this working capital changes? Working capital changes is nothing but the difference between current assets and current liabilities. The changes in current assets and current liabilities. See, sometimes the changes in current assets and current liabilities, they may impact my profits, but there is no cash inflow or outflows. So they are not relevant for cash flow statement. Sometimes the changes in current assets and current liabilities, there is a cash inflow or outflow, but they have not included in the net profit. Now I need to adjust. I will take only one example for each category. First, debtors I will take. Debtors. See, debtors, my opening balance is 10, sir, closing 20. That means during the year there is an increase of 10 lakhs, increase in current assets, increase in debtors. What this increase indicates? This increase indicates that the bottom line is the credit sales are more than the collections. So this 10 lakhs is what? Credit sales. But is there any cash inflow? No, cash inflow. Therefore, this increase should not be relevant for cash flow statement. But this 10 lakhs increase is already credited to P&L account, because sales we will credit to P&L account. So this 10 lakhs we credited to P&L, it is already included in net profit, but there is no cash inflow. So the increase in current assets, the increase indicates to that extent there is a profit appreciation, net profit appreciation, but there is no cash inflow. So what I need to do now? I need to decrease, because it is not relevant for cash flow statement. So always understand, sir, whenever there is a change in current assets, if current assets increase is there, we need to give minus, opposite effect. Suppose if there is a decrease in current assets, add. Why? The logic is very simple. For example, debtors, same debtors you take. Opening balance 10, closing 5. That means how much reduced? 5 lakhs. Maybe that is collection during the year. Collection from debtors. Is this collection is cash inflow? Yes. Is it part of cash flow statement? Yes. All cash items should be part of cash flow statement. But is this 5 lakhs is already included in the P&L account? No. Collection from debtors we don't include. Therefore, now I need to include, because in the net profit this 5 lakhs collection not included. Now include. So therefore, decrease in current assets indicates that to the extent of decrease there is a cash inflow, but it is not adjusted in the P&L account. So therefore, now I need to add. Similarly, come to current liabilities, sir. Come to current liabilities, give the same effect, sir. Increase, add. If there is a decrease, minus. If you want to see, if you understood the logic, that is good. I am trying to explain the logic here. Even if you don't know the logic, don't remember the logic also, in examination, don't panic. Follow the simple technique what I am telling. In case of current liabilities, same effect. Increase, add. Decrease, minus. Generally increase indicates positive. So increase, add. Decrease, minus. Current assets, increase, minus. Decrease, add. Okay. So coming to this one, sir, creditors, if I take the example for changes in current liabilities, suppose my opening creditors 10, closing 20. What it indicates? Increase in creditors. This increase in creditors, that indicates that there is a credit purchases during there, but there is no cash outflow. No outflow of cash. No outflow. Therefore, they are not relevant for cash flow statement. But this 10 lakhs credit purchase is already debited to P&L account. Because of that, my net profit was decreased. But is it actually impacting my cash flow statement? No. Therefore, what I need to do now? Increase. I need to add back, because it is already deducted from net profit. Similarly, suppose creditors opening 10, closing 5, sir. That means deducted 5 lakhs. Decrease in 5 lakhs. What is this decrease? Cash outflow. We paid the amount to creditors. But is this 5 lakhs is already impacted my P&L? No. Which is already included in net profit? No. Therefore, now I need to deduct, because there is a cash outflow. Okay. So the bottom line is what? Working capital changes, current assets, current liabilities. Logic is quite simple. sometimes the changes in the current assets and current liabilities is impacting your net profit, but there is no cash inflow outflow. Second thing is, sometimes because of the changes in the working capital, changes in the current assets, current liabilities, there is inflow and outflow, but it is not adjusted in the P&L account. Therefore, now I am adjusting. So the increase in current assets always decrease. The decrease in current assets add. Current liability, same effect. Increase, add, decrease, minus. Okay. So once you do these working capital changes, you will get one amount. From that, you deduct tax paid. Tax paid. Tax paid. And finally, you will get a net cash generated from operating activities. That's it. So hardly it has taken only 10 minutes to explain the concept of indirect method. So indirect method, what is my starting point? Net profit before tax and extraordinary items. Because extraordinary items, I want to show them separately. Then I will adjust non-cash items. I will adjust non-operating items. Okay. And then I will get net profit, operating profit before working capital changes. Then I will do working capital changes. Working capital changes, current liabilities, increase, add, decrease, minus. Current assets, increase, minus, decrease, add. Cash flows from operating activities before tax and extraordinary items. Tax paid you take. And extraordinary items, if at all there, show them separately. You will get net cash from operating activities. Okay. Now let us try to solve some questions, sir. First, I have taken one question from MTP, April 23, September 23. And this type of question already they have asked in examination, sir. So see this question. See, there is a company, Mannan Limited. They are asking us to prepare the cash flow statement as per indirect method, sir. Indirect method. So they have given net profit before taking into account income tax and income from lawsuits, but before taking into the following items was 30 lakhs. So therefore, what is the net profit before tax and extraordinary item? Here extraordinary item is what? This one, income from lawsuits. So before tax and extraordinary items, after adjusting these items, so the profit is 30. So the starting point for calculating cash flows from operating activities 30 lakhs, net profit before tax and extraordinary items, which is given in the question itself. Now to arrive these 30 lakhs, what adjustments they have done is depreciation, they have 750 lakhs or 7.5 lakhs. Discount on issue of debentures written off, interest on debentures paid, book value of investment sold 4.5, sale value 4.8, and interest received on investments 90,000. Now you see 5 adjustments are there. So I told you, for this net profit, we need to make non-cash items, non-operating items, working capital changes. First, non-cash, non-operating items. See this. Depreciation, debited to P&L, add. While arriving profit, this was deducted, add. Discount on issue of debentures written off, it was debited, add back. Non-cash, non-operating. Interest on debentures paid, interest on debentures, non-operating, which is debited to P&L account, add. Book value of investments 4.5, sale value 4.8. So 30,000 profit. Profit was credited to P&L account, but sale of investment is which activity? Non-operating, investing activity. So therefore, this was already included in the net profit. Now minus. Correct? Profit was credited to P&L account. Next, interest received on investments 90,000 credited to P&L account. Now minus. Non-operating item. So you see the solution. I will show you. See this. First cash flow statement, they started with operating activities. First start with net profit before tax and extraordinary items given in the question itself, 30 lakhs. And do adjustments. Depreciation, add. Discount on issue of debentures, add back because they are all deducted while arriving at profit. Interest on debentures paid, add. Interest on investments received, minus because interest was credited to P&L account. So now deduct, that is what I have written. And also profit on sale of investments, actually wrongly given, sir. This one, I think this is 30,000, right? Minus 30, sorry. So 30 lakhs plus 7 lakh 50 plus 45 plus 5 lakh 25 minus 90 minus 30. So 42 lakhs, sir. This is before working capital changes. See this. Operating profit before working capital changes. Now I need to do the working capital changes. Working capital changes means the difference in current assets and current liabilities. See, definitely they will give in the question, whenever they are asking any indirect method, they will give you the current assets and current liabilities balance. You see this. This is opening, this is closing. First inventory, opening 18 lakhs, closing 19 lakhs 77,000. So increase. So increase in current assets, what we need to do? Minus. So the difference is minus. Okay. Next, trade receivables, opening 3 lakh 87, closing 3 lakh 79 650. Decrease. Decrease means add. Current assets decrease means add. Cash in hand we will not consider, because in cash flow statement, as I told you, once you got the net increase or decrease, for that opening balance will be added, automatically closing cash and cash balance will come. Next, trade payables, and that means current liabilities. Opening 3 lakh 16,500, closing 3 lakh 16,950. So increase. Increase means add. Next, outstanding expenses 1 lakh 12,500 opening, 1 lakh 22,700 increase, add. So I think 4 changes will happen, sir. In respect of working capital changes, you see this working capital adjustments. Increase in inventory 1 lakh 77,000. This one minus. Next, trade receivables, add. That is what they say. Trade receivables, add 450. Next, trade payables, add. Trade payables. Yeah, increase in trade payables, add. Decrease in trade receivables, add. Increase in outstanding expenses, add. So you will get 1,59,000 net effect. And if I adjust this, I will get cash generated from operations before tax 40 lakhs 41,000. Now I need to deduct tax paid. So in the question itself, they have given tax paid, sir. See this, income tax paid during there 15 lakh 75,000. Income tax is very important adjustment. So tax paid in the paid given in the question itself, directly you take 15 lakh 75,000. So they deducted 15 lakh 75,000 tax. Then one more item, sir, because in this question extraordinary item is there, sir, because in the net profit they have given income from lawsuits. So this compensation received 1,35,000 by company in a suit filed. So it is an extraordinary item. So this 1,35,000 they have presented separately. See this cash flow from extraordinary item, compensation received in a lawsuit 1,35,000. Like this you need to present, because in theory also I told you, whenever there is an extraordinary item, that extraordinary item has to be shown separately. Then you will get finally net cash from operating activity. So this question is one of the best questions here. It will cover all the non-cash items, so non-operating items, so working capital changes, so extraordinary items, so tax paid, everything given. Okay, next, once you finish the operating activities, next investing activities. Investing activities is basically what? Sale and purchase of assets, so sale and purchase of investments, so receiving interest in incomes relating to those assets and investments, so right? So in the question you see, identify what are the investing activities. First, sale of investment is there. See this, we sold the investments here for 4 lakh 80. So sale of investment is an investing activity, one item. Interest income received on investment activity, in investments, this is also investing activity, another item. So 2 cash inflows. So if you see the investing activity, see this, sale proceeds of investments 4 lakh 90, interest income 90. Any other item, you check it. The land was purchased on 2/4/2021 for 3 lakhs, of which the company issued 22,000 equity shares of 10 each at a premium of 20% to the landowner and balance in cash as a consideration. See, important, sir. Sir, here we purchased a land for 3 lakhs, sir. And for this, the consideration is 22,000 equity shares of 10 each at a premium of 20% to the landowner, and balance in cash we have paid, sir. Sir, only cash transactions will be considered in cash flow statement. Apart from that, if any other, other than cash, in this case, suppose we issued shares, it is not part of cash flow statement. Therefore, when you are considering the purchase of land here, you need to consider only the cash portion. We need to consider only the cash portion. The cash portion is how much, sir? 3 lakhs. We have issued 22,000 shares of 10 each at 20% premium. So 22,000 into 10 plus 20% premium, 2,64,000, 3 lakhs. So it will be 36,000 cash, sir. 36,000 is the cash. So this 36,000 only they have considered. See this purchase. Actually, this is outflow, sir. Outflow. So therefore, any other investing activity, that's it. No other investing activity. Only 3. One is sale of investments. Another one is interest received on investment. Third one, sale of land. So when you're reading the question itself, you mark yourself in examination. What is investing activity? What are the financing activities? What are operating activities? So that time will be saved, sir. So if I 4 lakh 80 plus 90 minus 36. So 5 lakh 34,000, sir. What is this? 5 lakh 34,000. This is net cash flows from investing activities, and then financing activities. So what is financing activities? Any activity relating to borrowings and share capital. For example, you see here interest on debentures paid, financing activity. And also 22,500 10% preference shares of 10 each, 100 which was redeemed on 2/4/2021 at a premium of 5%. So 22,500 redemption of preference shares at a premium of 5%. So 23,62,500. So this is the amount, redemption of preference shares. This is also financing activity. Further, company issued 75,000 equity shares of 10 each at a premium of 20%. So 75,000 into 10 plus 20%. So 9 lakhs. Issue of shares. This is also financing activity. Out of 75,000, 25,000 shares are issued to supplier of machinery. Okay. Supplier of machinery we have issued, sir. Not a problem. Next, dividend for financial year 2021 on preference shares were paid at the time of redemption. So dividend for the year 2021. Actually, we are in the year 21-22. See, when you are preparing cash flow statement, sir, which year expenses we are paying current year doesn't matter, sir. Whether there is a cash outflow or inflow during this year or not, that is important. So dividend of 2021 on preference shares was paid at the time of redemption. Okay, during their we are redeeming, right? So in the year only we paid the dividend of 2021. Yes, we need to consider. So dividend paid on preference shares is also considered as part of what? Financing activity. Next, dividend on equity shares paid on 31st January 2022 for the year 2021 7.5 and interim dividend of 2.5. Not a problem. Total 10 lakhs dividend was paid. So therefore, when it comes to financing activities, sir, one, interest on debentures. See this, interest on debentures paid, given in the question 5,25,000 considered. Another one is issue of redemption of preference shares 23,62,500 considered. Next, and also issue of equity shares, proceeds of issue of equity shares 6 lakhs only they have considered. Why 6 lakhs, sir? Yeah, sir, here one important thing, sir. Out of 75,000 shares, sir, 25,000 shares we have issued for supplier of the machinery, which is a non-cash transaction. So you purchase the machinery, you issued the shares. So for this 25,000 we will not consider, sir. Only for 50,000 we have received the amount at a premium of 20%. So I think 50,000 into 10 plus 20%. So 6 lakhs we need to consider. So that is what they have considered, 6 lakhs. And also, you know, preference dividend paid. At the time of redemption, they have paid preference dividend 2,25,000. So because how to calculate preference dividend? Simple, 22,500 into 100, 10% preference dividend. So 2,25,000. See this outflow. And also dividend paid given in the question, sir. See this financing activity. 7.5, 2.5. Irrespective of the year, sir, whether it is paid in the current year or not, that is important. If it is paid, we will consider. So total 10 lakhs. So financing activities, 5 items, sir. So we got this net cash used in financing activities. Then net decrease overall 3,77,500. Add opening cash and cash equivalents. Opening cash balance they have given in the question itself. 3,94,450. Then automatically you will get closing balance 16,950. Okay, so that's it, sir. So in this question, sir, operating activities under indirect method is the most important thing, sir. One more question from indirect method, sir. January 2025 examination question for 7 marks. See, in this question, they have given the extracts of the balance sheet of a company and they're asking us to prepare cash flow from operating and financing activities. So first cash flow from operating activities, I want net profit before tax and extraordinary items, but no net profit given. Net profit before tax and extraordinary items not given, just balance sheet items given. So when I told you when net profit before tax and extraordinary items not given, there is a way to find out. What is the way, sir? Simple. Go to the P&L account. See the opening balance 60. See the closing balance 1,10,000. What is the meaning? The difference is nothing but current year profit. Current year profit after appropriations. Add back appropriations. You will get net profit before tax. So therefore, whenever net profit before tax is not given in the question, simply they might have given you the P&L account opening and closing balance. So take P&L account closing balance minus opening balance. The difference is nothing but current year profit. Current year profit, but after appropriations. So generally, once you arrive at a net profit, we will do some appropriations from the net profit, like transfer to general reserve, dividend, provision for tax. So if at all these things are there, add back. So like provision for tax, dividend to transfer to general reserve, you will get net profit before tax, because I want net profit before tax. Okay. So in this question, what you are going to do, sir? Opening 60, closing 1,10,000. So the difference is how much? 50. So this is my net profit before tax and extraordinary items. Any appropriations in the question, like transfer to general reserve, dividend, nothing. Of course, here dividend payable is there. This is not current year dividend. Last year opening, this year paid. This year it becomes 0. That means 50,000 dividend was paid during the year. So dividend paid is basically financing activity. Okay. So in this question, they are asking operating as well as financing activities. So first I am focusing on operating activities. So in operating activities, first I want net profit. So the difference between P&L accounts is net profit. Okay. One thing is done. Now to this non-cash, non-operating items, working capital changes. First debentures, one by one item I will check. Share capital you see opening 4, closing 5. So increase in share capital. That means shares was issued during the year. So it is definitely, this increase is what? Financing activity, correct? This increase is financing activity. Debentures opening not there, closing 1 lakh is there. That means debentures was issued at the end of the year. At the end of the year means no interest was accrued on debentures. Okay. Debentures issued during there. Sir, debentures issued is which activity? Financing activity. Okay. Bank loan you see opening 2 lakhs, closing 2,50,000. That means 50,000 bank loan taken extra during the year. So bank loan taken, financing activity. Trade payables opening 75, closing 60. So decrease in trade payables, what we need to? Working capital changes. It is part of operating activities. So working capital changes. 75 has become 60. So trade payables decrease, minus we need to do. Next, dividend payable opening 50, closing not there. That means dividend was paid during there. Dividend paid is which activity? Financing activity, which is not going to affect my P&L. Interest payable on bank loan current year. See, 20,000 opening, 25,000 closing. Important thing, sir. Interest payable on bank loan current year 25,000. Current year. This 25,000 is current years. That means during the year, interest incurred was 25,000, which might have debited to P&L account. And interest payable on bank loan is generally which activity? Non-operating, other than operating. Interest loan, financing activity basically. So, but it has already debited to P&L account. So therefore, what I need to do to net profit? I need to add back to the net profit. Next, goodwill opening 1,50,000, closing 1,20,000. That means there is a decrease. We sold the goodwill. No. Concept of sale of goodwill will not arise. Here there is a amortization of goodwill, sir. Actually, goodwill was decreased by 30,000. So this is amortization of goodwill. This amortization of goodwill is already debited to P&L account. Now we need to add back, because it's a non-cash item. It does not involve any cash now. 1,50,000 has become 1,20,000. So therefore 30,000 decrease in goodwill, amortized goodwill, which debited to P&L account, add back. Next, trade receivables opening 95, closing 65. So how much decrease? 30,000. So this is working capital changes. So decrease in trade receivables, add. Next, inventory opening 30, closing 55. How much increase? 25. So working capital changes, increase. What we need to do? Deduct. So current assets, same effect. Current liabilities, opposite effect. I told you. Current assets, opposite effect. Current liability, same effect. So that's it, sir. So therefore, if I start preparing the operating activities, my starting point is 50. Correct? See this, 50. They have taken. And two adjustments, I think. One adjustment is amortization of goodwill 30, add back to the net profit. And also interest payable on bank loan 25,000, add back. See this, 30, 25. Non-cash items. Then you will get one item 1,05,000. You do working capital changes. Here working capital changes, I think this one, sir, 15,000 decrease. minus 15,000, one thing, this decrease minus 15,000, and also trade receivables add 95 has become 65, 30,000 add back to this, and then increase in inventory minus 25,000. So working capital change is also done. So we got cash flow from operating activities 95, tax paid not there. Now financing activities, how many financing activities are there? Issue of share capital is there, 1 lakh. Issue of debentures is there, 1 lakh. Bank loan bank loan taken 50,000, 3. Dividend paid 4. So 4 items are there in the financing activities, sir. See this. First increase in share capital, yes, it is there, 1 lakh. Bank loan increase, yes, there. Debentures issued, there. Dividend paid, there. And interest paid, very very interesting, sir. Sir, you see, interest payable on bank loan they have given, sir, 25. So therefore, it was assumed that it was paid during the year, this interest. So therefore, they have considered this interest paid also, 20,000. Sorry. This 20,000 belongs to last year, sir. Last year interest was paid in the current year. Correct. So this 25,000 is current year accrued interest. It was debited to P&L account. That's why when you are ascertaining the cash flow from operating activities, you are added back to net profit. Because current year net profit was impacted by this 25,000. Current year expenses. Last year outstanding 20, that was paid in the current year. So therefore interest paid 20,000 you need to consider, not 25. So you will get cash flow from financing activities. So this is the question they have asked in January 2025 for 7 marks, sir. So this is also one more question relating to indirect method. One more question from indirect method cash flow statement. Question number 19, scenario based question, sir, from study material. Actually, this is very good question, sir. Number of adjustments are covered in this question. So kindly practice this question carefully. So there is a company New Light Limited, sir. This company balance sheets as on 31st March 2010 and 11 given, sir. Opening balance sheet to closing balance sheet. Equity and liabilities, shareholders funds, non-current liabilities, current liabilities. Asset side, non-current assets, current assets. When it comes to notes to accounts, we have share capital, reserves and surplus, long-term borrowings, other current liabilities, property, plant, equipment. Look at the additional information. First, they have the company sold PPE for 1 lakh. Cost is 2 lakhs. Depreciation was provided on it was 80,000. So sale of PPE. Okay. Second point, the company also decided to write off another PPE, cost 56, depreciation 40,000 has been provided. This is also relating to PPE. Depreciation given on PPE 3,60,000, non-cash item. Company sold some investments at a profit of 40. So there is a sale of investment. Debentures, preference share capital redeemed at 5% premium. Debentures was redeemed at the year end. Okay. The most important adjustment is this one, 6th. Company decided to value inventory at cost, whereas previously the practice was to value the inventory at cost less 10%. See, previously they are valuing inventory at cost less 10%, sir. Now they decided to value the inventory at cost. That means previously inventory was undervalued. Inventory according to the books on 31st March 2010 last year was 2,16,000. Inventory on 31st March 2011 was correctly valued at 3 lakhs. So that means current year end inventory was properly valued, but last year inventory was undervalued. Okay. How much undervalued? This 2,16,000 cost less 10%. If I assume cost is 100, they have valued at 90. So this 2,60,000 is for 90. So undervalued is for 10. So 2,16,000 into 10 divided by 90. So it is 24,000, sir. So 24,000 is what? Undervaluation of inventory. Now they are asking us prepare cash flow statement as per AS3 by indirect method. Say this. Their testing is indirect method. Therefore, I need to ascertain cash flow from operating activities under indirect method. First, I need to start with what? Net profit before tax. But in the question, is net profit before tax given or not given? So I told you whenever net profit before tax is not given, what to do? So we need to ascertain it by taking P&L account closing and opening balance. The difference is nothing but current year net profit after appropriations. For that, you add back the appropriations like provision for a tax, dividend, transfer to general reserve. You will get net profit before tax. So from the question, go to P&L account. Opening P&L is 2,40,000, closing 3,40,000. So the difference is 1 lakh. That is current year profit after appropriations. But here one important thing, sir. In the additional information, they said last year inventory was undervalued. If it has been valued at cost, our inventory value would have been increased by 24,000. Just now I calculated 24,000. So if the last year closing stock is increased by 24,000, obviously last year P&L account balance should increase by 24,000. So the adjusted opening P&L account balance will be 2,64,000. My closing is 3,40,000. So 2,64,000 minus 3,60,000. So 96,000 is what's the current year profit after appropriations. 96 or 76. One minute. 3,40,000 minus 2,64,000. It is 76,000, sir. 76,000. So this 76,000 is what? This is current year profit after appropriations. Sir, this is closing balance, sir, 3,40,000. This 3,40,000, how we got, sir? Opening plus current year profit after appropriations. But I want net profit of the current year before appropriations. So from this 3,40,000, first reduce the opening balance. But here opening balance of P&L account is adjusted by 24,000 because it is undervalued. Stock was undervalued. So if it have been properly valued, my opening P&L account balance will be 2,64,000. So if my opening is 2,64,000, from this 3,40,000, I reduce 2,64,000. What is the balance available? 76. This 76 is on what? Current year net profit after making appropriations. What appropriations? Maybe transfer to general reserve, provision for tax, current year dividend proposed. Now see one by one appropriations, what happened from the current year profits. First, transfer to general reserve. Because I am in reserves and surplus, sir. See, look at above the P&L account, there is a general reserve. No need to search anywhere. See the general reserve balance. What is the opening balance? 6 lakhs. What is the closing balance? 1,60,000. How much increase? 1,60,000. 6 lakhs has become 7,60,000. So 1,60,000 is increase in general reserve. How it is increased? Because it was appropriated from current year profit. Therefore, if I want net profit before tax, net profit before appropriations, to the 76,000, I need to add 1,60,000. One more appropriation, provision for tax. I need to see in the question, is there any information relating to provision for tax is available? Go to liability side and check current liabilities, because in current liabilities, short-term provisions, provision for tax is available. And also, look at the additional information. Is there any provision for tax information given? Nothing. Only information relating to provision for tax is available is from the balance sheet. Okay. So take short-term provision, provision for tax. Your opening provision 3,60,000, closing 3,40,000. Now, I'm going to explain now one of the important adjustments, that is tax adjustment. See, when you are solving indirect method cash flow statement question relating to taxes, sir, 3 cases are possible. One case is they will give you only opening, closing provision for tax. That's it. In this situation, what is the treatment you need to follow is very simple. Whatever the opening provision is there, assume it was paid during the year. Whatever the closing provision is there, that is current year provision for tax, which is appropriated from current year profits. So therefore, this 3,60,000 is opening. So it was assumed it is paid during the year. So this is income tax paid during the year. This 3,40,000 is what? This 3,40,000 is closing provision for tax, which is appropriated from current year profits. So therefore, this is current year provision for tax. So which should be added back to net profit in order to get net profit before tax, because I want before tax. This 3,40,000 might have been appropriated from current year profits. So this to this 76,000, I need to add back this 3,40,000 also. Okay, that is the treatment. Now, any dividend declared in the current year? No. Additional information also, no declaration of dividend. But relating to dividend, sir, you see other current liabilities, we have dividend payable. This dividend payable, you see opening is there. That means this is last year dividend. Closing nil. That means it was paid during the year. That means current year there is no dividend. Therefore, no dividend was appropriated from current year profit. So here, finally tell me how much is the net profit before tax I will get? 76,000 plus transfer to general reserve 1,60,000 plus current year provision for tax 3,40,000. I think you will get net profit before tax 76 plus 1,60,000 plus 3,40,000. So 5,76,000 is the net profit before tax. 5,76,000. You see the solution I will show you from my notes. So look at the working note 1. First I have done working note 1. In examination you need to present like this, net profit before tax calculation. So how they have done it? First take the closing P&L 340 minus opening, you will get 76. How opening is 2,64,000 sir? 2,40,000 plus increase in inventory 24. Increase in opening inventory if valued at cost is 24,000. Because this 2,60,000 is for 90. How much for 10? 24,000. And appropriations, provision for tax transfer to general reserve. How much we transfer to general reserve? So 6 has become 7.6, so 1.6. So therefore, what is your net profit before tax? 5,76,000, which is exactly we got it. 5,76,000. So when you are solving the question, first to find out net profit before tax. See this. 5,76,000. Now to this net profit, I need to adjust what? Non-cash, non-operating items. While arriving this net profit, whatever the non-cash, non-operating items are there, adjust it. Now from the question, identify the non-cash, non-operating items. Sir, definitely if you read the additional information, sir, third point they have given, sir, depreciation they have given 3,60,000. It is definitely non-cash item. So add back. When you are arriving the net profit, it might have been debited to P&L account. So profit has been decreased by 3,60,000, but it is not relevant for cash flow statement. So therefore add back 3,60,000. So 3,60,000 you see added. Next, sir, whenever sir in the question they have given information relating to sale purchase of PPE, try to prepare the ledger account for PPE. Maybe the balance figure can be additional purchases. Sometimes additional purchases they will not give you. So you need to ascertain. Okay. Sometimes sale of PPE they may not give. You need to ascertain as a balancing figure. Sometimes current year depreciation is not available because depreciation is a non-cash item which I must require it, because in order to complete cash flow from operating activities under indirect method, I want non-cash items also. So therefore here first point, second point, third point is relating to PPE. So better you prepare one ledger account relating to PPE. Okay. So if I prepare ledger account relating to PPE, see what happens. Very simple. Just PPE account if I prepare, sir. Sir, here PPE account is prepared at cost, because in the question if you see carefully, sir, they have given cost separately. This is provision for depreciation separately they have given. So in this case, when cost is given separately, provision for depreciation is given separately, sir, you need to prepare PPE account at its cost. See this. The PPE given at cost, provision for depreciation given separately. In that situation, sir, better you prepare PPE account separately at cost, provision for depreciation account separately. Generally, provision for depreciation account is prepared to ascertain the current year depreciation. Okay. If you have a time, sir, you do one thing, sir. In my channel, I have done one video before the last exams, important adjustments. In that cash flow statement, all the important adjustments I have done. I mean, relating to each and every chapter, I have done important adjustments. You kindly check it once. Of course, even if you solve this question or if you see this question right now I'm solving, you will get clarified. Okay. Now see, if I prepare PPE account at cost, sir, in this case, opening 32, closing 38. So 32 lakhs, 38 lakhs, opening or closing, I got it. Now in the additional information you see, first there is a sale. Sale 1 lakh sale value, cost 2 lakhs, depreciation 80. That means 2 lakhs minus 80. Carrying amount is 1 lakh 20. Right? Sale value 1 lakh. So how much is the loss? 20,000 is the loss. So what is the entry we will write here in this case? Tell me. In this case, the entry could be bank account debit. 1 lakh is the sale value. And whenever you sell the asset, corresponding depreciation will be cancelled. In respect of the asset you sold, what is the accumulated depreciation? 80,000. Next, to PPE. What is the cost of PPE? Sold 2 lakhs. So what will be the loss which is debited to P&L account? 20,000. So this loss you might have debited to P&L account. So which is a non-operating item. So if I present this in this account, 1 lakh, this is sales, sale. Sale of PPE is investing activity. Next to provision for depreciation 80,000. Provision for DIP. And then 20,000 is P&L account. This is loss. So when you are ascertaining net profit before tax, you need to add back because this is a non-operating, non-cash item. Loss, non-operating item. So already net profit was deducted. So add back. Okay. And also you see, relating to PPE, they have given that the company decided to write off another item of PPE. Cost 56,000, sir. Accumulated depreciation on it 40. So see this. They have written off PPE cost of 56. Accumulated depreciation on that was, provision for depreciation is 40,000. So what is loss on written off which is debited to P&L account? 16,000. So if I present this in ledger account, 16,000 is what? Loss on written off, which is non-cash item. We need to add back to net profit to arrive cash flow from operating activities. And also provision for depreciation 40,000. Provision for depreciation. That's it. These are the details they have given, sir. Sir, what about depreciation, sir? Sir, whenever cost of the asset provision for depreciation given separately, if I provide current year depreciation, what is the entry, sir? The entry is depreciation account debit to provision for depreciation. Depreciation to provision for depreciation, and this depreciation will be transferred to P&L account, non-cash item which is already adjusted. So this current year depreciation 3,60,000 will not appear in the ledger account of PPE. Okay. Now this ledger account must tally, sir. But is it tallying? I don't think so it will tally. So 38 lakhs plus 56,000 plus 2 lakhs minus 32 lakhs. So the difference is 8,26,000 came, sir. This 8,26,000 is nothing but additions during the year. 8 lakh, 1 minute. 38 plus 56 plus 2 lakhs plus 32 lakhs. 8,56,000, sir. So this is the balancing figure. So in PPE account, we have a debit balance of 8,56,000. Sir, asset account, any debit balance is obviously what's the additions during the year. So this is purchase of PPE. So purchase of PPE is investing activity, which we need to consider. So therefore, whenever they have given any sale purchases relating to assets, try to prepare a ledger account, try to see whether it is tallied or not. If it is not tallied, maybe a balancing figure will come, which will affect the cash flow statement. Okay. Now, depending upon this account, if I analyze what adjustments I will do to this net profit, see this. This one I will adjust, sir. Loss on sale of PPE and also loss on written off 20,000, 16,000. So see this. The solution, loss on sale of PPE 20, loss on written off PPE 16. Non-cash item, loss on written off, add back, which is not part of cash flow statement, but it is already adjusted in net profit. So net profit, it was deducted, right? Add back. Next, similarly, if you see the questions here, they have given information relating to sale of investments. They have sold some of the investments at a profit of 40,000, sir. Investments was sold at a profit of 40,000. What is the sale value? You see in the question, investments opening 4 lakhs, closing 3,20,000, sir. How much decrease, sir? 80,000. We sold at a profit of 40. That means 1,20,000 is the sale value, correct? So say this. If I prepare investment account, sir, my opening is 4 lakhs, sir, given, closing 3,20,000, sir. And we sold the investment, sir. So whenever there is a sale, what is the entry, sir? Bank to investments. What is the gross sale value? 1.2, 1.2. So investment account is created with 1,20,000. This is a sale value which comes in investing activity, sale of investment. Now in this 1,20,000, what will be the profit, sir? 40,000, because 80,000 cost sold for 1,20,000. So investment account debit to investment account debit to investment to P&L account credit 40. So investment account to P&L 40,000 I will write. So this 40,000 is what? Profit on sale of investment, which is created to P&L account, which is non-operating item. Now I need to deduct it. See this, profit on sale of investment, because it's a non-operating item, right? And here if I close the investment account, sir, any balance figure comes? No. 4,40,000 tally it. That's it. Okay. So therefore all these adjustments we have done. Next, sir, any other non-cash, non-operating items? Yes. You see the question carefully, sir. First point, second point, depreciation, sale, over. Now see the fifth point. Debentures and preference share capital redeemed at 5% premium. Debentures were redeemed at the end. Sir, debentures or preference share capital redeemed, sir. Redemption of debentures and preference share capital is which activity? Financing activity. But here the question is, they are redeemed at a premium of 5%. That premium was debited to P&L account, which is a non-operating item, which is already adjusted in net profit. So therefore we need to add back. So how much is the worth of debentures was redeemed? 4 lakhs has become 2,80,000. That means 1,20,000 redeemed at a 5% premium. So that means 1,20,000 into 5%. So it will be 6,000. And also you see preference share capital 4 lakhs has become 2,80,000. Again 1,20,000 worth of preference share capital was redeemed at 5% premium. So 6,000. So 6,000 total 12,000 was debited relating to premium on redemption of debentures and preference share capital, which is a non-operating item, because it is redemption of debentures and preference share capital comes under financing activity, which is debited to P&L account. So in order to ascertain cash flow from operating activities to this net profit, what I need to do? I need to add back. See this, premium on redemption of debentures 6,000 add back. And also you see the question carefully. Any interest expenses, interest income, sir. See, we have debentures, sir, 4 lakhs. Closing it become 2,80,000. So debentures is 4 lakhs, sir. On 4 lakhs, the interest is 9%, sir. So 36,000 interest. That interest was debited to P&L account, which is a non-operating item, because payment of interest is financing activity. So that 36,000 you add back. So you will get what? Net profit before working capital changes. Now do the working capital changes. See, if you want to do the working capital changes, go to current assets and current liabilities. Now go to first current assets. In current assets, we have cash and cash equivalent, that we don't consider. Other current assets you go. What is there in other current assets? Nothing. Other current assets. Opening 11,10,000, closing 11,50,000. But here one important thing, sir. Last year closing was undervalued. Now we made it at cost. We made a proper valuation. Because of that, 24,000 increase in the last year closing stock. That means last year current assets also would have been increased by 24,000. So therefore your opening current assets will be 11,10,000 plus 24,000. So it will be 11,34,000. So 11,34,000 will be the opening current assets, closing 11,50,000. So 16,000 is what, the increase in current assets. We need to deduct minus. See this, increase in current assets minus. And one more thing, sir, current liabilities. You go to current liabilities, what items are there? Other current liabilities, note number 4. In other current liabilities, we have dividend payable, that we will not consider. Current liabilities, others. Opening 4,80,000, closing 5,20,000. So increase. How much increase, sir? 40. Increase in current liabilities, add. Positive effect. Add. So you will get cash flows from operating activities before tax. From that you reduce the tax balance. Coming to tax paid, I told you your opening provision for tax is how much? 3,60,000. Closing 3,40,000. I told you whenever only opening closing is available, whatever the opening is there, that is assumed to paid during there. So this 3,60,000 was paid during the year. So you will get cash flow from operating activities. So look at how they have approached. So okay, Next, investing activities. Very simple. In investing activities, we already done this account in PP account. In that sale is there. So this 1 lakh sale of investments, purchase of investments, 8,56,000 to 1 lakh. One is inflow, another one is outflow. 1 lakh is inflow. See. Sale of PP 1 lakh, outflow 8,56,000. Relating to investments, there is a sale value 1,20,000. We sold investments, right? So in relating to investments, we sold 1,20,000. So that you need to consider here. 1,20,000. So see, 6,36,000. Now financing activities. What activities are there relating to financing? Observe one by one in the question. See, in the question, if you see carefully, sir, relating to financing, debentures was redeemed. 1,20,000 plus 6,000, 1,26,000 debentures, 1,26,000 preference shares. Both were redeemed, right? 126, 126, you see. Redemption of debentures, redemption of preference shares. 126, 126. And also you see in the additional, in the question, they have clearly mentioned dividend payable opening is there, closing is not there. That means dividend paid during there. Even the last year dividend, I told you, see in cash flow statement, we don't see the, it belongs to which year. Whether it is paid in the current year or not, that is the important. Whether it is received in the current year or not. 1,20,000 opening dividend payable, paid in the current year. So consider it in the financing activity. So 1,20,000, see this. And also relating to share capital, opening 12, closing 16. So 4 lakhs stock was increased. So issue of share capital 4 lakhs. So see, whenever you are doing financing activities, sir, recollect what is financing activity relating to what? It is relating to change in the size and composition of owner's capital, including preference share capital, right? So do that. Identify those items. And also interest on debentures is there, 36,000. It was paid. So you will get it 8,000. So net increase, decrease, nothing, nil. So opening cash 10,000, closing will also be 10,000. So this is one important question, sir, where every point I have covered. Okay. Stock adjustment, in important adjustments list, I covered this, net profit before tax. Stock adjustment also I covered this in this question. Dividend adjustment also I covered. Opening dividend payable is assumed to be paid during the year. Okay. And this adjustment also I covered. PP. PP given at cost separately, provision for depreciation separately, you prepare separate accounts. Sir, if I prepare provision for depreciation account, maybe current year depreciation is the balancing figure. But in the question we solved, sir, just now, current year depreciation is available. Suppose if that current year depreciation not available, sir, you prepare provision for depreciation. In that provision for depreciation, the balancing figure is current year provision, current year tax, current year depreciation, which is added back to net profit to arrive cash flow from operating activities. And next, relating to stock, sir, only one adjustment I told. There are two other cases. Sometimes what happens now, sir, they will give you opening provision, current year as well as closing. All three things will be, they will give, sir. Opening, closing, current year. Then in such a situation, sir, prepare provision for tax account. Opening you write, current year provision by P&L account you write, closing you write. The balance figure is nothing but what? Tax paid during the year. Tax paid, which is part of operating activities. So in ascertaining cash flow from operating activities, you deduct it. That's it. This is one time. I think one question. Yeah, this question, sir. I think question number 18, study material, scenario based question. Number 18, you see. In this question, we have opening provision for tax 60, closing provision 95, sir. And also if you see the additional information, they have given income tax liability for the current year 1,35,000. So here if I prepare provision for tax, opening 60, closing 95. See this, opening 60, sir. Current year 1,35,000. Closing 95. So therefore what is the tax paid during the year? 60 plus 135 minus 95. So 1 lakh is the tax paid during there, which is the balancing figure. You see, I will show you tax paid during the year. It is 1 lakh. So therefore, whenever in the question they will give you opening, closing, current year, ascertain tax paid as the balancing figure. And of course, current year tax liability is nothing but current year appropriation. If you want to find out net profit before tax, add back. And sometimes what happen, they will give you opening, closing, and also provision for tax given. Opening, closing provisions they will give, and tax paid also given. In that case, provision for tax account you prepare, opening you will write, closing you write, tax paid you write, and balance figure is ascertained as current year provision for tax. Okay. And also I told you I solved one question, sir. In the question, if they have given provision for tax liability, they have given opening, closing, advance tax also given. See, whenever they have given any advance tax, sir, current year end, whatever the advance tax is there, 15 lakhs, it was assumed to be paid during there. So tax paid is 15 lakhs advance tax. Okay. So this is question number. Okay. These are the adjustments, sir. All the adjustments relating to stock we have discussed. That's it. So cash flow statement chapter done. Next chapter we are going to cover is buyback of securities chapter. Examination point of view, you can expect one question from this chapter, sir. This is highly practical chapter. Whenever a company wants to buy back its own shares, there are certain limitations and conditions they need to follow. So understanding those conditions and limitations from the Companies Act and applying them in the accounting treatment for buyback of securities, that is the most crucial part of this chapter. So in this chapter, our focus is on understanding those limits, conditions of buyback, and also the accounting treatment. Okay. First, let us try to understand what is buyback. Suppose there is a company A Limited, sir. This company issued 1 lakh equity shares of rupees 10 each. Issued, subscribed, called up, paid up. So this is the paid up share capital, 10 lakhs. Now these shares are there with whom? Equity shareholders. Now from equity shareholders, if company wants to purchase back some shares, suppose out of 1 lakh, company wants to purchase back 40,000 equity shares. That means existing equity shareholders from whom the company wants to purchase, they will be what? Sellers. Company is purchasing its own shares. Okay, sir. After purchasing our own shares, company purchases its own shares. Can these shares be held as investment? So company purchased its own shares. So like suppose a company purchased shares of other company, we are showing as investment asset in the books of purchasing company. Similarly, company purchased its own shares, 40,000 equity shares. Can company hold this as investment? The answer is no, because as per the Companies Act, no company is allowed to purchase its own shares unless there is a consequent reduction of share capital. That means you purchase your own shares, but you cannot hold them as investment. So buyback is not an investment option. In the name of buyback, you cannot purchase your own shares and show them as investment in your books. So company will purchase its own shares. For which purpose? Not for the purpose of holding them as investment, but for the purpose of cancellation. So cancellation, for that the buyback is allowed. So basically in buyback, what happens, sir? Company will purchase its own shares. One thing. Second, the purchased shares will be cancelled. These two things should be there in the buyback. Okay. So that is what they have given. So purchase of own shares with an intention of cancellation. No company is allowed for buyback unless there is a consequent reduction of share capital, and buyback is not an investment option. Now the question arises, sir, why? What company is going to achieve? Of course, see, the purpose, the advantage, depending upon the company, for which purpose the company selected this buyback. Some companies use this buyback as a tool, as a strategy for different purposes. Of course, these advantages and objectives may not be relevant for accounting purpose, but let us quickly discuss them. First thing, to support the share price of the company, especially in a depressing economic conditions, in order to support our share price, company can use this buyback as a strategy, as a tool. Second, to increase the EPS, thereby the market price, company may use buyback as a strategy. And also to increase the promoters holding or to protect the controlling interest of the promoters, company can use the buyback as a strategy. and also to stop the hostile bid to take over the company by the competitors. So company can use this buyback. And also whenever a company has surplus cash balance, they can go for buyback. So these are some of the reasons or objectives, advantages why company will go for buyback of shares, which is not at all relevant. Now the most important in buyback is sources of buyback. Okay sir, a company decided to purchase its own shares. Now the Companies Act coming into the picture, and it says, see, we are giving you three sources. You use any one or combination for buyback. What are those three sources, sir? First, free reserves. Second, securities premium. Third, proceeds from issue. Proceeds from fresh issue, we can say. Proceeds from issue of shares or other securities. These sources you can use. Free reserves, securities premium, proceeds from issue of shares. First, free reserves. What is free reserves? Free reserves means divisible profits, distributable profits, which can be used for any purpose. But it does not include any notional gains, any unrealized gains, any reserve created by revaluation of assets. They are not part of free reserves. And also any change in the carrying amount of assets and liabilities because of the fair value measurement. They are not part of free reserves. If you see the definition of free reserves, you will understand this. Securities premium, okay. Proceeds from fresh issue of shares. See, whenever a company going for buyback, sir, what they can do is they can make a fresh issue. So whatever the amount they got from the fresh issue, they can use it for buyback. But here one important point, sir. Suppose, sir, a company is going for buyback, sir. They want to buy back equity shares and they made a fresh issue. And this fresh issue, they have to make preference shares, sir, not equity shares, because no buyback is allowed from the proceeds of an earlier issue of the same kind or type of shares. Suppose if company wants to go for buyback of equity shares, they can issue preference shares. Suppose they are going for buyback of equity shares and fresh issue also equity shares, not allowed. Not allowed. Because on one hand you are reducing equity share capital, on the other hand you are making a fresh issue of equity shares. It doesn't make any sense. So therefore Companies Act says no. So no buyback we are going to allow from the proceeds of an earlier issue of the same type of shares or securities. Okay, if you see the sources, free reserves, securities premium, proceeds of issue of any shares or other specified securities. No buyback of shares or securities can be made from the proceeds of earlier issue of the same type of shares or securities. Right? And here other securities means ESOPs. And free reserves also I discussed. So remember these sources. Again, I am going to link these sources with the CRR concept. Next, limits for buyback. This is very, very important, sir. Okay. Sir, company decided to bought back its shares. Is there any limits? Yes. There are certain limits. The maximum number of shares a company can bought back. Maximum number of shares to be bought back is equal to least of the above 3. Least of the above 3. Least of the above 3. See, from the provisions of the Companies Act, sir, we have prepared 3 tests. Test number 1, which is called resource test. Test number 2, which is called shares outstanding test. And the last test, test number 3, which is debt equity ratio test. Debt equity ratio test. These are the 3 tests, sir. Okay. Resource test, shares outstanding test, debt equity ratio test. So the maximum number of shares to be bought back is what? Least of the above 3. So according to each test, we need to find out how many maximum number of shares a company can buy back. For example, as per resource test, 20,000 shares we can buy back. As per shares outstanding test, 25,000 equity shares we can buy back. As per debt equity ratio test, we can buy back 30,000 equity shares. So least of the above 3 is what? 20,000 equity shares. So therefore, a company can buy back maximum 20,000 equity shares. See, from this chapter, they are going to ask two type of questions. One type of question is, they will give you capital structure of the company, and they will tell you company wants to buy back this many number of equity shares, or this many number of shares they want to buy back. And they will ask you whether it is within the permissible limits or not. Then what you need to do is, you need to calculate the maximum number of shares to be bought back by applying these three tests. According to each test, what is the number of shares to be bought back, you find out, and you take the least, and you compare with the number of shares company wants to buy back. If it is within this limit, then buyback is allowed. Otherwise, buyback is not allowed. For example, here 20,000 equity shares is the maximum number of shares to be bought back. Suppose a company wants to buy back 18,000, which is within the limits, so buyback is allowed. Suppose company wants to buy back 22,000, that means buyback is not within the limits, so buyback is not allowed. So therefore, these are one type of questions they are going to ask. Now understand what is this test is all about. See, these are nothing but the limitations which is prescribed by the companies, and the names we have given, sir. Resource test, shares outstanding test, debt equity ratio test. If you see the Companies Act, these names will not be there, but the conditions, the limitations will be there. Now, first see the resource test. What this test says is very simple. See, this test, they are talking about amount. What is the maximum amount you can use for buyback? The Companies Act says, sir, the maximum amount you can use for buyback is 25% of paid up share capital plus free reserves. That's it. You can use maximum 25% of the paid up capital plus free reserves. Paid up share capital plus free reserves. Here paid up share capital means equity plus preference. Free reserves including securities premium you have to consider. Suppose for example 25% of paid up share capital 100, free reserves 50, total 150. So 150 into 25, which is 37.5 lakhs for example. So the maximum amount a company can use for buyback under resource test is 37.5 lakhs. Sir, by using this 37.5 lakhs, how many shares we can buy back? Divided by buyback price. Suppose the buyback price is 20. Each share we are buying it to 20. So therefore 1.875 lakhs shares a company can buy back as per resource test. Now second test, shares outstanding test. Sir, this test talks about the number of equity shares to be bought back. Number of equity shares to be bought back. The condition is that Companies Act says the number of equity shares to be bought back cannot exceed 25% of paid up equity share capital of that financial year. In that financial year, what is the paid up equity share capital of the company? On that, apply 25%. For example, paid up equity share capital is 100 lakhs. On that, 25%. That means 25 lakhs. 25 lakhs. And I want number of shares to be bought back divided by nominal value. Suppose the nominal value of each share is 10. So therefore 2.5 lakhs shares company can buy back as per shares outstanding test. Understand the difference between the resource test and shares outstanding test. In resource test we are talking about amount. In shares outstanding test we are talking about number of shares to be bought back, which is simply you can calculate number of equity shares into 25%. Next, debt equity ratio test, which says the debt and equity should be maintained in 2:1 ratio. That means the Companies Act says you need to ensure that after buyback, if your debt is 100 rupees, your equity should be 50. So this ideal ratio should be maintained. By following this ratio, how many shares you can buy back? That is the number of shares to be bought back as per debt equity ratio test, which we are going to understand by solving one question, sir. So therefore, three tests. Okay. So what is the first test, sir? Resource test, which is talking about amount. What is the maximum amount you can use for buyback? 25% of the paid up capital plus free reserves. What is the second test, sir? Shares outstanding test. This test talks about which? Equity shares. Number of equity shares to be bought back. What is the maximum limit, sir? 25% of the total paid up equity capital of that financial year. Next, what is the third test, sir? Debt equity ratio test. What is the ideal ratio, sir? 2:1. So it should not exceed 2:1. Here, debt equity. What is debt here? Debt means both secured plus unsecured. Equity means, equity here doesn't mean only equity share capital. Here equity means paid up share capital plus free reserves including securities premium. Sir, understand, sir, in buyback, whenever you are taking free reserves, please include securities premium also. So okay, so that's it. So the maximum number of shares to be bought back, least of the above three. So understand these three limitations, very, very important. There are some other legal provisions also, which is purely theoretical, which is not relevant for accounting purpose. But another important concept is CRR. Okay, listen to me carefully. So first, sources, free reserves, securities premium, fresh issue. Second, limits, three limits: resource test, shares outstanding test, debt equity ratio test. Okay, maximum number of shares to be bought back, least of the above. And what is the last one? I mean, the concept of CRR. Understand, sir? What is CRR, sir? Capital Redemption Reserve. See this. Look at the name. Observe this name. Capital Redemption Reserve. You have redeeming the capital. That's why you are creating this reserve. That's why this is Capital Redemption Reserve. Sir, am I redeeming the capital here? Yes. See, you are doing buyback. In buyback, ultimately what happens, sir? Company purchasing its own shares and then cancelling them. That means there is a scale down of capital. That means there is a redemption of capital. And one more thing, sir. I think redemption of preference share capital. In redemption of preference share capital also, as per section 55, when you are going for redemption of preference share capital also, concept of CRR will arise. So the common thing between these two is what? If you ask me, the common thing is that there is a scale down of capital. Scale down of capital. Share capital is decreasing here. Okay, sir. What happens if there is a scale down of capital? Why they brought this concept of CRR? For that, I am explaining the reason. The beginning point is that because of the buyback, because of the redemption of preference shares, here our focus is on buyback. Ultimately, in buyback, share capital was reduced. Okay. So whatever this capital is been scaled down, maybe they want to create that capital. They want to fill that gap which is created by redemption of or buyback of securities. How they are going to fill it up? That's why in the sources, one of the sources is what? Fresh issue. Proceeds from fresh issue. For example, a company is going for buyback. So the nominal value of equity share capital they are buying back is 100,000 lakhs. Example, the nominal value of shares they are buying back and cancel. I'm taking nominal value 1,000 lakhs. Now this company have selected a fresh issue. For the purpose of buying back, they have made a fresh issue. From the fresh issue, whatever the proceeds they collected, they use it for buyback. Suppose I told you they issued preference share capital. Nominal value 1,000 lakhs. See this. That means because of the buyback, there is a scale down of capital. Since company is depending upon the fresh issue, capital was increased. So therefore here, when company depends upon the fresh issue, on one hand there is a reduction in the capital, but on the other hand there is an increase of capital. So there is a scale down of capital is not arising. That's why the concept of CRR will not arise when company depends upon the fresh issue. To the extent of the nominal value of shares so bought back by using fresh issue, no need to create CRR. Why? Because there is no scale down of capital. Okay, sir. And creditors also happy because company is not utilizing the existing sources. Rather, company is making a fresh issue. Whatever the amount collected, they are utilizing for payment. But imagine a situation, sir. Company is going for a buyback, sir. Buyback. Nominal value of equity share capital they are buying back is 1,000 lakhs. But there is a scale down of capital. But see here, company is not making a fresh issue. So that means there is a scale down of capital and there is no fresh issue. That means whatever the capital has been down, that has not been filled up. Now, how we are going to fill this capital? That they are bringing through the law. The law says here, in case of buyback, you are not making a fresh issue, but there is a scale down of capital because of buyback. You do one thing. Whatever the free reserves or securities premium which is available in your company, to the extent of the nominal value of shares so bought back, you transferred from your free reserve securities premium to CRR account. That means free reserve securities premium basically is available to whom? Equity shareholders. Now make them as restricted reserve, transfer to CRR. Once you transfer this amount to CRR, next they are saying that this CRR amount will be utilized only for fully paid bonus shares. So what is the logic for this? Fully paid bonus shares. Again, bonus shares will be issued to whom? Existing shareholders. That means in the name of buyback, there was a scale down of capital and again they want to fill that gap. In that the first step is let's transfer the nominal value of shares so bought back from free reserve securities premium to CRR. This is the first step. The second step is use this CRR for fully paid bonus shares. Okay, so if anybody asks you why CRR is created, you have to be very logical. The first reason could be capital intactness. How capital was intact, sir? See, That's why I understand the concept, sir. When you are going for a buyback, sir, if you are depending upon the fresh issue, that's why I've given this example. Nominal value of equity share capital 1000, fresh issue also 1000. So there was capital is intact. There is no scale down. But when there is no fresh issue, there is a scale down of capital. Then Companies Act is coming into the picture, which says you do one thing. First, you need to transfer the amount to CRR. Later, again, they will use this CRR to issue fully paid bonus shares. So that whatever the capital reduced, that capital has to be filled up. Okay, sir. We understood. Capital was intact. Okay. Why? To protect the interest of creditors. How creditors' interest is protected? Sir, suppose you are the creditor of a company, sir. When company is going for buyback, if the company made a fresh issue, you are not, when the company is depend upon fresh issue, you are not worried. But when the company is not making a fresh issue, that means they are using the existing sources, existing resources. You are not happy as a creditor. Because as a creditor, your feeling is that I have to be paid first. If the company is utilizing the existing resource for the equity shareholders, I am not happy. Therefore, the Companies Act is coming to the picture, which says, creditors, don't worry. What we do is, we will introduce a provision which says that a company, since you are using existing sources for buyback, you do one thing. Whatever the free reserve securities premium which belongs to the equity shareholders, to the extent of the nominal value of shares so bought back, you transfer to an account called CRR. Once you transfer this from free reserves or securities premium to CRR, that means you are restricting that amount. That means in future it will not go in the form of dividend to the shareholders. So that's how the creditor's interest will be protected. Hope you understand the concept. So therefore, tell me the bottom line when you are going to create CRR. In the question you see, if the company is going for a fresh issue, okay, to the extent of the nominal value of shares so bought back by fresh issue, no need to create CRR. But for the remaining part, suppose in the question there is no fresh issue, whatever the nominal value of shares so bought back, you transfer from free reserves to CRR. Later the CRR will be utilized for fully paid bonus shares. I explained the concept of CRR also. And then entries for buyback. Last concept, accounting treatment, accounting entries. See, when it comes to accounting entries for buyback, sir, 4 entries you have to keep in mind, sir. 4 entries, that's it. 4 entries. First entry, buyback entry. Buyback entry. Suppose when company bought back its shares, they have to write an entry. The entry is, suppose company bought back equity shares. So equity share buyback account debit. They will open an account called equity share buyback account. To bank account they will write, because they need to make the payment to the existing shareholder. So bank account will be created, equity share buyback account will be created, debited. Next, once a bought back is over, the shares bought back will be what? Cancelled. Buy and cancel. So when you cancel the shares, what happened? Tell me. Equity share capital will be reduced. To what extent? To the extent of the nominal value. And you cancel this dummy, temporary account we created, equity share buyback account, in the first entry. So equity share capital to equity share buyback account. This equity share buyback is nothing but what is the amount of buyback? Nothing but what is the amount we are using for buyback. And the difference is nothing but premiums, or premium on buyback. Premium on buyback. Suppose you are buying back 1000 lakhs nominal value of equity share capital, and you are spending 1500 lakhs. See, generally, in order to, encourage the existing shareholders so that they will sell the shares to the company, we will offer more price than the, we will offer much higher price than the market price. So that will go to premium, sir. Suppose here in this case, premium. So first buyback entry, after that shares bought back will be cancelled. Now third entry is what? Adjustment of premium. Adjustment of premium. Whatever the premium on buyback is there, no sir, adjust it. So this premium on buyback we will adjust against what? Free reserves or securities premium we will adjust. First we will adjust to securities premium, then free reserves. So this premium will be adjusted. Premium on buyback. Okay. And the last entry, the most important entry, is transfer to CRR. So understand, to the extent the nominal value of shares are bought back, not by making fresh issue. That means we are depending upon free reserves or securities premium. So from free reserves or securities premium, you transfer the amount to CRR account. So that's it. This is the entry number 4. Okay. So this is the theory part of this entire chapter, sir. Next, what we are going to do is, I'm going to solve the questions relating to buyback. So we'll take some questions and we'll understand how these conditions will work in the questions. Now in buyback of securities, let us see some questions here. Question number 8, scenario based question from study material. See this question. There is a company SMM Limited. The capital structure as on 31st March 2011 given rupees in crores, sir. Two situations given, situation 1 and 2. Loan funds are different. That means debt is different. Remaining data, share capital reserves same. So what they're asking, sir, the company has offered a buyback price of 30 per equity shares. So they're buying back equity shares. You are required to calculate maximum permissible number of equity shares that can be bought back in both the situations. So they're asking us maximum number of shares to be bought back by following the provisions of Companies Act. And also pass necessary entries. Now you tell me how to find out the maximum number of shares to be bought back. Least of the above 3 tests. Resource test, debt equity ratio test, shares outstanding test. So situation 1 and 2. So when the situation is 3,200 crores, when the situation is 6,000 crores, what is the maximum number of shares to be bought back? See, first I will apply resource test. What this test says, sir, the maximum amount which can be used for buyback cannot exceed 25% of the paid up share capital plus free reserves. What is the paid up capital here? 1200 plus free reserves. Free reserves, general reserve 1080 plus P&L account 200 plus including free reserves, securities premium 400. Infrastructure development reserve we will not consider. So 25% of 2,880 crores. 25% of 2,880 crores. So it will be 720 crores. This is the maximum amount which we can use for buyback. 720 crores. Okay. Sir, by using 720 crores, how many shares we can buy back, sir? Divided by buyback price, 30. 720 divided by 30. So it will be 24 crore shares. So therefore, the maximum number of shares to be bought back under resource test is 24 crore shares, sir. You see. So statement showing maximum number of shares to be bought back when the loan funds is 3,200, 6,000. Share resource test, if you see, 24, 24. Resource test. Because irrespective of the loan funds, the number of shares to be bought back is same. That is 25% of the paid up capital plus free reserves. Next, shares outstanding test if I apply. Shares outstanding test, which says the maximum number of equity shares to be bought back cannot exceed 25% of the paid up equity share capital. Paid up equity share capital is 1200 crores. So 1200 into 25, which is 300 crores. Divided by face value 10 rupees per share. Divided by 10 rupees. Face value per share. So therefore 30 crores is the maximum number of shares to be bought back. 30 crores. Or else simply what you can do is 1200 crores divided by 10. That means 120 crores equity shares are there. On that directly you can apply 25%, which is 30 crores. So the maximum number of shares to be bought back as per shares outstanding test is, see this, 30 shares outstanding test. Very simple. Just apply. So shares outstanding test, resource test. Now the most important thing is debt equity ratio test. So this is the test you need to focus on. So debt equity ratio test, sir. Debt equity ratio test. See, here two situations, right? Situation 1, situation 2. Situation 1, when the loan funds are 3,200 crores. Situation 2, when the loan funds are 6,000 crores. See, this is your debt. You maintain 2:1 ratio. So if your debt is this much, what will be the equity after buyback? What will be the equity I need to maintain after buyback? Tell me. Exactly half. So it will be 1,600 and then 3,000. So this is the equity I need to maintain. But what is my present equity? Present equity in the company. Equity means paid up capital plus free resources, including securities premium. Already we ascertained 2,880, 2,880. Now straight away, if you see situation number 2, sir, yet present your equity is 2,880, but after buyback you need to maintain 3,000. So therefore, is there any reduction in equity is possible? Not possible. Therefore, as per test 3, the maximum number of shares to be bought back in situation number 2 is nil. Nothing. Because if I buy back, what happens here is We know CRR, we need to transfer the amount from free resource to CRR. Therefore, my present equity will further sink in, further reduces, which will not maintain 2:1 ratio, because present equity itself 2,880 sir, and in future I need to maintain 3,000. So therefore here buyback is not permitted as per debt equity ratio test when the loan funds are 6,000 crores. So therefore the maximum number of shares to be bought back when the loan funds are 6,000 crores is 0, because least of the above 3. So therefore if you see, when the loan funds are 3,000 crores, debt equity ratio test nil. Why nil? Understand. Because my present equity is 2,880, but I need to maintain 3,000, so buyback is not permitted. So therefore here maximum number of shares to be bought back is nil, whichever is least, when the loan funds are 6,000. Now when the loan funds are 3,200, what happens? You see carefully. See, when the loan funds are 3,200, my present equity 2,880, the equity to be maintained after buyback is 1,600. Therefore, how much reduction is possible? Can you tell me? In equity, how much reduction is possible? From 2,880, it can reach up to 1,600. So therefore, 1,280 I can reduce. But first, from this 1,280, I need to transfer the amount to CRR. How much amount? To the extent of the nominal value of shares so bought back, which I don't know. Okay, because in the question you see, company is not going for fresh issue. Therefore, the act says whenever there is a buyback by using free reserves or securities premium, to the extent of the nominal value of shares so bought back must be transferred from free reserves to free reserves or securities premium to CRR. So therefore, in the equity of 2,880, first we need to transfer the amount to CRR. How much amount I need to transfer? To the extent of the nominal value of shares to be bought back. How much is the nominal value of shares I am buyback? For that I need to find out what is the equity eligible for buyback as per debt equity ratio test. So therefore from this 1,280 or from the present equity 2,880, first I need to transfer the amount to CRR. Then only the balance amount is eligible for buyback. So therefore what to do here, sir? See here, from the study material, there is a pattern they have given. There is a way of solving this. Only if you do that, they will allot marks. So here you need to frame two equations, sir. Two equations you need to frame, sir. First, equation number 1. That is, amount to be transferred to CRR, assume X. And second, maximum amount permissible for buyback. Permissible for buyback, assume Y. So based on these two things, you frame an equation, sir. I will frame an equation, sir. See this. What is the maximum amount permissible for buyback? Y is equal to, what is my present equity? 2,880. From that, first I need to transfer the amount to CRR. And what is the equity I need to maintain after buyback? 1,600. 1,600. See this. 1,600. So therefore, maximum amount permissible for buyback Y is equal to 2,880 minus amount to be transferred to CRR, which is X, minus 1,600. So it will be 1,280 minus X. Y is equal to 1,280 minus X. This is one equation. Equation number 1. Equation number 2, that is amount to be transferred to CRR, that is X is equal to, what is the amount we are going to transfer to CRR? Y, that is maximum amount permissible for buyback, divided by buyback price 30. Then you will get number of shares to be bought back into face value or nominal value. You will get number of shares to be bought back. Nominal value of equity share capital buying back, which is exactly equal to CRR. CRR, how much amount do you transfer to CRR is nothing but nominal value of shares you are buying back. So Y divided by 30, you will get number of shares to be bought back into face value. So therefore 3x is equal to Y. This is equation number 2. So solve these two equations, sir. Solve these two equations. If I solve, what happens is, so if I substitute this here, Y is equal to 3x. So 3x is equal to 1,280 minus x. So 4x is equal to 1,280. So x is equal to 1,280 divided by 4. That is 320. So therefore amount to be transferred to CRR is 320, sir. So Y is equal to 1,280 minus 320. So therefore 960. So this is the amount eligible for buyback. So therefore, if 960 crores is eligible for buyback as per debt equity ratio test, and I am buying back each share at 30 divided by 30. So therefore, 32 crores is the maximum number of shares I can buy back as per debt equity ratio test. Okay, 32 crores. So the maximum number of shares to be bought back as per debt equity ratio test when the loan funds are 3,200 is 32 crores. So how we got 32 crores? Very simple. What is the present equity? 2,880. What is the equity to be maintained? 1,600. So how much reduction? 1,280. But from that, first I need to transfer the amount to CRR. So I frame two equations. What is the equation number 1? Maximum amount permissible for buyback, which is Y, is equal to present equity minus amount to be transferred to CRR minus equity to be maintained after buyback. So Y is equal to 1280 minus X. Next, second equation, what is the amount to be transferred to CRR is equal to what is the maximum amount permissible for buyback, which is Y, assumed as Y, divided by buyback price into face value. So therefore, if you solve these two equations, you will get the X and Y. X is nothing but amount to be transferred to CRR. Y is nothing but the maximum amount permissible for buyback divided by buyback price. You will get number of shares to be bought back as per debt equity ratio test. Okay. So therefore, when the loan funds are 3,200, what is the maximum number of shares to be bought back? The least, which is 24. So they're asking entries also. So when the loan funds are 3,200 crores, you pass the entries. First entry, equity share buyback account debtor to bank account. How many shares you are buying back, sir? 24 crores. 24 crores into 30. So 24 into 30, which will be 720, 720. Now shares bought back will be cancelled. So when you cancel a shares, 24 crores into 10. So equity share capital will be debited with face value 240 and you are paying 720. So therefore premium payable on buyback will be 480, which is the balancing figure. And then this premium will be adjusted against securities premium. If it is not sufficient, general reserve or P&L account. So premium payable, so 480, which they have adjusted against these things. Okay. Next, to the extent of the nominal value of shares of bought back, we need to transfer the amount from free reserves to CRR. See this. What is the nominal value of shares we bought back, sir? 24. 24 into 10. So 240 we have transferred to CRR. And how we are going to present this debt equity ratio test like this. See this. See, when the loan funds is 3,200, equity to be maintained 1,600, present equity 2,880. So what is the future equity shareholders fund? After transferring to CRR, 2,880 minus 320, 2,560. Maximum permitted 960. Maximum number of shares to be bought back 960 divided by 30, 320, 32 crores shares. So two equations you see. Equation number 1, equation number 2. Okay. This is how we are going to solve, sir. These are one type of questions they are asking. Similarly, you see question number 10, sir. There is a company Competent Limited. This company balance sheet given on 31st March 2011. So what happened is this company wants to buy back 25,000 equity shares of 10 each on 1st April 2011 at 20 per share. So they want to bought back 25,000 shares. Comment with your calculation whether buyback of shares by the company is within the provisions of Companies Act. So they're asking whether the buyback is within the limits. That means you need to find out the maximum number of shares to be bought back. Then if it is 25,000 or above, then buyback is within the limits. Otherwise, buyback is not within the limits. So therefore, you need to follow resource test to shares outstanding test to debt equity ratio test. So resource test, if you see, 25% of the total paid up capital plus free reserves. So here, 25% of the total paid up capital, 12,50,000, securities premium 2,50,000, P&L account 1,25,000 plus revenue reserve 15 lakhs. So total 31,25,000, sir. Free reserves, paid up share capital plus free reserves including securities premium. On that 25% if I apply, you will get 7,81,250. So this is the maximum amount permitted for buyback divided by each share we are buying at 20 rupees. So divided by 20. So therefore 39,062.5. That is the maximum number of shares to be bought back as per resource test. See this 39,062.5, which is 39,062. So maximum number of shares to be bought back as per resource test 39,062. Okay. Next, shares outstanding test. Actually, if you see the question carefully, we have 12,50,000. Each share face value 10 rupees. So that means 1,25,000 into 25%. So 31,250. That is the maximum number of shares to be bought back as per shares outstanding test 31,250. Next, debt equity ratio test. That is the most important test. So in debt equity ratio test, how we are going to approach? Very simple. Same manner. First you take the debt. Debt portion you take. What is the debt portion of this company, sir? Come to the debt. First we have long-term borrowings 28,75,000. 28,75,000. 2875 plus other current liabilities 16,50,000. So this is total debt 2875 plus 1650. 45,25,000, sir. This is the debt, sir. If this is the debt, equity will be half of it 22,62,500. This is the equity we need to maintain after buyback, correct? But what is the present equity of the company? Present equity, just now we got it. Paid up capital plus free reserves including securities premium. What is the present equity? 31,25,000. 31,25,000. So therefore, from this 31,25,000, first we need to transfer the amount to CRR. So again, two equations I will frame. Equation number 1, what is the maximum amount permitted for buyback, which is Y is equal to my present equity 31,25,000 minus X, that is amount to be transferred to CRR, minus equity to be maintained after buyback 22,62,500. So therefore, Y is equal to 31,25 minus 22,62,500, which is 8,62,500 minus X. This is one equation, sir. Equation number 2, that is what is the amount I need to transfer to CRR, is equal to maximum amount permitted for buyback divided by buyback price 20 into face value per share. So therefore 2x is equal to Y. So now solve these two equations. So 2x is equal to 862,500 minus x. So 3x is equal to 862,500. So therefore x is equal to 862,500 divided by 3, which is 2,87,500. Therefore amount to be transferred to CRR is 2,87,500. So y is equal to, from 8,62,500, if I transfer 2,87,500 to CRR, what is the amount eligible for buyback, sir? 862,500 minus 287,500. So which is 5,75,000. This is the maximum amount permitted for buyback divided by buyback price 20. So therefore maximum number of shares to be bought back is 28,750 as per debt equity ratio test. See this, as per debt equity ratio test, 28,750 shares they need to buy back. See this, clearly given. Loan funds how much? 45,25. What is the equity I need to maintain? Exactly half of it, 22,6,500. What is my present equity? 31,25. And if I transfer the amount to CRR, what will be the balance? 28,37,500. Therefore, after buyback, my equity shareholders fund is 28,37,500, and I need to maintain 22,6,500. Therefore, what is the amount I can reduce, which is nothing but the amount permitted for buyback, that is 5,75,000. So by using 5,75,000 at each share bought at 20 rupees, what is the maximum number of shares I can bought back? 28,750. So therefore, see this, as per resource test 25, as per shares outstanding test 31,250, as per debt equity ratio test 28,750, whichever is least, 25,000 shares. So the answer is 25,000 shares they can, no sir, what is the maximum number of shares they can bought back? 25,000, correct. No, maximum number of shares to be bought back is 31,250, 39,62, 28,750. 28,750 least, and they want to buy back 25. So therefore buyback is within the limits. See this, resource test 39,62, outstanding 31,250, debt equity ratio 28,750. So 28,750 is the maximum number of shares to be bought back, and company wants to buy back 25,000. So within the limits. Okay. So this is another type of question they are asking. And these are one type of questions, sir. They will test you whether the buyback is within the limits or find out the maximum number of shares to be bought back. Another type of questions is they will give you directly the company is going for buyback or do the accounting treatment. Like that, they will ask a question. So see this question. For example, illustration number 3, there is a company D Limited. Their balance sheet given, sir, in thousands. So share capital, reserve surplus, trade payables, so asset side data given. Share capital, you see, authorized, issued, subscribed, 250,000 shares of 10 each fully paid up, 2,000 10% preference shares of 100 each, issued 2 months back for the purpose of buyback. See this. In this case, company made a fresh issue of preference shares for the purpose of buyback, clearly given in the question. So therefore, to the extent the buyback is done by using proceeds of fresh issue, CRR is not required. So 200. So to that extent, not required, sir. CRR not required. So company passed a resolution to buy back 20% of its equity capital at 50 per share. For this purpose, it sold all investments. You are required to pass necessary entries and prepare a balance sheet. So they are asking us pass necessary entries and also balance sheet. So in this case, what are the necessary entries? First, they sold investments. So sale of investment entry we will write. Then buyback entry. Shares bought back will be cancelled. So first sale of investments. Investments are sold for 22,000, sir, actually. Here. Original value of investments 3,000. And they sold it for 22 lakhs. So therefore there is a loss. So what is the entry? Bank account debtor, investment account debtor, P&L account will be debited. Loss. So this bank account 2,200, P&L account loss, investment account will be created. Now buyback. 20% of equity share capital we are buying back. 2,50,000 into 20%. That means 50,000 shares. Each share we are buying at 50. So therefore 25 lakhs. So equity share buyback account debtor to bank account. Equity share buyback to bank. 25 lakhs, 25 lakhs. In thousands it is 2,500, 2,500. Actually number of equity shares is 2,50,000, sir. So 2,50,000 into 20% we are buying back. And each share we are bought back at 50. Now shares bought back will be cancelled. So equity share capital account debit 50,000 equity shares of 10 each. So 5 lakhs. In 1,000 it is 500. Premium on buyback balance 2,000. And equity share buyback account 2,500 will be cancelled. Now this premium is adjusted against securities premium. Premium on buyback adjusted against securities premium. Then this is the most important thing, sir. How much amount you transfer to CRR? What is the nominal value of shares bought back here? See this 500. 500 is the nominal value of shares we are bought back and cancelled. Out of this 500, through fresh issue, we receive 200. So to that extent, CRR not required. So therefore, we need to transfer from free reserves to CRR only 300. So therefore here the free reserve is what? Revenue reserve. So from this either you can use revenue reserve or P&L account also, nothing wrong, whatever be the free reserves. So from that free reserves we need to transfer the amount to CRR, including securities premium also you can use. But the important thing is how much we need to transfer to CRR? Only 300. Okay. And you need to prepare the balance sheet. Once you complete the buyback, after that you need to prepare the balance sheet. What changes happened in the respective items. After that you need to prepare the balance sheet, sir. So this is one type of questions. So in this question, they are not going to test what is the maximum number of shares to be bought back like that. Okay. That's it. Hello, my dear students. Hope all of you are fine, doing great. The next chapter we are going to discuss is amalgamation of companies, sir. Examination point of view, 114 marks question regularly they are testing from amalgamation of companies topic. And also a 4 or 5 marks question they are asking from PC calculation, sir. So in this chapter, sir, the most important areas are PC calculation and accounting treatment for amalgamation in the books of transfer and transferee, especially transferee books they are testing, sir. So let us start discussing this amalgamation of companies chapter along with accounting standard 14, sir. Okay. Now let us first start with the what is amalgamation basically. See, when two or more companies liquidated and joined together to form a new entity is called amalgamation, sir. Suppose there are two entities, sir, A limited, B limited, sir. These two are individual independent companies. Suppose A limited liquidated by transferring their business to a new company AB limited. B limited is also liquidated by transferring their business to AB limited. This is basically called amalgamation. Two or more companies liquidated and joined together to form a new entity. Here A limited, B limited are liquidated by transferring their business to AB limited. Now here AB limited is a new company which is called a transferee company, which will continue after amalgamation, also called as purchasing company. And A limited, B limited are old companies which are called transferor companies because they are transferring their businesses, and also called as selling company because they are selling their business to purchasing company AB limited. So now what will be the accounting treatment in the books of A limited, B limited, that is transferor company books? What will be the accounting treatment of AB limited, transferee company or purchasing company? That is what we are going to learn in this chapter. For that is what for AS 14 has came into picture. Accounting treatment in the books of transferor company, transferee company. Now one more important point, sir, here. See, here AB limited is purchasing the business of AB limited, A limited and B limited. Now tell me, when you purchase something, you have to pay in return, right? Similarly, the new company, the purchasing company has to pay some consideration to the shareholders, the owners of the transfer company, that is called PC. So PC is basically what? The consideration which is payable, which is payable by the purchasing company or transferring company to the shareholders of transfer company. The PC can be in the form of shares, or it can be in the form of cash, or it can be in the form of any other securities. Just whatever is given by transferee company to the shareholders of transfer company, you add everything, you will get purchase consideration. So that's why PC calculation is very, very important here. And one more thing here you need to understand, sir. If you read accounting standard 14 carefully, AS 14 is applicable only for transferee company, not for transferor company. Okay, AS 14 is applicable only for transferee company. Simple reason, sir. Transferor company anyway is liquidated, na, sir. So that will be no more in existence. So therefore, the only accounting treatment is closed books of accounts. So the accounting standard 14, whatever the accounting treatment they are giving, na, sir, they are giving only for transferee company, purchasing company. Okay, next. So we understood what is amalgamation. Now there is another word called absorption, sir. What is this absorption? Simple, sir. One company take over the business of another company, or suppose B limited is liquidated by transferring their business to A limited. A limited is absorbing B limited in it. Now B limited is no more, will be in existence. So B limited is called transferor company, which is transferring their business, or also called selling company. A limited, which is purchasing the business of B limited, is called transferee company or purchasing company. So in the books of A limited, B limited, what will be the accounting treatment? That is what we are going to cover under this chapter. One more thing, sir, there is a concept called external reconstruction. Sir, basically what is external reconstruction? Simple, sir. A new company is formed to take over the business of existing company, or an existing company transformed itself into a new company. For example, A limited transformed itself into AB limited. Now here AB limited is a new company which is going to continue after external reconstruction, which is transferee company. A limited is old company which is going to transfer their business to AB limited, transferor company. See, there are actually two types of reconstructions: internal, external. External reconstruction is learned as a part of amalgamation. Internal reconstruction, there is a separate chapter. So therefore, two or more entities liquidated and formed as a new entity, or one existing company take over the business of another existing company, or a existing company transformed itself into a new company. So amalgamation, absorption, external reconstruction. Now after learning the technical meaning of these things, the interesting part is AS 14 says amalgamation includes absorption and external reconstruction. So therefore, whether you call it as amalgamation, absorption, external reconstruction, there is no difference. Amalgamation includes absorption and external reconstruction. So when you're solving the question, suppose you see two companies liquidated and formed as a new company, or one existing company take over the business of another existing company, or a new company is formed to take over the business of existing company. These are all part of amalgamation only, and accordingly we need to do the accounting treatment as per accounting standard 14, and understand accounting standard 14 is applicable only in the books of transferee, not in the books of transferor. So these are some of the basics you need to understand. So that is what I have covered, meaning I have covered. Now, the most important part of this chapter is types of amalgamation. Types of amalgamation. Listen to me carefully. Sir, AS 14 has to prescribe the accounting treatment for amalgamation. And this AS 14 is applicable only in the books of transferee company. Now, for the purpose of accounting treatment for amalgamation in the books of transferee company, AS 14 has divided the amalgamation, so-called amalgamation, into two types. This is exclusively for accounting purpose only. One is amalgamation in the nature of merger, another one is amalgamation in the nature of purchase. So whenever you want to do the accounting treatment in the books of transferee company, first you need to see what is the type of the amalgamation involved. Is it merger? Is it purchase? Now, in the standard, sir, they have given 5 conditions. If all the 5 conditions are satisfied, they say it is merger, otherwise it is purchase. Because the manner in which the amalgamation agreement is entered by the parties, what will be the terms and conditions of the amalgamation agreement, based on that, whether it will be a merger or purchase, we will decide. 5 conditions they have told us, sir. All 5 satisfied, that is amalgamation in the nature of merger. If it is a merger, the accounting treatment will be different. If it is a purchase, the accounting treatment will be different in the books of transferee company. Of course, in the books of transferor, it doesn't make any difference, because being a transferor company, whether it is amalgamation in the nature of merger or purchase, anyway AS 14 is not applicable for me. I just simply close the books of accounts in the books of transferor. So therefore, transferor company books very easy. They just close the books of accounts. It is transferee company which need to follow accounting standard 14. So when you want to do the accounting treatment in the books of transferee company, you need to see whether it is amalgamation in the nature of merger or purchase. Now 5 conditions we need to satisfy. We need to see if all the 5 satisfied, merger. So what are the 5 conditions, sir? Listen to me carefully. First thing. First, assets and liabilities transfer. Sir, all assets and liabilities, including the reserves of transferor company, must be transferred to transferee company. See, some of you might use the word transfer or transferee. Some of you might use the word selling, purchasing. Don't confuse transfer or transferee. Transferor means the company which is transferring their business. Transferee means the company which is taking over the business of transfer companies. So throughout this chapter, I am going to use this transfer or transferee only. Majority of the cases. Okay. All assets and liabilities, including reserves of transfer company, must be transferred to transferee company. See, the identity of the reserves of transfer company must be maintained by the transferee company. This is the first condition. Whether all assets, liabilities, including reserves of transfer company, are transferred to transferee or not. If even one asset is not transferred, that is amalgamation in the nature of purchase, not amalgamation in the nature of merger. So therefore, all assets and liabilities of transfer company must become the assets and liabilities of transferee company, including the reserves. Because in amalgamation in the nature of merger, sir, the genuine identity of the reserves of the transfer company must be preserved by transferee company. Okay. Second, sir, shareholder approval. Sir, when one company is taking over the business of another company, sir, suppose, sir, there are 2 entities here, A Limited, B Limited. Now imagine, sir, A Limited is now taking over B Limited. So B Limited is what? Transferor company. A Limited is transferee company. Now in B Limited, there are shareholders, right? Equity shareholders I am talking about. So the condition is that shareholders holding not less than 90% of face value of equity shares. In the transferor company, equity shareholders. Out of that, shareholders, equity shareholders holding not less than 90% of the face value of equity shares must agree to become the equity shareholders of transferee company. Sir, how? Suppose you are a equity shareholder of B Limited. You want to become an equity shareholder of A Limited. How will you become, sir? By purchasing shares of A Limited. But here, B Limited is transferring their business to A Limited. So A Limited will give shares in return to the shareholders. So that's how at least equity shareholders having 90% face value of equity shares must become the equity shareholders of transferee company. This is also another condition. Second condition. Here, most important thing is they are talking about only equity shares, not preference shares, and that too not less than 90% of the face value. Must become only equity shareholders of transferee company. Suppose shareholders having not less than 90% equity shares of transfer company must become preference shareholders. Condition number 2 failed. It is amalgamation in the nature of purchase. Condition number 3, consideration. Now see, here B Limited equity shareholders having not less than 90% face value of equity shares. Suppose they want to become equity shareholders of B Limited, A Limited, transferee company. Now the condition is that the purchase consideration to those equity shareholders of transfer who agree to become the equity shareholders of transferee must be wholly in the form of equity shares of transferee company only. Suppose for example Mr. X is there. Mr. X is the equity shareholder of B Limited, transfer company. He accepted to become the equity shareholder of A Limited. Now for him, only equity shares will be given as a purchase consideration. Suppose sir, cash given sir, or preference shares given sir, condition failed. That means at least shareholders, equity shareholders having not less than 90% of transfer must become the equity shareholders of transferee, and the consideration for them will be only in the form of equity shares. Of course, suppose sometimes if any fractional shares to be issued, for that fraction we can give cash, nothing wrong. For example, we worked out the number of shares to be issued. Suppose it came 562.5 shares. It can't be issued now, 562.5. So therefore, for fractional shares, cash can be paid. That is an exception. So therefore, the consideration must be in the form of equity shares only to who agreed to become the shareholders of transferee company, except cash can be paid for fractional shares. For fractional shares, cash can be paid, nothing wrong. So understand, most of the students are confusing in these two conditions, very simple conditions. Shareholders of transfer company having not less than 90% of the equity shares must become equity shareholders of transferee company. For them, only equity shares will be given. Of course, for fraction, cash can be given. Next, business continuity. See here, suppose B Limited business must be carried on by A Limited. Suppose if B Limited business is not carrying by A Limited after amalgamation, condition number 4 is not satisfied. And the last condition is that book value of assets and liabilities. This is very, very important, sir. Sir, transferor company, all assets and liabilities must be transferred to transferee company at their book value only. Suppose if any asset and liability is transferred at other than book value, condition number 5 is failed. It is amalgamation in the nature of purchase. So therefore, if you ask me, shall I require to remember all the 5? No. First condition, that is assets, liabilities. Second condition, book value of assets and liabilities. And these two conditions are very practical conditions. And also consideration. So when you are reading the question, you read carefully. Whether all assets and liabilities, including the reserves of transfer company, is taken over by transferee company. Okay. Second, check whether any asset and liability is taken other than at book value. And one more thing, what is the purchase consideration paid by transferee company to the shareholders of transfer company? Is it only equity shares or is it any other form? So these are the three practical conditions which will give you an idea, or which will enable you to judge whether it is amalgamation in the nature of purchase or merger. So therefore, what we are discussing, types of amalgamation. Why we need to decide the types of amalgamation? Because accounting standard 14 is applicable in the books of transferee company. So in the books of transferee company, I need to do the accounting treatment. For that, I need to decide the type of amalgamation, because in accounting standard 14 they have prescribed the method of accounting for depending upon the type of amalgamation. So there are two types of amalgamation. One is amalgamation in the nature of merger, another one is purchase. Now when we call amalgamation is amalgamation in the nature of merger, 5 conditions they are telling. First thing, all assets and liabilities including the reserves of transfer company must be transferred to transferee company. Second, shareholders holding not less than 90% face value of equity shares of transfer company must agree to become the equity shareholders of transferee company. Third, the purchase consideration, the consideration payable to those equity shareholders of transfer company who agree to become the equity shareholders of transferee company must be in the form of equity shares only. And the business of transfer company must be agreed to be carried on by transferee company. And the last condition, all the assets and liabilities must be transferred at book value only, except to ensure uniformity of accounting policies. Okay, so all 5 satisfied, merger, otherwise purchase. Okay, now the most important concept in this chapter is PC, purchase consideration. So tell me, what is PC? PC is basically consideration payable by whom? PC is the consideration payable by whom? Payable by the transferee, purchasing company. To whom? Transferor company shareholders. And this PC can be in the form of shares, securities, cash, any other asset. You add everything. So PC is the sum of the shares, securities, assets, cash, anything given by the transferee company to the shareholders of transferor company. Now here one simple trick I will tell you, sir. In order to calculate PC, you see always who is the recipient. Recipient who is? If the recipient is shareholder, then it is part of PC. Whether it is equity shareholders or preference shareholders. Recipient must be whom? Shareholder. Sir, if the recipient is other than shareholders, it is not part of PC. For example, transferee company. Suppose for example, transferee company A Limited. In B Limited, that is transfer company, there are some debenture holders. Suppose 10% debentures are there. Now A Limited, transferee company, to these 10% debenture holders, they have issued 12% debentures of transferee company. Now tell me, is this 12% debentures of worth of 10 lakhs, is it part of PC? Answer is no. Because who is the recipient here? Debenture holder. Purchase consideration means only payment made to whom? Shareholders. Company's shareholders. Transfer company shareholders. Whether it is equity shareholders or preference shareholders. Okay. Next. See, there are certain methods for calculating purchase considerations. Important, sir. Everybody please focus. Sir, in amalgamation chapter, sir, whenever you are solving any question relating to amalgamation, the first thing you need to do is calculate PC. For PC calculation, there will be separate marks will be allotted. See, there are some methods for calculating PC, sir. We understood what is PC. There are certain methods to calculate PC. In these methods, sir, net assets method is the most important method. Second, net payments method will be there. So lump sum method, net payments method, net assets method. Lump sum method is what? Simple. Transferee company will pay one lump sum amount to the shareholders of transfer company. Of course, this is very unscientific, and generally in the question they will make you calculate PC. They will not give PC directly. If they have given, you are so lucky. So lump sum method, the transferee company agrees to pay lump sum or fixed amount to the shareholders of transfer company. Ignore it, this method. Now net payments method. Sir, what is this net payment method? See, net payments method, sir, how to calculate PC is whatever the payments given by the transferee company to the shareholders of transfer company, whether equity or preference, both, add everything, you will get PC. So when the transferee company makes individual payments to equity and preference shareholders, maybe in the form of cash, shares, debentures, aggregate all of those to arrive PC. When it is possible to calculate net payments, PC under net payments method, sir? Sir, when everything is quantifiable, sir. When the information given in the question enables you to quantify each mode of PC, then follow net payments method. For example, sir, transferee company is giving shares, cash, securities to the shareholders of transfer company. Whatever they are giving, if they have absolutely mentioned in the question, or if the necessary information is given to quantify all modes of PC, just quantify and give a total, made a total, you will get PC. But sometimes what happens, sir, they will tell you the terms of payments, the mode of payments, but they will not give you the necessary information to calculate the mode of PC. For example, they will tell you transferee company. See, for example, important, listen to me carefully. For example, A Limited, which is a transferee company, sir, which is taking over B Limited, transferor company. Okay. Now in the question they mentioned A Limited is giving to B Limited 1 lakh equity shares, 1 lakh equity shares of rupees 10 each. So clearly quantifiable, 1 lakh into 10 lakhs. So 15%, 10 lakhs preference shares of rupees 1 each. So this is also 10 lakhs into 1, 10 lakh rupee, easily quantifiable. But cash, necessary cash will be given, like that they have mentioned, necessary cash. They have not given the amount, they are saying necessary cash. But see here, can I able to calculate PC? I know how much shares they are giving in the form of PC. In the form of PC, how much preference shares they are giving. So 10 lakhs plus 10 lakhs. What about cash, sir? They have not mentioned, sir. So therefore, how can I calculate PC under net payments method, sir? Because in net payments method, they are saying that if you want PC, just simply add the individual payments made to equity and preference shareholders. Whatever the payments made by the transferee company to the shareholders of transfer company, cash, shares, debentures, aggregate everything. But in order to aggregate, sir, I should know the amounts now, but based on the information given, I don't know the amounts. So therefore, this net payments method will work out only when they have given necessary information, when we are able to quantify each mode of PC, then simply calculate all modes of PC and aggregate, you will get PC. Okay. Sir, suppose in this case, in this example you have said, we clearly know PC in the form of equity shares, preference shares. We don't know cash. Then what to do, sir? They said, when you are unable to quantify the PC, when you are unable to quantify any mode of PC, then we have another method called net assets method, which is one of the important method. See, in all big 14 marks questions, sir, most of the cases they are going to test the net assets method. So when we need to follow net assets method, sir, when based on the information given in the question, if you are unable to quantify any mode of PC, if all the terms and conditions to quantify the PC is not clearly known, then you calculate PC by net assets method. Sir, how I am going to calculate PC by net assets method, sir? Simple. Agreed value of assets taken over minus agreed value of liabilities taken over. Agreed value of assets taken over minus agreed value of liabilities taken over. Agreed value of assets taken over, not book value, agreed value. At what value you have taken over the assets of the transferor company. If there is an agreed value, take it. If there is no agreed value, book value itself is agreed value minus agreed value of liabilities taken over. You will get net assets. Here some important points I am going to tell you, sir. Listen to me carefully. See, whenever you are calculating PC under net assets method, sir, in calculation of PC under net assets method, sir, consider only those assets and liabilities of transferor company which are taken over by transferee company. Generally, these are the small areas students will get a doubt. Only the assets and liabilities which are taken over by the transferee company from the transferor company, they only considered for calculation of net assets, PC under net assets method. So that's why I have written here, consider only those assets and liabilities of transfer company which are taken over by transfer company. Suppose in the question they have mentioned A limited take over B limited, all assets taken over except cash. Don't consider cash. Second, consider the assets and liabilities taken over at agreed values only. If agreed value not available, book value you take. So these are the 2 points. Next, if any mode of PC calculation is not quantifiable, follow net assets method to ascertain the PC. Okay, so have you understood this? When to follow net assets method? When based on the information given in the question, if you are unable to quantify any mode of PC, follow net assets method. How to calculate PC under net assets method, sir? Agreed value of assets taken minus agreed value of liabilities taken. Agreed value of assets taken minus agreed value of liabilities taken. If agreed value is not available, then book value we need to consider. Of course, we are going to do some questions also. There is one more method called intrinsic value method or share exchange method. Sir, based on the intrinsic value, the real value of the share, the companies will decide to exchange PC. Suppose there are two entities, sir, A limited and B limited. There are two entities, A limited, B limited, sir. A, B. A limited is transfer, B limited is transferee. Suppose the intrinsic value of the share of B limited is 150 rupees. The intrinsic value of A limited, which is given in the question, is 25. Now you see, one share of transferee company is equal to 2 shares of transfer company. Now based on this 25-50, this ratio they will exchange the shares. That's how PC will be calculated. Okay, this is called intrinsic value method or share exchange method. Share exchange method. Very simple, sir. Intrinsic value method or share exchange method, not something extraordinary, sir. Very simple. There is a concept called intrinsic value, real value of the share, net assets value of the share. So we will calculate, they will give you the net asset value of the, intrinsic value of the transfer, intrinsic value of transferee. Now based on that intrinsic value, if they decided to exchange the shares, if they decided to execute the PC, that is called intrinsic value or share exchange method. Okay, these are different methods to calculate PC. Now let us see some questions relating to PC calculations, sir. Next we are going to solve some questions relating to purchase consideration concept. See illustration number 3 from ICA study material. See, in this question they have given balance sheet of X Limited on 31st March 2011. All rupees are in thousands, sir. And in the other information, Y Limited takes over X Limited, they have given. So Y Limited takes over X Limited, sir. That means, can you tell me who is transferee? Y, also known as purchasing company. Who is transferor? X Limited, also known as selling company. So who will pay PC? Transferee company. To whom? To the shareholders of transferor company. Transferor company is X Limited. They have given, generally they will give you transferor company balance sheet. If you see the share capital in transferor company, we have equity shareholders as well as preference shareholders. So whatever be the mode of PC given to equity and preference shareholders, if you add, you will get PC. Okay. Now second point, debenture holders of X Limited are discharged by Y Limited. They are talking about discharge of debenture holders of transferor company X Limited. Whether discharge to the debenture holders of transferor company is part of PC? No. I told you recipient must be shareholder in order to consider that as a part of PC. Here the recipient is debenture holder of transferor, so it is not part of PC. Now coming to third point, sir, they are talking about discharge to preference shareholders. To preference shareholders. How preference shareholders of transferor company are discharged? X Limited are discharged by Y Limited. 14% preference shareholders of X Limited are discharged at a premium of 20%. Actually, if you see, 14% preference share capital of X Limited is 2,500 plus 20% premium we need to add. So it will be 3,000 in thousands actually. So it will be 30 lakhs, sir. See, here we are discharging at premium. We are not issuing shares at premium. You should read the lines carefully, sir. Are we issuing shares at premium? Generally, when we issue shares at premium, securities premium will be created. Here we are not issuing shares at premium. We are discharging the amount at premium of 20%. See this. 14% preference shareholders of X Limited are discharged at a premium of 20%. 2,500 plus 20%. So it will be 3,000 in thousand. So it will be 30 lakhs. How this 30 lakhs is discharged? By transferee company Y Limited, by issuing necessary number of 15% preference shares of Y Limited, face value 100. Necessary number of shares means simple. 30 lakhs is the PC and this is discharged by issuing 15% preference shares of Y Limited, each share face value 100. So 30 lakhs divided by 100. So 30,000 is the number of preference shares will be given. So 30,000, 15% preference shares of Y Limited, each 100 rupees. So it will be 30 lakhs. So one part of PC we got it, that is amount paid to preference shareholders, 30 lakhs. Rupees in thousands, it will be 3,000. In what is the mode, what is the form of PC discharged? 30,000, 15% preference shares of Y Limited is given to the X Limited preference shareholders. Okay. Now the last point they are talking about discharge to equity shareholders. Carefully observe, sir. Intrinsic value per share of X Limited 20, Y Limited 30. So they have given the intrinsic values. Maybe here PC is worked out by intrinsic values. Y Limited will issue, see this, transferee company will issue equity shares to satisfy the equity shares of X Limited on the basis of intrinsic value. See, number of shares to equity shareholders, the PC is discharged based on intrinsic value. And the most important line is, however, the entry should be made at par value only, and the par value of each equity share is 100. See this. In the if you observe the question carefully, X Limited intrinsic value 20, Y Limited intrinsic value 30, and number of equity shares in X Limited is 7,50,000. Number of equity shares 7.5 lakhs. Now your transferee company Y Limited, you need to give or you need to settle the equity shareholders of X Limited based on intrinsic value. So can you tell me how many number of shares will be given? 7,50,000 shares in X Limited. Each share intrinsic value is 20. Based on intrinsic value, we are going to issue. Divided by intrinsic value of transferee company 30. So 7,50,000 into 20 divided by 30. So it will be 5 lakhs shares. 5 lakh equity shares will be given based on intrinsic value. And entry is made at par value only. So par value is 10. So into 10. So it will be 50 lakhs. So PC to the equity shareholders is 50 lakhs. That means 5,000 in thousands. See this. 5,000, 50 lakhs. How? 5 lakhs equity shares in Y Limited. For equity shareholders of X Limited, 7,50,000 shares, each share intrinsic value 20, transferee company intrinsic value 30. Into entry should be made at par value only. Sir, here one important point, sir. Suppose this word is missing, sir. Entry should be made at par value only. They have not given. Then what is PC? Can you tell me? Simple. Here, if this sentence is not there, no, sir, the PC will be 5 lakh shares into transferee company each share value 30. 5 lakhs into 30. So 1 crore 50 lakhs will be PC. 5 lakhs into 30. It will be 1 crore 50 lakhs will be the PC, sir. But sir, the question is why they have given issued at par value only? Because if we multiply number of shares which we arrived based on intrinsic value with par value, securities premium is not created in the books. Securities premium is not created. So unnecessarily they don't want to create the securities premium, because logically speaking, sir, securities premium, when any company wants to issue shares at premium above the face value, there are necessary approvals are required. And even in the Companies Act, if you see, only for specific purposes only the securities premium will be utilized. But here the transferee company intrinsic value is 30, but the face value of the share is 10. So instead of 10, if I multiply with 30, if I issue shares at 30, 20 rupees securities premium will be created in the books. 5 lakhs into 20, 1 crore securities premium is created in the books. So in order to eliminate this, because here our intention is to discharge based on intrinsic value. So we don't want to issue shares at premium. So unnecessarily we don't want to create securities premium. That's why they have given this entry should be made at par value only. The logic is that we want to eliminate the unnecessarily creating securities premium in this case. Okay, so that is the PC, sir. So this is one type of question, sir. So total PC is how much? 8,000. That means 80 lakhs. This is one question relating to PC. Next, see illustration number 4, sir. This question also I will explain. This question is also relating to PC. One more question relating to PC calculation. Illustration number 4 from study material, sir. They have given two companies, Neil and Gagan Limited. These two companies amalgamated to form a new company, and they have given the balance sheets of these two companies, Neil and Gagan. Shareholders funds, current liabilities. Asset side, we have non-current assets, property, plant, equipment, current assets. In the notes to accounts, property, plant, equipment, you have land and buildings, plant and machinery. What is the following additional information they have given, sir? But what is the requirement? They are asking us to compute the equity and preference shares to be issued to Neil and Gagan Limited. Purchase consideration. In this case, Neil, Gagan, both are transferor companies, selling companies. New company is transferee company, purchasing company. Transferee company is going to pay PC to the shareholders of transferor company. Okay. So see the additional information given in the question. First, assets of Neil and Gagan Limited are to be revalued as under. So revalued figures of assets and liabilities given, sir, in Neil and Gagan. Plant and machinery, building. Purchase consideration is to be discharged under. PC, how they are discharging, this is important for us. Issue 24,000 equity shares of 25 each fully paid in proportion of their profitability in the preceding 2 years. That the new company will issue 24,000 equity shares, sir, to Neil and Gagan together, and these 24,000 shares will be shared between them in the
based on the basis of the profitability of the preceding 2 years. Preceding 2 years profitability also given in the question. See this 4,75,000, 5,25,000. So you share this 24,000 shares based on this ratio 4,75,000, 5,25,000. So it will be 11,400 equity shares of rupees 25 each. Here 12,600 equity shares of rupees 25 each. Okay, one mode of PC we got it. 11,400, 12,600 equity shares. Anyway, in the question they are asking number of shares to be issued. In respect of equity shares, 11,400, 12,600. If you want amount of PC, 11,400 into 25 you do, you will get the amount of PC in the form of equity shares. And the most important point is C point. See this. Issue 12% preference shares of 10 each fully paid at par to provide income equivalent to 8% return on net assets in the business on 31st March 2011 after revaluation of assets of Neil and Gagan Limited respectively. So to the shareholders of Neil and Gagan, they are also issuing, new company is also issuing 12% preference shares. 12% preference shares of 10 each fully paid, they are issuing at par. But this 12% preference shares of 10 each must provide income which is equivalent to 8% return on net assets in the business on 31st March 2011 after revaluation of assets of Neil and Gagan. So you need to find out the net assets on 31st March 2011 of Neil and Gagan after considering the revalued figures, because in the question they have given the revalued figures of plant and machinery building. So after considering the revalued figures of Neil and Gagan, find out the net assets. Now on that apply 8% return. You will get one amount, right? You are issuing 12% preference shares of 10 each, right? So this 12% indicates what? Preference dividend. This dividend must provide at least 8% return on net assets. So find out the corresponding face value of the preference shares. You will get the PC. Okay. Sir, how we are going to do this? Very simple. Find out the net assets of Neil and Gagan, sir. How you are going to find out the net assets? So Neil, Gagan, when you are ascertaining the net assets, considering the revalued figures, plant and machinery, building, these two are revalued. So consider only revalued figures. Plant and machinery 5 lakh 25, 6 lakh 75. And coming to building, sir, 7 lakh 75,000, 6 lakhs 48,000. Okay. Next. And we have current assets. 1 lakh 63,500. And then Gagan 158,600. Minus current liabilities. Current liabilities 623,500. $623,500, sir, and 557,600. That's it. Okay. So now find out net assets. 525, 7 lakh 75 plus 163,500 minus 623,500. It will be 8 lakh 40,000 is the net assets of the business of Neil on 31st March 2011. Next, Gagan 675 plus 6 lakhs 48 plus 158,600 minus 557,600. It will be 9 lakhs 24,000. 9 lakh 24,000. So these are the net assets of the business. Now 8% return apply. 8% return on net assets. So 8 lakh 40,000 into 8%, it will be 67,200. 9 lakhs 24,000 into 8%, it will be 73,920. See, we are issuing 12% preference shares of 10 each, which must provide an income equivalent to 8% return on net assets. So if you issue 12% preference share capital, 12% preference share capital, to give 8% return on net assets, what will be the face value of preference shares you are going to issue? Very simple. 67,200 is what I need to provide as preference dividend. and my rate of preference dividend is 12%. So 67,200 divided by 12%, it will be 5,60,000 face value of preference shares. 5,60,000 into 12%, you see, you will get exactly the 8% return on net assets. Okay. Now here 73,920 divided by 12%. 73,920 divided by 12. 6,16,000. So this is the PC. Okay, in the form of preference shares. And if I want to find out the number of preference shares, because in the question they have asked number of preference shares to be issued, 5,60,000 face value, sir, divided by face value 10. So therefore 56,000 preference shares. 6,16,000 divided by 10. So 61,600. That's it. This is the number of preference shares to be issued. So therefore, if you want to calculate total PC, this one and as well as equity shares, both will be added. See this actually calculation of PC for illustration number 4 in the form of equity shares. You see 24,000 into 20. Okay, 24,000 shares, we proportionately share it, 11,400 shares for them, 11,400 into 25. So 2850, 2,85,000, this is 3,15 in the form of equity. Look at preference shares, sir, 5,60,000, 6,60,000. That's what we got it. 5,60,000, 6,60,000. So total PC is this. And the most important point here is you need to consider the revalued figures, because in the question clearly given after revalued assets. Okay, that's it. This is one more question relating to PC calculations, sir. Now next, in amalgamation chapter, we need to discuss the accounting treatment for amalgamation in the books of transferor. As I told you in this chapter, PC calculation is one of the important area. So we have seen the types of amalgamation and also how PC will be calculated. Next, accounting in the books of transferor company and then transferee company. Now we are going to discuss accounting in the books of transferor company. Next, we are going to cover the accounting treatment for amalgamation in the books of transferor company, sir. What exactly happening in transferor company, sir? Transferor company is liquidated by transferring their business to transferee company. So after amalgamation, transferor company no more will be in existence. So what is the accounting treatment we will do in the books of transferor company? Just close the books of accounts. Like in case of partnership firm, if it is dissolved, what we are doing, sir? We are closing the books of accounts and settling the partner's account. Similarly, if you are a transferor company, you are liquidated by transferring your business to transferee company, we need to close the books of accounts of transferor company. And you know, accounting standard 14 is not applicable for transferor company. So irrespective of the type of amalgamation, whether it is amalgamation in the nature of merger or purchase, the accounting treatment remains same in the books of transferor company. And one more important thing, sir, when you're closing the books of accounts of transferor company, it must happen systematically. Generally, here we will take the help of realization account. One account called realization account will be opened, sir. All the transactions of amalgamation will routed through this account. Okay. So whenever you are doing the accounting treatment for amalgamation in the books of transferor company or selling company, you need to remember certain things. The first point you need to remember is AS 14 is not applicable for a transferor company. And also we need to close the books of accounts of transferor company because it is liquidated and no more in existence. And with the help of realization account, this books of accounts will be closed. Okay. Now let us try to understand what will be the basic procedure for closing the books of accounts. Let me give you an idea. Suppose this is the balance sheet of transferor companies. Transferor company balance sheet. Generally in balance sheet you will find assets, liabilities, share capital, equity share capital, preference share capital, if it is there, reserves and surplus. These are the basic items. Transferor company assets. how you are going to close it. Some of the assets of transfer company or maybe all of the assets of transfer company may be taken over by transferee company. The assets which is taken over by transferee company, close them by transferring to realization account. The assets which are not taken over by transferee company, transfer company assets which are not taken over by transferee company, sell them. Sale. And when you make a sale, either you get a profit or loss. Again, that profit or loss you route it through realization account, transfer to realization account. Because the main object of realization account is ultimately, because of this entire transaction, whether we are getting profits or loss, that profit or loss again we will transfer to shareholders. We will give to equity shareholders. So for that purpose, we are preparing realization account. So in the transfer company assets, some of the assets will be taken over by transferee company, routed them to realization account, close them by transferring to realization account. Assets which are not taken over, you sell. Transfer company have to sell them or return off them. When you are selling them, whatever the profit or loss you got, you transfer to realization account. Similarly, liabilities. Some of the liabilities of transfer company will be taken over by transferee company. Close them by transferring to realization account. The liabilities which are not taken over will be discharged. On our own, we need to discharge. At the time of discharge, any profit or loss we got, that will be transferred to realization account, so that entire assets and liabilities are closed. The liabilities, the assets taken over by transferee company, close them through realization account. Not taken over, if it is an asset, you sell. If it is a liability, you discharge. Equity share capital transferred to equity shareholders. Preference share capital transferred to preference shareholders. Reserves and surplus belongs to equity shareholders, transferred to them. Receive PC from transferee company. This PC, give it to the shareholders. Equity as well as preference shareholders, give it to them so that their accounts will be closed. So this is the basic way of closing the books of accounts of transferor company. Okay, very simple. Now let's put this through entries, sir. Let us try to understand the entries. How closing entries will be passed here. See, total there are 13 entries will come, sir, here. Total 13 entries. And you remember exactly in the same manner, same order I am teaching, so that you will not do any kind of mistake when you are solving a question relating to transfer books. First, sir, think about it. 13 entries. Assets of transfer company taken over by transferee company. First thing. Second, liabilities of transfer company taken over by transferee company. Third, PC due. Fourth, PC received. Fifth, assets not taken over will be sold. Fifth. Sixth, liabilities not taken over will be discharged. Seventh, liquidation entries. Eighth, amount due to preference shareholders. Payment due to preference shareholders. Ninth entry. 10th, close the realization account. 11th, amount due to equity shareholders. I mean, transferring equity share capital reserves and surplus to equity shareholders. 12th, whatever the fictitious assets are there in the company, adjust it to the equity shareholders. And the last entry, closing the equity shareholders account. So 13 entries. You remember this order. So first, assets of transfer company taken over by transferee company. When assets of transfer company are taken over by transferee company, what is the entry we will write is assets of transfer company taken over by transferee company. Assets basically debit balance. So when they have taken over, they will be credited. So various assets, whatever taken over by transferee company will be credited. Realization account will be debited. So realization to various assets. At what value? Book value. This is important. Sir, for example, in the books of transfer company, there is one asset called plant and machinery. This plant and machinery book value is 100 lakhs. But this plant and machinery is taken over by transferee company at 90 lakhs. At 90 lakhs. So in the books of transfer company, what is the entry you will write? Here, plant and machinery is going out, so it will be credited. Realization account will be debited. So realization to plant and machinery. And plant and machinery account will be recorded at their book value, 100, not at agreed value. And one important thing, sir, most of the students here doing one mistake, sir. When they're doing accounting treatment in the books of transfer, they're seeing what happening in transferee books. No need to, sir, because accounting treatment is independent in the books of transfer as well as transferee. So you cannot interlink both of them. What's happening in transfer doesn't matter for us. What's happening in transfer is relevant for us.
because AS14 they will follow transferee company, but being a transfer company I don't follow AS14. I'm just closing the books of accounts. So therefore, whatever the assets of transfer taken by transferee company, close them by transferring to realization to assets at their book value, Similarly, liabilities. And one more important point, sir, relating to assets, sir. In respect of any asset, if there is any provision, for example, in the transfer company, there are debtors, sir. Debtors, 10 lakhs are there. Now, relating to this debtors, there is a provision for doubtful debts. Suppose 2 lakhs. And 8 lakhs is our net debtors. So when this debtors is taken over by transferee company, how you are going to close? Realization to debtors. You close them at their gross value, sir, 10 lakhs. You transfer this provision for doubtful debt separately along with liabilities. You close this 2 lakhs separately. That means in respect of any asset, if there is any provision, sir, close the asset at its gross value. The provision in respect of that asset will be closed along with the liabilities. So this point also you remember. Okay. Now second, transferring liabilities taken over by transferee company. Whatever the liabilities of transfer company taken over by transferee company, close them. So liabilities basically show credit balance. So liabilities account debtor to realization account at their book values. Next, entry number 3, PC due. See, being a transfer company, I am going to receive PC from transferee company. So therefore, whenever PC due is there, we will write transferee company account debtor to realization account, because we need to receive the amount from transferee. So transferee company account will be debited, realization account will be credited at PC amount. Okay. Next, you receive the PC due entry, PC receive. Whatever PC you are receiving, you debit. Cash or bank account debit, equity shares in transferee company account debit, preference shares in transferee company account debit, debentures in transferee company account debit to transferee company account. So transferee company account, first due, then discharged. So their account will be closed. Whatever the PC you are receiving, you just debit it. Next. So 4 entries we have completed, sir. Assets taken over by transferee company, liabilities taken over by transferee company, PC due, PC received. Next, 5th entry. Assets which are not taken over by transferee company. See, in the transfer or company books, there are some assets which are not taken over. What we need to do? We need to sell them or return off them. So when you sell, either you may get a profit or loss. That will be routed through realization account. So when you sell an asset, basically what is the entry? Cash or bank account debtor to asset account. The difference is what? The difference is nothing but profit or loss. For example, we will compare sale value, book value. If the sale value is more than book value, profit, that will be credited to realization account. If the sale value is less than the book value, that is a loss, that will be debited to realization account. So sale of assets not taken over by transferee company. So cash or bank account debit, realization account debit to assets to realization. Okay. Similarly, 6th, liabilities. The liabilities which are not taken over by transferee company, we need to discharge on our own. When you discharge the liability, what is the entry? Liabilities account debit to cash or bank account, right? So when you settle a liability, liabilities account will be debited at book value. Cash or bank will be at amount paid. The difference will be either profit on payment or loss on payment, that will be transferred to realization account. This. So when you pass a 6th entry, all assets and liabilities are closed. So understand. First entry, assets taken over. 5th entry, assets not taken over. 2nd entry, liabilities taken over. 6th entry, liabilities not taken over. Okay. Now 7th entry, liquidation expenses entry. Sir, what is this liquidation expenses? Generally, when companies are amalgamating, sir, there are some expenses they are going to incur. Legal charges, liquidation, we need to sell the assets, we need to discharge the liabilities. For that, some expenses will be incurred. Basically, they are called realization, liquidation expenses. Now, relating to the liquidation expenses, we need to pass the entries. Here, in case of liquidation expenses, sir, 3 cases will come. First case, sir, this liquidation expenses will be incurred by transfer company itself. We are doing the accounting treatment for transfer company. Transfer company itself will bear the liquidation expenses. First case. Second case, sir, liquidation expenses will be borne by transferee company. As per the agreement, transferee company says, no, we are going to pay this liquidation expenses. No, don't worry. Now, third case, sir, first you incur, later we are going to reimburse. That means first liquidation expenses will be incurred by a transfer or company. Next, reimbursed by transferee company. Liquidation expenses incurred by transferor. Later on, that amount is going to be reimbursed by transferee company. The difference between second case and third case is what? In second case, directly transferee company will pay the liquidation expenses. Third case, must we pay? Later they are going to reimburse. Okay. So what is the entry you are going to pass? Suppose if the liquidation expenses are borne by transfer or company itself, realization to cash or bank. That is what we will write. Realization account debit to cash or bank. Suppose if the liquidation expenses are borne by transferee company, no entry will be passed because we are not bothered. They are paying the amount. So they are not recorded in my books. And the third most important case is, first we are going to bear transfer company, later they are going to reimburse. So when we
incur liquidation expenses, we know this amount is going to be reimbursed by transferee company. So when we incur the expenses, we will write a transferee company account debit to cash or bank. When we receive the amount, cash or bank account debit to transferee company account. So therefore, transferee company to cash or bank to transferee company. So when we incur this entry, when we receive the reimbursement, this entry, that means nothing, no entry has been passed. So therefore, the difference between B and C is nothing, both are same only. But the difference is that in second case, directly they are paid by transferee. Third case, first we are incurring, later they are paying. That's it. That's the difference. So 3 cases relating to liquidation expenses also have explained. Now, once you pass the liquidation expenses entry, 8th entry is now go to the shareholders. First take preference shareholders. In the transfer company, if there are preference shareholders, go to preference shareholders. First transfer the preference share capital to preference shareholders. So transferring preference share capital to preference shareholders. Now when you transfer preference share capital to preference shareholders, what is the entry? Preference share capital account debit to preference shareholders account. The difference is what? What is the amount due to preference shareholders will be created to them. Preference share capital will be at their face value of preference share capital. The difference is what? The difference is when you are discharging to the preference shareholders, either you are paying excess amount or discount amount. If there is an excess amount you are paying, it's a loss, it will be debited to realization account. If you are discharging at a discount value, that will be kind of a gain, so it will be transferred to realization account. For example, the PC due to the preference shareholders is 9 lakhs, sir. We calculated the PC. As per the terms given in the question, the PC due to the preference shareholders is 9 lakhs. So preference shareholders are credited with 9 lakhs. And their preference share capital they contributed to the company, face value is 10 lakhs. So preference share capital debited at 10 lakhs, preference shareholders credited at 9 lakhs. The difference is what? 1 lakh. That 1 lakhs we are discharging at a discount. So that will be created to realization account. So this 1 lakh we will create to realization account. Company point of view thinks, when they contribute 10 lakhs, but ultimately you are paying 9 lakhs, obviously it is a kind of a gain for us. Sometimes you pay excess premium also, that will be debited to realization account. For example, the amount due to the preference shareholders is suppose 10 lakhs, 9 lakhs, sir. And in the form of preference share capital, we are giving him only 8 lakhs. That means what will be their preference share capital is 8 lakhs, sir. The amount due to them is 9 lakhs. So the excess amount we are paying is 1 lakh, that will be debited to realization account. Next, pay to preference shareholders. Preference shareholders account debtor to cash or bank to preference shares and transferee company. Whatever the PC you received, na, sir, in entry number 4, PC received. In respect of this PC received, whatever the PC belongs to preference shareholders, give it to them. So preference shareholders account debit to cash or bank to preference shares and transferee company. Whatever PC we are giving, whatever the PC we received in entry number 4, just give it to them so that their account will be discharged. And then entry number 10, which is the most important entry, closing realization account. So before closing the equity shareholders account, we need to first close the realization account. And if you understand properly, sir, the realization account, what we have passed here is, first we have transferred to realization account whatever the assets taken over by transferee company, realization to various assets. Suppose we have transferred 100 lakhs worth of assets at their book value. Liabilities taken over by transferee company, various liabilities to realization. Suppose the liabilities we have given over is 50 lakhs. Next, PC due, whatever the PC we have received, entry we have written transferee company to realization. Suppose PC we have received is 60 lakhs PC we have received. So 100 lakhs worth of assets we have given over, 50 lakhs worth of liabilities we have given over. So what is the worth of net assets we are giving away? 50 lakhs. And PC we received how much? 60. How much excess we are receiving? 10 lakhs. What is this? This is profit. But, and also, suppose in the name of realization, you are incurring some expenses. Suppose 1 lakh expenses, you incurred realization expense, you debit it to realization account. Therefore, your realization profit is 9 lakhs. This will be transferred to equity shareholders. So the main purpose of preparing realization account is to ascertain ultimately whether we are earning some profit or loss in respect of this entire transaction. So close the realization account. If you got a profit, transfer to equity shareholders account, credit to equity shareholders account. If it is a loss, debit to equity shareholders account. Then whatever the equity share capital, reserves and surplus is there in the transfer company, transfer to equity shareholders. So equity share capital account debit, reserves and surplus account debit to equity shareholders account. And one important point, sir, in the balance sheet of transfer company, sometimes you will see some fictitious assets, sir, like preliminary expenses not written off, discount on issue of shares and debentures. Any fictitious assets are there, they will be adjusted to equity shareholders only. So therefore the entry is equity shareholders account debit to fictitious assets.
Okay, including any losses, sir. Losses also will be adjusted to equity shareholders. Suppose P&L account debit balance is there, equity shareholders to P&L account. So fictitious assets as well as losses in the transfer company, everything will be transferred to equity shareholders. And finally close the equity shareholders account. How you are going to close the equity shareholders account? Whatever the PC you received in entry number 4, give it to them. Equity shareholders account debit to cash or bank if they receive PC, to equity shares in transferee company, to preference shares in transferee company, whatever they receive. See, there is no restriction regarding the mode of payment. It can be in any form, shares, equity shares, preference shares, debentures, cash, but the recipient should be shareholders. So whatever the mode of PC you received in entry number 4, give it to the equity shareholders so that their account will be closed. So these are the 13 entries we are going to pass for closing the books of accounts depending upon the information given in the question. Okay. So once again, please recollect with me. We are closing the books of which company? Transfer company. So transfer company, first entry, assets taken over by transferee company. What is the entry? Realization account data to various assets. At what value? Book value. Next, liabilities taken over by transferee company. What is the entry? Various liabilities to realization account. At what value? Book value. Third, PC due. What is the entry for PC due? Transferee company account data to realization. Next, PC received. What is the entry? Whatever you receive, debit. Cash or bank account debit. Equity shares in transferee company, preference shares in transferee company, debentures in transferee company to transferee company account. Fifth, assets not taken over will be sold. When you sell the assets not taken over, what is the entry? Cash or bank account data to asset account. The difference is transferred to realization account. Next, settle the liabilities which is not taken over. Liabilities to cash or bank. The difference will be transferred to realization account. Next, liquidation expenses, 3 cases. Liquidation expenses borne by transfer company, realization to cash or bank. Transferee company, no entry. Incurred by transfer, later on reimbursed by transferee company. When we incur, we know this amount is going to be reimbursed by transferee. So transferee company account data to cash or bank. When they reimburse, cash or bank to transferee company account. Next, in the entry number 8, transferring preference share capital to preference shareholders. So preference share capital account debit at their face value to preference shareholders, the amount due to the PC due to the preference shareholders. The difference is transferred to realization account. Next, discharge to preference shareholders. Whatever the PC you received in entry number 4 belongs to preference shareholders, give it to them. Preference shareholders account debit to cash or bank to preference shares in transferring company. Whatever the PC due to the preference shareholders, give it to them. Next, close the realization account. Realization account, when you close, you will get a profit or loss. That profit or loss will be transferred to equity shareholders. Next, to transfer equity share capital, realization reserves and surplus to equity shareholders. Next, any fictitious assets, any P&L account debit balance is there, adjust to equity shareholders. And finally, settle equity shareholders account. So when you are transferring equity share capital, reserves and surplus to equity shareholders, the entry is equity share capital account debit, realization reserves and surplus account debit to equity shareholders account. Next, when you adjust the fictitious assets account debit, equity shareholders account debit to fictitious assets. And finally, when you discharge, when you close the equity shareholders account debit to whatever the mode of PC they are receiving in entry number 4, whatever the PC they received to cash or bank, to equity shares in transferee company, to preference shares in transferee company, just pass them. That's it. These are the entries. Now, most of the times what they will ask is they are going to ask you prepare the ledger accounts. But these are the entries. If you know the entries, you can easily prepare the ledger accounts. The main ledger account we are going to prepare is realization account, then transferee company account, then equity shares in transferee company, preference shares in transferee company, sometimes bank account too. So these are the main ledgers we are going to prepare in the books of transfer company. Hope you understand the accounting treatment in the books of transfer company. Now see some questions relating to transfer company, how we are going to apply this. Next, relating to accounting for amalgamation in the books of transfer company, let us see some questions, sir. First, May 2025 examination question, sir. May 2025 exam question from amalgamation chapter, testing the accounting treatment in the books of transfer company, sir. If you solve this question, you will get a comprehensive idea about accounting treatment in the books of transfer company. See, in this question, they have given balance sheet of one company, Pickles Limited, as on 31st March 2025, sir. In the balance sheet equity and liability side, we have shareholders funds, share capital, reserves and surplus. Non-current liabilities, we have long-term borrowings, long-term provisions. Current liabilities, we have trade payables, other current liabilities. Then asset side, we have non-current assets, property, plant, equipment, intangible assets. Current assets, we have inventory, trade receivables, cash and cash equivalents. In the notes to accounts relating to share capital, this Pickles Limited company had two types of equity shares, two types of shares, equity as well as preference. 6,000 equity shares, 5,000 preference shares. Reserves and surplus, general reserve, P&L account. Long-term borrowings, 8% debentures. long-term provisions, retirement gratuity fund. Property, plant, equipment, land and building, plant and machinery, furniture and fixtures, intangible assets, patent. So this is the balance sheet of Pickles Limited on 31st March 2025. Next, what happened, sir? On 31st March 2025, Foods Limited acquired the business of Pickles Limited. See this. Pickles Limited business was acquired by Foods Limited. So Pickles Limited is transferor company, which is transferring its business, also known as selling company. Foods Limited is transferee company, also known as purchasing company, on the following terms. Now, if you see the final requirement of the question, sir, they are asking in the books of Pickles Limited, that means in the books of transferor company, necessary journal entries, prepare realization and cash account. So that means they are testing the accounting treatment of transferor company. Okay. And whenever you are solving any question relating to amalgamation, sir, first most important calculation is PC, purchase consideration calculation. See, in the terms of amalgamation, I think this point and this point, they are talking about purchase consideration. First, we are going to calculate PC here. See this. Foods Limited decided to pay for each preference share in Pickles Limited rupees 27 in cash and 8% preference share of 100 in Foods Limited. So first preference shareholders, sir, how PC will be paid to preference shareholders? For each preference share in Pickles Limited. In Pickles Limited, 5,000 preference shares are there. So for each preference share, 27 rupees cash will be given. And also 8% preference share capital. 1:1 ratio, sir. For one preference share in Pickle Limited, one preference share of Foods Limited will be given. So 5,000 preference shares will be given. Each is given at 100. So 5,000 into 27 is 1,35,000 and 5,000 into 100, 5 lakhs. So total 6,35,000 is the PC to preference shareholders. Now see the equity shareholders, sir. Equity shareholders. See this. For each equity share in Pickles Limited, it was decided to pay 30 rupees in cash and one equity share of Food Limited for 145, face value 100. See, for equity shareholders of Pickle Limited, cash is given, sir. Total 6,000 equity shares are there. For one equity share, 30 rupees cash will be given. 6,000 into 30, 1,80,000. And also equity share capital will be given. 1:1 ratio. 6,000 equity shares, 6,000 equity shares will be given. But each share is given at 145. So we need to multiply with issue price, 145. So 8,70,000. So 10,50,000 is the PC. 1,80,000 plus 8,70,000. 10,52,000 equity shareholders. So if you want total PC, add both 6,35,000 plus 10,50,000. So it will be 16,85,000. 16,85,000, sir, total PC. So this is the first calculation you need to do, sir. 16,85,000. Okay. 16,85,000. You see here PC calculation in the working note. 16,85,000. Preference shareholders, cash, preference shares, 6,35,000. Equity shareholders, cash, equity share capital, 10,50,000. Total 16,85,000. So that we got it. Okay. So first we have done the PC calculation. Next, sir, they are asking entries in the books of transferor company. So you see the terms of amalgamation, sir. Food Limited take over all assets except cash and liabilities at their book values. So transferee company Food Limited will take all assets of transfer company, sir, except cash. All liabilities also will be taken at their book value. So therefore, in the books of transfer company, sir, First entry is what? Closing the assets taken over by transferee company. So realization account debtor to various assets. So various assets of transfer company are land and building, plant and machinery, furniture and fixtures, patents, and also see here inventory, so trade receivables, so cash will not be taken over. So therefore the first entry is, see this, realization account debtor to various assets, land and buildings, plant and machinery, furniture and fixtures, patents, inventories, trade receivables. First entry done. Next, liabilities taken over. Liabilities taken over. So what are the liabilities of transferor company, sir? Pickles Limited. Liabilities, debentures 1 lakh, retirement gratuity fund 60,000, and also trade payables, other current liabilities. So debentures account debit, one thing, this debentures will be closed. Trade payables 1,75,000, other current liabilities 65. Now relating to retirement gratuity fund, one important point, sir. Actually, if you see the books of accounts of transfer company, retirement gratuity fund is 60,000 is there. We created, but in the additional information, the retirement of employees was due on 31st March 2025. A portion of 35,000 from retirement gratuity fund was earmarked towards the payment due to them. That means in the transfer company books, there is a provision for 60,000 for retirement gratuity fund. In that 60,000, sir, 35,000 has become a liability. So therefore, only to the extent of 35,000 will be taken over by transferee company. So being a transfer company, I will close this retirement gratuity fund to the extent of the liability 35,000. Sir, what about remaining 25k? Because in our books we have created total 60,000. In that 35,000 has become due because some of the employees are retiring at the end of the year. What about remaining 25,000? How I am going to close? Sir, this is not a liability for the company. This is just a provision. Of course, some of the employees are becoming retired at the end of the year. So that's why out of 60, 35,000 has become a liability. Now that liability has been taken over by transferee company. What about the remaining balance in retirement gratuity fund? That has to be closed now. How you are going to close it? By adjusting to equity shareholders. It is not a liability. If it is a liability, it might have been discharged. So it is just a provision now. So this provision is closed by transferring to equity shareholders. So that's why out of 60,000, 35,000 has become a liability which is taken over by transferee company. So that's what I close here. Retirement gratuity fund account debit to realization 35,000 I closed. Remaining 25,000, see this, remaining 25,000 I transferred, I adjusted to equity shareholders. So this is very, very important points. Hope you understand this point. Okay. So therefore this entry also we have done. Assets taken over, liabilities taken over, covered. Next, sir, one more interesting point in the question is this point, sir. Part of the furniture and fixtures is disposed by Pickles Limited for 55,000 at cost. Sir, all assets of transfer company is taken over by transferee company, including furniture and fixtures. That's why in entry number 1 itself, we have closed furniture and fixtures by debiting to realization account total 1 lakh. But the part of the furniture and fixtures is disposed by Pickles Limited for 55,000. So what is the entry you will write? Tell me. When we are closing the furniture and fixtures which is taken by transferee company, we have written realization account is debited. Realization account debit to furniture and fixtures account. Because our asset is taken by transferee company. 1 lakh, 1 lakh. In our books, we have closed this by transferring to realization. But later on, this furniture and fixtures, we have sold part of it. So we received 55,000. So what is the entry we will write? Bank to realization account. Entire sale value will be transferred to realization account. Because already furniture and fixtures account we have closed. So therefore, in our books, furniture and fixtures is entirely closed, but we have selling this part of the plant and furniture and fixtures. So the entire amount collected will be credited to realization account. So cash or bank account debit to realization account. See this. Cash to realization being part of the furniture sold. This is entry number 3. So assets sold, assets taken over, liabilities taken over. and also furniture sold. Next, PC due entry, transferee company account debtor to realization, that is Foods Limited to realization, 16,85,000 total PC. Next, PC received, cash account debit, equity shares in Foods Limited, preference shares in Food Limited to Foods Limited account. PC received in the form of cash 3,15,000. How we got 3,15,000? Add both 1,35,000, 1,80,000. In the form of equity shares 8,70,000. In the form of preference shares 5 lakhs. Next, sale of assets not taken over is not there. Discharge of liabilities not taken over is not there. Next, closing preference shareholders. First, to transfer preference share capital to preference shareholders. See, this is face value of preference share capital. 6% preference share capital, 5 lakhs is there. But what is the amount of PC due to preference shareholders? We calculated 6,35,000. The amount due to preference shareholders 6,35,000. But preference share capital they contributed 5 lakhs. So what is the excess we are paying? 1,35,000, which is debited to realization account. Excess. Now discharge to preference shareholders. Preference shareholders account debited to cash to 8% preference shares in Food Limited. Whatever be the purchase consideration paid by transferee company to the preference shareholders of transfer company, you already received, na, give it to them. So when you discharge, the entry is preference shareholders account debit to cash to preference shares in Foods Limited. 1,35,000 cash, 5 lakhs preference shares. Okay. Now preference shareholders account is also closed. Now I told you, if you remember, before going to equity shareholders, we need to close the realization account, and the realization account, whatever the profit or loss arises, sir, that will be adjusted to equity shareholders. And also one more point, sir, here in this question, they are given about liquidation expenses. Actually, liquidation expenses also they have given, sir. Here you see, liquidation expenses of 22,500 paid by Pickles Limited were reimbursed by Food Limited. I told you liquidation expenses, there are 3 cases, sir. This is the 3rd case. First, liquidation expenses are incurred by transferor. Later on, it is paid by transferee. So what is the entry? When we incur, we know it is the amount going to be reimbursed by other company. So therefore, Foods Limited account debit to cash or bank. Later on, when we realize cash or bank account debit to Foods Limited account. If you see, that entry is also they have passed. See this. First, liquidation expenses, Food Limited to cash, liquidation expenses paid. Later on, when your liquidation expenses are reimbursed, cash to Foods Limited. Net effect is nil, sir, because cash going out, cash received. Food Limited account debited, Food Limited account credit. This point already we have done, correct. I have explained it. Okay. Now, anyway, they are asking realization account. If I prepare the realization account by transferring all the entries. So realization account debtor to assets. Assets taken over, all assets, land and building, plant and machinery, furniture, patent, inventories, trade receivables. And also liabilities taken over. Liabilities to realization, by debentures, by trade payables, by other current liabilities, by retirement gratuity fund. And also we have sold furniture on our own, 55,000. So cash account debtor to realization, so by cash. And also PC due from the Foods Limited. Food Limited account debit to realization, 16,85,000. And also we have discharged to preference shareholders excess amount, that is debited to realization account. So this is a loss on payment to preference shareholders, 1,35,000. So ultimately, if I close the realization account, I got 3,30,000 debit side balance, which is nothing but profit on realization, which is transferred to equity shareholders. So the entry is realization account debtor to equity shareholders. See this, realization to equity shareholders, 3,30,000, 3,30,000. Okay. Now once the realization account is also done, next what we have done is equity share capital, reserves and surplus transferred to equity shareholders. So equity share capital 6 lakhs, general reserve is there, P&L account is also there. In the books of transfer company, you see we have general reserve 1 lakh, P&L account 1,10,000, equity share capital 6 lakhs. Everything is transferred to equity shareholders, including this retirement gratuity fund. This provision, out of this provision 25,000, 35,000 only has become a liability, which is taken by transferring company. Remaining 25,000, how we are going to close? By adjusting to equity shareholders. Okay, so 6,35,000, 8,35,000 is created to equity shareholders account. No fictitious assets, nothing. Now finally settlement entry, important, sir. Equity shareholders, sir. Relating to equity shareholders, what are the modes of PC we received, sir? One is cash 1,80,000, sir. Another one is equity share capital 8,70,000. So equity shareholders account debtor to equity shares in transferee company, that is Foods Limited, 8,70,000. Relating to cash, sir, in the form of PC, 1,80,000, sir. But in the question anyway, they have asked cash account, sir. So if I prepare cash account of this company, transferor company, see this. Opening balance given in the question 60. They have already given, sir. Opening balance 60,000 they have mentioned in the question. See this. Cash balance 60,000, sir. 60. Okay. So what are the receipts of cash during the year? What are the receipts of cash? Receipts, we sold furniture on our own, 55,000 we received. And also liquidation expenses we paid, they reimbursed, that is 22,500. And also in the form of PC from transferee company, we have received 3,15,000, that is 1,35,000 plus 1,80,000, both 3,15,000. Outflows of cash, sir, liquidation expenses 22,500 we spent. To the preference shareholders we paid 1,35,000. Now see, in the cash account the balance figure is 2,95,000. This 2,95,000 will be given to equity shareholders. Okay, including purchase consideration of 1,80,000 cash. Total amount left in cash account is 2,95,000, which is given to equity shareholders. So to cash 2,95,000 important, and to equity shares 8,70,000, total 11,65,000. Okay, so whatever the PC you received in respect of equity shareholders, cash only actually 1,80,000, but if I prepare the cash account and if I find out the closing balance, 2,95,000 came. So this entire 2,95,000 will be transferred to equity shareholders. So that is the important thing here. Okay, balancing figure. That's it, sir. I think this is how we need to prepare the transferor company books, sir. This question you solve it once, I think you will understand it better. Very good question. Number of important points are there in this question. Two important points in this question is relating to retirement gratuity fund, 1 point, good point, and also part of the furniture and fixtures sold, which is already closed by transferring to realization account. Now this entire 55,000 we need to transfer to realization account. That is important point here. And PC calculation, one important point. Liquidation expenses, case number 3, important. And also when you are settling the equity shareholders, okay, cash balance. So you need to prepare the cash account, whatever the ultimate cash balance is there, that will be given to equity shareholders only. So this is May 2025 examination question, sir. Okay, relating to transferor company books. Of course, we are going to solve one more question relating to transferor company books accounting. Now relating to the accounting for amalgamation in the books of transferor company, one more question we are going to cover. Illustration number 7, sir, from ICAI study material. Illustration number 7, accounting treatment of transferor company. See this question, sir. See, there are two entities, K Limited and L Limited, sir. They amalgamate to form a new company, LK Limited. So here LK Limited is a new company which is transferee company or purchasing company. K and L are transferor companies. Two transferor companies are there. The financial position of these two companies are given below. K Limited, L Limited balance sheets and also notes to accounts given, sir. And what they are asking, the requirement of the question, if you see, they are asking prepare ledger accounts in the books of K Limited and L Limited to close their books. They are asking K Limited, L Limited ledger accounts to close their books. That means K and L are what's a transferor company. So transferor company books closing they are asking. Okay. And whenever you are solving any question relating to amalgamation, we need to calculate PC. So PC calculation is one of the important things, sir. So in K and L, if you see shareholder, share capital, sir, they have both equity as well as preference shares. I am going to solve for K Limited. L Limited, it is similar accounting treatment. Okay. So in K Limited, when it comes to equity shares, we have 8,000 equity shares. preference shares, we have 4,000 preference shares. Now look at the terms of amalgamation to calculate PC. I think point number 2, point number 3, they are talking about the terms of purchase consideration, sir. First to point number 2, issue of 5 preference shares of 20 each in LK Limited at 18 paid up at a premium of 4 per share for each preference share held in both the companies. Sir, for one preference share of K and L Limited, LK Limited, the transferee company is going to give 5 preference shares of rupees 20 each, but they are given at 18 paid up at a premium of 4. That means 22. 18 at a premium of 4. So suppose you see in K Limited, the number of preference shares are 4,000. 4,000 for each preference shares, 5 preference shares will be given. 4,000 into 5, 20,000 into each one is given at 22 rupees. So 20,000 into 22. So it will be 4,40,000. So this is the purchase consideration to the preference shareholders of K Limited. Very simple. Done. Next. Issue of 6 equity shares of 20 each in LK at 18 paid up at a premium of 4 per share for each equity share held in both the companies. Now they are talking about purchase consideration to the equity shareholders. For one equity share in both the companies, 6 equity shares of LK Limited will be given. In K Limited, we have 8,000 equity shares, sir. So for one equity share, 6 equity shares will be given. 8,000 into 6, 48,000. And each share is given at 18 plus 4, 22 into 22. So 8,000 into 6 into 22. So it will be 10,56,000. Now comes the most important point of this sum, sir. In addition, necessary cash should be paid to the equity shareholders of both the companies as is required to adjust the rights of the shareholders of both the companies in accordance with the intrinsic value of shares of both the companies. Intrinsic value means net assets value of the share. Necessary cash will be paid to the equity shareholders apart from the equity shares. But the question is, how much is the necessary cash? We don't know. So therefore, I told you when I'm discussing the concept of methods for calculation of purchase consideration, I clearly told you when you are unable to quantify any mode of PC, just you need to follow net assets method to calculate the PC. Sir, here everything is clear, sir. To preference shareholders 4,40,000, to equity shareholders in the form of equity shares 10,56,000 clearly given. But necessary cash, they use the word necessary cash. Even if one mode of PC, if you are unable to quantify, follow net assets method. So therefore here K Limited, L Limited net assets we need to consider, and that will be the purchase consideration. So from that purchase consideration, 4,40,000 is in the form of preference shares, 10,56,000 is in the form of equity shares, remaining will be the cash balance. Only if you know the breakup of the purchase consideration, you can able to write the entries properly in the books, right? Transfer or company books. And so thereby you can prepare the ledger accounts. So therefore, in the information given in the question, since we are unable to determine the cash amount, necessary cash word they have used, so we need to follow net assets method. And I told you how to calculate PC under net assets method. Under net assets method, PC will be calculated agreed value of assets taken minus agreed value of liabilities taken. And I told you only the assets and the liabilities taken over by transferee company will be considered, and that to at agreed value. If agreed value is not there, book value. So you have to be very careful. Okay. So first identifying in the question that we need to follow net assets method for calculation of PC is the first step, first success of this question, sir. Next, fourth point is also one of the important point of this question. See this. Issue such amount of fully paid 6% debentures in LK Limited as is sufficient to discharge the 5% debentures in K Limited yet a discount of 5% after takeover. Here many students are asked me one doubt, sir. Here what they will ask is, see here LK Limited, the transferee company, is discharging the debenture holders of K Limited. Whether debentures are discharged at a discount of 5% or debentures are actually taken at book value, after that they will be discharged by issuing debentures, 6% debentures of LK Limited at a discount. That is the most important thing here. That means whether takeover happened at discount or after takeover, the debentures we are issuing to discharge the debenture holders of K Limited are happened at discount. If you read the sentence carefully, sir, LK Limited is now issuing 6% debentures to whom? To the 5% debenture holders of K Limited at a discount of 5% after takeover. That means takeover happened at book value only. That means the transferee company has taken over the debentures of K Limited at 2 lakhs only. After takeover, to this 2 lakhs, okay, sufficient number of 6% debentures will be given at a discount of 5%. See, this is very important. Why? Because now when you are calculating net assets, PC under net assets method, you have to consider the assets and liabilities at their agreed value. Suppose, for example, in this case, if the student is interpreted like this, 2 lakhs is the debentures of K Limited and LK Limited is taken over these debentures at a discount of 5%. That means 95% value at which they have taken over. So 2 lakhs into 95%. So they will take 1,90,000 in the liability side when they are calculating net assets. That means 10,000 shortage they have taken. So therefore your PC calculation go wrong. Because when you are calculating PC under net assets method, the assets and liabilities, if they are taken over at agreed values, we need to consider agreed value only. Here they have given you debentures are taken over at book value only. After takeover, for the 5% debentures of K Limited, 6% debentures of LK Limited is given at a discount of 5%. Suppose if the takeover happened at discount, na 1,90,000 is correct. But takeover happened at book value only. After that, for the 2 lakhs, so they are issuing debentures, 6% debentures, fully paid debentures at a discount of 5%. So read the sentences carefully. That is the important thing here. Okay. And also, you see, the assets and liabilities are to be taken at book values. Inventory and trade receivables for which provision at 2%, 2.5% respectively to be raised. See, the LK Limited is taking the assets and liabilities of K and L at book value only, but 2 assets. One is inventory, another one is trade receivables. Both are taken over at these two inventories as well as trade receivables are taken over at 2% and 2.5% provision. So we need to create a provision. That means other than book value, agreed values we need to take when you are calculating PC under net assets method. Next, the trade receivables of K Limited includes 20,000 due from L Limited. So between K and L, there are mutual debts which is not relevant for transfer. Okay. Now the LK Limited, the transferee company, issued 15,000 new equity shares of 20 each. Rupees 18 paid up at a premium of 4 per share so as to have sufficient working capital. Sir, the LK Limited, the new company, issued shares, sir. 15,000 new equity shares for the purpose of working capital. What to do with transfer company books, sir? Nothing to do with transfer company. Okay. So understand, we are doing the accounting treatment in the books of transfer company. First, we need to calculate PC. Here we identified that PC we need to ascertain by net assets methods. Okay. Now let us try to find out the PC first. So here PC means what? Here we need to find out PC by net assets method. K Limited I am taking. L Limited same manner you have to take. Agreed value of assets taken minus liabilities taken. So take one by one assets, sir. So assets, if you see, land and buildings, plant and machinery, furniture and fixtures, all these assets, land and buildings, plant and machinery, furniture and fixtures, these are all taken over at book value only, no agreed value. 4,50,000, 4,50,000, 6,20,000, furniture and fixtures 60,000. Okay. Next, goodwill also same, 80,000 book value. Next, we have other assets also like inventories, 2,25,000. But when it comes to inventories, sir, 2,25,000 less 2% we need to consider, sir, because in the question clearly given inventories are taken over at 2% provision. Correct? Inventories are taken over at 2% provision. See this 2%. On debtors 2.5%. So therefore 2,25,000 minus 2%. So it will be 2,20,500 agreed value, important. And also trade receivables, debtors will be debtors balance is how much? Trade receivables 2,75,000. 2,75,000 less 2.5%. 2,75,000 less 2.5%. So it will be 268,125. 268,125. I think any other assets, sir? Cash and cash equivalents breakup is there. Cash at bank 1,20,000. Cash in hand 41,375. So cash, bank, in hand. So cash at bank 1,20,000, sir. Cash in hand 41,375. So total minus liabilities. So what are the liabilities of K Limited we have taken over? Debentures. Debentures are taken over at book value only. So first 5% debentures 2 lakhs. And any other liability, sir? In K Limited, trade payables 1 lakh is there. Trade payables 1 lakh. I think these are the liabilities. Then you will get net assets. So that you will get PC. So you see this, whether we have done correctly or not. See, refer this. So land and buildings we have considered 4,50,000. Plant and machinery, furniture and fixtures, goodwill, inventories less 2%, trade receivables less 2.5%, cash at bank, cash in hand, minus debentures, trade payables. So PC is 15,60,000 we got, sir. This is 15,60,000. What is this 15,60,000? This is net assets of K Limited, which is nothing but PC, sir. PC. Nothing but PC. Now, important point, sir. This is the total PC for K Limited. How this PC is discharged, sir? This is discharged by, we know certain terms of purchases clearly. Like for example, here, preference shares of LK Limited 4,40,000. Preference shares 4,40,000. Equity shares 10,56,000. So what is the balance here? I think 15,60,000 minus 4,40,000 minus 10,56,000. So 64,000, sir. Balance. What is this? Cash. Balancing figure. That's it. These are the different modes of PC. See this. So this PC is discharged by in the form of preference shares clearly given in the question 4,40,000. Equity shares clearly given in the question. Cash they have not given. We have set it 64. Okay. Now we need to close the books of transfer company. You know how to close them. 13 entries and then ledger accounts. First realization account is the most important account. How? Realization account, what items will appear in the realization account? First, assets taken by transferee company. Realization to assets. What are all the assets taken over by transferee company? All assets. At their what value? Book value, sir. Most of the students here confused, sir. When you are calculating PC under net assets method, sir, agreed values, the value at which assets and liabilities taken over by transferee company we need to consider, because PC is always calculated from the point of view of the transferee. But when you are closing the books of transfer companies, remember you need to close the assets and liabilities taken over at their book values. Okay, so first assets taken over. So what are all the assets taken over, sir? Land and buildings, so plant and machinery, furniture and fixtures, so goodwill, inventories. Look at book values, important. Book value, trade receivables, book value. Even though takeover happened at less 2.5% provision, but we will not consider in the books of transfer. Everything book value. All of them are book value only. Next, cash in hand, cash at bank, everything. Liabilities, debentures, trade payables, everything book value. Then PC due, LK Limited to realization. PC 15,60,000. And to preference shareholders. See, preference shareholders, if you see, what is the PC we need to pay? 4,40,000. But how much is the preference share capital they contributed, sir? Preference share capital they contributed is only 4 lakhs. But we are paying 4,40,000. So preference share capital account debit to preference shareholders. Preference shareholders is credited with 4,40,000. Preference share capital debited with 4 lakhs. The difference is 40,000. That is excess payment that is debited to realization account. Last problem also we have done that. So 40,000 is what, sir? premium we are paying, excess amount we are paying, that will be debited to realization account. So realization account to preference shareholders excess payment. So ultimately we got a loss 51,375. Realization account loss we got, sir. This loss we need to transfer to shareholders. Now when you prepare shareholders account, na sir, how you are going to prepare equity shareholders account in this question? Very simple. Equity shareholders account. First, to equity shareholders, we need to transfer equity share capital. You know that. So what is the entry? Share capital account debit, reserves and surplus account debit to equity shareholders. So by equity share capital, what is the equity share capital they have contributed, sir? Equity share capital, I think equity share capital is 8 lakhs, correct? Huh? See this 8 lakhs. 8 lakhs. Any reserves and surplus? Yes. P&L account in K Limited by P&L 3,71,375. And also realization we got a loss. So what is the entry? Equity shareholders to realization. So how much is the loss? I think we got loss of realization is 51,375, sir. 51,375. Next, sir, discharge to equity shareholders. Here fictitious assets, so P&L account debit balance not there. Next, whatever the PC received, that will be given to equity shareholders. So to equity shareholders, two modes of PC. One is equity shares in LK Limited. Second one is cash. So what is the entry? Equity shareholders account debit to equity shares in LK Limited, one PC, and also to cash. So equity shares in LK Limited, I think we got it 10,64,000. We calculated now 10,56,000. Clearly no. And in the form of cash also we calculated 64,000. So I think 8 lakhs plus 371, 375. So 11 lakhs 71, 375. This one 51, 375 plus 10 lakh 56,000 plus 64,000. So 11 lakhs 71,375 tallied. Like this. So equity shareholders account tallied. And also preference shareholders account, transferee company. This is transferee company, LK Limited. So relating to transferee company, LK Limited, in the books of transfer company, two entries will come: PC due, PC discharged. So when PC due, what is the entry? LK Limited to realization. So to realization. So what is the total PC? Total PC we calculated 15,60,000. And then this PC is received. So what is the entry when PC is received? Cash account debit by cash, I think 64,000. Next to buy preference shares in LK Limited. Next to buy equity shares in LK Limited. We need to consider equity shares 10,56,000 and preference shares 4,40,000. That's it. Their account will be closed. So generally realization account to equity shareholders account to transferee company account. So these are the ledger accounts. Generally they will prepare, sir. That's it. Okay. This is one question, sir. Important question relating to books of transfer company, illustration number 7. Try to solve this type of questions. Next, in amalgamation topic, we are left with accounting for amalgamation in the books of transferee company. What transferee company will do, sir? Transferee company will take over the business of transfer company. For this takeover, how accounting will be done in the books of transferee company? What kind of entries we are going to pass? That is what we are going to cover here. Now, when you are doing the accounting treatment for transferee company, sir, first thing you need to remember is AS 14 is applicable for transferee company. Accounting standard 14 is applicable to the transferee company. And AS 14 says there are two methods for accounting for amalgamation in the books of transferee company. One is pooling of interest method, another one is purchase method. Sir, which method I need to follow for accounting, sir? That depends upon the type of amalgamation. If the amalgamation is in the nature of merger, then follow pooling of interest method. If the amalgamation is in the nature of purchase, then follow purchase method. Therefore, when you are doing the accounting treatment for transferee company, the type of amalgamation is the most important thing, because depending upon the type you select the method and accordingly you need to do the accounting treatment. Okay.
As I already told you, amalgamation in the nature of merger, they will give you 5 conditions. All the 5 satisfied, it is merger, right? 5 conditions will be there. If any one of the condition fails, purchase. Now if it is amalgamation in the nature of merger, pooling of interest method, otherwise purchase method. Okay, now let us see the entries. What kind of entries we are going to pass for amalgamation in the books of transferee company under pooling of interest method, purchase method. Listen to me carefully. Sir, suppose there are 2 entities, sir. A Limited, B Limited. Now A Limited take over the business of B Limited. So A Limited is transferee company, B Limited transferor company. Already transferor companies accounting we have completed, sir. Now transferee company books, we need to write the entries. Basically what entries you will write, sir? Tell me. We are acquiring the business of one company. So for that acquisition, one entry. And once you acquire that business, the assets, the liabilities, the reserves of that business is now becoming your assets, liabilities, reserves. So that entry. And also transferee company has to discharge the PC, that entry. So these 3 entries are very common, whether it is amalgamation in the nature of purchase or amalgamation in the nature of merger. I mean pooling of interest method or purchase method doesn't make any difference. So first, business purchase entry. So being a transferee company, we have purchased the business of transferor company. So that's that entry. And incorporation entry, most important entry, incorporation of assets, liabilities, reserves of transferor company by transferee company, and also discharge of PC, So transferee company will pay purchase consideration to the shareholders of transferor company. See, these 3 are most important common entry. There are remaining entries also that depends upon the information given in the question, whether they will come or not, that depends upon the information given in the question. Now see, first, purchase, business purchase entry, sir. Sir, what is the entry we will write as a transferee company when we acquire the business of transfer company? We will open a temporary account called business purchase account. So business purchase account debit to liquidator of transferor company. Business purchase account debit to liquidator of transferor company. Under both the methods, there is no difference. First entry, business purchase account debit to liquidator of transferor company. Sir, at what value, sir? PC. Whatever the amount we are going to pay in the form of purchase consideration, at that amount we are going to write this entry, business purchase to liquidator of transfer company. Liquidator of transfer company, anyway transfer company is going to liquidate, right? So who is going to handle the entire procedure, sir? Liquidator. So that's why liquidator of transfer company account has been credited. First entry done. The most important entry is incorporation of assets and liabilities entry. Listen to me carefully, sir. Sir, I am A Limited. I am taking over B Limited. Okay. Now from B Limited, if you look at the balance sheet of B Limited, suppose this is B Limited balance sheet, sir. In this balance sheet, they have assets, they have liabilities, share capital, reserves and surplus. Basically this is right. Suppose they have assets 100 lakhs, liabilities 50 lakhs, reserves and surplus suppose 40 lakhs. Obviously share capital is 10. So this is their balance sheet. Okay. Now I am A Limited. I have taken over B Limited. Amalgamation in the nature of merger, pooling of interest method. Now the assets 100 lakhs. Everything will be taken over at book value in merger. The assets of B Limited becomes my assets now. So I will debit assets account debit 100. 2. The liabilities of transferor company becomes my liabilities, the liabilities 50. Including reserves, the reserves and surplus will become my reserves and surplus 40. And for this entire business, how much purchase consideration we are paying? First entry we have opened business purchase, right? That account we need to credit now, business purchase. Suppose we are paying 30 is the business purchase consideration, nothing but PC. See this. That means we have taken over the assets 100, the liabilities 50, your reserves 40, and we are paying 30. But debit and credit side tallied? No, not tallied. See, debit side total debited with 100, credit side the total is I think 120, right? 120. Sir, why it is not tallied, sir? Simple reason, sir. Here always in pooling of interest method, sir, you need to compare PC with the share capital of transferor company. Why we need to compare with share capital of transfer company? See, that is what exactly the worth of business you are taking over. If you observe carefully, sir, from the balance sheet of transfer company, you are taking over the assets, you are taking over the liabilities, you are taking over reserves and surplus. That means from this balance sheet entirely, if you observe, you have taken over this part 100 minus 50 minus 40. Therefore, you are taking business worth of 10, which is exactly equal to share capital. Therefore, why there is a need to always calculate how much business I have taken from B Limited in amalgamation in the nature of merger, pooling of interest method, because in amalgamation in the nature of merger, anyway, we will take all assets, all liabilities, including reserves, we will taken over. Everything will be taken over at book value. So therefore, simply look at the transfer company balance sheet. In that, look at the share capital amount. That amount is exactly the worth of business we have taken over. That means we have taken over 10 lakhs worth of business because our share capital of transfer company is 10. Or else you can calculate like this: 100 minus 50 minus 40, 10. What is the PC you are paying? 30. 30 PC you are paying, sir, but the worth of business is 10. Therefore, how much is the excess amount you are paying? 20. Now the standard coming into the picture and says, see, in pooling of interest method, the purchase consideration is in excess of the share capital of the transfer company. The excess you are paying, it is a loss to you. So do one thing. This loss you adjust against the free reserves of transfer company first. So always this excess first free reserves of which company? Transfer company you adjust. If transfer company free reserves are not sufficient or not available, then the second preference is free reserves of transferee company. Suppose they are also not available or not sufficient, then finally debit to P&L account. P&L account will be debited. Which company? Transferee company P&L account will be debited. So in this case, if you see in this entry, the reserves and surplus, suppose assume all the reserves and surplus are free reserves. This reserves and surplus 40 of transfer company, the excess is 20. First adjust this 20. Say this. From this 40 minus 20 you do. So that means balance is 20. So now you see credit side liabilities 50, reserves and surplus after adjusting the loss 20, business purchase 30. So tally it. So this is what we need to do in case of pooling of interest method. So in pooling of interest method, understand transfer company assets, my assets. So assets account debit at book value. Transfer company liabilities, my liabilities, two liabilities, book value. Transfer company reserves, my reserves, two reserves and surplus. But what? The excess amount you are paying, adjust it. The balance reserves and surplus you take. Two business purchase. So this is what the basic entry here. See this. Various assets at book value, account debit, to various liabilities, sundry liabilities at book value, to statutory reserves of selling company. See, in the transfer company books, selling company books, if there are any statutory reserves, they are also your reserves. You need to maintain them. So you incorporate in your books. And reserves, balancing figure if any. Why they are saying balancing figure? Because if you pay any excess amount than the share capital, obviously that is worth of business you are taking. That will be adjusted against reserves and surplus. So the balance reserves and surplus we will take to business purchase. Hope you understand the logic here. Their assets, our assets. Their liabilities, our liabilities. Their reserves, our reserves. Their statutory reserves, our statutory reserves. And for this entire, what is your paying? You paying PPC, business purchase. Compare with the share capital. Share capital. Why share capital? Because that is the worth of business you are taking. Now, if you are paying excess than the share capital, that is loss that will be adjusted against free reserves of transfer company. That is what I have given here. When purchase consideration is greater than the share capital of selling company, the excess consideration is adjusted against the free reserves of selling company, transfer company. If not sufficient, then free reserves of purchasing company, transferee company. If not sufficient, it will be debited to transferee company P&L account. Sir, what about reverse happens? For example, here the PC you are paying is not 30, sir. Suppose your PC you are paying is 5. Suppose if you are paying a PC of 5. So you need to compare PC with what? Share capital of selling company or purchase transfer company, right? So the share capital of transfer company is 10. That means you are taking business worth of 10, but you are paying 5. So in this case, there is a gain for you, right? Profit, we can say. How much? 5. This will be transferred to capital reserve, kind of a capital profit to you. So that's why, see, when purchase consideration is less than the share capital, that means less than the worth of business you are taking, that is a gain. That shortfall in consideration is created to capital reserve. This is what we do in case of amalgamation in the nature of merger, pooling of interest method. Now coming to amalgamation in the nature of purchase. Very interesting, sir. Sir, in purchase, what happens, sir? All assets of the transfer company you take. So they will become now your assets. Same example I am continuing. Assets. But here the important thing is the transfer company assets, there is no guarantee that you are going to take at book value. You may take at agreed value, whatever the value. If you take at agreed value, you write at agreed value, because you are a transferee company. At what value you are taking the assets, that value will be relevant for you. So suppose, assume they are taken at book value. So assets we will incorporate. The liabilities of transfer company, at what value you are taking over, what liabilities you are taking over, incorporate it. But tell me, reserves and surplus, will you incorporate? No. Because generally in case of amalgamation in the nature of purchase method, the identity of reserves of transfer company will not be maintained by transferee company. So the question of incorporating reserves and surplus in the books of transferee company will not arise here. The assets, the liabilities, we will incorporate. That means nothing but net assets we have incorporated. How much? 50. Now for this, what is the PC you are paying? Business purchase. You are paying a PC of, I think, 30, right? 30 in our example. PC is 30. Now you see the difference. So here in amalgamation in the nature of purchase, we need to compare PC with what? PC with the net assets of transfer company, or selling company. So PC we are paying 30. What is the net assets of transfer company? See, net assets means 100 minus 50. So how much? 50. 50 is the net assets, right? 50. 100 minus 50, sir. So therefore you are paying shortage. Actually you are taking business worth of 50. Assets minus liabilities, 50 worth of business you are taking, but you are paying only 30. Therefore there is a profit 20, which will be transferred to capital reserve. So here we will write to capital reserve account 20, so that it will be tallied. Or else imagine a situation, sir. Suppose you are paying a business purchase consideration of 60 instead of 30. What happens? Tell me. You are paying purchase consideration of 60, but worth of business you are taking 50. So therefore excess you are paying, na sir, excess. That excess will be transferred to goodwill. So the concept of goodwill arising in amalgamation will come in the purchase method. Not in pooling of interest method. In pooling of interest method, if you pay any excess consideration, we compare with share capital. If the purchase consideration is greater than the share capital, we will adjust against the free reserves of transfer company. If not sufficient, transferee company. If not sufficient, debited to P&L account. But in purchase method, sir, whatever the excess consideration you are paying, we compare PC with the net assets. If the PC is more than net assets, that excess will be transferred to goodwill. Okay. But if there is a shortage, in both the methods, it will be transferred to capital reserve only. So say this, in case of purchase method, we will incorporate assets of transfer company as our assets. Whatever the assets we have taken over at agreed value, if there is an agreed value. If there is no agreed value, book value itself is an agreed value. And liabilities, whatever the liabilities of transfer company you have taken over, you incorporate in your books. Sir, always remember, sir, pooling of interest method means merger. In merger, all assets, all liabilities, including reserves, will be taken over, that too at book value. So there is no question of I am taking only these assets, I am taking only these liabilities, that too at this value, will not arise. In case of pooling of interest method, everything will be taken over at their book values. But in case of purchase method, you are taking assets, you are taking liabilities selectively. There is a possibility, and you may take assets and liabilities other than book value. That's why they have given agreed value here. And this is what? Assets minus liabilities. You are taking net assets. You compare with purchase consideration to business purchase. Purchase consideration. So if your purchase consideration is greater than the net assets, then that is loss. That loss will be debited to goodwill. Loss will be debited to goodwill. Suppose if your purchase consideration is less than net assets, that is a kind of a gain, so that will be transferred to capital reserve. So in pooling, in purchase method, we compare PC with net assets. If PC is greater than net assets, goodwill. If PC is less than net assets, capital reserve. I think this is incorporation entry is the most important entry. So I'm going to ask few questions. Tell me, in which method you will consider the assets and liabilities selectively? Purchase method. In which method you will consider the assets and liabilities other than book values? Purchase method. In which method you will compare PC with net assets? Purchase method. In which method you are going to adjust the reserves of transfer company? Pooling of interest method. In which method you are going to compare PC with the share capital of transfer company? Pooling of interest method. So these are the points you need to understand. Now once you incorporated the assets and liabilities, next discharge of PC. Discharge of PC. See, in the first entry, when you acquire the business, you have credited the purchase consideration to liquidator of transfer company, right? Now you debit. Liquidator of transfer company account debit to whatever the purchase consideration you are giving. Suppose liquidator of transfer company account debit to share capital. Suppose if you are issuing shares, equity shares, preference shares as a purchase consideration to share capital. See, when you are issuing share capital, you are the issuer company, right? Always you need to credit the share capital at face value. Number of shares into face value. And suppose if the shares are issued above the face value, that will be transferred to securities premium account. That will be transferred to securities premium account. The excess amount, excess than face value, issue price minus face value. And suppose if you pay any cash account will be created. Similarly, in case of purchase method also, same entry. Whatever you are issuing, credit to share capital. Suppose for example, I am transferee company, sir. I have acquired your business. Now I will pay to you purchase consideration. So what is the entry generally we will pass here? So liquidator of transferor company, first I debit, because already we have created his account. Now we debit. And what is the PC we are paying, which is given in the question, right? So suppose we paid cash or bank, credit it. Suppose we have issued equity share capital, credit. We have issued preference share capital, credit. We have issued debentures, credit. Everything will be credited. And remember guys, share capital will always be created with face value. Students not understanding, if you are issuer company, always share capital is created with the number of shares into face value. If you are issuing above the face value, that will go to securities premium account. Securities premium account. This is very, very basic level. So that's it. So these three entries are very common entries in the books of transferee company. Business acquisition, incorporation of assets and liabilities, discharge of PC. Hope you understand up to these three. Now, I told you three entries are common. I mean, common in the sense regular. Remaining entries depends upon the information given in the question. Let us see the remaining entries. Cancellation of intercompany owings. Sir, what is this intercompany owings? Let us discuss. Cancellation of intercompany owings. Sir, A Limited, B Limited, two entities are there. A, B. Now, A Limited is transferee, which is taking over the business of B Limited transferor. Okay. See, before amalgamation, there may be some transactions happened between A and B. So, in the balance sheet of A Limited, asset side trade receivables is there, 10 lakhs, right? Which is nothing but B Limited, because A Limited sold goods to B Limited, sir, on credit basis. So, A Limited sold goods to B Limited. So, in the A Limited balance sheet, debtors 10 lakhs is there. Now, similarly, B Limited balance sheet, sir, liability side, trade payables is there. To whom? A Limited, 10 lakhs. Now, interesting, sir. See, now I am A Limited transferee company. I am doing the accounting in the books of transferee company. Whether it is amalgamation in the nature of, pooling of interest method, purchase method, understand the basic thing. See, being A Limited, I will take over all assets and liabilities of B Limited transfer company. Suppose in B Limited, the liabilities, trade payables, we will incorporate in our books. So just now we have completed incorporation entry. Assets, whatever the assets we are taking over, we will debit. Whatever the liabilities we are taking over, we will credit now to liabilities. So trade payables also we will credit in our books. That means in A Limited books for amalgamation, at the time of incorporation, we will incorporate the liabilities of transfer company. One of the liabilities, trade payables. So we incorporated 10 lakhs. Now later on we understood that this trade payables is nothing but ours. We made the sales. So B Limited point of view, they need to pay 10 lakhs to us and we need to receive 10 lakhs from them. Now A and B is becoming one entity. So the question of paying themselves will not arise now, because the asset, the liability now is coming into the same company. Already in A limited books there is an asset, trade receivables. Now from the B limited, this liability also be incorporated. So therefore next what we need to do is we need to eliminate these two, because I can't pay to myself now. Who is the receiver? A limited. Who is the giver? A limited. Because from B limited this trade payables are incorporated in our books. So therefore what we need to do is we need to eliminate. What we need to eliminate? The trade payables which we have incorporated from B limited. So trade payable of which company? B limited. From B limited, whatever the trade payables already we credited, now cancel them 10 lakhs, and in our books trade receivables is there na, cancel it. So therefore the entry is trade payables of B limited, trade receivables of A limited. In the books of A limited we need to eliminate this. This is called intercompany owings. So before amalgamation, because of any transaction, if there are any common owings between them, just eliminate it. How we are going to eliminate? Simple entry, debtors to creditors. So creditors account debit to debtors, that's it, eliminated. Creditors of which company? In this example, creditors of transferor company, debtors of transferee company. Similarly, I will take one more bill, maybe in the form of bills. Suppose A limited sold the goods to B limited, A limited draw the bill, B limited accepted the bill. Now in the A limited books asset side, we have bills receivable 10 lakhs from B limited, and in the B limited balance sheet on the liability side, bills payable will be there for A limited 10 lakhs. 10 lakhs. Now you eliminate these two things, because at the time of incorporation we will incorporate bills payable, transfer company liabilities we will incorporate 10 lakhs, and later on we understood that this bills payable is for us only. So we from B limited bills payable, from A limited point of view bills receivable, both becoming same entity. So therefore we need to cancel. How we are going to cancel it? Simple, bills payable whatever we incorporated already in our books, bills receivable is there. So bills payable which is incorporated from B limited, in the incorporation entry cancel it, and bills receivable in our books debit credit it. So 10 lakhs 10 lakhs. So that means both will be eliminated. Similarly sir, I will take one more example sir. Loan given. For example, A limited has given a loan to B limited sir. So in the A limited balance sheet you see asset side loan given to B limited 10 lakhs is there, asset side. In the B limited balance sheet liability side, loan taken will be there 10 lakhs, right? So now you are taking over B limited. So if you write the incorporation entry, first you incorporate the liabilities. So in the liability of the B limited, loan is there. So therefore to loan we will incorporate 10 lakhs. Now this loan is what? Nothing but we have given this loan to the B limited. B limited has to pay this loan to us, but B limited liability has now become our liability. Therefore, first we incorporate that liability into our books. Later on, we will cancel the loan liability with our asset. So this loan we have taken from B limited, incorporated from B limited, which is no more relevant. And in our books, loan asset in the books of A limited, the asset, this loan and this loan liability, whatever we have taken over, both will be cancelled. This is called cancellation of intercompany owings. So what is the entry for this? Same, I told you now, if the intercompany owings is in debtors and creditors, creditors to debtors. If the intercompany owings is there in bills, bills payable to bills receivable. If the intercompany owings is there in loans, loan to loan. That's it. Okay, intercompany owings eliminated, discussed. Next, one more thing, sir. Elimination of unrealized profit on goods sold by one company to the other company and remaining unsold on the date of amalgamation. Same. What is this, sir? Sir, elimination of unrealized profit. Important concept, sir. Listen to me carefully. Elimination of URP. URP means unrealized profit. URP elimination. Sir, what is this unrealized profit elimination? Sir, A limited sold goods to B limited. For example, A limited is before amalgamation, sir. This has happened before amalgamation. So before amalgamation, what happened is there are two entities A and B. A limited sold goods to B limited, sir, at cost plus profit, sir. Cost plus profit. Suppose the cost is 100 lakhs, sir. 20 lakhs profit, 20% profit. So 120 lakhs they sold it, sir. So A limited point of view, they are the seller. B limited point of view, buyer. Now, when A Limited sold goods to B Limited, now the stock is there with whom, sir? B Limited. Suppose 120 lakh stock is there. Exactly at this point of time, amalgamation happened. A Limited take over the business of B Limited. Now, A Limited is what? Transferee company. B Limited is what? Transferor company. Now, understand. Important, sir. Sir, before amalgamation, A sold goods to B at cost plus profit. So 120 lakhs worth of stock is there with the B Limited. B Limited point of view, that is the cost. See, the price at which we are buying, that is our cost now. So in our books, 120 lakhs is the cost of the inventory. But A Limited knows they have sold the goods at 20% profit. Okay. Now listen to me carefully. And once this transaction happened, suppose A Limited takes over B Limited. Amalgamation happened. So A Limited will become transferee company, B Limited will become transferor company. Okay. Now what happens is, when I incorporate the assets of transferor company, I will incorporate stock also. So this stock is now my stock. Okay, stock account I will debit. In incorporation entry, I will debit. Okay. Suppose I incorporated at book value 120 lakhs. Incorporation entry. Pooling of interest method, purchase method doesn't make any difference. See this. The stock, the asset of transfer company, we incorporated in our books 120. But being a transferee company, we know this stock is nothing but we sold our stock. This is, and in this stock there is a profit of 20, which is unrealized. What is unrealized profit? That means it is not yet collected. It is not yet sold. It is not yet collected from the customer. See, I sold goods to you. You have to sold to the customer, right? Then only profit will be realized. Now, if the stock is still there with you, that means the stock is not yet sold. When the stock is not yet sold, how profit will be realized? So in this 120, sir, in this 120, 20 lakhs profit is still not yet realized, right? Now amalgamation is happening. Now B Limited stock, A Limited is taking over, and A Limited knows that in this stock there is a 20 lakhs profit which is not going to realize now. It's not going to be realized. This is called unrealized profit. Unrealized profit. Because we sold to B Limited. We sold to B Limited. But B Limited has not made a sale. Because this is unsold yet. So in the unsold stock, whatever the profit is there, which is not yet realized, therefore, now A and B becoming one entity. So in the B Limited, in the name of unsold stock, whatever the stock is there, in that unsold stock, there is a profit included in it. That profit is called unrealized profit. That unrealized profit I need to eliminate. Sir, why we need to eliminate? Sir, without realizing profit, how can you book in the books, sir? That's the logic, sir. Here, see, the logic is, suppose if you allow us to write the inventory at 120, we are making you to write inventory at an inflated price, which is not correct, sir. Actually, the cost of the inventory is 100 lakhs only. You know, being a transferee company. But simply because you sold at 120, now that company you are acquiring, and you know that the stock is overvalued, including profit. So that has to be eliminated, right? So therefore, stock you incorporated at 120 at the time of incorporation. Later on, what you need to do is, in this stock, whatever the unrealized profit is there, in this example 20, eliminate it. So stock will be created, or else you credit to one account called stock reserve account. Later on, the stock reserve will be adjusted from the stock. Both are same only. Okay. So stock account will be created 20. Now, which account will be debited, sir? Simple. If it is pooling of interest method, sir, you will debit general reserve or P&L account. That means it will be adjusted against the free reserves. Suppose if it is a purchase method, what we need to do is, this 20 will be adjusted against goodwill or capital reserve. If it is goodwill. Otherwise, capital reserve to stock account. Very simple. 2020. So elimination of unrealized profit. What is this elimination of unrealized profit? Before amalgamation, if transferee company sold goods to transferor company, now in the transferor company books, whatever the stock is there, which is purchased from the transferee company, whatever the stock remains unsold, in that stock, whatever the profit included, that profit we need to eliminate, because A and B, transferee becoming now one entity. So whatever the profit which is not yet realized, which is not relevant, we have to eliminate it. So therefore, at the time of incorporation, you incorporate with the cost which is there in the books of transfer. Later on, whatever the unrealized profit is there, you eliminate it. What is the entry? If it is amalgamation in the nature of pooling of interest method, general reserve or P&L to stock reserve or stock. If it is purchase method, goodwill or capital reserve to stock reserve or stock. So that's the difference, sir. Sir, we have one doubt, sir. Tell me. Sir, suppose at the time of incorporation itself, if you incorporate 120 minus 20 lakhs, because being a transferee company, we know we sold at 20% profit. So whatever the unsold stock is there, in that unsold stock at the time of incorporation itself, if you reduce the URP and taken over, then it will be debited in the books of transferee company at the time of incorporation 100. That means URP is already eliminated. Unrealized profit is already eliminated. No need to write a separate entry, because in the incorporation entry itself, if you eliminate URP and incorporate the balance, what happens is, if it is a purchase method, automatically goodwill or capital reserve is adjusted. If it is pooling of interest method, then free reserves and capital reserve is automatically adjusted. Therefore, no need to adjust again. If you observe carefully here, what we are adjusting in pooling of interest method, reserves and surplus. Here, goodwill or capital reserve. So at the time of incorporation itself, if you eliminate the unrealized profit and incorporated, sir, no need to write a separate entry. But the general practice is that at the time of incorporation, you incorporate the original value in the books of transfer company, and the balance next unrealized profit in that stock you eliminate separately. Hope you guys understood the concept of elimination of unrealized profit, because the goods I sold, that goods unsold with you. And one more point here, sir. Suppose, sir, we sold the stock 120. Out of this, 60 lakhs only unsold. That means remaining 60 lakhs already sold now. So profit realized. Don't bother about it. We are bothered about the only unsold stock unrealized profit. So in this 60 lakhs, whatever the profit is there, that is not at realized. That has to be eliminated now. So therefore, if you incorporate, in this case, 60 lakhs you will incorporate. In these 60 lakhs, how much unrealized profit is there? 10 lakhs will be there. 10 lakhs will be there, because for total 120, 20 lakhs profit. If it is half sold, 60, so only 10 lakhs unrealized profit is there. That has to be eliminated. Okay, very simple. That's it. Next, liquidation expenses concept, sir. Liquidation or realization expenses. Sir, in transfer company books, I explained. Similar to that in the transferee company also, 3 cases, same cases. First, liquidation expenses incurred by transferee company. Transferee company. Suppose I am A Limited, I have taken over B Limited. The liquidation expenses incurred A Limited itself. Now, what is the entry? If it is a pooling of interest method, sir, whatever the liquidation expenses I am spending, I will debit to general reserve or P&L. General reserve or P&L account debit to bank account. If it is purchase method, sir, I will adjust to goodwill or capital reserve account. Goodwill or capital reserve to bank. This is the first case. Second case, suppose the liquidation expenses are borne by transferor company or selling company. So when transfer company incurred, there is no entry in my books. No entry. And the last one, sir, last case, you know this case. Liquidation expenses incurred by transferor, later we are going to reimburse. See this. Liquidation expenses incurred by whom? Incurred by transferor or selling company, later on reimbursed by transferee. So therefore, you are writing entries in the books of transferee. Think from transferee point of view. When liquidation expenses are incurred by transferor, we know we have to reimburse it. We know we have to reimburse to the transferor company. So therefore, in our books, the transferor company account will be credited, because we need to pay the amount to him. Which account will be debited? If it is pooling of interest method, it will be general reserve or P&L account. If it is for purchase method, goodwill or capital reserve account will be debited. So in the third case, when the liquidation expenses incurred by transfer, later on it is going to be reimbursed by transferee company. When the liquidation expenses are incurred by transfer company, being a transferee company, in my books, I have to credit transfer company because I need to reimburse him. And which account will be debited? That depends upon the type of amalgamation method. If it is pooling of interest method, I will debit to goodwill, general reserve or P&L account. See this. General reserve or P&L, credit selling company. That means transfer company. If it is purchase method, goodwill or capital reserve to selling company. Okay. Sir, when you actually reimburse it, when you reimburse them, transfer company account will be debited. Transfer company discharge it. When you are paying amount to creditors, what is the entry will rate? Creditor to bank. Transfer company to bank. So that's it. Transfer company to bank. Selling company, also known as. Okay, so liquidation expenses, 3 cases. First, liquidation expenses incurred by transferee company himself. Pooling of interest method, general reserve or P&L account debited to bank account. If it is purchase method, sir, goodwill or capital reserve to bank account. Next, if liquidation expenses are borne by transferor, no entry in the books of transferee. Liquidation expenses borne by transferor, later reimbursed by transferee. When they incur, so what is the entry will rate? In pooling of interest method, general reserve or P&L account debit to transferor company, transferor, selling company. And in purchase method, sir, goodwill or capital reserve to transferor. Later on, when you reimburse, transfer company to bank in both the methods. And the last entry, sir, the incorporation of statutory reserves of transfer company. See, the question of incorporation of statutory reserves of transfer company will not arise in case of pooling of interest method, because in pooling of interest method, sir, at the time of incorporation we have incorporated all reserves of transfer company. See, in pooling of interest method we will maintain the identity of all reserves of the transfer company including statutory reserves, therefore no need to incorporate separately. The question of incorporation of statutory reserves of transfer company in the books of transferee company will arise only in the purchase method. Why? Because in purchase method, at the time of incorporation we have not incorporated any reserves of transfer company, but if there are any statutory reserves in the books of transfer company, they have to be maintained for certain balancing period. For example, in the transfer company, suppose B Limited is the transfer company. In this transfer company, sir, there is one reserve. Statutory reserve means the reserve which is required to be maintained as per the law. Suppose the statutory reserve is export profit reserve. Suppose they are maintaining 10 lakhs. This has to be maintained for 5 years. Already 3 years over. Remaining 2 years they need to maintain. Now amalgamation is happening. So the balance 2 years has to be maintained by whom? Transferee company. That's it. So this statutory reserve of transfer company, the balance period has to be maintained by transferee company. Even in income tax also, so many provisions are there. Whenever mergers, amalgamations happen, the reserves, the balance reserves has to be maintained by transferee company. The transfer company's obligations has to be carried on by transferee company. Like that, whenever amalgamation happen, sir, being a transferee company, if there are any statutory reserves in the transfer company, okay, those reserves I need to maintain in the amalgamation in the nature of purchase. Because in the merger, pooling of interest method, anyway, I will incorporate everything, including statutory reserves. But in purchase method, generally, I don't maintain the identity of reserves of transfer company. But if there are any statutory reserves, I need to maintain for the balance period. So tell me what entry you are going to pass. See, actually that reserve is not your reserve. So you have to write an entry without impacting your reserves. You have to incorporate the statutory reserves of transfer company. Generally, when you incorporate reserve, you will credit. Reserves will be created. Okay. So statutory reserves will be created and we will open an equivalent dummy reserve called amalgamation adjustment reserve. Equivalent adjustment reserve, that is this. Statutory reserve will credit, transfer company statutory reserve will credit, amalgamation adjustment reserve account will be debited. Sir, what is this amalgamation adjustment reserve? It is a dummy reserve. Dummy reserve we created. Why this dummy reserve is created? In order to nullify the effect of statutory reserves of transfer company. Sir, why we need to nullify the effect? Because this is not our reserve. We are maintaining only for the accounting purpose. For the law, we are maintaining this. Sir, how many years we will maintain balance? Once the maintenance is over, cancel it. Reverse the entry. Statutory reserves to amalgamation adjustment reserve. So the statutory reserves of transfer company now become our reserve. Statutory reserve will be created. Amalgamation adjustment reserve account will be debited. I have given us some notes also in my class here relating to this. If you see, amalgamation adjustment reserve to statutory reserve. Once the period is over, reverse. Why? See, what is this? This is a dummy reserve. A dummy reserve created to nullify the effect of statutory reserve incorporated from transfer company. Because this is not my reserve, transferee company reserve, but I have to maintain it as a legal obligation for the balance period, and which should not affect my reserves. So my goal is what? Incorporate, but my reserve should not be affected. How can I do that? With the help of a dummy reserve called amalgamation adjustment reserve. Basically, amalgamation adjustment reserve I'm debiting. That means it is showing a negative balance. Statutory reserves, credit balance. Both are adjusted and the effect is nil. That's it, sir. These are the entries to be passed in the books of transferee company. Now what we are going to do is we are going to see some questions relating to them. Now relating to accounting for amalgamation in the books of transferee company, we are going to cover few questions, sir. First, I am going to cover September 2024 examination question from amalgamation chapter. September 2024, they have asked a 14 marks question from amalgamation, testing mainly the accounting in the books of transferee company, sir, that too purchase method. So see the question. They have given balance sheets of two companies, sir, Well Limited, Nice Limited, as on 31st March 2024. Rupees is in thousands. Equity and liability, shareholders funds, non-current liabilities, current liabilities. Asset side, we have non-current assets, current assets. And also in the notes to accounts, if you look at the share capital, they have equity as well as preference share capital. Both the companies have equity as well as preference. In Nice Limited, 9% preference shares are there. In Well Limited, 10% preference shares are there, 100 rupees. In reserves and surplus, you see, Nice Limited is having a positive balance, Well Limited is having a negative balance. In long-term borrowings, Nice Limited 9% debentures of 100 each, Well Limited 10% debentures of 100 each, and then there is a loan from banks in both the companies. They have also given details of trade receivables and trade payables. So debtors, bills receivables in trade receivables, creditors, bills payable in trade payables. Okay, so these are the balance sheets of Nice and Well Limited as on 31st March 2024. Next, what happened? On 31st March 2024, Nice Limited absorbed the business of Well Limited on the following terms. The Nice Limited absorbed the business of Well Limited. That means Nice Limited has taken over the business of Well Limited. So Well Limited is transferring its business. So it is a transferor company, also known as selling company. Nice Limited is what? Transferee company, which is purchasing company, also known as purchasing company. Now, if you see the requirements of the question, sir, what they're asking is, pass the journal entries in the books of Nice Limited. Here, Nice Limited is which company, sir? Transferee company. So they're asking journal entries in the books of transferee company. Now, how accounting will be done in the books of transferee company? I told you the accounting will depend upon the type of amalgamation involved. If amalgamation is in the nature of merger, pooling of interest method. If amalgamation is in the nature of purchase method. So you need to identify what is the type of amalgamation involved here, because you want to do the accounting treatment in the books of transferee company. And also they are asking us to prepare the balance sheet after absorption. Okay. And one more important thing, whenever you are solving amalgamation question, is PC calculations, purchase consideration calculation. You know, whether you are doing amalgamation accounting in the books of transfer or transferee doesn't make any difference, sir. PC calculation is very, very important. And if you see the terms, sir, first point, third point, they are talking about the terms of payment to equity and preference shareholders. So that will be considered for calculation of PC. So first concentrate on the PC calculation. If you see the question, first point, they are talking about PC payable to the equity shareholders. How? For every 5 equity shares held by equity shareholders of Well Limited, they receive 3 equity shares of Nice Limited at a premium of 20 per share. Sir, for every 5 equity shares in Well Limited, they are going to get 3 equity shares in the transferee company Nice Limited. And that too, these shares are issued at a premium of 20 per share. That means we have not, here two things, sir. Are we taking the share capital, or are we discharging at a discount or premium, or we will take at normal amounts. After that, we are issuing shares at a discount or premium. Students have to carefully analyze here. Most of the students are confusing here. Here, see, for every 5 shares, we are going to give 3 shares. And for the amount, for example, I will tell you here. See here, in the Nice Limited, you see, total equity share capital is 12,500 in thousands divided by 100. So total 1,25,000 shares are there. 1,25,000. So if I calculate here, 1,25,000 shares in Well Limited, for every 5 they will get 3. So divided by 5 into 3. So that means 75,000 shares they will get. Each share they will get at 120 rupees. 100 plus premium of 20. 120. So you need to multiply with 120. So 75 into 120. That is 90 lakhs. If I write in thousands, it will be 9,000. So this is the PC payable to equity shareholders. Okay. Now coming to third point, sir, they're talking about preference shareholders. 10% preference shareholders of Well Limited are to be paid at a 10% discount. So look at this. That means the preference shareholders of Well Limited are paid at a 10% discount. What is the total preference share capital of Well Limited, sir? 1800. That means 18 lakhs. Correct? 18 lakhs. And this 18 lakhs, 1800 paid at 10% discount. That means 1620. That means 16 lakhs 20,000 is the PC payable to whom? Preference shareholders. That means here we take over at a discount. Now how this 16 lakh 20,000 is paid? By issue of 9% preference shares at par in Nice Limited. That means the shares are issued by the transferee company to the shareholders of transferor company at par only. In place of 10% preference shares, the transferee company is going to issue 9% preference shares. But takeover happened at discount. Here shares are not issued at a discount. Here takeover, for considering the amount of PC, discount will be given. After that, that amount will be discharged in the form of preference shares which are issued at par only. So therefore you have to interpret it carefully. So therefore I think we got total PC. So for if I calculate PC for equity shareholders, it is 9,000, 90 lakhs. In thousands, it is 9,000. For preference shareholders, 16 lakhs 20, 1620. So total it is 10 lakh 60, 10 lakh, 10,620 is the PC. That means 1 crore 6 lakhs 20,000, sir. In normal rupees, it will be 1 crore 6 lakhs 20,000. So if you see the PC calculation, see, work in the solution working out, PC consideration. So for preference shareholders, 16 lakh 20, equity shareholders 90, total 1 crore 6 lakhs 20,000. Absolutely correct? Yes. So PC, we have done it. Next. So once we know the PC, the next thing is, here they are asking us to pass the entries in the books of transferee company. This is transferee company. That too, what is the method we need to decide, whether it is amalgamation in the nature of purchase or merger, depending on that method. You see the questions here, one of the points is you have to search in the question those 5 conditions. The main condition is what? Whether assets and liabilities are taken over at book values or not. See this. Here, inventory of Well Limited is taken over at 10% more than the book value by Nice Limited. See this. So this is confirming that this is amalgamation in the nature of purchase. Why? Because to become a merger, all assets and liabilities must be transferred at their book values. But here inventory is taken 10% above the book value. Therefore, this is amalgamation in the nature of purchase. So type of amalgamation, purchase. Therefore, which method we need to follow? Purchase method. Purchase method we need to follow. And also, if you see this point, sir, yeah, the property, plant, equipment of Well Limited are revalued at 20% above their book value. Again, the property, plant and equipment is also taken over at 20% above the book value, which is also saying that, so inventory is taken over at agreed value, property, plant, equipment is taken over at agreed value, which confirms that this is amalgamation in the nature of purchase. So we need to follow purchase method. We need to follow purchase method. Okay. So we understood. We calculated PC. We identified the type of amalgamation. Now let us pass the entries. Of course, remaining points, when we're writing the entries, we will try to align with them. Okay. Now, how you are going to start? Tell me. Entries in the books of Nice Limited, transferee company. Which method? Purchase method. For your understanding. In exam, no need to write purchase method. Okay. Now, let us start writing the entries. Recollect the entries in the books of transferee company under purchase method. First 3 entries common now. First entry, purchase of business. So whenever you purchase the business, what is the entry? Business purchase account debtor to liquidator of Well Limited. So here business purchase account will be debited, liquidator of Well Limited will be created. What is the amount of PC? 10,620, 10,620. That is 1 crore 6 lakh 20,000. In normal rupees, in 1000 it is 10,620, 10,620. The most important entry is incorporation entry, which is where the most of the students are doing the mistake. Now think like this. See, whenever you are writing an incorporation entry under purchase method, I told you, you have to incorporate the assets which you have taken over from the transferor company at their agreed value. If agreed value is not their book value. Similarly, liabilities you have to incorporate. Reserves you should not incorporate because this is purchase method. So therefore, as a nice transferee company, Nice Limited, whatever the assets and liabilities I am taking from Well Limited, I have to incorporate. If there is an agreed value, otherwise book value. Now, in the balance sheet, check what are the assets and liabilities. So if you come to the asset side of the Well Limited, what are the assets they had? Property, plant, equipment is there. 16,380. Inventories 870. Trade receivables 1950. But breakup is available. Okay. So if I write the incorporation entry, PP account I will debit in my books. I am writing entries in the books of transferee company. Transferor company PP, now my PP. Next, inventory. I will take over inventory, right? So inventory account debit, I will. Amounts I will write, wait. Next, trade receivables. But trade receivables, they have given a breakup for this 1950 in Well Limited. See this, debtors 1800, Bills receivable 150. So you have to write separately. So debtors account debit, and also what is that, bills receivable account debit. I think these are the assets. Now out of these assets, sir, PP is taken over at agreed value, inventory is taken over at agreed value, but debtors book value, bills receivable also book value. So PP is taken over at 20% above the book value. That is what they have given in the question. So PP total balance how much? In 16,380. So 16,380 plus 20%. 16,380 plus 20%. 16,380 plus 20%. It will be 19,656. This value we need to incorporate because I am transferee company, sir. At what value I am taking, that is cost for me. So I will incorporate. Inventory 10% above the book value. So inventory 870, sir. So 870 plus 10%. 870 plus 10%, sir. It will be 957. Now coming to debtors. Trade receivables, we have debtors. So debtors 1800 and bills receivable 150. I think these are the assets, right? Any other asset available from Well Limited, sir? No. Cash and cash equivalents not there. That's it. Now coming to liabilities, sir. So all assets we have incorporated. Now coming to liabilities. Now what liabilities are there in Well Limited? Long-term borrowings is there, note number 3. Go to note number 3. See the long-term borrowings. 10% debentures are there. Loan from banks is there. Now 10% debentures. Important, sir. Carefully you see. Relating to debentures, transfer company liability I am taking over 10% debentures. Okay. Now at what value I am taking the debentures? This is important. See this. In the question they clearly mentioned, sir, the 10% debenture holders of Well Limited were to be allotted 9% debentures in Nice Limited, as would bring the same amount of interest. Same amount of interest. Sir, in place of 10% debentures, we are going to issue 9% debentures. So being a transferee company for your debenture holders, since we are taking over your company, 10% debenture holders are there in your company, we will give you 9% debentures in our company for you. But at same amount of interest you are going to get. So therefore, what are the 10% debentures, sir? 10% debentures is 900. That means 9 lakhs in normal rupees, 9 lakhs. So if I calculate here, 9 lakhs, 10% interest is 90,000. The same amount of interest they should get for 9% debentures also. So what will be the face value of the debentures we were going to issue? Simple, 90,000 divided by 9%. So you will get 10 lakhs. So 10 lakhs, 9% face value of debentures will be given. That means debentures are taken over at 10 lakhs. So debentures are taken over at 10 lakhs. So I am writing here 10 lakhs. So in 1000 it will be thousands. So you understand it? So agreed value debentures are taken over it. So because debentures we have taken over, after that these debentures are issued. In place of 9%, 10% debentures will be given, but they will maintain the same amount of interest. So by maintaining same amount of interest, how much worth of debentures we are going to issue? So that is what very important, sir. Sir, understand here, debentures are not issued at premium or debentures are not issued at discount. The takeover happened itself to maintain interest. Okay, the same amount of interest. Okay, next one more liability. Loan from banks 4525. So to loan from bank from transferor company Well Limited. I think the loan from bank is 4525, sir. 4525. Is there any adjustment for this 4525? I think so. They have one adjustment in the question. The banks agree to waive off the loan of 270,000 of Well Limited. So this 270 out of this was waived off. So balance liability we need to consider.
Sir, why the 270 was waived off? Actually, you see, if you observe the question carefully, that well limited is in losses. So maybe they are going for internal reconstruction also. So one of the creditor has given a waived off 270. Okay, nothing wrong. So total loan 270 was written off, remaining will be taken over. Okay. Next, any other liability? So debentures taken over. Loan from banks is over. Next, trade payables 4850. Trade payables. And relating to trade payables, there is a breakup available. Creditors 4400, bills payable 450. So we will write 2 creditors, 2 bills payable. Since there is a breakup available, we need to write separately. So 4400 and then 450. Okay, bills payable. Next, there are short-term borrowings. Short-term borrowings also taken over. Everything is taken over. Short-term borrowings 1975. 1975. So that's it, sir. So I think these are the assets and liabilities we have taken over. So property, plant, equipment to inventory is taken over at agreed value in assets. Liabilities, debentures is taken at agreed value, remaining all book value. Of course, loan from bank, there is a waived off. So after that, you consider. Now, this is amalgamation in the nature of purchase. I told you in amalgamation in the nature of purchase, we need to compare PC with what? Net assets. So what is the PC you are paying here? 10,620. What is the worth of net assets you are taking? So you calculate assets minus liabilities. See this. So what is the debit side total, sir? 19,656 plus 957 plus 1800 plus 150. So it will be 22,563. What is the worth of liabilities we are taking, sir? 1000 plus 4255 plus 4400 plus 450 plus 1975. So total it will be 12,080. 12,080. 22,563. So 10,483 is what, sir? Net assets we have taken. So see, PC is more than the net assets taken over. PC is more than net assets taken over. How much? So 137 we are paying excess. So this will be called as what? Goodwill. So this goodwill we will write on the debit side. So goodwill account debit 137. This is the balancing figure. Balancing figure, goodwill, sir. See the entry number 2, sir. See this. Entry number 2, they got goodwill 137. Very, very important. This is where the students are doing mistake. They are not able to incorporate the assets and liabilities properly. So when you are incorporating, always remember, when you are doing incorporation under purchase method, incorporate only those assets and liabilities taken over. Incorporate at agreed values if it is available. Okay. And you compare PC with net assets, that excess is goodwill or capital reserve. So everything done. Incorporation entry is the most important entry, and if you cross this, I don't think so. This problem will be difficult now. I think we got it. 10,620. This side, oh, I forgot to write assets minus liabilities. 2 business purchase. So what is the business purchase? 10,620, right? Okay, that's it. This is the entry. Business purchase first entry we have opened now, that we will cancel. So incorporation entry is also over. Next, discharge entry. We need to discharge the PC now. So when you discharge the PC, what is the entry? Liquidator of well limited account debit. So in the form of PC, you are giving what? Equity shares, preference shares. Now, if I write the entry for liquidator of well limited account debit to equity share capital to 9% preference share capital. Now important, sir. How many equity shares we are giving, sir? For every 5, 3, I think. Total 1,25,000. So 1,25,000 into 3 divided by 5, it will be 75,000 shares. 75,000 shares, each one given at, I think, 20%, 20 rupees premium. Equity shares are given at 20 premium. But when you write an entry, sir, being a issuing company, second.
Being a issuing company, you need to write at face value, and remaining will go to securities premium. So 75 into 100, 7,500 equity share capital will be created, because always face value, and in the form of preference share capital, how much we are giving? 1620, correct? And securities premium 75 into 20, so it will be 1500, right? So total it will be 1060. This is the entry for discharge. See this entry for discharge. So liquidator of well limited 1060, 2 equity share capital 750, preference share capital, securities. Here also students are doing mistakes, sir. When they are discharging the entry, they are forgetting that transferee company is the issuing company. When you issue shares at premium, sir, please transfer the amount to securities premium, the excess of face value. They are not transferring this directly. They are creating entire amount to share capital, which is wrong here. Basics. Equity share capital always created with face value. Remaining, I mean securities premium 20 rupees will be transferred to separate account. Okay. So this entry also done. So purchase entry, incorporation entry, discharge entry. These three entries common. Next, remaining entries I told you based on the information given. Like for example, intercompany owings. In this question, is there an intercompany owings are there? Yes. And here also we are also discharging the debenture holders, right? First we have taken over the debentures. Next discharge them. Debenture holders to 9% debentures. So in place of 10% debentures, these debentures we have taken over at these debentures we have taken over at 1000, right? Debentures. Discharge them with 9% debentures. So 10% debentures to 9% debentures. Instead of this, they have written here debenture holders account. Debenture holders to 9% debentures. Okay. So this entry. Next, intercompany owings are there. Liquidation expenses also there in the question. Intercompany owings in the question. See this. Debtors of Nice Limited include 215,000 receivable from Well Limited. See, in the books of transferee company, debtors 215, receivable from Well Limited. So in the books of transferee, trade receivables. In the books of transfer of Well Limited, trade payables. So first when we incorporate, we will incorporate trade payables, right? Later on the trade payables of Well Limited, trade receivables of this company, Nice Limited, will be cancelled. So if I cancel the entry, if I write the cancellation entry for intercompany owings, what is the entry I will write? Tell me. Trade payables of which company? Well Limited. From Well Limited, trade payables we already incorporated. And trade receivables of this company. Which company? Nice Limited. Both will be eliminated because now both are becoming single entity. How much amount, sir? Intercompany owings 215. So 215, 215. This is the entry. Elimination. See this. Sundry creditors of Well to sundry debtors of Nice Limited. Okay. Here they have given a breakup clearly, right? So in place of trade payables, please write creditors, because trade payables break up creditors and bills payable given. Here debtors you write, whatever. That's it. Now one more entry, sir. Liquidation expenses in the question. See this. Expenses of liquidation of Well Limited are to be reimbursed by Nice Limited 55,000. So here liquidation expenses of Well Limited are to be reimbursed by Nice Limited. That means first they will incur, later they are going to reimburse, right? So here, see this. What is the entry? Goodwill to bank. Being liquidation expenses reimbursed to Well Limited 55. Goodwill to bank. Here you can understand like this. I told you liquidation expenses. If it is case number 3, first when they incur, see I am transferring. Transferor company incurred, I know I have to reimburse them. So it is amalgamation in the nature of purchase. So when they incurred, I will write in my books goodwill or capital reserve. Goodwill came in this question. So goodwill account debit to, I need to reimburse to whom? Well Limited. So Well Limited account. And when I reimburse, Well Limited account debit to bank account, I will write 55. So ultimate entry is what, sir? Goodwill to bank. That is what they have written here. Understand? So this is the entry. So all the entries we have passed, sir. Now, once the entries you passed, later on balance sheet, sir. So balance sheet will be quite easy. First write down the format, and you know what items, what assets, what liabilities you have incorporated. They will be added with your assets, your liabilities, and whatever the shares you have given in the form of PC, add back to the share capital. So you will get the balance sheet, sir. You solve this question once. Entries are very, very important. Balance sheet is quite simple. Okay, you please try this question once. So this is one question which is covering the accounting treatment of transferee company. Okay, under purchase method, September 2024 examination question, which I explained in a very detailed manner. Okay. Hello, my dear students. Hope all of you are fine, doing great. The next chapter we are going to cover is internal reconstruction. See, from examination point of view, every attempter, they are asking one question from internal reconstruction chapter. This chapter is mainly entry based chapter. How to pass journal entries for different situations in the context of internal reconstruction. That is the main part of this chapter, sir. If you can able to manage that entries part, if you can able to learn that entries part, I think this chapter is done, sir. Okay. Now let us start discussing this chapter, sir. First, what is this internal reconstruction? See, when it comes to reconstruction, there are two types of reconstruction, sir. One is internal reconstruction, another one is external reconstruction. External reconstruction is covered in amalgamation. We have discussed amalgamation chapter. In that, amalgamation includes external reconstruction. Therefore, external reconstruction is covered in amalgamation, and accounting treatment will be done as per accounting standard 14. In external reconstruction, one existing company transformed itself into a new company, or a new company is formed to take over the business of existing company. So the existing company first liquidate by transferring its business to a new company. The new company, transferee company, for them AS 14 is applicable. So accordingly, accounting will be done. Transfer books, I told you, they need to close the books of accounts, irrespective of the type of amalgamation. So AS 14 is not applicable. Okay. The external reconstruction is not part of this chapter. Now, internal reconstruction, exclusively we are focusing on this chapter, sir. Sir, what is this internal reconstruction? See, suppose I have taken one company, A Limited. I have observed the financial statements of this company. Now, when I observed the financial statements of this company, I have found out some weaknesses, some shortcomings in the financial statements of A Limited. What are those, sir? First, I observed when it comes to assets, sir, the assets are overvalued. They are showing assets at overvalued amounts. Now, when it comes to liabilities, there is undervaluation, undervalued. They have showed the liabilities less than the actual value. And another problem I observed is overcapitalization, overcapitalization. And one more important problem I observed is accumulated losses. This company is suffering huge accumulation of losses. Okay. So these are some of the shortcomings in the financial statements of A Limited. Now A Limited doesn't want to liquidate. That means they are putting aside external reconstruction option. Because in external reconstruction, existing company has to liquidate by transferring its business to a new company, right? Here A Limited doesn't want to liquidate. They want to continue as a company. But all these problems they want to remove. Because when you have these weaknesses in your financial statements, it is very difficult to survive in the long run. These days, stakeholders scrutinizing everything in the company. When your company is not properly valuing your assets, not properly assessing your liabilities, the capital is overcapitalized, and there are huge accumulated losses. These are some of the burdens you have. Now, if you want to travel with these burdens, your company will not survive for a long period of time. So what to do? A Limited doesn't want to liquidate on one point, and they want to remove all these weaknesses. Now, how can you do that? So to do that, they resort to one process that is called internal reconstruction. So basically, what is internal reconstruction? Internal reconstruction or reconstruction is a process where company will try to reorganize or restructure its reorganize its financial structure without going for the option of dissolution. Okay, and in this process, what they're going to achieve, sir? They make sure that the assets and liabilities are properly valued. They make sure that the capital will be set right. They make sure that all these accumulated losses will be wiped out from the company's financial statements. So that I want to make these financial statements without error, without shortcomings, so that the financial statements look viable, stable, and it is good for the organization to continue in the long run. That's the basic idea of internal reconstruction. See, when you have a problem, if you take the outside help, external reconstruction, so that's why you liquidated and transferred your business to some other company. Now some other company takes over. Now when you have a problem, you call all your stakeholders and entered an agreement, a scheme with them, explain the situation to them, and entered an agreement with them and execute that agreement. The main object of this agreement is all these weaknesses in your financial statement has to be removed. Okay, this entire process is called internal reconstruction. So basically, what is internal reconstruction? Basically, it's a process, sir. It's a process. In this process, basically what they will do, they reorganize the financial structure without being dissolved. We don't want to dissolve, we want to continue. Okay, so we have unhealthy financial statements. And what are the, why you are saying they are unhealthy? Because we have accumulated losses, overcapitalized, overvaluation of assets, overvaluation of liabilities. Now I want to sort out all these problems by adopting to one scheme, that is internal reconstruction. So basically in internal reconstruction, what happens is we explain the situation to our stakeholders. Now every stakeholders, we ask for some favor. Like for example, we went to shareholders and we asked the shareholders, dear shareholders, we are doing subdivision, consolidation, reduction of share capital. Are you ready to sacrifice something? We ask the preference shareholders, reduce your dividend rate, or maybe you reduce the type of your shares, or maybe you ready to leave your preference dividend, like that. Creditors, we ask discount if we settle like that. Okay, so whatever the contributions made by the stakeholders of the company, that will be transferred to an account called capital reduction account. Now this balance in this capital reduction account, we will use to set off all these things. We will use to wipe out all these weaknesses we had: overcapitalized asset, overvalued assets, undervalued liabilities. All these things we will try to adjust, and after internal reconstruction, all these weaknesses will not appear in the financial statements, and financial statements look very stronger. Okay, so that's the idea of internal reconstruction. So we understood internal reconstruction. What is the objective? I told you. The difference between internal and external reconstruction also we have understood. But see, these are not relevant for examination point of view, because I told you in this chapter, first you have a basic idea. See, any chapter, how you are going to learn. First thing is that have some basic idea about the background, why this chapter came, what they're trying to discuss in this chapter. Without knowing that, don't directly jump into the questions. What most of the students are doing is they're jumping directly into the questions without knowing anything. So first try to understand what is internal reconstruction, what is the difference between internal and external. See, you may thought these are all theory which is not relevant. No. So they are very much relevant. Knowingly or unknowingly, they will help you to understand this chapter better. They help you to solve the problems better. Okay. Now next, methods of internal reconstruction. Methods of internal reconstruction. Sir, what is this methods of internal reconstruction? See, when a company is resort to internal reconstruction process, when the company want to execute a internal reconstruction process, sir, there are certain methods they have prescribed, but there are 5 methods. All these 5 methods predominantly focusing on share capital. Okay, because in internal reconstruction, reorganization of the share capital, reorganizing the financial structure. In the financial structure, share capital plays a very important role, right? So that's why they're predominantly focusing on this share capital. Now relating to this methods, there are 5 methods they have prescribed here. All these methods they have prescribed, they have taken from the provisions of the Companies Act. Like for example, in these methods, what you can say is alteration of share capital, variation of shareholders' rights, reduction of share capital, compromises and arrangements, share surrender. Like this, there are 5 topics are there. Alteration of share capital, variation of shareholders' rights, reduction of share capital, compromises and arrangements, share surrender. See, when a company going for internal reconstruction, in the internal reconstruction scheme, any one of these things may company wants to adopt. Either they want to adopt alteration of share capital or variation of shareholders' right or reduction of share capital or compromises and arrangements or share surrender. Any one of these things you will see in the questions, because company will resort to any one of these things as a part of internal reconstruction. But see, understand, as I told you, these methods primarily focusing on only share capital, but internal reconstruction is not just reorganization of share capital. It is relating to make sure that the assets are properly valued, liabilities are properly reassessed, accumulated losses will be wiped out, and also entering agreement with the creditors to settle, and creditors obviously will give you some discount. All these things are also there as a part of internal reconstruction, but the main focus is on share capital. That's why in the methods of internal reconstruction they are focusing on the share capital more. Okay, see this. First, alteration of share capital. See this. We have Companies Act, sir. In the Companies Act, we have different provisions. Those provisions only we have adopted, and we are saying they are methods of internal reconstruction. Nowhere in the Companies Act, these are the methods of internal reconstruction they have prescribed. These methods of internal reconstruction, the name we have given by adopting the provisions of the Companies Act. Okay. In the Companies Act, there is one section called Section 61, which talks about alteration of share capital. What is alteration of share capital? In the Act, they have prescribed 4 things, sir. One is increase of authorized capital. Second, subdivision and consolidation of shares. Third, conversion of shares into stock, vice versa. And fourth one is cancellation of unissued shares. These 4 are alteration of share capital. If any one of these things are happening in the internal reconstruction, so that is called one of the methods of internal reconstruction. That is called alteration of share capital. So increase in authorized capital, subdivision of shares, consolidation of shares, and conversion of shares into stock, cancellation of unissued shares. So out of these things, subdivision consolidation is important. Sir, what is this subdivision and consolidation? Subdivision means, sir, one share split into multiple shares of the lower value. I mean, suppose for example, we have in our company one share of rupees 100 each. Now we want to make this one share as 10 shares by splitting this 100 rupees into 10 rupees. So one share has become 10 shares of rupees 10 each. This is called subdivision. One share is divided into multiple shares. Sir, why they are doing this? Maybe to make this share more affordable to everybody, to increase the liquidity of the stock, to align with the market trends, whatever be the reason. So company as a part of internal reconstruction will do the subdivision. Here you need to understand, sir. Overall capital remains changed, sir, but the terms are changing now, sir. Suppose previously one share is 100 rupees. Now 10 shares has become 10. So the face value has become 10. Maybe now our share value is properly valued to align with the market trend. So it is not about total share capital, sir. It's also about the number of shares and the face value of the share. So as a part of internal reconstruction, we try to become better, right? So therefore, in that process, what we do is, if required, we do subdivision. One share we split into number of shares. And also reverse can also be done, consolidation. What is consolidation? Multiple shares are clubbed into one share. Like for example, 10 shares of 10 each. Our company had existing 10 shares of 10 each, 100. Now we made every 10 shares as one share, so that the face value has become 100. So this can also be possible, consolidation. So subdivision, consolidation, you will see in most of the problems of internal reconstruction, this is happening in the company, subdivision, consolidation. Okay, in subdivision consolidation, understand the total capital remains unchanged. Okay, the terms are changing, the number of shares and the face value. Next, conversion of shares into stock. Sometimes company may change its shares into stocks and reconvert the stock into shares. So that is also part of internal reconstruction. Suppose there is a company A Limited, it has 1 lakh equity shares of 10 is 10 lakhs. Now they convert this into equity stock of 10 lakhs. So equity share capital to equity stock. When they reverse it, equity stock to equity share capital. So therefore here in alteration of share capital, please remember subdivision and consolidation. This is one method of internal reconstruction. Second method is variation of shareholders' rights, section 48. In the Companies Act, section 48 talks about the different rights of the shareholders. Now, if company wants to vary the rights, variation of shareholders' rights, okay, they can. As a part of internal reconstruction, company what will do is company will change the rights of the shareholders. Best example could be when you take a preference shareholders, company suppose as a part of internal reconstruction, they may reduce the rate of dividend for them. And also suppose company may change one class of shares into another class of shares. That is also may happen as a part of internal reconstruction. That is called variation of shareholders right. This is also one of the method of internal reconstruction, like changing the dividend rate on preference shares, converting the cumulative preference shares to non-cumulative preference shares. These things are part of variation of shareholders right. Suppose when a company change the rate, dividend rate on preference shares, what happens are only rate will change, capital will be same. So therefore, when I write an entry, if I want to try to write an entry for this, what I will do, cumulative preference share capital to cumulative preference share capital. Old rate, suppose for example, the old rate is 10%, the new rate is 8%. So therefore, 10% cumulative preference share capital account will be debit, 8% cumulative preference share capital will be credit. That means the old one will be cancelled, new one will be created in the books, because share capital basically represents credit balance. Okay. Next, suppose for example a company converted the cumulative to non-cumulative, then sir, cumulative to non-cumulative, cumulative will be debited, non-cumulative will be credited. See this, cumulative preference share capital to non-cumulative preference share capital. So whatever the capital from now onwards will come into existence will be created, old capital with old future will be debited, kind of a cancellation. But amount wise there will not be any impact here also. So this is variation of shareholders rights. So as a part of internal reconstruction, company may resort to this also. Now out of all the methods, sir, the most important method is reduction of share capital. Listen to me carefully. Sir, what is this reduction of share capital? See, in the Companies Act, I think section 66 talks about reduction of capital, reduction of share capital. I have prepared some notes relating to this, sir. See this, reduction of share capital. In reduction of share capital, sir, we have 4 situations. If any one of these 4 situations are happening, then only we call it as reduction of share capital. This is one of the methods of internal reconstruction. So as a part of internal reconstruction, company may go for reduction of share capital. Sir, what is reduction of share capital? See here, in reduction of share capital, sir, first thing, A, liability of the shareholders is reduced. How? In respect of the unpaid shares, company says it will be cancelled. For example, you see here, suppose face value 10, sir, shareholders paid 7.5, company called 7.5, they paid 7.5 till now. Unpaid balance is what? 2.5, right? So these are which shares? Partly paid up shares. So in the books of the company, if you observe carefully, the share capital is credited at what value? 7.5, right? Because paid up value we will credit in our books. Paid up share capital 7.5 in our books. This is partly paid up, partly paid. Now company said remaining 2.5 you are not required to pay. We are making 7.5 fully paid up share. Previously it was 10 rupees face value, 7.5 paid up, so it is partly paid up shares. So in the books of the company, the share capital was created with 7.5. Now we are making the 2.5 rupees unpaid capital, you are not required to pay because we are cancelling it. We are making share as 7.5 rupees so that your share has become fully paid up. So what you are going to do here? So previously the share capital was created 7.5, partly paid up. Now that share capital 7.5, which is partly paid up, will be debit, kind of a cancellation. In that place, to share capital 7.5, you write it is now fully paid up. Sir, understand, amount wise there is no difference. Previously in our books 7.5 share capital is created, now also 7.5, but the thing is that the character was changed. Previously it was partly paid, now it is fully paid. So partly paid is cancelled, fully paid shares are now coming into the picture. So this is one type of one type of reduction of share capital. So liability of the shareholders will be cancelled in respect of the unpaid amount on shares. Unpaid amount on shares. That means we made partly paid up shares into fully paid up shares. Now here you need to understand, sir, the face value changed. The face value changed. Now, second situation I am doing, sir. Second situation. Sometimes what company will do is excess paid up share capital will be returned to the shareholders. How? By reducing the face value of the share. By reducing the face value as well as the paid up value of the share. Excess paid up share capital will be returned to the shareholders. Why excess paid up share capital will be returned, sir? Because company thought that they cannot effectively utilize the entire amount which they have taken from the shareholders. It is better to return them, right? So that is what. For example, you see here, there is a face value of 10 rupees, sir. Paid 10. That means it is fully paid. Now company decided that out of this 10, we make 8 fully paid only. You already paid 10. So we reducing this to 8. Face value also we are reducing 8. So still you are fully paid only. This 2 rupees we are going to return you. We are going to return you. So therefore understand, in the books of the company already share capital is created how much? 10 rupees, which is fully paid, right? Already credited 10 rupees fully paid. Now what they want to do is this they want to cancel. This they want to cancel. This share capital they want to cancel. 10. Okay. In place of that they want to bring 8. Okay. New share capital 8. Okay. What about remaining 2 rupees? They want to give it to the shareholders. 2 rupees. That's it. And when they pay the amount, this is the share capital shareholders to bank. 2. That's it. So therefore old one 10 was cancelled, new one 8 was created in the books. So this is fully paid, this is also fully paid. Okay, so this is second case. So second situation for reduction of share capital is excess paid up share capital. If the paid up share capital is returned to the shareholders. And the speciality of A and B is there is a change in face value. See this. There is a change in face value in both the cases. In the first case, the liability of the shareholders is cancelled or reduced in respect of the unpaid amount of shares. Here, we have reduced the face value of the share. Second situation, you see, here also face value has 10 has become 8. Okay. Now, situation number C. Reduction in paid up value only. Reduction in only paid up value. Suppose there is a company, sir, the face value 100. Paid up also 100. That means it is fully paid. Now, company asked the shareholder that dear shareholder, you already paid 100, but now we convert this to 10 only. Face value we are not changing. Face value 100. That means you have to pay 100. Already you paid 100, but as a part of internal reconstruction, you should sacrifice something. Okay, so you need to reduce your paid up value from 100 to 10. 100 to 10. That means how much sacrifice the shareholders? 90. That means, see here, face value remains unchanged, sir. Paid up value changed. That means in the books of the company, already share capital was created how much? 100. This is fully paid. Now the share capital 100 already created. They reduce this to 10. Sorry, they cancel this. In place of that, they want to reduce 90, right? See, shareholders contributed 100. We are reversing 90 because they agreed that they are going to sacrifice. Now, whatever the sacrifice they have done, sir, it will be transferred to capital reduction account. Important, sir. Sir, in the first two situations, capital reduction will not arise. You observe this. Capital reduction does not arise in these two cases, because in these two cases what happens is partly has become fully paid and fully paid amount again fully paid. But here you observe without changing the face value, we just reduce the paid up value. That means shareholders sacrificed 90 rupees for the company. In future when the company calls, they will pay. They already paid 100. Now company reduced it to 10. So whatever the capital they sacrificed, that will go to capital reduction account. Now this capital reduction account again they will use to wipe out the shortcomings of our financial statements, right? This is the important situation here. Face value does not change. And the last one, there is a change in face value as well as paid up value. Suppose for example, same example, 100 rupees face value, paid up value 100, fully paid. Now company has converted this to, say this, face value 10, paid up value 10, fully paid up. Now in this situation, you see in our books, already share capital is created how much? 100, right? Now they want to cancel this 100. They want to brought new share capital to 10. Remaining 90 rupees capital reduction account will be transferred, correct? See, this is old capital already created in the books, which will be cancelled. This is the new capital they want to bring. New capital means capital in 10 rupees, new face value capital. And this capital reduction account is what sacrifice done by the shareholders. Okay. So this is situation number 4, sir. See this. Share capital old, share capital new, capital reduction account. This is situation 4. So can you sum it for me? When capital reduction will come? Capital reduction will come when the paid up value of the shareholders is reduced. When paid up share capital is reduced, then obviously the capital reduction will come. See, in the first case, you see paid up value 7.5, 7.5. In the second case, paid up value 10, they reduced to 8, but this 2 rupees we are not keeping, we are returning it. That's why capital reduction does not arises. But in third case, you see paid up value 100 has become 10, 90 rupees they have sacrificed. So that will be transferred to capital reduction account. In the fourth case, you see paid up value 100 has become 10. So that means 90 rupees will be transferred to capital reduction account. So what is the sacrifice done by the shareholders? Sometimes they will change only the term. Sometimes actually the paid up value has been reduced. That means even though they paid, so they're ready to reduce that paid up share capital. So to what extent they have sacrificed, that will be transferred to capital reduction account. So in problems, you are going to see any one of these situations. So carefully observe. So if you ask me, the C case is very, very important. So most of the cases, this will only come C case. Okay. So we have discussed reduction of capital also. Next method for internal reconstruction is compromises and arrangements. Sir, as a part of internal reconstruction, company will enter agreement with its members, shareholders as well as creditors, sir. Because company is facing some financial issues, company is having some shortcomings. So as a part of internal reconstruction scheme, they entered some arrangements, some agreements, compromises and arrangements with the shareholders and also with the members. Okay, this is called compromises and arrangements. So a scheme of compromise and arrangement is an agreement between the company and its members and outside liabilities when the company faces financial problems. Such an arrangement therefore also involves sacrifice by the shareholders, creditors and debenture holders or by all. So our creditors, maybe creditors for goods, so creditors for suppliers, so debenture holders, so bankers, so those who have given loans for us, shareholders, they may sacrifice something. So when they sacrifice something, transfer it to capital reduction account. For example, when equity shareholders give up their claim on reserves and surplus. In the company, we have reserves and surplus. But frankly speaking, sir, if a company is going through internal reconstruction, there won't be any positive reserves and surplus. If at all there are any reserves and surplus in the company which is going for internal reconstruction, given up by the shareholders. They said to the company that, okay, the reserves and surplus in the company actually belongs to us. We are giving up. Now, in that case, what you do? The amount of reserves and surplus will be transferred to capital reduction account or reconstruction account. Capital reduction account will transfer. Similarly, for example, when you are settling the liabilities at a lesser amount, discount. So the discount amount will be transferred to capital reduction account. For example, I will tell you. Suppose there are creditors, sir. In our books, in the company books, creditors having a credit balance of 10 lakhs. Now, as a part of internal reconstruction, we approached the creditors and said that, dear creditors, once and for all, we are going to pay you 50%, that is 5 lakhs. Remaining 5 lakhs, please give us discount. This is the problem. Creditor said, okay. Then whatever the creditors discount given, transfer this to capital reduction account. So these are all the positive, accumulations from different sacrifices, which will be transferred to capital reduction account. Finally, this capital reduction account balance we will use to sort out the problems like accumulated losses, overvalued assets, undervalued liabilities, any reconstruction expenses, all these things, any fictitious assets in the company, all the weaknesses in the balance sheets we will try to remove with the help of this capital reduction account. Okay, so this is also one of the methods, sir. And the most important method is surrender of shares. Sir, out of all the 5 methods, sir, reduction of capital, surrender of shares. In alteration of share capital, subdivision, consolidation. So these are the most important things as a part of internal reconstruction. Now try to understand the surrender of shares concept, sir. I think most of the students are confused in surrender of shares. I'm going to give you absolute clarity here. Listen to me. First of all, what is this surrender of shares? See, if the shareholders at the time of internal reconstruction, if they voluntarily surrender some shares to the company in order to contribute something for the company, now if they voluntarily return back the shares to the company, that process is called surrender of shares. Once the shares are surrendered by the existing shareholders to the company, what company will do? Company will use these surrendered shares to settle the liabilities. One thing. Or if they are not utilizing for settling the liability, just these surrendered shares will be cancelled. Okay. So three things will happen here. First, existing shareholders will surrender the shares. Second thing, these surrendered shares may be utilized to settle the liabilities. Maybe they will be cancelled. Okay. See, when suppose existing shareholders surrendered the shares, what is the entry we will write is, when shares are surrendered, to that extent the share capital will be reduced. So share capital account will be debited. And we will credit share surrender account. Share surrender account will be credited. Share surrender account will be credited. And this share surrender account, suppose if it is utilized to set the liabilities, to pay the liabilities, suppose whatever the shares came as a part of share surrender, we given to the liability holders. So when you use the surrendered shares to settle a liability, the entry is whatever the liability you have cancelled or settled by using the surrendered shares, that liability will be debited, because the liability usually credit balance. So when you settle, debit. To liability to whatever the liability you have settled with the surrendered shares, the entire amount will be transferred to capital reduction account. The entire amount will be transferred to capital reduction account. Why? Because here the liability of the company is discharged without flowing any 1 rupee from the company side. They have settled this liability entirely from the surrendered shares. So whatever the liability settled with the surrendered shares, entirely it will go to capital reduction account, a kind of a contribution to the capital reduction account for the purpose of internal reconstruction. Okay. Next, sir, you have issued surrendered shares to the liability holders, right? So when you issue shares, what happens? Share capital will be created in the books again, and share surrender account will be debited. So share surrender account debit to share capital account. These are two entries are very, very important. When the surrendered shares are issued, so to settle a liability to capital reduction account, share surrender to share capital account. Sir, whatever the surrendered shares not utilized to settle a liability, just to cancel them. That means the share surrender account debit to capital reduction account. That's it. Okay. So these three things will come in surrendered shares. The share surrender concept. So relating to surrender of shares, see this. Share surrender concept. When surrendered by the shareholder, share capital to share surrender. Suppose if the surrendered shares are utilized to reduce the liability, settle the liability, liabilities to capital reduction account, share surrender to share capital account. And if surrendered shares are not utilized, just cancel them, share surrender to capital reduction account. Okay. Now I have taken one example here, and one more important point I would like to bring here is, whenever a company is going for surrender of shares, sir, first subdivision will happen, because in subdivision number of shares will increase, right? We have discussed dividing the one share into multiple shares. So first subdivision will be done. After that, surrender will happen. This example is the best example. I have taken this example. See this. There is a company. It is having an equity share capital of 10,000 shares of 100 each. Subdivide the shares into shares of 10 each. Okay. 100 rupees share has divided into 10 rupees share. That means each share is divided into 10 shares. So 10,000 shares into 10, 1 lakh shares. Ask their shareholders to surrender 50% of the shares. Once the subdivision happened, we asked the shareholders to surrender 50% of the shares. That means 50,000 shares. And to issue 60% of the surrendered shares to 15% debenture holders of 4 lakhs. Out of the surrendered shares, 60% of the surrendered shares is utilized to set off the liabilities, debenture holders of 4 lakhs in full settlement of their claims, and cancel the unissued shares to shareholders. Now here, see this. First, tell me how many shares were surrendered, sir? First of all, in the company, we have 10,000 shares of rupees 100 each, right? Now they make each share 10. That means the number of shares will be 1 lakh. Out of this 1 lakh shares, surrendered will be 50% of 10 rupees each. So 50,000 into 10, 5 lakhs will be what? Share surrender account. So share capital to share surrender, 5 lakhs, 5 lakhs. Okay. Now out of this, how much amount, how much? 60% of the 5 lakhs. 3 lakhs. We used to settle the liability of debenture holders. So therefore this liability we settled, sir. What is this liability? Debentures. Debentures account debit to capital reduction account. How much? 4 lakhs we have settled. 4 lakhs liability. Sir, understand, sir. 60% of surrendered shares is 3 lakhs. But this 3 lakhs worth of shares we used to settle a liability of 4 lakhs. So through the extent of the liability we settled by surrendered shares, transfer it to capital reduction account. And share surrendered to share capital, 3 lakhs, 3 lakhs. Because we have issued to the debenture holders 60% of the surrendered shares. That is 5 lakhs into 60%. 3 lakhs, 3 lakhs. What about the remaining, sir? Remaining 40%, I think 2 lakhs will be transferred to capital reduction account because they remains unused. So the only point student has to concentrate is when shares are surrendered, these surrendered shares are utilized to settle liability. Understand? See the liability settlement separately. Whatever the liability we are settling, that will be transferred to capital reduction account, and share surrendered will become share capital. Okay. What most of the students are doing is this share surrender liability, they want to write both of them in a single entry. Don't write that. Liability to capital reduction, share surrender to share capital. Okay. So I think we have done share surrender concept also. So all the 5 methods we have discussed it, sir. And finally, come to the entries part in the internal reconstruction. Of course, when you are solving the questions, you will understand these entries better. But anyways, I have given in the material. First, reduction of share capital happened in the company. So whenever reduction of share capital happened, old equity share capital will be debited, new share capital will be credited, the difference will be transferred to capital reduction account. Similarly, reduction in preference share capital, simple. Old preference share capital will be debited, new preference share capital will be credited, the difference will be capital reduction account. Suppose reduction of amount due to debenture holders. Suppose you settle debenture holders with discount. So whatever the amount you settled with the discount, that amount, debenture holders to capital reduction account. Reduction of amount due to creditors. Suppose you paid the creditors discount. So whatever the discount you given, creditors to capital reduction. Suppose appreciation in asset value. Suppose asset value increased. Asset to capital reduction. Whatever the value the asset increased, that will be transferred to capital reduction account. Reconstruction expenses. Like in amalgamation, we have amalgamation expenses. In internal reconstruction, we have some expenses. These reconstruction expenses to bank. Later on, these reconstruction expenses will be adjusted with capital reduction account. Okay. Or else directly you can write, reconstruction expenses directly will be transferred to capital reduction account also. That is also correct. Okay. Next, finally, whatever the balance is there in the capital reduction account, what we are going to do is, we need to write off the losses, we need to write off the fictitious assets, we need to make sure that the assets are properly valued, liabilities will be properly reassessed. So see this, capital reduction account debit to any accumulated losses we will adjust, any preliminary expenses like fictitious assets, discount on issue of shares, debentures, underwriting commission, advertising suspense, these are all fictitious assets which is appearing in the balance sheet, just adjust. I told you reconstruction expenses you adjust, goodwill, fictitious asset if it is there, adjust paid patents or trademarks, so fixed assets, suppose if they are overvalued, reduce by using this capital reduction account. Any other assets if you want to adjust, and whatever the balance remains still in the capital reduction account, that will be transferred to capital reduction account. So these are the different entries we are going to pass. So see, internal reconstruction theory wise you just learn this. So we have taken 30 minutes approximately, we have completed the entire theory. Now I am going to solve some important questions from internal reconstruction so that you will understand this concept better. In internal reconstruction, let us solve some important questions. First, I am going to cover January 2025 examination question. Why I selected this question? Because this question has so many adjustments, so many points. So my intention is to cover as many adjustments as possible. With that intention, I have selected this question. Very good question actually. Examination question, they asked it for 14 marks in January 2025 attempt. See, in internal reconstruction, sir, reading the question is very, very important, sir. Because for each adjustment, each situation, you need to pass an entry, right? You have to be very careful.
So there is a company, Sustain Limited, sir. They are incurring losses due to adverse market conditions. So it has decided to reorganize its capital structure. That means they want to go for internal reconstruction. Their balance sheet given, sir. So if you observe the balance sheet, we have equity and liability, shareholders funds, share capital, reserves and surplus. Reserves and surplus, we have a negative balance, sir. Coming to non-current liabilities, we have long-term borrowings. Current liabilities, we have trade payables, short-term borrowings, bank overdraft, other current liabilities, interest on debentures, short-term provisions, we have provision for income tax total. On the asset side, if you see non-current assets, property, plant, equipment, intangible assets, non-current investments. In current assets, we have inventories and trade receivables. Okay. Now, if you observe the notes to accounts, in share capital, this company got equity share capital, 50,000 equity shares of 10 each fully paid up, 5 lakhs, 25,000 equity shares of 10 each, 8 paid up, partly paid up, 2 lakhs. And they have preference share capital also, sir, 30,000, 8% cumulative preference shares of 10 each, 3 lakhs. And in the question clearly mentioned, preference dividend has been arrears for 3 years. Reserves and surplus, P&L account, debit balance is there. Long-term borrowings, they have debentures. Property, plant, equipment, freehold property, plant and machinery. Intangible assets, they have goodwill. Non-current investments, they have 2,80,000 at cost. Subsequent to approval by court, all interested parties, the following scheme of reconstruction was agreed. See this, the following scheme of reconstruction was agreed. So as a part of internal reconstruction, they have agreed for 12 points. Okay. Now what they're asking, show the journal entries necessary to record the above transactions in the company books. This is the main thing. Once you, write the journal entries, they are asking us to prepare revised capital structure, share capital note we need to write after completion of internal reconstruction scheme. Okay. Let us see one by one and try to pass the entries. Okay. First one, you see, uncalled capital is to be called up in full and such shares and other fully paid up equity shares to be reduced to 5 per share. So first balance uncalled capital we need to call, sir. You know, in the question we have 50,000 equity shares of 10 each fully paid, 25,000 equity shares of 8 paid up. So 2 rupees we will call it. And 50,000 shares has become fully paid, 25,000 shares will also become fully paid. After they become fully paid up, each share is reduced to 5 rupees per share. So this is what we need to do. So therefore, what is the entry we are going to write here in this case? Can you tell me? First, if you call the amount bank account debit to equity share capital account, call the remaining amount 25,000 shares, and each share, I think the pending amount is how much? 2 rupees. Correct? 2 rupees. 8 already paid up. We need to call the 2 rupees. So 50k. So first entry, call entry. Now shares has become fully paid. Already 50,000 shares fully paid up. Now 25,000. Total 75. What they have done is they have reduced it to 5 per share. So old equity share capital, right? 75,000 shares of rupees 10 each, 7,50,000. Now reduce it to 75,000 shares into 5 rupees. So it will be 3,75,000. So remaining 3,75,000 will go to capital reduction account. 3,75,000. This is reduction of share capital. You remember, company decided to reduce the face value as well as paid up value, right? Shares are already fully paid. Each share 10 rupees, 10 rupees, 10 rupees fully paid because we made the call first. After that, they reduced the share from 10 to 5. That means 50% of the share capital sacrificed by the equity shareholders, which will go to capital reduction account. Okay. So you look at the first two entries. See this. Bank to equity share capital 50-50 call amount, and then equity share capital
to equity share capital. Old capital cancelled, new capital created, balance transferred to capital reduction account. Okay, done. So for first situation, entry passed. So this one is done, sir. Now come to second one. Second decision. The preference shareholders will accept a reduction of 2.5 per share. Reduction of 2.5 per share. In exchange, the rate of dividend is to be increased to 9%. Sir, actually in the question, 8% cumulative preference shares are there. Okay. Now, as a part of internal reconstruction, they want 9% preference share capital, but they're ready to accept a reduction of 2.5 per share. So therefore 30,000, 8% cumulative preference shares of 10 each, 3 lakhs. So what is the entry we will write here? Very simple. 8% cumulative preference share capital already there in the books, right? 30,000 of rupees 10 each. 3 lakhs. Now they want in place of 8% cumulative preference share capital, 9% cumulative preference share capital. And they accept that they will reduce each share 2.5. That means the new share capital is how much, sir? 30,000 into 7.5. Revised capital. 30,000 into 7.5. 2,25,000. That means how much they sacrificed, sir? That will be capital reduction account will be created, 75,000. So preference shareholders in place of 8%, they ready to accept 9%. And they for 10 rupees fully paid up, they can accept 7.5 fully paid up. So 2.5 rupees they are sacrificing to the company. So that is transferred to capital reduction account, right? So this is the second, this one. So if you see the entry for this, see this 8% cumulative preference share capital. In place of that, 9% cumulative preference share capital will come. Amount is reduced from 10 to 7.5. 2.5 will be transferred to capital reduction account. Okay. So second is also done. So in first two cases, if you observe carefully, reduction of capital happened. Face value 10 has become, in the first case it is 5. Second case, face value 10 has become 7.5. First case, paid up value 10 has become 5. Second case, paid up value 10 has become 7.5. Okay. So in both the cases, what happened in reduction of share capital, one situation I told you, both face value, paid up value, both are reduced. And when paid up value reduced, obviously the amount will be transferred to capital reduction account. Next, point number 3, sir. Preference shareholders will forego their claim of dividend for 1 year, and 1 equity share of 5 rupees each is to be issued for the remaining arrears of dividend. Because each equity share capital is reduced to 5 per share. That's why now for the preference shareholders, they are giving equity shares of rupees 5 each. Okay. Actually, if you look at the question, preference dividend is in arrears for 3 years. So if you calculate preference dividend, how much amount will come? Tell me. Total preference share capital 8%. 8% is the rate of dividend for 3 years. So it will be how much? 3 lakhs into 8% for 3 years. It will be 72,000 for 3 years, sir. That means out of this 72, sir, 1 year dividend they will forgo. 1 year dividend is how much, sir? 72 divided by 3. 24,000 they are ready to forgive, sacrifice. Remaining 2 years, sir, second and third year dividend, 2 years dividend, 2 years dividend, 48,000. For this 48,000, they're ready to accept equity shares. That is what given in the question. See this. Preference shareholders will forgo their claim of dividend for 1 year, and 1 equity share of 5 each is to be issued for the remaining arrears of dividend. Can you tell me here what entry you will write?
For the dividend, 1 year dividend, they forgo. What is the entry we will write? No entry, because preference dividend was not recorded in the books. Therefore, when it is not recorded in the books, the question of cancellation of preference dividend, which is foregone, which is foregone by the preference shareholders, will not arise. So therefore, for this, no entry. What about this 48,000? This 48,000 we will write an entry, because for this 48,000 they are ready to accept what? They are ready to accept equity share capital. So first of all, this 2 years dividend I need to brought it in the books. So capital reduction account will be debited, and preference dividend payable account. Preference dividend payable account. I will create a liability, preference dividend payable account, 48,000. So important, sir. I am creating a liability for the preference dividend because I need to give equity shares for this 48,000. So that's why preference dividend payable liability will be created. Capital reduction account will be debited. Now for this, we need to give what? Equity shares. So preference dividend payable account debit to equity share capital. How much? 48. Actually, how many shares you will give, sir? Simple, sir. 48,000, each share 5 rupees, sir. So 48 divided by 5. It will be 9,600 equity shares of rupees 10 each. 5 each. The new share capital. That's it. So this is very, very important, sir. So for 1 year dividend is foregone, sir. For that, no entry. For this 2 years, they're ready to accept equity shares. For that, we need to write an entry. So if you look at the answer, see this. Capital reduction to preference dividend payable. Actually, this is 2 years dividend, 48. And then for this 48,000, what they have given? Preference dividend payable to equity share capital, 48. Okay. Got it. So this one is also done, sir. So first 3 points over. Fourth point. Mr. X holds 10% debentures for 2,50,000. He is also creditor for 50,000. He agreed to cancel 50% of his debt, including interest on debentures, pay 20,000 to the company, and receive new 12% debentures for the balance amount. Very careful. Sir, Mr. X, he is also having debentures, sir. First, write the due entry, sir. So, 10% debentures belongs to Mr. X. So, Mr. X account I will credit because I need to discharge him. His share in debentures is how much, sir? Debentures 2,50,000, sir. Okay. And he is also one of the trade creditors, sir. Creditor. So, trade payables 50,000, including interest on debentures, they are saying, sir. Including interest on debentures. So, his debentures are 2,50,000. So, interest on debentures in the balance sheet, they have separately recognized it, sir, 45,000. So, on this 2,50,000, 10% interest per annum, if I apply, it will be 25,000. So, therefore, total amount due to Mr. X is 3,25,000. Correct? 3,25,000. First, I have written the due entry. Next, what happened? Pay 20% to the company. See, Mr. X has to pay 20,000 to the company. So, if company receives the 20,000 amount from him, what is the entry in the books of company? Bank to Mr. X. Bank to Mr. X 20,000. So, now Mr. X already credited with 3,25,000. Now, he has paid 20. Total 3,45,000 is credit balance. Now, what happened, you see? And to receive new 12% debentures for the balance amount, he will receive balance amount. 50% of his debt will be first cancelled. So his total debt is 3,25,000, right? Out of this 3,25,000, 50%. That means Mr. X account will be debit 3,25,000, 50% of 3,25,000. Or else you can write directly like this. See, Mr. X account 3,25,000 plus 20. Total 3,45,000 will be debited. 50% of his debt was cancelled, sir. So capital reduction to the extent of the liability cancelled. 3,25,000 into 50% will go to capital reduction account. So 325 into 50%, it will be 162,500. And for balance amount, he will accept what?
12% debentures. See this. 12% new debentures. So 12% debentures. Balance amount how much? So it will be 180 to 500. Super. Okay. So see this. So first X hold 2,50,000 debentures. Trade payables 50, interest 25, total 3,25,000. 3,25,000 into 50%. That is 160 to 500 will be cancelled. That will be go to capital reduction account. And he paid 20,000 to the company. So balance amount he will accept debentures. So Mr. X account created with 3,45,000. In that 50% of 3,45,000, not correct. 50% of his debt 3,25,000 will go to capital reduction account because he only 50% of his debt will be cancelled. Here most of the students what they are doing, 3,45,000 into 50%, wrong. 3,25,000 into 50% and balance they will accept debentures. See this, actually solution I will show you. Yeah. First what they have done here, debentures 2,50,000, interest 25, trade payables 40, total amount 3,25,000. Actually here some zigzag happened, sir. So 2,50,000, 3,25,000. He paid 20,000. So bank to Mr. X 2020. And now look at his settlement. Mr. X 3,45,000, debentures 180 to 500, capital reduction 160 to 500. 50% of his debt 3,25,000 will be reduced. Balance amount will be adjusted by, settled by debentures. Okay, done. This is also done, sir. Fourth point. Coming to fifth point. The remaining claim of debenture holders, including outstanding interest, reduced to 60%. In consideration of the reduction, the debenture holders are to receive 9% preference shares at a new face value. What is the new face value of preference shares, sir? 7.5. Each share of 10 reduced to 7.5, now, sir. Okay. Now see, remaining debenture holders. Actually, our total debentures is how much? 4,50,000. In this 4,50,000, how much is belongs to Mr. X? 2,50,000. So 4,50,000 minus 2,50,000, 2 lakhs for the remaining debentures. So see this. So what are the debentures remaining? 10% debentures out of 4,50,000 debentures. 4,50,000 debentures. 2,50,000 debentures belongs to Mr. X, already settled. That means 2 lakhs will be the 10% debentures, right? And what is the interest, remaining interest? On 2 lakhs, if I apply 10%, it will be 20,000. So 10% debentures interest on debentures. Okay, 2,20,000. Now for this, what they are accepting? First they reduce it to 60%. Reduce it to 60%. So therefore, how much reduction is done, sir? 40%. 2,20,000 into 40% if I apply, it will be 88,000, which will go to capital reduction account because the liability was reduced. So 2,20,000 into 40%. So for once it is reduced to 60%, for this 60% they accept what? Preference share capital. 9% preference share capital for the balance amount. So 2,20,000 minus 88,000. So it will be 1,32,000. So 1,32,000 is the preference shares to be issued. See this. Actually, if you want, I will show you. Okay. So see this. 10% debentures balance 2 lakh. Interest on debentures outstanding 20. For this, how much reduced? 40% reduced. 2,20,000 into 40% will go to capital reduction account. For the balance, they accepted preference shares, new preference shares of 7.5, which 1,32,000. So that means this also we have done. Fifth point. Come to sixth. The taxation liability is to be settled at 1.2 lakhs. Settled at 1.2 lakhs. Actually, if you look at the question, sir, our provision for tax is how much? Our provision for tax 1 lakh, but we need to settle at 1.2. So therefore, what is the entry, sir? Income provision for income tax liability 1 lakh to bank 1,20,000. The difference will go to capital reduction account. Correct? The difference will go to capital reduction account. See this. So provision for tax will be 1 lakh. Capital reduction account debit 20,000 to bank account 1,20,000. Actually, we need to settle this 1,20,000. Provision already created 1 lakh. So balance will be transferred to capital reduction account. Okay. So this balance, this are also done. Next, market value of non-current investments of 2,50,000. Investments to be brought their market value. So actually our non-current investments 2,80,000 is there, but market value 2,50,000. So we need to reduce the investments value by 30,000. That means overvaluation of assets has to be adjusted to capital reduction account. Okay, we will do that. And also you see inventory equal to 1 lakh at book value will be taken over by the remaining creditors in full settlement of their claim. Actually creditors, if you see carefully sir, what is the total creditors of the company? The total trade payables 1,30,000. In that how much belongs to Mr. X? 50k. So therefore what is the balance? 1,50,000 minus 1,30,000 minus 50. So it will be 80,000. Now this 80,000 trade payables we need to settle. How? They have taken inventory. So inventory will be credited, trade payables account will be debited because we are settling it. So how much? Trade payables 80,000 balance. Inventory they have taken over, and what is the value of inventory they have taken over? I think 1 lakh, right? 1 lakh worth of inventory they have taken over. 1 lakh. So therefore, see the differences will go to capital reduction account. 20,000. Because the liability was settled 80 with an inventory of 1 lakh. So therefore loss which will be transferred to capital reduction account 20k. So see this, if you want I will show you the entry also. This entry, trade payables 80, capital reduction 20, inventory 1 lakh. Done. And finally, so this is also done sir. Now if you see the final adjustment entry, see most of the students are confused in the final entry. Simple sir. Once you pass the normal entries, finally whatever the balance in the capital reduction account, whenever you see any asset value is to be adjusted. Okay, like for example, see this investment, reduce it to its market value 2,80,000 to 2,50,000, 30,000, that will be adjusted. And also a provision of 2% is to be created on trade receivables. This one, plant and machinery is to be write down by 20%. So generally these things we will do, we will adjust to capital reduction account. If you want to do individually also it is correct, but writing a combined entry is important. I mean will be preferable sir. Capital reduction account debit 2. So what are all things we adjusted? Investments and provision for doubtful debts, one thing we adjusted, and also we adjusted plant and machinery. See this, in investments we reduced 30,000, and provision for doubtful debts we need to create sir. How much provision? 2% is to be created on trade receivables. How much is the trade receivables given in the question? The trade receivables 2,30,000, on that 2%. So trade receivables, on the trade receivables if I created 2% provision it will be 4,600. And also inventory, property plant equipment 7,50,000 is there. What they have done, property plant equipment is written down by 20%. 7,50,000 into 20%. So it will be 1,50,000 reduced. See this, investments, provision for doubtful debts, plant and machinery, everything is adjusted. Okay, 1,50,000 adjusted here. So 1,50,000 plus 4,600 plus 30, total it will be 184,600. Capital reduction account is debited. Okay, so this is also done. Next is here, the company will further issue 12% debentures for such amount which is sufficient to pay off the bank overdraft, other outstanding liabilities, and maintain a cash balance of 85,000. Now this is important sir. See, actually this company going to issue debentures sir. How much worth of debentures they are going to issue? Which is sufficient to pay the bank OD, other outstanding liabilities, and maintain its cash balance at 85. So in this case, suppose if I prepare cash or bank account, if I prepare sir, my closing balance will be how much sir? 85,000 I need to maintain, right? 85,000. And what is the balance they have given in respect of the cash in the question sir? Nothing, no cash balance given, but in the entries if you see, first we have issued, we have called the remaining amount, we got 50k. So 50k we got it, and also from debenture holders we received 20, 50, 20, So 50,000, 20,000, okay, 50, 20. And also, we need to settle the liabilities, bank overdraft. What will be the bank OD given in the question, sir? Bank OD they have given in the question is 65. So 65. And also income tax liability 1,20,000. So if you see the credit side, 65 plus 1,20,000 plus I need to maintain this one 85, 2,70,000 minus debit side 50,000, 20, 70. So balance figure is 2 lakhs. So therefore this balance figure is what? This is what I need to collect from issue of 12% debentures. So company issued 12% debentures for exactly an amount of 2 lakhs. So if 2 lakhs came na sir, already 50,000 called from the shareholders, 20,000 collected from Mr. X. 2 lakhs if you issued, it will be 2,70,000. You pay bank OD 65. Okay. Tax liability you pay 1,20,000. Then your balance will be 85. So here this finding this amount is also very, very important. Prepare cash and bank balance. So bank account debit to 12% debentures. So 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs. So got it. So see this amount actually 12% bank to 12% debentures, 2 lakhs, 2 lakhs. And finally with this amount settle the bank overdraft. And finally whatever the balance is there in the capital reduction account, remaining assets like goodwill is there, adjust fictitious asset. P&L account debit balance is there, adjust. Inventory 20,000 because inventory has to be reduced to 20,000, which is if it is already transferred to capital reserve, capital reduction account, no need to transfer. And finally the balance in capital reduction account will be transferred to capital reserve account. And they're asking the capital structure also, the revised capital structure. Actually you see equity share capital 84,600 equity shares of 5 each. Actually 75,000 are there in the before internal reconstruction, and in the name of internal reconstruction we have issued 9,600 for that preference dividend we have issued now. I'll show you 48,000 we have issued equity shares. Yeah, 48, 9,600 equity shares. That is what they have written here. So total it will be 423,000. And also cumulative preference shares existing 30 we have issued 17,600. To whom we have issued, sir? Preference shares we have issued, sir. See this. Other creditors 1,32,000 divided by 7.5. So it will be 17,600. See this. That's it, sir. So this is how we need to solve the questions relating to internal reconstruction, sir. Kindly solve January 2025 attempt question once. So you will get a lot of confidence because so many important points are there in this question, sir. Okay. Another question we are going to cover from internal reconstruction chapter, illustration number 7 from ICA study material. So the reason for selection of this question is this question involves the concept of share surrender, which most of the students had some doubts. So that's why I'm covering this. So let us see the question first. See, there is a company Revise Limited. Its balance sheet on 31st March 2011 given, sir. In the balance sheet, equity and liability, shareholders funds, share capital, reserves and surplus, negative balance is there, reserves and surplus, non-current liabilities, we had long-term borrowings, current liabilities, trade payables, other current liabilities, short-term provisions. Asset side, if you see, we have non-current assets, property, plant, equipment, current assets, inventory, trade receivables, cash and cash equivalents. Notes to accounts, observe the share capital carefully. This company is having equity share capital, 10,000 equity shares of 100 each. Reserves and surplus, they has a debit balance of P&L account. Long-term borrowings, they had debentures. Other current liabilities, interest payable on debentures. Short-term provisions, provision for tax is there. Property, plant, equipment, machinery is there. So this is the balance sheet of Revise Limited along with its notes to accounts on 31st March 2011. Sir. Next, what happened? It was decided to reconstruct the company, for which necessary resolution was passed and sanctions was obtained.
So this company wants to, this company decided to go for internal reconstruction, sir. So what are the decisions they have taken here? First, each share is subdivided. Each share is subdivided into 10 fully paid up equity shares of 10 each. Subdivision is happening, sir. See, in the company, 10,000 equity shares are there. Originally, 10,000 equity shares of rupees 100 each is there. Now, one share they have converted into 10 shares. So, 1 lakh equity shares of rupees 10 each. So, overall capital 10 lakhs only. But after subdivision, the number of shares have been increased. Subdivision happened. Generally, what is the entry we will write for subdivision, sir? Simple. Equity share capital, old one. Old one is having a face value of 100. New equity share capital with a face value of 10. But the overall capital remains same, 10 lakhs, 10 lakhs. Okay. So subdivision over. Next, after subdivision, each shareholder shall surrender to the company 50% of his holding for the purpose of reissue to debenture holders and trade payables as necessary. 50% of the shares will be surrendered to the company, sir, and these surrendered shares will be utilized by the company for reissue to the debenture holders and trade payables. That means they are used to settle the liabilities. Okay. Out of this, 50%, sir, that is 50,000 equity shares of rupees 10 each, that is 5 lakhs, was surrendered. Okay. Now tell me, what is the entry we will write for share surrender? I told you, when shares are surrendered, to the extent the capital will be reduced, equity share capital, 50,000 equity shares were surrendered of rupees 10 each. So 5 lakhs will be debited to equity share capital account, and this will be transferred to an account called share surrender account. Share surrender account, 5 lakhs. Okay, share surrender account. Now this share surrender account, either we can use to settle the liabilities, or if you have not utilized to settle the liability, just cancel it. So what they are doing here, see this carefully. Out of the surrendered share surrendered, 10,000 shares of 10 each shall be converted into 12% preference shares of 10 each fully paid. 50,000 shares surrendered, sir. Out of the 10,000 shares of rupees 10 each, 1 lakh is converted into 12% preference shares. Okay. The claims of the debenture holder shall be reduced by 75%. In consideration of the reduction, the debenture holder shall receive preference shares of 1 lakh which are converted out of the share surrender. See this. First of all, there are 50,000 shares surrendered. Out of 50,000, 10,000 was what? Converted into preference shares, 12% preference shares. These are given to 75% claim of the debenture holders. So that means when surrendered shares are used for payment of liability, two entries will come. One is, to the extent the liability is settled by issue of the surrendered shares, will be transferred to capital reduction account. Therefore, 75% of the debentures and also interest on debentures, which are claims of the debenture holders, will be transferred to capital reduction account, and 1 lakh from the share surrender account will be transferred to preference share capital account. Correct? So two entries will be passed here. From share surrender account, we need to transfer 1 lakh to 12% preference share capital. Right? And debentures, if you take 12% debentures and interest on debentures. So debentures total 2 lakhs. Out of that, 75% will be settled by surrendered shares, issue of surrendered shares, 1,50,000, and also interest on debentures 24,000 into 75%. 18,000. So total 1,68,000 liability is settled by issue of surrendered shares. So it will be transferred to capital reduction account. So liability to capital reduction account. Okay. So this one is done. Next, trade payables. Trade payables claim shall be reduced to 50%. It is to be settled by issue of equity shares of 10 each out of the shares surrendered. See this. Trade payables total 72,000 trade payables. So in the question they are saying that total trade payables 72. 50% was what, sir? Reduced. So balance 50% will be there. So 50% of the trade payables will be reduced. So this will be transferred to capital reduction account to the extent the liability transferred. So trade payable account debit to capital reduction account, liability transferred to capital reduction. How much? 36,000, 50%. Remaining 36,000 is settled by issue of equity shares from the surrendered shares. So trade payable account debit to capital reduction account to the extent the liability is settled by issue of the surrendered shares. So out of the shares surrendered, to equity share capital, out of the surrendered shares, how much has become equity share capital? 36,000. So out of the trade payables, sir, 50% was reduced, sir. It is transferred to capital reduction account. Remaining 50% is settled by issue of the equity shares out of the surrendered shares. So to equity share capital. Okay. So that means we have passed the entries for this one also. Next, to balance profit and loss account to be written off. The shares surrendered and not reissued shall be cancelled. So actually surrendered shares account we have 5 lakhs. Out of that 1 lakh is converted into preference share capital which is given to debenture holders ultimately. And 36,000 equity shareholders, equity share capital that is given to trade payables. So remaining which is not issued, surrendered shares not issued will be cancelled by transferring to capital reduction account. So sacrifice made by the shareholders 5 lakhs, 1 lakh converted into preference share capital, 36,000 equity share capital, total 3,64,000 balance is there that will be transferred to capital reduction account. So therefore in the capital reduction account, 3,64,000, 1,68,000, 36,000. So total trade payable 72. Debenture holders 75% of the claim 1,68,000 plus balance 3,64,000. So total 6,04,000 is there in capital reduction account. 6,04,000. Out of the 6,04,000, so P&L account will be adjusted. What is the debit balance of P&L account, sir? Debit balance of P&L account is 6 lakhs. So adjust it. So balance will be transferred to capital reserve account. How much? 4,000. That's it. So observe how I am solving the question. See, if you want to revise me the entire thing in a simple manner, I will tell you. First of all, this is what given. 10,000 equity shares of 100 is 10 lakhs. Now that was subdivided into 1 lakh equity shares of 10 each. Out of that 50% was surrendered, that is 50,000 shares. Out of the share surrender of 50,000, 5 lakhs, 1 lakh is converted into preference share capital, 36,000 is converted into equity share capital, nothing was utilized. Remaining balance 3,64,000 will be transferred to capital reduction account. And entries, first subdivision entry, then surrender entry, then share surrender account is transferred to equity share capital, preference share capital balance. This preference share capital is given to debenture holders for their 75% of the claim. So to the extent the liability debenture holders is settled 75% reduced by issuing the surrendered shares will be transferred to capital reduction. That is what I have explained in the theory. When you have settled a liability by issuing of the surrendered shares, share surrender account data to share capital, have to write separately, liability to capital reserve account, because here the liability was settled by issue of the surrendered shares, not even a single rupee flown from the organization. So to the extent the liability is settled by issue of the surrendered shares will transfer to capital reduction account. Similarly, if you look at trade payables, 50% was reduction, that reduction in liability will be transferred to capital reduction account. Remaining 50% was settled. How? By issuing of the surrendered shares. So therefore it will also be transferred to capital reduction account. And finally in the capital reduction account we have a balance of 6,04,000.
P&L account, accumulated losses will be adjusted, balance will be transferred to capital reduction account. So this is one question. You please solve this question again, because this concept is relating to share surrender. They may ask in examinations. Okay. This is one more question from internal reconstruction. One more question from internal reconstruction chapter. This question we are going to cover now is previous exam question, November 22 attempt examination question, sir. They have given balance sheet of a company Purple Limited as on 31st March 2022. So in the balance sheet on the equity and liability side, we have shareholders funds, share capital, reserves and surplus. Current liabilities, we have trade payables and also short-term borrowings, bank overdraft. Asset side, non-current assets, current assets, non-current assets, property, plant, equipment, intangible assets, current assets, inventories, trade receivables, cash and cash equivalents. And if you see the notes to accounts, sir, share capital, you observe this company is having equity shares as well as preference share capital, both. Reserves and surplus, they have P&L account debit balance. Property, plant, equipment, land and buildings, plant and machinery is there. Intangible assets, goodwill, patents is there. Okay. So this is the balance sheet of a company, Purple Limited, as on 31st March 2022. Now, dividend on preference shares are in arrears for 3 years, sir. Okay. On the above date, company adopted the following scheme of reconstruction. So this company is going for reconstruction, sir. And these are the decisions they have taken. And what is the requirement of the question? You are required to give journal entries incorporating the above scheme of reconstruction, capital reduction account, and prepare the reconstructed balance sheet. So main focus is on entries. If you've done the entries correctly, remaining things will be very easy. So what are the decisions they have taken as a part of reconstruction, sir? See one by one. First, preference shares converted from 6% to 8%, 6% to 8%, but revalued in a manner in which the total return on them remains unaffected. See, they are changing the dividend rate on preference shares, which is also one of the element can be conducted in the internal reconstruction scheme. Variation in shareholders' rights can be done. They are converting 6% preference shares to 8% preference shares, but the total return on them remains unaffected. It should not be affected. Actually, if you see, relating to preference share capital, we have 6% preference share capital of 6 lakhs. That means 6 lakhs into 6% if I apply, my return right now on this is 36,000. Now, the same return we need to maintain at 8% dividend rate. So, 36,000 divided by 8%, it will be 4,50,000. Therefore, for this, what is the entry we will write, sir? 6% preference share capital now will become old. 6% preference share capital, 6 lakhs. In place of 6% preference shares, we are giving 8% preference share capital of 4,50,000. Return becomes same return will be maintained, and obviously the difference will be transferred to capital reduction account. Okay, so 6% preference share capital 6 lakhs to 8% preference share capital 4,50,000. The difference will be transferred to capital reduction account. So this is the first entry, sir. See this. 6% preference share capital to 8% preference share capital to capital reduction account. Next, sir, the value of equity shares is brought down to 8 per share. So equity shares, sir, 10 rupees fully paid. Now they want to bring it to 8 rupees. So this is also reduction of capital, you know. So equity share capital old, each one 10 rupees, to equity share capital new 8 rupees. And the balance is transferred to capital reduction account. So what is the entry here we are going to write in this case? So the entry for this is equity share capital account debit. What is the old equity share capital in the books, sir? 90,000 equity shares of 10 each, 9 lakhs, sir. 10 rupees each has now become an equity share capital of rupees 8 each. 90,000 equity shares into 8. So it will be 7,20,000. So how much is the reduction in the share capital? That will be transferred to capital reduction account. 9 lakhs has become 7,20,000. 1,80,000 will be transferred to capital reduction account. See this. Equity share capital old, equity share capital new, difference capital reduction account. So first two over, sir. Very simple. In first two cases, first 2 points, what are the common point? Can you tell me? In both these cases, if you observe carefully, sir, the preference share capital reduced, the equity share capital is also reduced. Preference share capital reduced from 6 lakhs to 4 lakh 50. Equity share capital reduced from 9 lakhs to 7 lakh 20,000. Okay. Next, the arrears of dividend on preference shares were cancelled. Tell me what is the entry you are going to pass? No entry. Because dividend on preference shares in arrear for 3 years, anywhere in the books they have recognized dividend arrears? No. So when it is not recorded in the books, how it will be cancelled? So for cancellation of arrears of dividend and preference shares, no entry is required. Next, the debit balance of goodwill amount is to be written off entirely. Okay, by using this capital reduction account, we will written off goodwill. And also land and building and plant and machinery is revalued at 85%, 80% of their respective book values. Land and building we will value at 85, that means 15% we will reduce. Plant and machinery we will value at 80%, that means 20% we will reduce. Okay. Book debts amounting to 14,400 to be treated as bad and hence to be written off. Bad debts will be written off. So relating to capital reduction, so they are talking about the adjustments we need to do. Assets, overvalued assets has to be adjusted. So when you adjust the assets which is overvalued, so see here, first goodwill balance is to be written off, 84,600, which is adjusted against capital reduction account. So goodwill account 84,600. And also there are two assets here. One is land and buildings. Land and buildings are valued at 85%. So land and buildings, and also one more asset, plant and machinery. See, land and buildings are valued at 85, plant and machinery is valued at 80. That means land and building is to be reduced by 15%. So 5,40,000 into 15%, it will be 81,000, sir. 81,000 we need to reduce. And plant and machinery we need to reduce 20%. 4,80,000 into 20%. So it will be 96,000. So 96,000 we need to reduce. And also book debts we need to written off to the extent of how much amount? Book debts. See this, book debts they have given 14,400. This will also be adjusted against capital reduction account, assets. So these are all the assets overvalued, we need to set right. Okay, book debts also we created. Next, the company expects to earn a profit at the rate of 90% per annum from the current year, which would be utilized entirely for reducing the debit balance of P&L account for 3 years. The remaining balance of the said account would be written off at the time of capital reduction process. Sir, we know whatever the P&L account debit balance is there, we will adjust to capital reduction account. But here they are telling that this company current year profit is 90,000, and like this 3 years, 90,000 into 3, 2,70,000 they will earn, and this will be used to reduce the balance of the P&L account, debit balance of the P&L account. Only remaining balance we will adjust against capital reduction account. You see the total P&L account debit balance is 3 lakhs. And we are adjusting against the profits 2,70,000, which is going to be earned in the next 3 years, including current year 90, second year 90, third year 90, like the 2,70,000 profits we are going to earn. So remaining balance is how much? 30,000 in the P&L account balance. That will be adjusted against the capital reduction account. So P&L account balance 30,000 only we are going to adjust. That is the interesting point here in this question. And the balance total capital reduction is to be utilized in writing down the patents. The balance whatever available in the capital reduction account will be used to write off the patents, sir. Okay. So balance will be used to write off the patents. So what will be the total amount credited to capital reduction account, sir? See this. Capital reduction account 1,80,000, and also here in this case 1,50,000. So 1,80,000 plus 1,50,000. Total it is 3,30,000, sir. So 3,30,000.
So from this 3,30,000, 84,600 minus 81,000 minus 96,000 minus 14,400 minus 30,000 will adjust. So the balance is 24,000, which is adjusted against patents. They said that. Okay. If you want, you can see the answer. Yeah, this entry, see. Capital reduction adjusted against goodwill, land and building, plant and machinery, trade receivables, patents, 24,000. We got it. And P&L account also 30,000. We adjusted already. See this. P&L account 30, patents 24,000, balancing figure. Okay. Next, sir, that there is a last point. A secured loan of 4,80,000 being interested at 12% per annum is to be obtained by mortgaging the tangible fixed assets for repayment of bank overdraft and for providing additional funds for working capital. So the company has taken a loan, sir, 4,80,000 at the rate of 12% interest. Okay, for why? For repayment of bank draft and providing additional funds for working capital. So when you first take the loan, when in this case, when the loan is taken, bank account attached to loan, 4,80,000, then bank overdraft will be paid, overdraft to cash or bank. So the overdraft balance 2 lakhs. So therefore, loan is taken, bank to loan 4,80,000, and we will pay the bank OD to bank 2 lakhs, 2 lakhs. That's it. So these are the entries. Now you prepare capital reduction account. So if I prepare here the capital reduction account, sir, capital reduction account is created with the 1,80,000 in case of equity share capital, 1,50,000 in case of preference share capital, goodwill written off, land and buildings, plant and machinery written off, trade receivables written off, P&L account 30,000 balance is written off, remaining balance patents written off. So capital reduction account automatically gets tallied. Now balance sheet of Purple Limited. So if you prepare the balance sheet, first how you are going to approach the balance sheet. First I told you, you need to write the format. So equity and liabilities, shareholders funds, in that share capital note number 1. So share capital, you see, original share capital of the company is 9 lakhs. Equity share capital. First I am talking about equity share capital. Now what happened to equity share capital? It was reduced to 8 per share. So equity share capital 9 lakhs now has become 7,20,000. Preference share capital actually 6 lakhs has become 4,50,000. So total share capital after adjusting, after internal reconstruction is, see this, share capital, yeah, equity shares has become 7,20,000, 90,000 equity shares has become 8. Preference shares, 8% preference share capital has become 4,50,000. So total 11,70,000. Got it. Actually, see, we have done it. See this, 8% preference share capital 4,50,000. This is, and also equity share capital, we have written the entry also. See this, 7,20,000. Next, reserves and surplus, only 30,000 was adjusted. Remaining balance still will be there. Right? Property, plant, equipment, land and building is valued at 85%. Plant and machinery 80%. Intangible assets reduce goodwill because we have written off it. Trade receivables, out of the sundry debtors, we created a provision for 14,400. We have written off it. I think remaining items and all very simple. Bank overdraft completely we paid. But here when you are preparing one new item will come, sir, that is bank loan they have taken. Short term borrowings they are considered as secure loan. You have taken a bank loan 4,80,000. Trade payables 2,20,000. Property, plant, equipment, intangible assets, goodwill will be written off, remaining balance. Current assets, inventory, trade receivables. Cash and cash equivalents also you should be carefully analyzed, sir, here. Okay, that's it. I think this is the question, sir. We have solved, we have covered. Previous year November 2022 attempt question. This is. Hello my dear students. Hope all of you are fine. Doing great. The next chapter we are going to cover is consolidated financial statements. In this chapter, there are 3 accounting standards: 21, 23, 27. 21 consolidation of subsidiaries, 23 consolidation of associates, 27 consolidation of joint venture. You see the past examination questions, sir. AS 21 is the most important area. 27 is the least important area.
23, they may coin one small question or maybe an MCQ. But our main focus is on Accounting Standard 21, Consolidation of Subsidiary Companies. Let us start discussing Accounting Standard 21, sir. Consolidated Financial Statements. First, what is Consolidated Financial Statements? Let us try to understand. Sir, in case of companies, there is a concept of parent subsidiary. If one company is exercising control over another company, then we say there is a parent subsidiary relationship. Suppose there are two entities, A Limited, B Limited. When we say there is a parent subsidiary relationship, if A Limited is exercising control over B Limited, then A Limited is called parent company or holding company. B Limited, which is controlled by A Limited, is called subsidiary company. In order to have this parent subsidiary relationship, control aspect should be there. Now the next question arises, sir, how this control is achieved, sir? How can we say one company is having control over another company? There are two ways this control can be achieved. One is having more than 50% voting power. That is, if one company is having more than 50% equity shares in another company, then we say there is a control. There is another way, sir, that is control over composition of board of directors. If one company is having the ability to appoint or remove either all or majority of the board of directors, then also we say there is a control. But the bottom line is, in order to have the parent subsidiary relationship, there should be control, and this control is predominantly achieved by having more than 50% share capital. Because in almost all the problems, sir, if you see, they say the control is achieved by having more than 50% shares. So this one you need to remember. Okay. Next, sir, every company at the end of the year, they have to prepare their individual financial statements. Suppose A Limited is there. At the end of the year, they need to prepare balance sheet, P&L, cash flow statement, notes to accounts. B Limited also, they need to prepare their individual financial statements. But if you are a parent company, along with your individual financial statements, as per Companies Act, you need to prepare consolidated financial statements. The word consolidation means joining together. Parent with its subsidiary, treating this entire group as one entity, they need to prepare financial statements. Those are called consolidated financial statements. Consolidated balance sheet, consolidated P&L, consolidated cash flow statement, consolidated notes to accounts, they need to prepare. Individually we are preparing, but as a group, how you are performing? As a group, what will be the financial position? For that purpose, as a parent company, we need to prepare consolidated financial statements. So basically, what is consolidated financial statements? Financial statements for the group, parent along with its subsidiary, joining together, treating as one economic entity. And if you prepare financial statements, that is called consolidated financial statements. And this is as per Companies Act, sir. And whenever you are considering subsidiary for consolidation purpose, the procedure you need to follow as per Accounting Standard 21. So can you tell me what is the bottom line? The bottom line is, if you are a parent company, at the end of the year, along with your individual financial statements, you need to prepare financial statements for the group. Right? Now the next question arises, sir. See this. See this. Suppose I am a parent company, A Limited. There is my subsidiary, B Limited. And I need to prepare consolidated balance sheet for the group by treating these two entities as one single economic entity. And then consolidated P&L account I need to prepare. Consolidated cash flow statement is also there, but no questions are there in the study material. Main focus is consolidated balance sheet and P&L account. Consolidated notes to accounts, anyway we will prepare for balance sheet and P&L account. Now consolidated balance sheet involves steps, so many steps and calculations. Consolidated P&L account compared with consolidated balance sheet is very easy. So first we are going to focus on the consolidated balance sheet. How consolidated balance sheet will be prepared? So that is the procedure they have given here. Consolidation procedure. Steps for preparing consolidated balance sheet. Sir, in order to prepare consolidated balance sheet, sir, there are 9 steps, sir. The entire procedure of consolidation is divided into 9 steps. 9 steps. Of course, if you see in study material or any other material, the number of steps may be more or less, but we have followed 9 steps. But in any source you follow, there are some compulsory steps which compulsorily they will do, like cost of control step, minority interest step, analysis of subsidiary company reserves and surplus and apportionment, resource for consolidated balance sheet. So these are some of the important steps in consolidation procedure. Okay, sir, what are the 9 steps, sir, in consolidation? First, what we are going to do is, we understood these steps, sir. We'll try to understand what are the steps they will follow when they are preparing consolidated balance sheet. First, sir, determine the date of acquisition, on which date parent acquired the subsidiary, determine the date. Second, ascertain the shareholding pattern. On the date of consolidation, what is the shareholding pattern? And also analysis of the subsidiary company reserves and surplus. Analyze the subsidiary company reserves and surplus. After analysis, apportion the subsidiary company, analyze it reserves and surplus. Step 5, minority interest. Step 6, cost of control. Step 7, any intercompany transactions are there between parent and subsidiary, those intercompany transactions, adjustment. And next, reserves for consolidated balance sheet. And the last step, preparation of consolidated balance sheet. Okay, see, on one hand we have parent company balance sheet, sir. This is the balance sheet of parent company, suppose A Limited. On the other hand, we have the balance sheet of the B Limited, which is subsidiary company, sir. In balance sheet, generally they have assets, liabilities, share capital, reserves and surplus. Assets, liabilities, share capital, reserves and surplus. Now I need to prepare one single balance sheet for the two entities together. So assets, simple, A Limited assets plus B Limited assets I will add. When it comes to liabilities, A Limited liabilities, B Limited liabilities I will add. When it comes to share capital, I will consider only parent company share capital, because I am preparing consolidated financial statements for parent company. Whatever the share capital is there in the subsidiary company, that will not be shown as the share capital, that will not be added to the share capital of the parent company. Only parent company share capital we need to consider. When it comes to reserves and surplus, important, parent company reserves and surplus, A Limited reserves and surplus plus B Limited subsidiary company reserves and surplus, A Limited share, that will be added. And one more interesting item here, they will in case of consolidation, is the concept of minority interest. Extra minority interest concept will come. And also there is a concept called cost of control. This cost of control either will give you goodwill or capital reserve. So therefore, basically consolidated balance sheet is what? Line by line addition. Parent company assets, subsidiary company assets. Parent company liabilities, subsidiary company liabilities. Share capital, only parent company. Okay. Reserves and surplus analysis is the most important thing, sir. Whatever the reserves and surplus are there in the subsidiary company, sir, these reserves and surplus will be properly analyzed, sir. Why the subsidiary company reserves and surplus are analyzed? Because as a parent entity, we acquired the subsidiary company on one particular day, right? On the date of acquisition, whatever the reserves and surplus already there in the subsidiary company, what is the nature of those reserves and surplus? Once I acquired the subsidiary, whatever the reserves and surplus generated, what is the nature of those profits? So an apportionment analysis of the subsidiary company reserves is, the analysis is pre-post. This analysis will help you what is the actual treatment I need to do with regarding to my share as a parent company. What is my share in the reserves and surplus of B Limited? Okay, so basic idea is, what is consolidated balance sheet, sir? Simple, sir. Assets, parent company assets, subsidiary company assets. Parent company liabilities, subsidiary company liabilities. But when it comes to share capital, only parent company share capital. When it comes to reserves and surplus, parent company plus parent company share in the reserves and surplus of the subsidiary company. And minority interest, sir, what is this minority interest, sir? See, for example, sir, A Limited is the parent company of B Limited. A Limited is having 80% shares in B Limited. What about remaining 20%? That is called minority interest. Sir, in consolidation, we need to calculate minority interest also. Sir, what is the logic for calculation of minority interest? Very simple, sir. Sir, when you are consolidating 100% net assets of the subsidiary company. But in the net assets of the subsidiary company, 20% belongs to other shareholders. Na? But being a parent company, since you are having controlling interest, you are consolidating everything. So therefore, since you are consolidating everything from the subsidiary company, but in fact, in that the 20% belongs to minority shareholders, that we need to calculate on the liability side, we need to show. So that is the logic of minority interest. And why goodwill and capital reserve? Cost of control calculation we need to do. What is cost of control, sir? How much investment I am spending? For this investment, what is the share of net assets I am getting? I need to compare. And if my investment is more than the share of net assets I am getting, that means I am spending excess amount, that will be treated as goodwill. Right? Suppose if I am spend, what is the amount I am spending? What is the net asset share I am getting? If the amount I spend is less than the net assets I am getting, it is my capital reserve. Okay. So this is the thing, sir. So I have given you the basic idea of consolidation. There are two balance sheets with you: parent company balance sheet, subsidiary company balance sheet. Now with these two, you have to prepare one single balance sheet. For that, there is a procedure. That procedure we are going to cover it now. I divided this entire procedure into 9 steps, sir. As I told you, let us try to understand first step. And each step is having its own logic, sir. First step is what, sir? Determine the date of acquisition. Sir, on which date parent company acquired the subsidiary company? First identify that date. Why we need to identify that date? Just now I told you, when you are consolidating the subsidiary company, whatever the reserves and surplus are there in the subsidiary company, they will be divided into two parts, the pre-post. Whatever the reserves or surplus and there, by the time you are acquiring the subsidiary, they are all pre-acquisition profits. Once you acquire the subsidiary, whatever the profit generated, they are called post-acquisition profits. The standard is all the pre-acquisition profits, your share in the pre-acquisition profits as the parent company is capital profits. All the pre-acquisition profits are capital profits. All the post-acquisition profits are revenue profits or revenue reserves. So to determine the, to classify the reserves into pre and post, I need to know the date of acquisition. First step. Okay. Second, ascertain the shareholding pattern. Sir, on the date of consolidation, who is having how much share in the subsidiary company? In the subsidiary company, as a parent company, what is your share? As a minority interest, what is their share? Suppose as a parent company, you are having 80% share. Number of shares, percentage 80%. Minority interest 20%. Total 100%. This you need to ascertain. This is step number 2. Why this step is necessary? Because once you analyze the subsidiary company reserves and surplus into pre and post, after that you need to apportion between the parent company and minority interest. Because in the subsidiary company, who are the owners? Parent and minority shareholders. So for them, you need to apportion this. For that, you should know what will be the shareholding pattern. So first, determine the date of acquisition. Second, ascertain the shareholding pattern. Okay. Now the most important step in consolidation is subsidiary company reserves and surplus must be analyzed. Analysis of the subsidiary company reserves and surplus. Sir, they will give you the subsidiary company balance sheet. Look at the reserves and surplus. Try to analyze each reserves and surplus. Analysis is nothing but divide the reserves and surplus into two categories: pre-post. Whatever the reserves and surplus are there by the time you are acquiring the subsidiary, pre, after that post. And all pre-acquisition reserves, capital profits, all post-acquisition revenue profits. Like that you have to divide. Next step is, once it is a capital profit, pre-acquisition profits, what I need to do? Once it is a revenue profit, what I need to do? That is what we are going to discuss. So, but analysis of the subsidiary company reserves and surplus we have to do. And when you are analyzing the subsidiary company reserves and surplus, sir, there are certain important things you should consider in mind. That is, any revaluation of assets of subsidiary companies having, that is going to impact my analysis. And also any dividend given by subsidiary company, maybe that is going to impact my analysis. And any intra-group transactions between parent and subsidiary, that is also going to impact my analysis. And once you analyze the subsidiary company reserves and surplus into pre-post, next thing is apportion. See, this apportion means dividing, sharing. Suppose pre-acquisition profits are capital profits, post-acquisition profits are revenue reserves. A post-acquisition profit, revenue reserve. Post-acquisition profits may be revenue profits. Post-acquisition profits can be a revenue reserve or can be a revenue profits. Now, what they have done, see this. General reserve, for example. What is the pre-acquisition profit? What is the post-acquisition profit? Other reserves, P&L account. Share between the parent and minority interest. Okay. So, till 4 steps we have completed, sir. So, tell me, date of acquisition, shareholding pattern, analysis, apportionment. See, you will understand this when you solve one question, sir. So let us quickly jump into one question, sir. I will give you a brief idea, because this chapter you will understand better when you solve. Suppose, look at this illustration. 11, sir. With the help of this illustration, I will try to explain up to 4 steps, sir. There are 2 companies, H and S. Relating to them, the following information is given, sir. Property, plant, equipment given of both the companies. Investment, look at this, investment, 8,000 equity shares of S Limited. Sir, H Limited is having 8,000 equity shares of S Limited. And the cost of investment is 1.26 lakhs. Okay. Current assets given, both the companies. Share capital of both companies given. What is the share capital of S Limited? 1 lakh. Each share face value 10. That means number of shares 10,000. And how many shares are held by H Limited? 8,000. So what is the percentage of holding? 8,000 divided by 10,000 into 100, 80%. So in S Limited, 80% of the share capital is held by H Limited. 20% held by whom? Minority interest. Now look at S Limited P&L account balance 40. Parent company 50. Trade payables also given. So there are 2 companies balance sheets given on 31st March 2012. Now what they are telling is additional information, you look at it. H Limited acquired the shares of S Limited on 1/7/2011. So date of acquisition, sir, 1/7/2011. And the balance in P&L account of S Limited on 1/4/2011 was 30,000. At the opening on 1/4/2011, the P&L account balance in subsidiary company is 30,000. Opening. Prepare consolidated balance sheet of H and its subsidiary as on 31st March 2012. See, they are asking what? Prepare consolidated balance sheet of parent along with its subsidiary. Now, I told you there are certain steps you need to follow. Let us see the steps. First 4 steps I am focusing. Okay. First step number 1, date of acquisition. So from the given question, identify the date of acquisition, which is 1/7/2011. Correct? So 1/7/2011 is the date of acquisition. Okay. I identified. Second is shareholding pattern. On the date of consolidation is what? 31st March 2012. On 31st March 2012, in S Limited, who is having how much shares, sir? See this. H Limited, being a parent company, I am having 8,000 shares. That means 8,000. The number of shares in subsidiary is 10,000. So it will be 80%. 80%. And remaining minority interest 2,000 shares. So 2,000 divided by 10,000 into 100, 20%. So I identify the shareholding pattern. In the subsidiary company, parent company is having 80%, minority interest having 20%. So this is step number 2. Step number 3, analysis of reserves and surplus. Analysis of reserves and surplus. Analysis of reserves and surplus of subsidiary company, which is the most important step. Analysis of reserves and surplus of subsidiary company, that is S Limited. Sir, at the time of consolidation, we have to analyze the subsidiary company reserves and surplus. Now look at the question and tell me, sir, what are the reserves and surplus of the subsidiary given? 40,000 P&L account given. Now take P&L account, 40,000 balance. Can you tell me this balance is on what date? 31st March 2012, correct? 31st March 2012. Yes. On 31st March 2012, this is the thing. Now you divide this into pre-post. How you are going to divide? Look at the first step. What is the date of acquisition? 1/7/2011. Therefore, on 1/7/2011, whatever the profits are there in the subsidiary, they're all pre. Before you acquiring subsidiary itself, these profits are there. Therefore, they are called pre. After that, post. Now, they have given on 31st March 2012, 40,000. And if you look at the question, they have given 1/4/2011. That is on the opening date. See this. 1/4/2011, 30,000 they have given. 30,000. This is opening, sir. Opening. And that means, what is the current year profit? Can you guess? Your closing is 40, sir. Your opening is 30. That means obviously anybody can say current year profit is, this is current year profit, 10,000. This is the balancing figure, 10,000 current year profit. Okay. So you acquired subsidiary on 1/7/2011. Subsidiary company is already having 30,000 at the beginning itself. So this entire 30,000 is what? Pre-acquisition profit. And it is called capital profit. And now coming to current year profit of 10,000. In the current year, on which date you acquired subsidiary? 1/7/2011. That means April, May, June. First 3 months is what? Pre-acquisition period. Pre-acquisition period. Next 9 months is what? post acquisition period. Post acquisition period, after you acquiring subsidiary, 9 months. Before you are acquiring subsidiary, 3 months. Here the assumption is that profits are earned evenly throughout the year. So therefore, whenever you are doing the apportionment, sir, analysis, dividing, sir, pre-post profits, you need to do it on time basis, sir. This is the assumption, time basis. We will follow time basis, sir, time basis. So if I divide the current year profits between pre-acquisition period and post-acquisition period, so 10,000 divided by 12 into 3, it is 2,500 rupees. So out of 10,000 profit, 2,500 profit is a pre-acquisition profit, which is capital profit. Remaining 7,500, which is a post-acquisition profit, which is a revenue profit. Because I am analyzing P&L account, it is called revenue profit. If I am analyzing general reserve, it is called revenue reserve. Hope you understand this analysis. So the entire summary of this analysis is what, sir? Out of the total 40,000 profits of the subsidiary company, what is total pre-acquisition profit? You see this, 30,000, 2,500. 32,500 is the pre-acquisition profit. What is the post-acquisition profit? 7,500. 7,500. And this 32,500 is what profit? Capital profit. This is revenue profit. So this kind of analysis is step number 3. For this is analysis, step number 1 is required. Done, sir. Analyze it, sir. After analysis, sir, step number 4, sir. Once you analyze, please apportion. Apportionment, because the subsidiary company, who are the owners? Parent, minority interest, right? So between parent and minority interest, this capital profit, revenue profit, you apportion. That means, see this, pre-acquisition profits, post-acquisition profits. Pre-acquisition profits is capital profits, post-acquisition profit is a revenue profit or revenue reserve. Here revenue profit, since we are analyzing P&L account. I analyzed P&L account and I came to know that the capital profit is 32,500 and the revenue profit is 7,500. In this capital and revenue profit, being a parent company, H Limited, what is my share? 80%. What is minority interest share? 20%. Apportion it. So 32,500 into 80%, it will be 26,000, and 20%, it will be 6,500. 7,500 into 80%, 6,000. And remaining 1,500 is the minority shareholders share. So this is step number 4. So like this, first 4 steps will be done. Okay. So this is what, see this, first 4 steps we completed. First we identify the date of acquisition. Second, shareholding pattern. Why shareholding pattern is ascertained, sir? Because see, in step number 4, if you want to apportion, you should know the shareholding pattern. That's why step number 2, shareholding pattern. Once you know the shareholding pattern, you can easily apportion between parent and subsidiary. Okay, sir. Still step number 4 we understood, sir. Next, sir, see this. Step number 5, minority interest. This is very, very important. Please understand this carefully. What is this minority interest? Sir, minority interest is nothing but in the subsidiary company, minority shareholders, what is their share in the net assets? That is what we need to calculate. Because I told you already the logic. As a parent entity, I am considering entire subsidiary for consolidation. Even though I am not 100% having the shares in the subsidiary company. Suppose 80% shares only I had. But I am consolidating 100% assets, 100% liabilities of the subsidiary company. But frankly speaking, in the subsidiary company, 20% of the share must belongs to minority shareholders. So therefore, whatever the share belong to the minority shareholders, as a parent company, I need to calculate, I need to recognize them as my liability in the consolidated balance sheet. In the, shareholders funds, equity and liability, shareholders funds. After shareholders funds, we will generally show minority interest. Shareholders funds and reserves and surplus, between them, we need to show minority interest. Okay. Sir, how to calculate minority interest? Simple. Minority shareholders share in the net assets of the subsidiary company. What is net assets of the subsidiary company? Assets minus liabilities is net assets, or share capital plus reserves and surplus. Share capital plus reserves and surplus, that is also net assets now. See, how can you ascertain the net assets of a company, sir? There are 2 ways. Suppose if this is the balance sheet of the subsidiary company, we have assets, liabilities, share capital, reserves and surplus. Suppose assets 100, liabilities 50, reserves and surplus 30, share capital 20, total 100. So how can I ascertain net assets? Can you tell me? Assets minus liabilities. Assets minus liabilities, 100 minus 50, it is 50. Or else there is another way. Net assets is equal to just share capital plus reserves and surplus. So share capital 20, reserves and surplus 30, total 50. So there are two ways to ascertain the reserves and net assets. What is the easiest way? Share capital plus reserves and surplus, because only there are two items. But in assets, there are multiple assets, liabilities multiple will be there. So the easiest way is finding out net assets like this. In this net assets, what is the share of the minority shareholders? Into 20%. For your example, I am saying. So look at this. That's why what they are doing. Minority interest is the aggregate of the minority shareholders' share. Share capital, what is their share? Capital profits. Because the subsidiary company profits are analyzed into pre and post. Na? So in the step number 3, analysis is done. Na? In that capital profits, what is the share? Revenue reserve, what is the share? Yeah, already we have done in step number 4, analysis and apportion also done. In this apportionment we have done to minority shareholders now. What is the share in the capital profits, revenue profits, what is their share? Add everything. If at all any equity dividend is also there, add. Less stock reserve, anything is there, upstream. What is this stock reserve? I am going to explain in the intercompany owings. So minority shareholders share you ascertain, sir. Suppose in our question we are solving, sir, if I calculate minority interest in this question, see this, how I am going to calculate minority interest here. Step number 5, minority interest. Minority interest is 20%, right? 20%. First, share capital. What is the share capital of the company, sir? Share capital is 1 lakh. Correct? In S Limited, 1 lakh is there. In this 1 lakh, what is the minority shareholders share? 20%. So 20,000. Next, reserves and surplus. Already reserves and surplus were analyzed and apportioned. See, this apportionment we have done. This is the reserves and surplus of the subsidiary company. In that reserves and surplus, the capital profit, what is the share of the minority interest? See, this capital profits, their share is 6,500. So capital profit, step number 4, 6,500 is the share of the minority shareholders. Revenue profit, what is their share? In step number 4, what is their share? Is 1,500. 1,500. That's it. You add everything. 20,000 plus 6,500 plus 500. 1,500. 28,000 is the minority interest. We got it. So this minority interest is nothing but the share in the net assets of the subsidiary company to the minority shareholders. Being a parent company, I am incorporating 100%, but actually speaking 20% belongs to minority shareholders. So that I need to calculate and show it in the consolidated balance sheet. That's why see, when they prepare consolidated balance sheet in this question, you see minority interest 28,000 they have shown. Important. So step number 5 in the consolidation procedure is what? Minority interest. Done. Next, what is step number 6, sir? Step number 6 is a very, very important step, sir. They can ask this as a individual question also. Okay. What is step number 6? Cost of control step. What is this cost of control, sir? Very simple, sir. AS 21 says, being a parent company, you are investing, you are spending some amount, you are investing in the subsidiary company. What is the cost of your investment? Compare this cost of investment with the what is the share in the net assets you are getting on the date of investment. Now, if your investment is more than the net assets you are getting, that is excess amount you are spending now, that is treated as goodwill. Otherwise, capital reserve. That's it. So, how to calculate the cost of control? First, take the cost of investment. That is, what is the amount you invested in the subsidiary company? Less any pre-acquisition dividend received from subsidiary company. This is very, very important. Sir, subsidiary company declares a dividend from pre-acquisition profits. If any dividend given by the subsidiary company from pre-acquisition profits, it is a capital profit. Capital profit is adjusted to cost of investment. I told you, pre-acquisition profits are what nature profits? Capital profits. Capital profits is adjusted to the cost of investment. Revenue profit will be transferred to P&L account. So, as a parent company, sir, I received dividend from subsidiary company. Okay. That dividend given by the subsidiary company from which profits? Pre-acquisition profits. If it is given from pre-acquisition profits, then my dividend is pre-acquisition dividend. That pre-acquisition dividend will be adjusted to the cost of investment. See, this is not a new point. Even in accounting standard 13 also this point came. As an investor, if I receive any dividend from pre-acquisition profits, generally the standard says the nature of the pre-acquisition dividend, if you receive any dividend from pre-acquisition profits, it's a capital profit. Capital profit is adjusted to your cost of investment. Now you will get adjusted cost of investment. Once you got the adjusted cost of investment, compare this with the value of investment, that is parent share of subsidiary company's net assets. As a parent company, with this investment, what is the share in the net assets I am getting? In the share capital as well as in the pre-acquisition profits of the subsidiary company, what is my share? You compare. So you will get cost of control. You will get cost of control. This is the important step, sir. So understand this step, the relevance of this step, sir. It makes sense, sir, because see, in this question, suppose if I want to calculate cost of control here, step number 6. See this step number 6, cost of control. If I want to calculate, first I will take cost of investment. So what is the cost of investment given in the question? As a parent company, how much I invested? 1.26 lakhs. See this 126. Any pre-acquisition dividend? No. So this is the cost of investment. Now parent company, that is H Limited share in net assets of subsidiary company, that is S Limited, represented by net assets. Here we are calculating through share capital plus reserves and surplus. So in the subsidiary company, what is the share capital, sir? 1 lakh. In that, what is the parent company share, sir? 80%. And also subsidiary company reserves and surplus. See, this is we are doing on the date of acquisition. So on the date of acquisition, whatever the profit are there is pre-acquisition profits, sir. Whatever the profits are there in the subsidiary company, they are pre-acquisition profits. So we already calculated, sir, the pre-acquisition profits of the subsidiary company is 32,500. In this, what is the share of the parent company? 26,000. So the parent company share in the pre-acquisition profits is 26,000, which we got from step number 4. 26,000. See this. So 1 lakh into 80%, 80,000. So parent company share in the net assets of the subsidiary company on the date of acquisition, 80,000 plus 26,000, it will be 1,06,000. See this, 1,06,000. So therefore you tell me, as a parent entity, I invested 1.26 lakhs, but my cost of my value of investment is only 1,06,000. My value of investment is nothing but parent company share in the net assets of the subsidiary company represented by share capital plus pre-acquisition profits. In the pre-acquisition profits of the subsidiary company, what is my share as a parent company and share capital? So total 1.6. So you compare this. Your investment is more than this. So therefore 20,000 is what, sir? Cost of control, which is goodwill. Goodwill came because excess investment. See this. In the balance sheet, asset side, you show intangible assets. See this. So 6th working note. So what is 6th working note? See this, goodwill, they got it, 20,000. How they got it? Cost of investment, 1.26. What is the share in the net assets of the subsidiary company? 80,000 share capital plus pre-acquisition profits, our share 26,000. So cost of control is what? Comparing your cost of investment with your share in the net assets. The difference is goodwill or capital, sir. Okay, see, when you are consolidating the balance sheet, sir, consolidated balance sheet, I'm going to tell you one important point, sir. In the parent company individual financial statement, you see we have investment, right? Investment 26,000. This investment will not come in the consolidated balance sheet, because what you are doing, this investment and your share in the net assets, you both, adjusted, and the difference is coming in the consolidated balance sheet. So when you are preparing a consolidated balance sheet, sir, parent company investment in subsidiary company will not come. And because this investment we are comparing with what is the share of the net assets, accordingly the difference only we are recognizing in the consolidated balance sheet. That step is called cost of control step, sir. See how they perfectly named it. The step is what, sir? Cost of control. What is the cost I am incurring to acquire this investment? So this is one step, sir. Step number 6. Okay. So we calculated minority interest, we calculated cost of control. Next, intercompany transactions, sir. In this question, I think intercompany transactions are not there, sir. So leave it. I'm going to explain these intercompany transactions. And then reserves for consolidated balance sheet. So once you've done everything, sir, you do reserves for consolidated balance sheet as a step number 8. 7 intercompany owings not there, leave it. Intercompany owings nil. Next step number 8, reserves for consolidated balance sheet. This is important step, sir. Understand. What is this reserves for consolidated balance sheet? Sir, you are preparing consolidated financial statements in the books of parent company, right? So first take as a parent company, what is your balance in P&L account? Your reserves and surplus balance, tell me first. Look at the question and tell me. As a parent company, what is my share? What is my reserves and surplus balance? 50,000. Parent company, I am asking, parent. Now for this add parent company, that is H Limited share in post acquisition profits of subsidiary company S Limited, which we already do in step number 4. Sir, in step number 4, when you are analyzing the apportionment of the profits you do in the post acquisition profits of the subsidiary company as a parent entity, what is your share? This is 6,000. So take it 6,000 here. Take it 6,000. So therefore, see, parent company balance in P&L 50. Parent company share in the post acquisition profits of the subsidiary 6,000. Total 56,000 is the reserves for consolidated balance sheet, which will come in the consolidated balance sheet, sir. Which will come in the consolidated balance sheet. See this, if you want, I will show. Reserves and surplus 56,000 in the consolidated balance sheet. So see this, P&L account. Originally 50,000. And in the subsidiary company post acquisition profits, parent company share, which we already calculated. So we got 56,000. So this is reserves for consolidated balance sheet, sir. And finally, we prepare the consolidated balance sheet. And when you're preparing the consolidated balance sheet, simple, assets add one by one. Suppose you take share capital first. I told you, when it comes to share capital, consider only parent company share capital. Only parent company. If you want, you can see parent company. Suppose what is the share capital of the parent company? 1.5. So this 1.5. 1.5. Parent company share capital. Coming to reserves and surplus, already we do. In step number 8, we calculated how to calculate parent company plus parent company share in the post acquisition profits of subsidiary company. Minority interest, step number 5. Minority shareholders share in the net assets of the subsidiary company. Why we calculate? Because as a parent company, we are incorporating everything. Actually, we belong only, we are eligible only for 80%. What about remaining 20%? They belong to minority shareholders. So that's why we need to calculate and we need to show them as a liability side. Below shareholders funds, below shareholders funds and before liabilities, we need to show this minority interest, 28,000. Now next, current liabilities we had, simply add both of them. Current liabilities, trade payables 1,60,000, 1.6 lakhs. See this, 1.6 lakhs. Coming to asset side, sir, property, plant, equipment 1 lakh, 1.3. Add both of them, 2,30,000. Simple addition. Intangible assets, goodwill, we got it. Cost of control step, in step number 6, we got it. And then coming to current assets, simply add everything. Current assets 7470. See this, 7470, 1,44,000. That's it. So therefore, the final conclusion I am giving, sir, when it comes to assets and liabilities, simple adding. When it comes to reserves and surplus, analyze a portion into pre-post. Okay. And extra thing is what? Calculation of minority interest, calculation of cost of control. These are the things which will appear in the balance sheet. So simple question I have solved relating to the entire consolidation, sir. Now I'm going to explain few important things, sir. The final conclusions, see this. Sir, when you analyze, analyze and apportion, simple trick I will tell you, remember it, sir. Sir, here parent company share in the pre-acquisition profits of subsidiary company. Look at this. Parent company share in the pre-acquisition profits of the subsidiary company, 26,000. Always Parent company share in the pre-acquisition profits is considered in step number 6, sir. In step number 6, when you are calculating cost of control, you are comparing the cost of investment with the parent company share in the net assets of the subsidiary company. In that parent company share in the net assets of subsidiary company share capital. In the pre-acquisition profits, what is the share? So for that purpose, we need to consider. So remember, parent company share in the pre-acquisition profits of subsidiary company, step number 6. Parent company share in the post-acquisition profits of the subsidiary company, post-acquisition profit, we consider in step number 8. Reserves for consolidated balance sheet. In step number 8, we have added to the parent company, see this, 50,000 H limited share in the post-acquisition profits of subsidiary company. Okay. And this minority interest share in pre or post will be considered in step number 5. In step number 5, when you calculate minority interest, in both the cases, we can, both the things, capital profit as well as revenue profits, we have considered. So the conclusions are very simple, sir. Parent company share in the pre-acquisition profits of subsidiary company considered in cost of control, adjusted. Parent company share in the post-acquisition profits of the subsidiary company, step number 8, reserves for consolidated balance sheet. Because post-acquisition profits are revenue profits. So whatever the parent company share in the post-acquisition profits of revenue profit considered in step number 8. Minority shareholders share will be considered in minority interest. So this is the conclusion. Now, I have explained, as I told you, I have explained a simple basic consolidation question covering certain aspects. Now I am going into deep. I am going to cover some important adjustments. What are those important adjustments? As I told you, when you are analyzing the subsidiary company reserves and surplus, sir, the most important adjustments are revaluation of assets and liabilities and also dividend. So listen to me carefully, sir. First, revaluation of assets of subsidiary company. Sir, generally what happens is when one company is acquiring another company, if any assets are not properly valued, they will make a changes. Similarly, being a parent entity, I am investing in subsidiary company. If any assets or subsidiary company are not properly there, not at proper value, I will make a revaluation. So generally this revaluation will happen on the date of acquisition. And when you revalue an asset, there are two possibilities. You know that, upward revaluation, downward revaluation. So tell me, in the subsidiary company, if there is any asset is there, that asset we are doing revaluation. That revaluation can be upward or downward revaluation. Upward revaluation, downward revaluation. Upward revaluation means what? Increase in the asset value. So whatever the increase is there, treat it as a capital profit, pre-acquisition profit, which is a capital profit. Because this revaluation is happening on the date of acquisition. Till the date of acquisition, whatever the profits earned, whatever the profit generated in the subsidiary, they're all capital profits, pre-acquisition profits. So if there is an upward revaluation, because of that, there is an increase in profits of the subsidiary company. They are called pre-acquisition profits, which are capital profits. Sir, suppose if there is a downward revaluation, the asset value decrease and they are pre-acquisition losses, they will be treated as capital losses. So when you are analyzing the subsidiary company reserves and surplus, and in the question, they have given that subsidiary company assets are revalued, then you need to consider this revaluation profit or revaluation loss and consider it as a capital profit or capital loss. Because in consolidation, step number 3, what we are doing, we are making analysis. How we are making analysis? By dividing the profits into pre-post. So any revaluation profit or loss is a capital profit, pre-acquisition profit. Okay. But here, one important point, sir. Suppose you do the upward revaluation of an asset, sir. Suppose, for example, there is a PPE, sir, whose carrying amount is 1 lakh. The revalued amount is 1,50,000. So 50,000 is the increase in the value of asset. What is the entry? PPE account debit to pre-acquisition profits, which is a capital profit, 50,000, 50,000. Okay. This 50,000 is what? Capital profit in step number 3. And in step number 4, it will be apportioned between the parent and minority interest. Okay. But if there is an upward revaluation, there is an increase in the value of asset. Because of that increase, there is an additional depreciation will come in future. That is going to impact my post-acquisition profits. Subsidiary company post-acquisition profits will also be affected by the upward revaluation. That is also we need to consider. Suppose if there is a downward revaluation, asset value decreases now. If there is asset value decreases, whatever the excess depreciation we already recognized, we need to add back so that my pre-acquisition profits of the subsidiary company will increase. Right? For example, here in this case, you see the revalued amount is 1,50,000. That means 50,000 increase in the value of the asset.
Suppose 10% is the rate of depreciation, which gives me 5,000 additional depreciation. This additional depreciation is decreases my post-acquisition profits. So whenever you are analyzing the subsidiary company reserves and surplus, so if there is any revaluation of assets, understand whether the revaluation is upward or downward revaluation. If it is an upward revaluation, capital profit. And because of that, additional depreciation will come, that is going to reduce my post-acquisition profits. And if there is a downward revaluation, there is a pre-acquisition loss, which is a capital loss. And because of that, whatever the additional depreciation I already booked, that I need to add back so that my post-acquisition profits will increase. Okay. So this is one adjustment, sir, revaluation of assets and liabilities. Next adjustment, dividend given by subsidiary company. Dividend, important adjustment, please carefully observe. Sir, in the question, in the consolidation question, whenever they have given that subsidiary company has given a dividend, subsidiary company will give dividend to whom, sir? Its shareholders. Who are the shareholders of subsidiary company? Parent, minority interest, right? Parent company, minority interest. Two shareholders, parent company as well as minority interest. Now, if dividend is given by the subsidiary company from pre-acquisition profits, as a parent company, what I need to do is my share of dividend, which I am going to receive from the subsidiary, and the dividend is given from pre-acquisition profit. Pre-acquisition profits are capital profits. So whatever the dividend I received, okay, that is pre-acquisition dividend, which is of capital nature, capital profit nature, I need to adjust to the cost of investment. So that's why it is adjusted to the cost of investment. The entry is bank account data to investment account. Suppose if subsidiary company has given a dividend from post-acquisition profit. So as a parent company, my share in the dividend of the subsidiary company, which is given from post-acquisition profit, I will credit to P&L account. In step number 8, reserves for consolidated balance sheet is there now. In the P&L account balance, already in the parent company reserves and surplus, if this dividend is already created, no need to do separate adjustment. Suppose if you are not done, then when you are preparing the consolidated balance sheet, step number 8, when you are preparing reserves for consolidated balance sheet, for that this dividend will be added. So simple formula, simple way to remember, sir. Dividend is given from which source? By the subsidiary company. Is it given from pre-acquisition profits, post-acquisition profits? Pre-acquisition profits or capital profits adjusted to the cost of investment. Post-acquisition profits or revenue profit created to P&L account. See, this is not a new point, sir. This point is already covered in accounting standard 13. Even accounting standard 13 also tell you the same thing. When you receive something, when you receive dividend, if it is of capital nature, obviously it has to be adjusted to the cost of investment. So when you receive something of profit, capital nature, it has to be adjusted to the cost of investment. And sometimes what happens, sir, is subsidiary company will give you dividends, sir, from pre-acquisition profits. In the question also they will mention, sir, subsidiary company has given a dividend and the dividend is given from pre-acquisition profit. But what parent company will do is, instead of adjusting to the cost of investment, they will credit to P&L account. They will do the wrong accounting treatment. Okay, then you need to rectify this. How you are going to rectify, sir? Actually, when you receive a dividend from pre-acquisition profit, it is a capital nature profit, so it is adjusted to the cost of investment. So the entry is bank account data to investment. But as a parent company, what you have done? You have created to P&L account. Now you rectify it. How you are going to rectify, sir? Simple. P&L account you already created, debit it. Investment account you need to credit, so credit now. Okay. Because see, I told you when you're doing step number 6, when you're calculating cost of control, say this one, any pre-acquisition dividend is adjusted from cost of investment. But sometimes what happens is they have wrongly created to P&L account, that we need to rectify it. So this is relating to dividends, sir. Okay. So revaluation of assets and liabilities as well as dividend adjustment I told you. And another important thing in case of consolidated financial statements is step number 7, intercompany transactions. What is this intercompany or intra-group transactions? Important, sir. Listen to me carefully. See, between parent company and subsidiary company, some transactions will take place. That is very natural. Maybe sale of goods, purchase of goods, these things. There are two types of transactions, sir. Downstream, upstream. What is downstream transaction? See, downstream transaction means parent company sold goods to subsidiary because subsidiary is below the parent, so it is called downstream. Sir, suppose when parent company sold goods to subsidiary company, profit is recognized in the books of parent company. Suppose the cost is 100, they sold at a profit of 20, so 120. So 20 rupees profit is recognized in the books of parent company. Now this stock is there with the subsidiary company which is unsold. 120. Now tell me, now we are preparing a consolidated balance sheet of the parent. See, this profit of 20 which is already recognized in the parent books, is this profit realized? No, this is unrealized profit because stock not went outside, it is not yet sold. Therefore, whatever the profit not realized, we need to eliminate this because now parent and subsidiary is treated as one economic entity. I can't recognize profit when I sold goods to myself, right? So A Limited sold goods to B Limited, recognized a profit of 20. Now A and B, by treating it as one entity, we are recognizing preparing the financial statements. So this 20 rupees profit already you recognize, is it realized? No, because the stock was within the group only, it is not sold. Therefore, this unrealized profit we need to eliminate. Eliminate this unrealized profit. From where? It is booked in which company profits? A Limited profit. So from the A Limited reserves P&L account, eliminate this profit. So that's why in step number 8, when you are preparing the consolidated balance sheet, if it's a downstream transaction, so what we need to do is from the parent company reserves, this unrealized profit has to be eliminated completely. See this in step number 8, I will show you. Reserves for unrealized profit created, we need to eliminate. And also here also I have given downstream means parent company sold goods to subsidiary. That means the profit is recognized in the subsidiary company books, in the parent company books. So entire profit has to be eliminated from the parent company. Unrealized profit. Sir, suppose goods sold 120, sir. Out of 120, subsidiary company sold 60. Only 60 is unsold. So therefore, in this unsold inventory, what is the unrealized profit? 10 only, na? Because the total profit is 20 for 100. In this 120, 20 rupees is the profit. If 60 is sold, 10 rupees profit realized. So realized profit, no need to cancel. Only unrealized profit we need to cancel. So unrealized profit is 10. So from the parent company P&L account, we need to eliminate 10. And also inventory value is reduced by this unrealized profit. When you are preparing the consolidated balance sheet, inventory 120 minus unrealized profit 20, 100 only you need to show. Suppose 60 worth of inventory sold, remaining unsold 60 is our closing. In this unrealized profit is 10, so 50 inventory we need to show. So the conclusion is what? Downstream transaction. Downstream transaction means what? Parent company sold goods to subsidiary company. When parent company sold goods to subsidiary company, who recognized the profit? Parent company. And if that stock is not yet sold, in that stock, whatever the unrealized profit is there, that unrealized profit we need to eliminate. From which company books? Parent company books. Where? In step number 8. Okay. And also inventory is to be, from inventory value, we need to deduct unrealized profit. Because inventory value has to be shown at cost. And there is one more kind of transaction, that is upstream transaction. What is this upstream transaction? Upstream transaction means subsidiary company sold goods to parent company, sir. Subsidiary sold goods to parent company here. Subsidiary sold goods to parent. Imagine, sir, this is the question. Suppose B Limited is the subsidiary company, sold goods to A Limited. Same cost, 100 rupees cost of goods at a profit of 20, sold for 120. So in the books of B Limited, the profit was recognized here. Because when subsidiary company sold goods to subsidiary parent company, who recognized the profit? Subsidiary. So 20 rupees profit is there with whom? Subsidiary. Now, out of the stock they sold, total stock remains unsold. Now consolidation happening. Tell me what you do. So stock is within the group only. So this 20 rupees profit not yet realized. So this has to be eliminated. But this profit is already there in whose books? Subsidiary company books. Already apportioned. Already analyzed and apportioned between the parent and minority interest. Therefore, this unrealized profit of 20 already we have apportioned, and we have already apportioned to the parent company H Limited and also minority interest. Therefore, we need to eliminate from the parent company reserves 16 their share, minority shareholders interest 4 their share we need to eliminate. This is very, very interesting. So if it is an upstream transaction, who is selling the goods? Subsidiary. That means who recognized the profit? Subsidiary. So subsidiary company profits who shared? Parent and minority interest. Therefore, this profit not yet realized, we need to eliminate. From where we will eliminate? Already subsidiary company profits are apportioned between the parent and minority interest. So eliminate from both of them. That's why, see, in step number 8, when you are preparing the reserves for consolidated balance sheet, we have done this. See this. Reserves for consolidated balance sheet. See this. Reserve for unrealized profit we created. Unrealized profit. Any unrealized profit. If it is downstream, 100% of the unrealized profit is there in the parent company books, eliminate. If it is a if it is a downstream, if it is an upstream, since goods sold by subsidiary to the parent, so in the subsidiary company, whatever the profit is there, in that profit, what as a parent company, what is my share, that has to be eliminated. And minority interest share, minority shareholders share, see this, less stock reserve, that means unrealized profit, it is to be eliminated from them. When only upstream, only in case of upstream transaction, minority interest, their share in the unrealized profit has to be eliminated. Sir, why can't we do it in downstream? Come on here, in downstream, who sold the goods? Parent. Therefore, the profit entirely is in whose books? Parent company books. Therefore, we eliminate completely from the parent. In case of upstream, who earned the profit? Subsidiary. Subsidiary profits belongs to whom? Their shareholders. Who are the shareholders? Parent and minority interest. Already, if you do the apportionment, then eliminate. Sir, when you are analyzing the profits itself, what I have done is, from the subsidiary company reserves, I eliminated this unrealized profit and I analyzed it. Then in such a situation, separately, it is not required to deduct. Hope you guys understanding what I am speaking. So that is what they have done. See this, in case of upstream transaction, if you see, subsidiary company sold goods to parent, unrealized profit must be eliminated from the asset 100%. From the stock, we need to eliminate unrealized profit 100%. And when it comes to this, adjusted against parent company reserves, their share in step number 8, not 7, sir. Here 8, step number 8. And minority interest share in step number 5, we need to eliminate. I explained the logic also. So this is upstream, downstream transactions, sir. So 3 important adjustments we have covered, sir. So what are the 3 important adjustments? Whenever consolidation of subsidiary is happening, in the subsidiary company, any assets and liabilities, any assets may be revalued, sir. So these revaluation profits or losses are capital profits, capital losses. And if it is a capital profit, because of the increase in the asset value, in future additional depreciation will come. That is going to reduce my post-acquisition profits. And if there is a downward revaluation, because of that, there is a capital loss for me. Because of that, whatever the excess depreciation I provide, I need to add back. That is one adjustment I told you. And second adjustment, I told you dividend. Whenever dividend given by the subsidiary company to its shareholders, I mean parent and minority interest, dividend is given from which source? Pre, post. If its dividend is given from pre-acquisition profits, as a parent company, I need to adjust to the cost of investment. If dividend is given from post-acquisition profit, as a parent company, my share I will credit to P&L account. But sometimes what they will do in the question is, dividend given by the subsidiary company from pre-acquisition profits, but as a parent company, what I done is, instead of adjusting to the cost of investment, I credited to P&L account. Now I need to pass a rectification entry. So that is what I have given here also. See this, in step number 8, less dividend received from subsidiary out of the pre-acquisition profits transferred to investment account. See this, dividend received from subsidiary out of pre-acquisition profits transferred to investment account. Wrongly they credited to P&L account. Now we are reducing. Since because it has to be adjusted to the cost of investment, but it is created to P&L account, now we reduced it. Okay, that's it, sir. So these are the adjustment, and upstream, downstream transactions also I have explained. So now what I'm going to do is, I'm going to consider one more problem and I will solve, sir, so that you will understand these concepts better. So let us come to illustration number 13, sir. Illustration number 13 we are going to solve. They have given balance sheets of H and its subsidiary S Limited, sir, as on 31st March 2011, and they are asking us to prepare the consolidated balance sheet. First thing, they have given reserves and P&L account of subsidiary company 25,000, 15,000 respectively on the date of acquisition of its 80% shares by H Limited on 1st April 2010. So date of acquisition 1st April 2010. On that date, in the subsidiary company, reserves 25,000, P&L account 15,000 is there. 80% of the control acquired. Okay. Next, one of the most important point of this problem is revaluation of assets. Here you see machinery book value 1 lakh, furniture book value 20,000 of S Limited subsidiary company were revalued at 1 lakh 50, 15,000 respectively on 1st April 2010. That means on the date of acquisition, subsidiary company assets were revalued, sir, for the purpose of fixing the price of its shares. Okay. And they have given rates of depreciation, machinery 10%, furniture 15%. I told you, sir, when you are analyzing the subsidiary company reserves and surplus, if there is any revaluation happened to any of the assets of the subsidiary company, that revaluation profit or loss is treated as what? Pre-acquisition profits or pre-acquisition losses, that is capital profit or capital loss. And if there is a upward revaluation, additional depreciation is come, which will affect the post-acquisition profit. If there is a downward revaluation, whatever the excess depreciation you provided, you need to add back to your post-acquisition profits. So you see here, machinery book value 1 lakh, revalue to 1,50,000. So therefore, there is a revaluation profit of 50k, which is nothing but pre-acquisition profit, nothing but capital profit, which we need to analyze and then apportion to the shareholders of the subsidiary company, which is parent company and minority interest. This is in respect of machinery. When it comes to furniture, sir, book value 20, revalue to 15. So there is a revaluation loss of 5,000, which is a capital loss, which is also nothing but, pre-acquisition loss, which is a capital loss, which is also analyzed and apportioned between the shareholders of the subsidiary company. So when you are analyzing, you need to consider that. And one important point, sir, since the machinery value has been increased by 50,000, because of that additional depreciation will come. How much additional depreciation will come? 50,000 into 10%, 5,000 will be the additional depreciation, which will reduce my post-acquisition profits. And also here you see furniture 5,000 reduced. Now excess depreciation you provided on this 5,000, 15% depreciation, 750 is the excess depreciation you provided, which will reduces my profit. So now I need to reverse back. I need to add back to my post-acquisition profit 750. I need to reduce additional depreciation of 5,000, add back 750, so that I will get the revised post-acquisition profits, which are revenue profits, which is analyzed and apportioned between the parent and minority interest. Okay. And they have given the balance sheet of the parent company, subsidiary company. Share capital, reserves and surplus, trade payables, asset side, non-current assets, property, plant, equipment, other current investments. So these are the details they have given, sir. Now they are asking us to prepare the consolidated balance sheet. Now tell me how you are going to approach this consolidated P&L account. First, you are going to start with what? Date of acquisition. So first you take the date of acquisition. What is the date of acquisition here? 1st April 2011. Very simple, given in the question. Second step is what? Shareholding pattern on the date of acquisition, on the date of consolidation, on the date of consolidation. So on the date of consolidation in the subsidiary company, H Limited is having how much? 80% directly given in the question. So therefore minority interest is how much? 20%, which will help you to apportion the analyzed profits of the subsidiary company. So step number 2 is done. The most important step is step number 3, that is analysis of reserves and surplus of S Limited. So I need to analyze the subsidiary company reserves and surplus. First analysis I have to do it is revaluation profit. So here there is a revaluation profit or loss. This is what I need to analyze first. Machinery, we already calculated, there is a revaluation profit of 50,000. Revaluation profit or revaluation loss. And in respect of furniture, there is a revaluation loss of 5,000. So overall 45,000 is what, sir? My revaluation profit, net revaluation profit, which is pre-acquisition profits, which is nothing but capital profit. This is one profit we have to analyze. Coming to other reserves and surplus, sir. In the balance sheet, you see in the subsidiary company, we have a reserves and surplus, note number 2, general reserve 75, P&L account 25. Let us try to analyze both. First, general reserve 75,000 is there. Take general reserve. General reserve on 31st March 2012. How much? 75. And opening on the date of acquisition, they have given the balance. On the date of acquisition, what is the balance in general reserve, sir? 25,000. So on 1st April 2011, 10,000 is there. 25,000, not 10, 25k. $25,000. So obviously this is what? Pre-acquisition profit, which is nothing but capital profit. What is the remaining profit of the current year? 11, 12. Remaining balance 75 minus 25, it will be 50,000. Balancing figure. So entire this profit is what, sir? Post acquisition profit. Because here acquisition happened on 1st April 2010. So whatever the profit earned in the subsidiary 11-12, it is entirely post acquisition profit, which is nothing but revenue reserve, because I am analyzing general reserve. And now come to the most important P&L account, sir. Another reserve of the subsidiary company. You see the P&L account of the subsidiary company, sir. The P&L account is 25,000 is there. This 25,000 is on 31st March 2012. And if I make an analysis on 1/4/2011 at the beginning, so what is the P&L account balance given in the question, sir? P&L account balance is 15,000. So entire this 15,000 is what, sir? Pre-acquisition profits, which is nothing but capital profits, right? Very simple. Next, tell me what will be your current year profit 11-12. 25, opening is 15, so 10,000 is the current year profit. But to this we need to make some adjustment. What are the adjustment? Less additional depreciation we need to provide. Additional depreciation. How much additional depreciation, sir? Machinery value increased by 50,000. Because of that, 10%, that means 5,000 depreciation will come in future, which will reduce my post acquisition profit. So it has to be deducted. And also whatever the excess depreciation I provided on furniture. Furniture actually 20,000, but it is revalued to 15,000. So I might have provided depreciation on 20,000. So on this 5,000 balance, I provide 15% depreciation. So which is 750. Now I need to add back. So 10,000 minus 5,000 plus 750. So it will be 5,750. Can you tell me what is this? This is my post acquisition profits, which is nothing but revenue profit, because I am analyzing P&L account. When you are analyzing the P&L account, the post acquisition profits are called revenue profits. When you are analyzing the general reserve, the post acquisition profits are called revenue reserves. So I think I have analyzed them properly, sir. Overall, if you see what will be my capital profit overall, if I add, my capital profit will be, see this, relating to revaluation, whatever the thing generated, entirely it is a capital profit, pre-acquisition profit, 45,000. And in general reserve, you see, in general reserve, the capital profit is 25K. 25K. And in the P&L account, the capital profit is 15,000. So 45 plus 25 plus 15,000. So total it will be 85,000 is my capital profit. And when it comes to revenue reserve, because I have analyzed general reserve. General reserve, the revenue reserve is how much? 50K. So 50K. And when it comes to revenue profit, post acquisition profit, it is 5,750. I think this is my analysis. I will show you how detailed I have solved in the classroom. See, this classroom I have solved like this. Revaluation reserves, machinery 50K, furniture minus 5,000 because there is a revaluation loss, entirely 45,000 pre-acquisition profit, capital profit. General reserve, you see 75, opening balance 25 is the pre-acquisition profits, capital profits. Balance is nothing but current year post-acquisition profit, revenue reserve. When it comes to P&L, the most important, the opening entirely pre-acquisition profits, capital profits. Current year profit 10,000. And because of the revaluation of the machinery, additional depreciation 5,000, excess depreciation you provided on furniture 750. So 5,750 is the post acquisition profit. So I have analyzed the reserves and surplus of the subsidiary company properly. Once you analyzed what, then apportionment. Then you have to apportion this. So once you got the analysis properly, sir, then apportion, sir. How you are going to analyze, sir? Simple. Pre-acquisition profits, which are capital profits. Post-acquisition profits, which are revenue reserves, revenue profit. Now, when it comes to first, what are the reserves? You see, revaluation profit, entire 45,000 capital profit. And next, general reserve. In general reserve, 25,000 is the capital profit, and remaining 50,000 is revenue reserve. When it comes to P&L account, in P&L account, the pre-acquisition profit is 15, which is a capital profit, and remaining is revenue profit, which is 5,750. See this, I have divided. Now I will make a total. So capital profit entirely 85,000. This is 50 and this is 5,750. Now you apportion this. Apportion between whom? Parent company H Limited, which is, I think they are having 80%. Minority interest 20%. Share between them 85,000 into 80%, it will be 68,000. 20%, it will be 17,000. So parent company share in the pre-acquisition profits of the subsidiary 68, minority shareholder share 17,000. And parent company 50,000 into 80%, it will be 40,000 here, 10,000 here. And 5,750, 80%, 4,600 here, 1,150 here. So I'll share it. Now I told you that once you made an apportionment, sir, parent company share in the pre-acquisition profits of subsidiary company, what we need to do? Step number 6, cost of control, we will use this. Parent company share in the post-acquisition profits of the subsidiary company will add it to its reserves in step number 8. Parent company share in the post-acquisition profits of subsidiary company. And this minority interest share entirely will go to step number 5, minority interest. That's it. So now calculate minority interest. Very simple, minority interest. So minority interest, how you are going to calculate? I told you the logic also. Minority interest here is 20%. Minority shareholders share in the net assets of the subsidiary company. So in the subsidiary company, what is the total share capital? The share capital of the subsidiary company is 1 lakh, right? 1 lakh. In this 1 lakh, 20% belongs to minority shareholders. Because here I am net assets I am ascertaining by share capital plus reserves and surplus into minority shareholders share. So share capital 1 lakh. In this 1 lakh, 20% belongs to minority interest. And also net assets, reserves and surplus. The reserves and surplus already analyzed and apportioned between the minority interest. So from step number 4, you take capital profit, step number 4, minority shareholder share, 17,000. Revenue reserve from step number 4, minority interest share, 10,000. And also revenue profit, step number 4, 1,150. Correct? Yes. This is 80,000. So I got minority interest. You see, 80,000 plus 17,000 plus 10,000 plus 1,150. So 1,08,150 is the minority interest. 1,08,150 is the minority interest. Oh, on small mistakes, sir. I think here 20,000 I need to consider. I considered 80. Sorry, 20. So calculation mistake. 20 plus 17 plus 10 plus 1,150. I think 48,150. Correct? 48,150. Done. So I got the minority interest, which I will show in the consolidated balance sheet. And another most important step is what, sir? Cost of control step. How to calculate cost of control? Cost of investment you take. What is the cost of investment, sir? Look at the balance sheet. Parent company balance sheet, asset side. Investment in shares of S Limited 4,40,000. Consider it. And any pre-acquisition dividend? Nothing. No dividend. And what is the parent company share? H Limited share in net assets of S Limited subsidiary company on the date of acquisition represented by share capital. What is the share capital of the subsidiary company? 1 lakh. In that, how much is the share acquired? 80%. And also on the date of acquisition, whatever the profits are there in the subsidiary, they're all pre-acquisition profits. So in this pre-acquisition profits from step number 4, consider what is the parent company share, which I already written. Step number 6, 68,000. 68. And this is 80. So this is the parent company share in the net assets, 80,000 plus 68. So total it is 1,48,000. So 1,48,000 is the share in the net assets of the parent company. But we are investing 4,40,000. So therefore, how much excess we are investing? 2,92,000. This 2,92,000. Sir, 1 minute, sir. Here, what is the cost of investment? 6 shares in S Limited, 1,60,000, sir, not 4,40,000 by my mistake. Yeah, I think I have considered another wrong item. The question they have clearly mentioned the cost of investment. See carefully. Shares in S Limited, we invested 1.6. So we need to take here 1.6. Yes. So 1.6 and Our share in the net assets 148. 160 minus 148, sir. I think we got 12,000, sir, which is what? Cost of control, goodwill, which will be shown in the consolidated balance sheet. You see here, 12,000. Intercompany owings, nothing. And the next one, reserves for consolidated balance sheet. So how much is the reserves you need to consider for consolidated balance sheet? This is important. Reserves for consolidated balance sheet. See, as a parent company H Limited, what are your reserves balance? You see, you have two reserves, general reserve, P&L account. What is the balance you had in the general reserve and P&L account? Parent company, not subsidiary. We are okay. So as a parent company, general reserve 2 lakhs, sir. P&L account 1 lakh, correct? 2 lakhs, 1 lakh. Consider it. 2 lakhs, 1 lakh. Now to this, what is the parent company share in post acquisition profits of subsidiary company? Post acquisition profits, parent company share, that means H Limited share in post acquisition profits of S Limited, which we already calculated in step number 4. You see, in step number 4 I have written what is the parent company share in the post acquisition profit? 40,000, 4,600. So 40,000 will be added to revenue reserve, which is added to our general reserve. 40,000, 4,600. Okay, 40,000 we need to add, and this is 4,600 I will add. Any other adjustment I need to do to my reserves for consolidated balance sheet? Any dividend received wrongly credited to P&L account? Nothing. Any unrealized profit? Any transactions between parent subsidiary? Nothing. I think the consolidated reserves is 2,40,000 general reserve, 1,04,600 P&L account. Yes, see this 2,40,000, 1,04,600. Done. So machinery for consolidated reserves for consolidated balance sheet also came. Now you need to prepare the consolidated balance sheet. So when you are preparing the consolidated balance sheet, I told you now, assets and liabilities, line by line addition. Reserves, already step number 8, reserves for consolidated balance sheet we need to take. Share capital, only parent company share capital I need to consider. You see this. When it comes to share capital, sir, note number 1, you see 6,000 shares of 100 is fully paid, 6 lakhs, which is the parent company. See this, parent company share capital we need to consider. Only parent company. Next, when it comes to reserves and surplus, sir, we already done in step number 8, reserves for consolidated balance sheet. I think general reserve as well as P&L account. You see, we got it. General reserve, how much we got? 2,40,000. Revenue reserve 1,64,600. 1,04,600. P&L account, nothing but. So if you see, general reserve 2,40,000. P&L account 1,04,600. So total 3,44,600 we got it. Next, minority interest we need to show. We got it. Minority interest. How much we got? This minority interest 48,150. So which got it. Next, trade current liabilities, line by line addition. See this current liability is 1,50,57. Total 2,07,000. Got it. Next, coming to asset side, non-current assets, property, plant, equipment, line by line addition. Property, plant, equipment. Here assets were revalued. Machinery in the parent company 3 lakhs. From the subsidiary company, you have to be very careful here. When it comes to machinery, see this. In the parent company, the balance is 3 lakhs, sir. In the subsidiary company, the machinery was revalued to 1.5. Current year depreciation is 15,000. Total depreciation I need to minus. So the book value is 135. So therefore, parent company value 3 lakhs plus subsidiary company 1,50,000 revalued amount minus current year depreciation. It will be 4,35,000. Machinery balance 4,35,000 we need to show, sir. Coming to furniture, sir, parent company 1,50,000. Subsidiary company, sir. Subsidiary company we revalue to 15,000 and depreciation for the current year on this 15,000. I think 15% depreciation, 2,255 reduce. The remaining balance will be the WDV, right? WDV. So whenever you are showing the asset value, parent company assets plus subsidiary company assets. But when you are showing the subsidiary company assets, if the subsidiary companies are revalued, you need to consider the revalued figure minus depreciation. And then you will get the WDV. Both will be added. So it will be 157,750. So if you look at the balance sheet, 157,750. Next, intangible assets, we got goodwill now. Goodwill we got. Cost of control step, we got 12,000 goodwill. Show this goodwill here, 12,000. Other current investments. See, actually, non-current investments 4 lakh 40, 1 lakh 50. Investment in shares of S Limited will not come. I told you. So 4 lakh 40 plus 1 lakh 50. So total 5 lakh 90,000. That's it. So this is how the balance sheet of the consolidated balance sheet will be prepared, sir. Assets and liabilities will be added, reserves will be analyzed, and parent company share in the pre-acquisition profit will be adjusted to the will be considered in step number 6. Parent company share in the post-acquisition profits will be added to step number 8, consolidated reserves, and minority interest share will be considered in minority interest. And in this question, why I have selected this question? Because this type of questions they are asking in the examinations are mainly testing the revaluation concept. Okay, that's it. Now what I'm going to do is I'm going to solve some small questions relating to consolidations. Illustration number 1 from ICI study material in consolidation chapter, sir. See this question. In this question they are asking determine in each case minority interest at the date of acquisition, at the date of consolidation, goodwill or capital reserve. So minority interest, step number 5, sir. Goodwill or capital reserve, cost of control step number 6, we need to calculate cost of control. This is minority interest. And what is the amount of holding company profit in the consolidated balance sheet, assuming holding company's own P&L account be 2 lakhs in each case. That means reserves for consolidated balance sheet, step number 8. Parent company P&L account balance given. What is the parent company share in the post-acquisition profits of the subsidiary company, that you will add, then you will get the consolidated reserves. Okay. There are 4 cases they have given, sir. Case 1, 2, 3, 4. So determine for each case these 3 things. Okay. The first case, the subsidiary company is A. Second case B. Third C. Fourth D. Okay. Percentage of shares owned. Parent company owned 90%. That means minority interest in the first case 10%. In the second case 15%. Third case 20%. Last case nil. Okay. First I need to find out minority interest on the date of acquisition, on the date of consolidation. Minority interest is nothing but what? Minority shareholders share in the net assets of the subsidiary company. Net assets means assets minus liabilities or share capital plus reserves and surplus. Here see, on the date of acquisition, the share capital, the P&L account given. So therefore if you add these two, you will get what? Net assets 1,50,000, right? 1,50,000 into 10%. So 15,000 is the minority interest on the date of acquisition. On the date of consolidation, 1 lakh plus 70,000. So on the date of consolidation, 1 lakh plus 70, 1,70,000 into 10%. So 17,000 is the minority interest. So 15, 17. Similarly, in case of case 2, you see opening net assets 1,30,000 into 15%. So 1 lakh 19,500. 19,500, sir. In this case, 19,500. Similarly, at the end, 1,20,000 is the net assets. 1,20,000 into 15%. It will be 18,000. So like this, you need to do. In the last case, you see the minority interest is nil. So therefore, it will not come on the date of acquisition, consolidation. In both the cases, there is no minority interest. So this is the first bit, sir. You see here, 15, 17, 19,500, 18,000, and in case number 3, 14, 14, last case nil. Okay. Now calculation of goodwill or capital reserve. How to calculate goodwill or capital reserve? Cost of control step. First you need to take the cost of investment. So cost of investment you take in first case, cost of investment. What is the cost of investment? They have given in the question. See this, 1,40,000. And you need to compare this with the what is the parent company share in the net assets of the subsidiary company on the date of acquisition. So here parent share in net assets, okay, on the date of acquisition. So on the date of acquisition, what is the share capital of the subsidiary company? 1 lakh, sir. In this 90% share, and also opening P&L account balance is how much? 50,000. In this 90%, sir. So 1,50,000 into 90%, that is 135. So therefore 5,000 is the excess amount, which is goodwill. So in first case we got goodwill, sir. First case we got goodwill 5,000. So you see this. Okay. Second case, sir, your cost of investment is 1,04,000 and share in the net assets 1,30,000 into 85%, 1,10,500. So second case, if you observe, sir, in case number 2, the cost of investment is 1,04,000, sir. 1,04,000. And what is the share of the parent company in the net assets? 1,30,000 is the net assets. On that, the share is 85%, correct? Parent company share, 85. So 1,30,000 into 85%, it is 1,10,500. See, this time you see, you invested 1,40,000, so share in the net assets 1,10,500. So therefore, the balance is capital reserves. 1,10,500 minus 1,04,000. So it will be 6,500. This is capital reserve. Second case, we got capital reserves are 6,500. See this capital reserve 6,500. And in third case, if you see, cost of investment is 56,000. Okay. Net assets at the beginning 70 into 80%. 56. So 56,000. That means share in the net assets 56,000, cost of investment is also 56,000. So goodwill or capital reserve nil in this case. Third case, goodwill or capital reserve is nil because both are same. And the last case you see, case number 4, your cost of investment is 1 lakh. At the beginning, the net assets is 90,000. So 1 lakh minus 90, 10,000 is the goodwill. So goodwill 10,000. So we have done cost of control step also. Third step, reserves for consolidated balance sheet. You know, in the every case, what is the parent company reserves, sir? Reserves balance they have given. Parent company P&L account balance. I think 1 lakh they have given and 2 lakhs in each case. So each case 2 lakhs, sir. Okay. Now to this, what we need to add, I told you, if you want to find out the consolidated reserves of the parent company, you need to add parent company share in the post-acquisition profits of subsidiary company. Now in case number 1, you see, what is the opening P&L? 50. What is the closing P&L? 70. Suppose the acquisition happened at the beginning of the year. Date of acquisition is this one, 1/1/2011. So that means this 50,000 is what? Capital profit. But closing P&L account is how much? 70. So if I make an analysis, 70,000, 50,000 is opening, 20,000 is the current year profit. The entire current year profit is what? Revenue profit. In this revenue profit of 20,000, what is the parent company share? 90%. So 18,000. So here we need to add 18,000. That is parent company share in the post-acquisition profits of subsidiary company. So parent share in post-acquisition profits, post-acquisition profits of subsidiary company, 18,000. So 2,18,000 is the consolidated reserves in case number 1. Say this, 2,18,000. Now come to case number 2, sir. Case number 2, if you observe, sir, opening P&L account 30,000, entirely capital profits, pre-acquisition profits. Closing P&L how much, sir? 20. That means current year there was a loss of 10,000. That's a post-acquisition loss. So in the 10,000, parent company share is how much? 85%. 8,500 we need to deduct. So from this 2 lakhs, I need to deduct 8,500. Yeah, 8,500. It will be 1,91,500. Okay. Sir, when subsidiary company profits are apportioned, losses will also be apportioned automatically. Now case number 3 you see. Opening P&L 20. Closing P&L account also 20. That means current year there is no profit, no post-acquisition profit. So therefore nothing will be added. Entire 2 lakhs will be the balance. Same balance, parent company balance only will continue. Because from subsidiary company profits, no share belongs to parent company because in the current year there is no post-acquisition profit. And the last case you come, sir, opening P&L account is how much, sir? 40. Closing P&L account 15. That means 15,000 increase, sir. This entire 15,000 belongs to parent company only because entire share 100% is held by parent company. So parent company share in the post-acquisition profits 15,000 will be added to this. So 2,50,000. That's it. This is how question number 1 is solved, sir. Sir, why I selected this question? Because this question covers 3 steps, sir. So I want to revise all these steps once again to you. That's why I have solved illustration number 1. Next. One more illustration I am going to solve is illustration number 3, sir.
from ICA study material. See, in this question, they are asking us to calculate what? The amount of goodwill or capital reserve on acquisition of shares of Z Limited. In consolidation, the goodwill or capital reserve is ascertained through cost of control step. These type of questions, there is a possibility that they may ask for 5 marks. See the facts of the question carefully. There is a company X Limited which acquired 70% equity shares of Z Limited. So X Limited is parent company, Z Limited is a subsidiary because 70% equity shares were acquired on 31st March 2011. So date of acquisition is 31st March 2011 at a cost of 70 lakhs. So cost of 70 lakhs. Cost of investment 70 lakhs. Following information is available from the balance sheet of Z Limited on 31st March 2011, rupees in lakhs. You see, in the subsidiary company on the date of acquisition, the assets and liabilities given: property, plant, equipment, investments, current assets, loans and advances, current assets, current liabilities. The following revaluations have been agreed upon. Some revaluations happened in the subsidiary company books. Property, plant, equipment up by 20%, investments down by 10%. So property, plant, equipment 20% upward revaluation, investments 10% downward revaluation. Okay. Next, what happened? Z Limited, the subsidiary company, declared and paid a dividend at 20% on equity shares on 31st March 2011, face value 10 per share. Sir, our subsidiary company has given a dividend, sir. When you acquired a subsidiary company on 31st March 2011, on 31st March 2011, subsidiary company declared dividend. That means the dividend relating to the last year was declared. Obviously, last year you don't have shares. So definitely dividend is given from which profits? Pre-acquisition profits. Because I told you, by the time you are acquiring the subsidiary company, whatever the profits are there in the subsidiary company, they're all pre-acquisition profits. So dividend is given from pre-acquisition profits. Therefore, the pre-acquisition dividend, generally the parent company share in the dividend, which is received from pre-acquisition profits of the subsidiary company. What we need to do? We need to adjust to the cost of investment. So that is what we need to do. Okay. Next, X Limited purchased the shares of Z Limited at 20 per share. Okay, so each share is purchased at 20 per share. Now you tell me how you are going to calculate goodwill or capital reserve here. Simple. Recollect what we have done in the cost of control step. In cost of control step, if you remember, first we need to take the cost of investment. Here, what is the cost of investment? At 70 lakhs. So 70 lakhs is the cost of investment. From this, I need to reduce first pre-acquisition dividend. Pre-acquisition dividend. So pre-acquisition dividend, because pre-acquisition dividend is adjusted from cost of investment. What is the amount of dividend we received, sir? Actually, they have given the rate of dividend 20%. Face value of the share 10. They have given face value of the share 10. So how to find out the dividend here? Very simple. How much is the amount you spent? 70 lakhs. Each share purchased at 20. So 70 lakhs divided by 20. You will get the number of shares purchased. That is 3,50,000 into each share 10 rupees. And the rate of dividend is how much, sir? 20% into 20%. So the dividend is 7 lakhs. Pre-acquisition dividend 7 lakhs. Now 63 lakhs will be what? Adjusted cost of investment. Now in cost of control step, what we need to do? We need to compare the cost of investment with the parent company share, that is X Limited share in net assets of subsidiary company, that is Z Limited, represented by what? Represented by net assets. I mean, parent company share in the net assets of subsidiary company, represented by share capital, pre-acquisition profits. But the specialty of this question is, in this question, they have given subsidiary company assets and liabilities. Net assets can be ascertained in two ways. Generally, we will follow the approach of share capital plus reserves and surplus. But here we don't know the share capital and reserves and surplus. But we know net assets can be ascertained like this: assets minus liabilities. So here assets given, liabilities given. So take it. But when you considering the assets, consider the revalued amounts. For example, PPE 120 plus 20% upward. So it is 144. Investments 55 minus 10. So it will be 49.5. Current assets same 70. Loans and advances 15. So these are all assets. So 144 plus 49.5 plus 70 plus 15. So it will be 278.5 minus liabilities 90, 50. Minus 90, minus 50. So therefore 138.5, sir. What is that? Net assets is 138.5. In this net assets, what is the share of the parent company? 70%. 70%.
138.5 into 70%. So 96.95. That is nothing but, so 96 lakhs 95,000. So therefore you see, what is the cost of investment? 63 lakhs. But what is the share in the net assets you are getting? 96 lakhs 95,000. So therefore, how much is the difference? 33 lakhs 95,000 is your capital reserve. Capital reserve. So your cost of investment is less than the share of net assets you are getting. So the answer is 33 lakhs 95,000. 33 lakhs 95,000. See this. 33 lakh 95,000 is the capital reserve. We got it. So this is one question, sir. Illustration number 3. One more important question from consolidation chapter, sir. Illustration number 4 from ICAI study material. The major focus in this question is calculation of minority interest. See the facts of the question, sir. There is a company A Limited which acquired 70% equity shares of B Limited. So A Limited is what, sir? Parent company. B Limited is the subsidiary company. And parent company had 70% shares in B Limited on 1/4/2011. So this is the date of acquisition at a cost of 10 lakhs. So cost of investment is 10 lakhs. When B Limited had equity share capital of 10 lakhs, reserves and surplus of 80,000. On the date of acquisition, the share capital 10 lakhs, reserves and surplus 80. So that means the net assets of the subsidiary company is 10.8 lakhs. On the date of acquisition, net assets 10.8 lakhs. Right? 10.8 lakhs is the net assets. In this, the share of the parent company is 70%. So 10.8 into 70%, which is 7,56,000. This is the parent company share in the net assets of the subsidiary company on the date of acquisition. And the cost of investment is how much? 10 lakhs. So the cost of investment is 10 lakhs. Parent company share in the net assets of the subsidiary company 7,56,000. So what will be the difference here? 10 lakhs minus 7,56,000. 2,44,000 is the excess amount you are spending. This will be treated as goodwill. Actually, in this question, they are asking cost of control also. So the cost of control is goodwill, 2,44,000. I think 2,44,000, we got it. See this, 2,44,000. Okay, 2,44,000. Okay. Now see the remaining facts, sir. In the 4 consecutive years, B Limited fared badly and suffered losses of 2,50,000, 4 lakhs, 5 lakhs, 1,20,000 respectively. Sir, you acquired subsidiary company on 1/4/2011. What happened? 11, 12, 12, 13, 13, 14, 14, 15. 4 years, they continuously suffered a losses. Okay. Thereafter, in 15-16, B Limited experienced a turnaround and registered an annual profit of 50. Next 2 years, 16-17, 17-18, B Limited recorded annual profit of 1 lakh, 1,50,000 respectively. Next 3 years, sir, that is 15-16, 16-17, 17-18, subsidiary company got profits. See, 4 years from the date of acquisition, subsidiary company suffered losses. After that, subsidiary company earned profits. Now they are asking show minority interest for the purpose of consolidation at the end of each year. So at the end of each year, they are asking minority interest. What is minority interest? Minority shareholders share in the net assets of the subsidiary company. This is what we have calculated. Okay. Now you see here, if I calculate minority interest, what is the date of acquisition in this question? 1/4/2011, right? So 1/4/2011, minority interest share is 30%, sir. 30%, right? In the subsidiary company, share capital how much? 10 lakhs. In that 30% is the share of minority shareholders. And then also they have a reserves and surplus of 80,000, correct? 80,000. 80, 30%. So therefore, we will get 10,80,000 into 30%. 3,24,000 is the opening minority interest. That is on 1/4/2011 minority interest. Now you see, what happens is, next every year what happens, you observe. 11, 12, there is a loss, correct? There is a loss. How much is the loss in the year 11, 12 in the subsidiary company? 2,50,000 is the loss. 2,50,000. Now this loss of the subsidiary company will be shared between the shareholders. Parent company, minority interest. Minority interest share is 30%, sir. 2,50,000 into 30%. So it will be 75,000 loss. Okay. Sir, this 3,24,000 is the minority interest balance, sir. Which balance, sir? This is credit balance. Generally, minority interest will show credit balance. Why? Because minority interest means what, sir? Minority shareholders share in the net assets of the subsidiary company. I told you the logic also. Being a parent entity, you are incorporating 100% assets and liabilities of the subsidiary company, but 100% is not belongs to you. In this case, if you see, 70% only parent company had, remaining 30% minority shareholders had. But in the consolidated balance sheet, sir, 100% of the assets and liabilities of the subsidiary company is acquired by whom? Incorporated by whom? Parent company. That's why out of the net assets of the subsidiary company, what is the share which is belongs to minority shareholders? We will calculate and we will show in the liability side of the balance sheet, credit balance. But see, suppose next year your subsidiary company suffered a loss. In that loss, what is the share of minority shareholders? 75,000. So from this 3,24,000 minus 75,000, we will adjust. It will be adjusted against the minority interest. So at the end of the year, what happens? 3,24,000 minus 75,000. So the balance is 2,49,000, still credit balance. Okay. Next year, again, 12,13, again loss, right? What is the loss? Here, 4 lakhs. See this, 4 lakhs is the loss. In this 4 lakhs, what is the minority interest share? 30%. So 4 lakhs into 30%, it will be 1,20,000. So 1,20,000 we will adjust against the credit balance of minority interest loss. So now it will become 1,29,000 at the end of second year. Again third year, you see 13, 14, again there is a loss. This time the loss is how much, sir? 5 lakhs. You see this 5 lakhs. Now important point, everybody please observe. In this loss, the minority shareholders share is 30%, which is 1,50,000. 1,50,000. Now you see, sir, minority interest credit balance is 1,29,000, sir. But current year subsidiary company earned a loss of, suffered a loss of 5 lakhs. In that minority shareholder share is 1,50,000. So if I adjust this 1,50,000 minority interest 1,29,000 minus 1,50,000, it will be 21,000. Debit balance will come. Debit balance will come. Minority interest will become a debit balance. Case 21 say, which is not possible. You cannot show minority interest as a debit balance, because credit balance indicates that as a parent company, maybe out of the total net assets, this much belongs to minority shareholders, but we have incorporated everything. So this is the amount payable to the minority shareholders, hypothetically. That's what we are showing in the consolidated balance sheet. What would be the reverse situation? Reverse situation is also possible. For example, minority interest showing a debit balance indicates that this is the amount payable by minority shareholders to the parent company. Not possible, because as and when subsidiary company earning a profit, no problem. When the subsidiary company is suffering a losses, what happens is in the loss is the share which belongs to the minority shareholders. So that the minority interest balance will become a debit balance. The standard says the moment it becomes a debit balance, you do one thing. This 21,000 don't show minority interest debit balance. This is adjusted to the parent company. Here A limited reserves you need to adjust. That means this 21,000 loss we have to adjust it to the parent company reserves. That means minority interest will become what? Nil. Minority interest will be shown credit balance. That's it. Sir, but minority shareholders loss is there, sir. Yes, this loss will be adjusted to the parent company reserves. Again, when the subsidiary company started earning profits, in that profits, whatever the share belongs to the minority shareholders, to the extent the loss previously adjusted to the parent company reserves, we will adjust. I will show you. See this. So at the end of the third year, minority interest is how much? Nil. And the minority shareholders loss 21,000 will be adjusted to A limited reserves. So how much we adjusted to the A limited reserves? 21,000. Next, what happened? You tell me. 14, 15 year. I think 14, 15 also there is a loss. 1.2. See this. What happens now? Loss 1.2 lakhs. Again in this 1,20,000, 30% is the share of the minority shareholders. 1,20,000 into 30%. It will be 36,000. So this 36,000 is also adjusted to A limited reserves. So A limited reserves will be adjusted. Yes. So previously how much we adjusted? 21. Minority shareholders share loss. This year 36. So total how much loss of the minority shareholders will adjust to the parent company reserves? 57. And minority interest is nil. At the end of this year, minority interest is how much, sir? Nil. Understand, sir? Sir, minority interest cannot show debit balance. So minority shareholders share in the loss of the subsidiary company. The moment it is becoming debit, it has to be adjusted to the parent company reserves. Because see, hypothetically, that question will not arise. How can you show in the parent in the consolidated balance sheet asset side I will show minority interest? It is like a amount which is recoverable from the minority shareholders by the parent company. That scenario is not possible. So that's why minority interest will show debit balance, credit balance. The moment it becomes a debit balance, that means the minority shareholders share in the losses of the subsidiary company will be adjusted to the parent company. Okay. Now next what happened? 15-16 year. So in the year 15-16, what happens? You see, they earned a profit. The subsidiary company earned a profit. See this. Subsidiary company earned a profit of 50,000. 50. See this. In this 50,000 profits, what is the share belongs to minority shareholders? 30%. 15,000. Already minority shareholders loss adjusted to the parent company reserves, right? 57,000. Now the moment again minority shareholders subsidiary company getting profits, in that the minority shareholders share 15,000. Now you need to adjust it back to the parent company reserves, because your loss we have adjusted to the parent company. Now when you got a profit, give it to them, give it to these reserves. So 57 minus 15. So now the parent company reserves 42,000. Still the loss of the minority shareholders adjusted to the parent company reserves is 42, and still minority interest is negative, nil. Nil. Okay, next 16-17 again. You see 16-17 also there is a profit 1 lakh. See this, there is a profit of 1 lakh. In this 30% belongs to minority shareholders, 30,000, and now this 30,000 adjust against the losses. Your loss adjusted to the parent company, recover it, 30,000. So still 12,000 loss of yours is adjusted to the air limited reserves. Now the last year 17-18, you see the profit of the subsidiary company is 1.5. Now in this 1.5, 30% belongs to minority shareholders. 1,50,000 with 30%, 45,000. Now see this. Out of this 45,000, 12,000 the losses of the minority shareholders, which is already adjusted to the parent company reserves, adjust it so that it will become a nil. Still there is a balance of how much, sir? Out of 45, 12,000 if I adjust, so the balance is 33,000. So this 33,000 is what? Minority interest credit balance. Again, subsidiary company started earning profit. That means minority interest by minority shareholders share in the net assets of the subsidiary company is now 33,000. So therefore, in this problem, what is the new point you learned? Minority interest cannot show debit balance. The moment, because of the continuous losses of the subsidiary company, if the minority interest is converting into debit balance, please adjust to the parent company reserves. When when parent subsidiary company started earning profit, then minority shareholders share already to the minority shareholders loss, which is adjusted to the parent company reserves, you reverse it back. Okay. See, this I have solved through this table, sir. This is how I presented. So if you follow this presentation, there is no wrong. You do this question absolutely correctly, sir. See this. Year opening balance, 30% share in the P&L account, total adjusted to minority interest, adjusted to parent company reserves. Closing balance, whether minority interest is showing credit balance or debit balance. Debit balance means adjusted to the parent company reserves. Opening, we started with 3,24,000 credit balance. First year there is a loss. In that loss, our share is 75, which is adjusted to the minority interest. So minority interest closing balance is 2,49,000. Again, second year we got a loss. In that the loss is our share is 1,20,000. We have 2,49,000. From that 1,20,000 we adjusted, so it will become 1,29,000 closing balance. Third year also we have loss, 1,50,000, but our credit balance is 1,29,000. See this excess 21,000 we adjusted to the parent company reserves, 21,000. So minority interest credit balance will be nil. Minority interest debit balance, which is 21,000, which is adjusted to the parent company reserves. Okay, 21. Next year also there is a loss of 36,000, which is adjusted to the parent company reserves. So the minority shareholders loss adjusted to the parent company reserves, total 57,000. 15-16 there is a profit 15,000 adjusted to the parent company reserves, 40. Now it will become 42. Again there is a profit, adjust it to the extent the loss already shared to the parent company reserves. Now it will become 12,000. And lastly 45,000 is the minority shareholders share. After adjusting to the parent company reserves, 12,000, balance will be 33,000, which will be the minority interest closing balance. So note, minority interest cannot show debit balance as it is irrecoverable. So minority interest can never show debit balance. So this is one question, sir. Please see this question carefully. I have analyzed it properly. So see 2 or 3 times. I think you will get this question. Very, very important question. Okay. Next, sir, consolidated statement of P&L account. So we have covered consolidated balance sheet. We solved some questions. Now see consolidated statement of P&L account, how it will be prepared. No separate calculations are required, sir. Like in case of consolidated balance sheet, cost of control, minority interest, reserves for consolidated balance sheet, all these things we have done. Subsidiary company profits were analyzed into pre-post, like this we have done. But here, no such things. Very simple way. Parent company P&L, subsidiary P&L, just combine it. Line by line addition of incomes and expenses. Only thing is that if there is any intercompany transactions between the parent and subsidiary, the effect you eliminate, because parent and subsidiary we are treating it as one economic entity. Suppose parent sold goods to subsidiary. Individually, that is revenue to the parent, expenses to the subsidiary. But when you look at parent and subsidiary as one entity, is it a revenue for the group? No. Is it an expenses for the group? No. Which is happening within the group only. So effect of that intercompany transactions we need to eliminate. That is the major thing in when you are preparing consolidated P&L account. Rest of the things is very, simple. Line by line addition, nothing but. So solve 1 or 2 questions are there in the study material. You solve them. I think consolidated P&L is over. Suppose see here, illustration number 15 from ICA study material, sir. One question we are going to see here. There is a company H Limited and it's a subsidiary S Limited. Parent is H, subsidiary is S. Following information for the year ending 31st March 2013 given, sir. Parent company rupees in lakhs, subsidiary company rupees in lakhs. Sales and other income, increase in inventory, raw materials consumed, wages and salaries, production expenses, administration expenses, selling and distribution, interest, depreciation. So these are the information they have given in respect of parent and its subsidiary. And you look at the other information. H Limited sold goods to S Limited 120 lakhs at a cost plus 20%. Parent company sold goods to subsidiary company. So parent point of view, revenue from operations, subsidiary point of view, purchases, cost. From both places, we need to eliminate this. Because group point of view, these are not incomes, these are not expenses. Within the group only they are happening, right? And inventory of S Limited includes such goods valuing 24 lakhs. See, out of the goods which is sold by the parent company to the subsidiary, still 24 lakhs worth of stock still remains unsold. In this stock, whatever the unrealized profit is there, that has to be eliminated from the inventory. That is also important point. We have, in consolidated balance sheet also, I explained you, downstream transaction, upstream transaction, any unrealized profit we need to eliminate when you are preparing the consolidated financial statements. So similarly, here, whatever the unsold inventory is there, which is purchased from parent company, in that stock, whatever the unrealized profit is there, group point of view, that is not a profit, eliminate it. And also, you see, admin expenses of S Limited, subsidiary company, include 5 lakhs paid to H Limited as a consultancy fees. Sir, subsidiary company paid 5 lakhs to parent company H Limited as a consultancy fees. So parent company books, it is other income. Subsidiary company books, it is expenses. From both the places, eliminate for consolidation purpose. Similarly, selling and distribution expenses of the H Limited include 10 lakhs paid to S Limited as a commission. So parent company paid commission to the subsidiary company. So subsidiary point of view, other income, parent point of view, expenses. From both the places, eliminate for consolidation purpose. H Limited holds 80% of equity share capital of 1000 lakhs in S Limited prior to 11-12. So before 11-12 itself, we made investment in S Limited 80% of the shares. Okay. H Limited took credit to its P&L account the proportionate amount of dividend declared and paid by S Limited for the year 11-12. Okay, no problem. For the year 11-12, whatever the dividend we received, we credited to P&L account. Maybe this dividend is given from post-acquisition profits because we invested before 11-12. After 11-12, they have given a dividend. So that dividend obviously given from post-acquisition profit. And we credit to P&L account, which is correct only. Okay. Prepare consolidated statement of P&L account. So now we need to prepare consolidated statement of P&L account. How you are going to prepare the consolidated P&L account? The format, same as per schedule 3. Revenue from operations, so other income, total revenue. Then Expenses is cost of materials consumed, purchase of stock in trade, change in inventories of the finished goods, work in progress, stock in trade, and what is that? Employee benefit expenses, finance cost, depreciation and amortization, other expenses. Then total expenses, total revenues minus total expenses, profit and loss for the period. Same thing. So you see first revenue from operations, other income. Together they have given this. See this. So parent company 5,000, subsidiary 1,000. Make an adjustment. In the parent company 5,000, 120 lakhs which is sold to subsidiaries there now minus 120. And also in the subsidiary company 1,000 lakhs, they have received 10 lakhs commission from the parent company, right? That is eliminated. And also in the parent company 5,000, they have received a consultancy fees of 5 lakhs from the subsidiary, eliminate it. So simple. So you can do simply 5,000 plus 1,000, total 6,000. From this, whatever the intercompany revenues are there, eliminate. Then you will get the total revenue for consolidation purpose. I will show you how it is going to be solved. So first you take revenue from operations, working note 1, note number 1. See this, how they have done. Sales and other income given. H limited 5, S 1,000, total 6,000. Between them, what are the incomes? See the sales. Parent sold to subsidiary, eliminate 120. In this 6,000, that 120 is there, eliminate. This is not revenue for the group. And also consultancy fees, subsidiary paid to parent, which is included in the parent company revenue, eliminate it because it is not revenue for the group for consolidation. Commission, which is paid by parent to the subsidiary. In the subsidiary company revenue, this is included, eliminate. Group point of view, this is also not a revenue. So the total revenue for the group is 5,865. We need to consider. See this 5,865. Now come to the expenses side. First, cost of materials consumed. So cost of materials consumed is, in the question you see, material consumption they have given. See this raw material consumed. Parent 800, subsidiary 200. So 800 plus 200, total 1,000. But here the important adjustment is, in the material consumption, generally how consumption will be arrived, sir, in financial statements I told you. Raw material consumption, how we are going to find out? Opening plus purchases minus closing. But in the purchases of the subsidiary company, there was a purchases from the parent entity, right? So the purchases is 120. In the consumption, sir, there was a purchases. In the consumption, generally purchases also adjusted. But these purchases are made from parent company. So which is not relevant for the consolidation purpose. So eliminate 120. Important. Now it is 880. Right? So for this, now you add production expenses also. Whatever the production expenses you are incurring now, sir. So that is also part of the consumption. So add. You will get 1,180. Here most of the students are confusing, sir. Very simple, sir. Not confusion. Raw material consumed by parent is this much. Subsidiary this much. Understand, you are a subsidiary company. You purchased material from parent. How consumption is arrived? Opening plus purchase minus closing. So in this consumption, already purchases also included, but these purchases are made from parent. So therefore, for consolidation purpose, this is not expenses for the group. So eliminate. Since this 120 you have already eliminated from the revenue. Similarly, 120 we have eliminating from the expenses. Okay, pa. So cost of materials consumed done. Next, change in inventories of the finished goods. So nothing but increase in inventory, 1,000 plus 200, 1,200. But important point, sir. Sir, change in inventories of the finished goods, sir. Change in inventories, the difference between the opening and closing. So 1,200, 1,200. Closing less opening, or opening less closing, whatever. Generally opening less closing. A negative balance. Generally closing stock will be more than the opening stock. That we will show. In the question they are saying closing less opening. So if you do opposite, it will be minus 1,000 minus 200. So it will be 1,200. But one important point here. Parent sold goods to subsidiary. In the subsidiary stock, there is 24 lakhs, which is purchased from the parent. In this 24 lakhs, there is a profit of 20% because goods are sold at cost plus 20%. That means 120. So this 24 is for 120. How much is the unrealized profit included in this 24? 4. This unrealized profit I need to eliminate. So if I eliminate this 4 from the closing stock of the subsidiary company, it will be only 196. So therefore 1,000 plus 196, it will be 1,196. 1,196 we need to consider. Important. In this point, I think financial statements of the company's chapter itself I told you. So increase in inventory, H limited 1000, S limited 200, unrealized profit eliminated from the subsidiary company inventory 4. Okay, sir. Done. This is also done, sir. Next, employee benefit expenses, anything is there? Yes. Wages and salaries, 800 plus 150, total 950. Any adjustments to it? Nothing. So 950, I think. Next, finance cost is there. Interest, 100 plus 50, 150. Finance cost, 150. Just line by line addition. Next, depreciation and amortization, I think line by line addition. Depreciation, 150, 150. We got it. Next, remaining and all other expenses. What are other expenses here? Production expenses already added to consumption. Admin expenses, selling and distribution expenses. Now coming to admin expenses, sir, 200 plus 100, 300. And the administration expenses of subsidiary company include 5 lakhs paid to H limited. We need to eliminate. Already we eliminated from the revenue. Now we need to eliminate from expenses also. So therefore subsidiary company expenses, admin expenses includes 5 lakhs paid to H limited as a consultancy fees. So group point of view, this is not expenses. So if I eliminate this, it will be 95. So 200 plus 95, it will be 295 we need to consider here. 295. See this, I will show you. See this administration expenses, 295. H limited, S limited, paid by S to H. Similarly, selling and distribution, you see, 200 plus 50, 250. But the parent company selling and distribution expenses includes 10 lakhs paid to S limited. So in the parent company selling and distribution of 200, so 10 lakhs which is paid to subsidiary is also included. So we need to consider only 190. So 190 plus 50, it will be 240. So this. So total it will be 535 other expenses. So consider here 535. So we'll get it. So this is how you need to do, sir. Consolidated P&L account. So very simple line by line addition, but make sure that any intercompany transactions are there, you eliminate it. So relating to consolidated P&L, one more question is there. Solve that question. Okay, that's it. Hello my dear students. Hope all of you are fine, doing great. The next topic we are going to cover is accounting for investment in associates in the context of consolidated financial statements. In the beginning of consolidation chapter, sir, I told you in this chapter there are 3 accounting standards. 21, 23, 27. 21 subsidiary consolidation already done. 23, when you have investment in associates, how these investments will be accounted when you prepare consolidated financial statements, that is what we are going to cover in this accounting standard 23. When you are learning accounting standard 23, sir, 2 things, sir. First, understanding the concept of associate company. After that, how investment in associate company will be accounted in the consolidated financial statements. This is the most important area, sir. So if you cover these 2 areas, it will be more than sufficient, sir. You can solve any question. Now let us try to understand first when a company is called associate company. See, basically associate company is a company in which the investing enterprise has significant influence and it is not our subsidiary or joint venture. So a company is an associate company if the investor company has what? Significant influence. And it is not a subsidiary or joint venture. Because if it is a subsidiary covered in AS21, joint venture AS27. So it should not be a subsidiary, it should not be a joint venture, and we should have a significant influence. Then we say it is our associate company. So the most important aspect is what? Significant influence. Now the question arises, sir, what is this significant influence? When we say a company, an investor company has significant influence, see, ability to participate in the financial and operating policy decisions of an enterprise, but not control of those policies is called significant influence. if one company has the power to participate in the financial and operating policies of the investing enterprise, but not control of those policies, then we say we have significant influence. But sir, this is very subjective and theoretical. How can I establish that I have one company has power to participate in the financial and operating policies of the enterprise, but not control of those policies? That's why they are saying that if one company had 20% or more voting power in any other company, then we say we have significant influence, and accordingly that other company will become our associate company. So the bottom line is, if one company had 20% or more voting power in any other company, then it constitutes as significant influence unless otherwise provided. Unless otherwise provided. Okay, 20% or more. Holding 20% or more voting power directly or indirectly in any other company constitutes as significant influence, and accordingly that company will be our associate company. See, in the classroom, first I have given a discussion of associate company definition. See this. Just now I have completed. Which company will be an associate? An enterprise other than subsidiary or joint enterprise in which the investor company has significant influence. Now, how to achieve this significant influence, sir? By having 20% or more control, directly or indirectly. Sir, 20% or more means maybe more than 50% also. No. Because if you control more than 50%, it will be your subsidiary. And in the definition clearly said it should not be a subsidiary. So, an enterprise, basically it is not a subsidiary, but we have significant influence. Then it will be our associate. Significant influence means having at least 20% share capital. See, for accounting purpose, you have to remember this. Of course, legal wise, I mean, when you are reading the law, maybe different combinations you have to test. But here you need to understand that if you have 20% or more voting power in any company, basically that will be constituted a significant influence, and that will be our associate company. Okay, so we understood the concept of associate company. Now I have done some little bit analysis. This knowledge of this is very, very important, sir. Kindly see this. Suppose there is a company A Limited, sir, which is investing in equity shares of B Limited. If A Limited invested in B Limited equity shares, the percentage is less than 20%. Then it's a normal investment, sir. No relationship is established. It is a normal investment. Then in the books of A Limited, the accounting will be done as per AS 13. Accounting for investments. Come to the second scenario. A Limited invested in B Limited more than 50%. More than 50%. That means they have controlling interest. The moment they are having control interest, parent subsidiary relationship will come. And in the standalone financial statements of A Limited, for this investment, the accounting will be done as per AS 13. In the consolidated financial statements of A Limited, being a parent entity, they need to follow AS 21 for consolidation of this subsidiary B Limited, which we already discussed. And the third case, sir, A Limited invested in B Limited, and the investment percentage is 20 to 50%. Invested 20, minimum 20 up to 50. Then the moment there is an investment of 20 to 50, we assume there is a significant influence. It constitutes a significant influence, and B Limited will be associate company of A Limited. A Limited is the investing party or investor. And here you don't have controlling interest, you have a non-controlling interest. And understand, when you are doing the standalone financial statements, this investment accounting will be done as per AS 13, and in the consolidated financial statements, the accounting will be done as per AS 23. That is what we are covering here. So these three cases analysis and the knowledge is very, very important, sir. You keep in mind. Okay. Okay. Now, okay, sir. We are an investor company. We have significant influence in another company. So it is our associate company. We are having minimum 20% shares in voting power in another company. So it is our associate company. So how this investment in associate company will be presented in the consolidated financial statements? Sir, AS 23 has prescribed equity method. For accounting of investment in associates, they have prescribed one method called equity method. Let us try to understand this equity method with one example, sir. With one example. Listen to me very carefully so that you will understand it very easily. See, suppose there are two entities, sir, A Limited, B Limited. A Limited acquired 30% shares in B Limited on 31st March 2025. Date of acquisition 31st March 2025. So obviously 30% shares acquired means A Limited is investor company, B Limited is associate company of A Limited, and on the date the balance sheet of A Limited, on the asset side, investment in B Limited will be there, investment in associate B Limited, 30% shares they have invested, investment in B Limited. Suppose the investment value is 40 lakhs, 40. See this. A Limited individual balance sheet, investment in B Limited is there 40, because that is only relevant for us. Remaining items I am not considering. But when it comes to associate company balance sheet, sir, on the date of acquisition, see this balance sheet is on the date of acquisition, sir, 31st March 2025. Balance sheet on 31st March 2025, sir. On 31st March 2025, when I look at the balance sheet of the associate company, sir, they have property, plant, equipment 70, current assets 30, share capital 50, reserves and surplus 50, suppose. So entire balance sheet 100. This. Right? So A Limited, B Limited. Now I want to prepare consolidated balance sheet as per AS 23. Who will prepare consolidated balance sheet? Investor, A Limited. Consolidated balance sheet. A Limited consolidated balance sheet on 31st March 2025. As per AS 23. These are individual balance sheets. Now listen to me carefully. The standard says, sir, standard says, as an investor, initially you prepare consolidated balance sheet, the investment will be initially measured at cost, presented at cost. What is the cost of investment, sir? 40. So in the consolidated balance sheet, sir, asset side, investment in B Limited 30%. How we are going to present it? See this. Share in net assets on the date of acquisition in the associate company. Add goodwill or capital, sir. If it is a goodwill, add. Capital is a minus. That means cost of controls we need to calculate. See this. On the date of acquisition, like in case of AS 21, we have done cost of control step. Even in case of investment in associate, we need to calculate cost of control. How to calculate it? Take cost of investment 40. Compare with the investor company share in the net assets of the investor company share in net assets of associate company. What is the net assets of the associate company? See this. Either assets plus liabilities minus assets minus liabilities. Here assets is 70, 30, 100. No liability. So net assets is 100. Or share capital plus reserves and surplus. Net assets can be ascertained either assets minus liabilities or share capital plus reserves and surplus. So share capital, reserves and surplus 50, 50, 100. So therefore share capital plus reserves and surplus, both of them together, or else I will share capital 50, in that 30%, reserves and surplus of associate company 50, in that 30% is my share. So therefore 100 into 30, so it will be 30. So see this, investor company cost of investment is 40, but we are getting net assets from the associate company on the date of acquisition 30. So how much excess we are spending, sir? 10. This will be treated as goodwill, like in AS 21. Here also goodwill. So this goodwill we need to show separately 10, and share in the net assets 30, total investment 40. This is how we need to present in the books of, in the consolidated balance sheet of investor company initially on the date of acquisition. So initially the investment in associate will be shown in the books of investor in the consolidated balance sheet at cost. But look at the breakup, sir. Share in net assets shown separately, goodwill or capital reserve has to be shown separately. For that, we need to calculate cost of control. Like in AS 21, compare your cost of investment with the share in the net assets. Okay, so 40 we need to present. So now look at this. See what they're saying, equity method. The investment is initially recorded at cost. Any goodwill or capital reserve arising during the acquisition is identified. Sir, it is about presentation, sir. Overall investment value 40 only, but AS 23 says if you are an investor and you are preparing consolidated balance sheet for investment in associate company, your investment will be shown at cost only. The cost is 40, but the breakup is share in net assets, calculate cost of control, then you will get goodwill or capital reserve. Like that you need to present. Sir, shall I need to add assets and liabilities line by line? No, because that is parent company. Line by line addition of the subsidiary company assets and liabilities. That is AS 21. Here you are not a parent company. You are just having 30% shares. That means you don't have controlling interest. You cannot take assets and liabilities of the associate company. You are the minority shareholder. See, I will tell you one important point here. One small interesting point. Suppose, sir, in B Limited, as a Limited, how much I had, sir? I had only 30%. That means remaining 70%, suppose, had by C Limited. So C Limited is what, sir? It is a parent company. To B Limited point of view, parent company. This is A Limited is what, sir? A Limited is minority interest, na, sir. Parent company point of view, this is minority interest because they are having 30% and they are having 70%. So when you are consolidating the financial statements of the parent company, you calculate minority interest, na? How you calculate minority interest? Minority shareholders share in the net assets of the subsidiary company. Similarly, here A Limited is a minority shareholder. And in the same manner, we are calculating in the net assets of the associate company. What is my share? In this net assets is 100. In this, my share is 30%. 30% means 30. So that's why you see share in the net assets 30. But how much investment I am spending? 40. Therefore, cost of control is 10. Cost of control is 10. Look at how we are presenting. Now some students get it out. Sir, A Limited, this is investor company. Why you are not writing remaining items? Sir, remaining items as it is A Limited balance sheet, whatever the items are there, they will come, sir. Line by line addition of A, B will not arise, sir. Here A Limited is not a parent entity. Just we are accounting the investment portion with the associate company. Look, concentrate on how I am presenting the things. For them, marks will be awarded. Overall, it is 40 only, but share in the net assets and goodwill or capital. So initially, this is how the presentation will be. So this is in the year of acquisition. Suppose next year what happens, very interesting. Listen. Associate company, balance sheet on 31st March 2025 given. Next year, balance sheet on 31st March 2026 of the associate company. I'm bothered about only associate company. Associate company, that is B Limited. Okay. See, B Limited balance sheet next year, what happens is, suppose PP went from 100 to, suppose 70 to 100. Current assets, they went from 30 to 50. Share capital, suppose, remains same, 50. Reserves and surplus, obviously, 100. So look at the last year reserves and surplus of the associate companies are 50. This year, 100. Why? Reserves and surplus increase. Because current year profits are, these are called post-acquisition profits. Post-acquisition profits. After I am acquiring associate company, in the current year, what are the profits of the associate company? 50. Because last year reserves and surplus, 50. This year, 100. That means current year profit, 50. Okay. So this is the balance sheet of the associate company at the end of 31st March 2026. Now look at this. So here I need to prepare the consolidated balance sheet of A Limited on 31st March 2026. How I am going to present it? I am not bothered about the remaining items. Only investment. Investment in asset side. Investment in associate company B Limited. Same 30%. Now how I am going to present it? See this. First my share in net assets. Share in net assets. Initially it is 30 on the date of acquisition. Now add or less. Add share in post acquisition profits. Sir, in the associate company Current year, how much is the profit, sir? 50. In this profit, what is my share? 30%. 50 into 30%, it will be 15. So it will be 45. And initially I got cost of control goodwill. How much, sir? Goodwill 10. So it will be 55. See this. So therefore, every year as an investor, when I am preparing consolidated balance sheet, my investment in associate company, how I am going to present it? What is my share in the net assets of the associate company initially when I acquired? 30. And what is my share in the associate company post acquisition profits? Important. Sir, I acquired associate company on 31st March 2025. Next year, 31st March 2026, the associate company profits is increased by 50. That means the net assets of the associate company increased by 50. You see, the net assets is how much? Share capital plus reserve surplus 150. Last year net assets is how much? 100. That means how much increase in net assets? 50. That increase in net assets I need to add. It is like just now I told, when parent company is preparing consolidated balance sheet as per AS21, they are calculating minority interest na. In the B limited, A limited is minority shareholder, nothing but minority interest. How minority interest is calculated? Simply the net assets, their share in the net assets of the subsidiary company. Similarly, in B limited, what is the share of A limited? 30%. So that means the B limited net assets 150. In that 30% means 150 into 30%, 45. But we invested initially 10 extra goodwill, cost of control. So it is 55. The concept is quite simple, sir. Can I tell you one simple sentence, sir? The investment in the books of investor in the consolidated balance sheet dancing with the tunes of the net assets of the associate company. When the net assets of the associate company increasing, the investment value will also increase. Best example is last year my investment in associate company I have shown 40. This year I am showing 55. Why 15 increase, sir? Sir, that 15 increase is my share in the associate company post acquisition profit. And here the presentation is important. That's what AS23 says. This you need to present like this. Sir, I will show directly investment in B limited 45. No, you won't get marks. Presentation. Share in net assets 30. Add share in the post acquisition profit. Suppose if it is losses minus losses. Add cost of control, goodwill or capital, sir. 55. So therefore, here what is the entry they have written? A simple, sir. Investment account debit to P&L account. How much? 15. And see, this is the consolidated balance sheet, sir. Similarly, when A limited investor is preparing consolidated P&L account, when they prepare consolidated P&L account, other incomes, revenue from operations, other income. In other income, they will show share in profits. Our associate company is there na, B limited. In the B limited profits, our share 15, that will be created to P&L account. That's why I have written here investment account debit to P&L account. Investment account debit to P&L account. In the consolidated balance sheet investment account, I will add 15. In the P&L account, consolidated P&L account, I will credit 15. Hope you understand what I am speaking. So therefore, whoever wants to leave AS23, please don't leave. Very 10 minutes, you will understand everything. Simple. First thing is, I am investing in a company. My investment size is 20 to 50. Okay. So when I am preparing the consolidated balance sheet, I need to show this investment on the asset side. Initially, it will be shown at cost, but I should give a breakup. What is my share in the net assets of the associate company? And I need to calculate cost of control. Cost of control is nothing but my cost of investment I will compare with share of net assets. It is more goodwill, otherwise capitalism. Initially, you need to present like this. Over next year, you look at the associate company balance sheet. Look at the net assets. How much increase in net assets? In that increase, what is your share? Add to your investment value. And I also told you one more interesting point. In the consolidated financial statements of as per AS21, how you are calculating minority interest? Exactly that minority interest is. Investor company is nothing but minority shareholder. In the B limited net assets, what is my share? I have calculated. Okay. In the consolidated P&L account, we need to show this. That's it. I think accounting is done. I will take one more example, sir, so that you will understand better. See this example. Suppose A Limited, there is a company, sir. They have invested in 25% shares of B Limited. So that means B Limited is an associate of A Limited. Amount invested 4 lakhs, sir. Cost of investment. Date of acquisition 31st March 2011. Now B Limited of balance sheet of B Limited. That means associate company balance sheet they have given, sir. PPE 5 lakhs, investment 2 lakhs, current assets 3 lakhs, share capital 4 lakhs, reserves and surplus 5 lakhs. Prepare consolidated balance sheet with associate. I will do this. Very interesting. See this. I want to prepare what? Consolidated balance sheet of which company? A Limited. Right? A Limited is the investor company. So A Limited books, A Limited. I need to prepare consolidated balance sheet as per AS 23. So when I prepare the consolidated balance sheet, look at the information given. Will they have given A Limited figures? No. Only investment in B Limited given. But they have given the balance sheet of B Limited. Always associate company balance sheet they will give, sir, because the net assets I need to calculate. So initially the investment is 4 lakhs. Initially what I need to do, sir? So investment in asset side I need to show in the consolidated balance sheet investment in B Limited associate company. How much investment? 25%. Okay. So first I need to calculate what? Cost of control I need to calculate. In cost of control, what is my cost of investment in B Limited, sir? 4 lakhs. So take 4 lakhs. Any pre-acquisition dividend minus no pre-acquisition dividend. And what is the A Limited share in net assets of B Limited? A Limited share in net assets of associate company B Limited on the date of acquisition. So on the date of acquisition, what is the position, net assets position of the B Limited, sir? See this. Net assets position is 10 lakhs. Share capital plus reserves and surplus, you will get net assets 10 lakhs, sir. So in this 10 lakhs, 25%. 10 lakhs into 25%. That means 2,50,000 is the share in the net assets of the associate company. And my investment is 4 lakhs. So what is my goodwill, sir? 1,50,000. So therefore in the consolidated balance sheet, share in net assets, how much we show? Share in net assets 2,50,000 we will show. And then next goodwill we show separately. Add goodwill. How much? 1,50,000. So total 4 lakhs. This is how the presentation will be done. See this. If you want, I will show you this. So see this. How presentation will be done. When you prepare consolidated balance sheet of B Limited with AS23, consolidated balance sheet of A Limited with B Limited, asset side, schedule 3, non-current assets. In that non-current investment, see this, investment in associate, first share in net assets, add goodwill, 4 lakhs. And we cost of control, if they calculate, this is how they will done. Cost of control step. Amount invested, how much? 4 lakhs. Share in net assets 2,50,000. So goodwill 1,50,000. So this is on 31st March 2011. Next year what happened, you see. 31st March 2012 associate company balance sheet given. Next year net assets is 17 lakhs. Last year net assets 10 lakhs. So how much increase in net assets? 7 lakhs. In that 7 lakhs, what is the share of the investor company? 25%. That means 1,75,000. That 1,75,000 we need to add. So therefore next year, that is on 31st March 2012, 31st March 2012, if I am preparing consolidated balance sheet of A Limited, so what I will do, sir? Simple. Investment in B Limited I will take. In that, first share in net assets initially 2,50,000. Now current year, what is the post acquisition profits? My share in profits. The associate company current year profits is, I think 7 lakhs, sir. In that 25%. So it will be 1,75,000. And then add goodwill. So it will be, goodwill is how much? 1,50,000 already we calculated. So therefore, what is the total investment? 2,50,000 plus 1,75,000 plus 1,50,000. It will be 5,75,000. See this. So that means last year, what is your investment value in the books consolidated balance sheet, sir? 4 lakhs. This year, 5 lakh 25. How much increase? 1 lakh 75,000. What is that increase? Associate company increase in net assets. To that extent, we have to increase the asset value. I mean investment value. That's what. See this. See how they have presented. Investment in associate. Share in net assets 2 lakh 50. Goodwill 1 lakh 50. Share of profits 1 lakh 75. Total 5 lakh 75. And in the consolidated P&L account, other income, share of profits, current year 1,75,000 we will show. So the investment entry is investment in associate to reserves and surplus 1.75, 1.75. Hope you understand, sir. So if you look at the equity method, what they are saying, initially the investment will be recorded at cost. Next, the carrying amount of the investment is adjusted based on the change in the investor share of the investee's net assets after the acquisition. See this. According to the changes in the net assets of the investee company, associate company, we need to change the carrying amount of the investment. And in the consolidated P&L account of the investor company, whatever the share in the profits we are getting, that will be shown on the credit side as other income. And any goodwill or capital reserve arising on acquisition of associates would be included in investment, but disclosed separately. So observe the presentation, sir. Observe the presentation. Hope you understand AS23 accounting treatments. Now, finally, sir, we can draw some conclusions, sir. This presentation you follow, sir. See, when you are preparing consolidated balance sheet of an investor company, when they have investment in associate, how it will be presented in the consolidated balance sheet? Asset side, non-current assets, non-current investments, investment in associate company. This is presentation as per AS23, sir. First, share in net assets, sir. What is the initial share in the net assets of associate company? That you will show. And what is the share in the profits of associate company, post acquisition profits? After acquiring associate, what is the profit they generated? Add. Any goodwill or capital reserve, add or less. Goodwill, add. Capital reserve, minus. You will get the investment value. This is the presentation of investment in associate in the consolidated balance sheet. When you are presenting consolidated P&L account of the investor company, whatever the share in the profits of the associate company I am getting, sir, I will credit to other income, share in profits. And also they are saying, if any pre-acquisition dividend you have received, that means any dividend given by associate company from the pre-acquisition profits, I know, I already told you in AS21, any dividend received from pre-acquisition profits, it is adjusted to cost of investment. That is what. Pre-acquisition dividend if you receive, less transfer to investment account. Because this pre-acquisition dividend which is given by the associate company will be adjusted to the cost of investment. So adjust transfer to investment, show the nil value here. Presentation purpose only, but predominantly this one. Okay, that's it, sir. So this is how things will be done, sir. And how to calculate cost of control, similar to AS21, sir. What is the cost of investment minus any pre-acquisition dividend received from the associate company, reduce it. And what is the share in the net assets of associate company? You will get goodwill or capital, sir. And what is the, how to calculate the carrying amount of investment? I told you, first share in the value of net assets. And next share in the post-acquisition profits. Next goodwill or capital reserve, sir. This is the presentation you follow. And any dividend paid by associate company, you minus it, sir. Sir, suppose if associate company has given a dividend, sir, what happens, you tell me? When associate company gives a dividend, sir, to that extent net assets will decrease, no, sir. So therefore, automatically, my investment value will also be decreased. My share in the dividend, which is given by associate company, will be decreased, which will reduce my investment value. So simple conclusion is, as an investor, my investment in associate, I will show in the consolidated balance sheet. Every year, my investment carrying amount, I will adjust according to the changes in the net assets. If the net assets of associate company increases, I will increase. If decreases, I will decrease. But the presentation, how you are going to done is matters. So this is the treatment of accounting for investments in the associate company as per AS23. That's it. Now see one question from AS23, sir. Illustration number 1 from ICA study material. See this question, sir. Suppose there is a company A Limited which acquired 45% of B Limited. So A Limited is what, sir? Investor company, B Limited is associate company. 45%. On 1st April 2011, the price paid was 15 lakhs. The cost of investment is 15. Following are the extracts of the balance sheet of B Limited as on 1st April 2011. B Limited associate company balance sheet extract given, sir. Paid up equity share capital 10 lakhs, securities premium 1 lakh, resource and surplus 5 lakhs. B Limited has reported a net profit of 3 lakhs and paid dividend of 1 lakh for the year ending 31st March 2012. So invested on 1st April 2011. So 11-12 is the current year. So next year, 1st April 2011 is the date of acquisition, sir. On the date, the position given. And in the year 11-12, this company, associate company has earned a profit of 3 lakhs. And they have paid a dividend also. Calculate the amount at which the investment in B Limited will be shown in the consolidated balance sheet. Sir, at what value the investment will be shown in the consolidated balance sheet on 31st March 2012? That is what they are asking, sir. Very simple, sir. Initially, sir, at what value investment will be shown? Can you tell me? Initially, investment will be shown at cost. So first on 31st March 2011. So in the consolidated balance sheet of A Limited, asset side, non-current assets, in that non-current investment, in that investment in associate company, that is B Limited. First share in net assets I will show. So, and cost of control. If I calculate cost of control, what is the cost of investment, sir? At what value investment is made? 15 lakhs. 15 lakhs is the cost of investment. And what is the A Limited share in net assets of B Limited on the date of acquisition? Sir, on the date of acquisition in the books of B Limited, the net assets is equity share capital plus reserves and surplus. You add these three. 10, 11, 5 lakhs. Total 16 lakhs is there, sir. 16 lakhs. On these 16 lakhs, what is your share as a investor? 45%. So 16 lakhs into 45%. It will be 7,20,000, sir. So therefore, initially your cost of investment is 15 and your share in the net assets is 7,20,000. So therefore, how much extra? 7,80,000 you are investing. So that will be your goodwill. So initially, in the share in the net assets, I will write 7,20,000 and add goodwill, I will write 7,80,000. So total investment value will be cost, which is 15 lakhs. This is the initial presentation we do. Initial presentation on 31st March 2011. Next 31st March 2012, how presentation will be done? So A Limited consolidated balance sheet, sir, I will prepare. And same asset side, non-current assets, in that non-current investments, in that investment in B Limited. Investment in B Limited. How presentation will be done, sir? As I already told you, first is share in net assets. Share in net assets. What is the share in net assets? 7,20,000. So 7,20,000 and add share in profits. Share in profits, sir. Share in profits. What is the share in profits, sir? The important, sir. What is the current year profit, sir? 3 lakhs. Current year profits, net profit is 3 lakhs, sir. But how much dividend they have given from the current year profit, sir? 1 lakh dividend they have given. So out of this 3 lakhs current year profits, 1 lakh dividend they have given, sir. So if you calculate, see this, share in profits, current year they are earning a profit of 3 lakhs. In this, as a investor company, my share is 45%. 3 lakhs into 45%. So it will be 1,35,000. And also less dividend, sir. Sir, when they give dividend, obviously the net assets will decrease, na, sir. How much dividend they have given? 1 lakh. In that, 45% of my share will be decreased. So therefore, 45,000 I need to minus. So therefore, 7,20,000 plus 1,35,000 minus 45. It will be 8,10,000 plus initially we calculated goodwill. Goodwill. How much? 7,80,000. So therefore, you see 8,10,000 plus 7,80,000. So 15,90,000 is the value at which investment will be carried in the balance sheet. 15,90,000. You see 15,90,000. See this 15,90,000. So this is the carrying amount of the investment, 15,90,000. First share in the net assets. See this, share in the net assets, 7,20,000. And then profit during the year, 1,35,000 add, less dividend, 45. And finally goodwill, so carrying amount of the investment. So in the balance sheet, when you are presenting, sir, you present like this. In the balance sheet, when you are presenting, please present like this. Share in net assets, share in profits, less dividend, add goodwill or capital reserve, you will get the balance. Okay, this is how the problems will be done. Every kind of problem, I mean same problem, sir. How investment will be shown. Initially investment will be shown by giving a breakup like this, and later on every time when the net assets increases, accordingly increase your share. When the in the name of dividend, if they decreased, you also decrease your share. That is what we need to do, sir. That's it. This is accounting standard 23, sir.